So welcome my friends, this is Professor CA Rohit Shroff and I welcome you on behalf of JK Shah classes. This is a quick revision video, a quick marathon video for November 23 CA final students. If you see this video, you will be able to revise a lot of things in a very short time. So when you go back to your books, your efficiency increases. Here in this video, I am going to focus mainly on the other chapters. So I understand my friends, a lot of students are done with the standards on auditing, they are done with company audit, they are done with professional ethics, but the chapters that they are facing problem is other chapters. My friends, if you see these chapters, you will be in a position to revise the chapter. Also, I have discussed all the question bank, the notes that I have given to you consist of all the questions asked in the past. So even if you do these notes, you are in a position to score very good marks. So our discussion throughout the video will be into parts. Firstly, we'll be discussing few other chapters such as NBFC, we'll be talking about peer review, we'll be talking about due diligence, forensic audit, internal audit, management audit, liabilities of auditor, CFS, PSU, a lot of other chapters. After that, we will be discussing the company audit, we will be discussing CARO, we will be discussing questions based on CARO. So if you are aware about CARO, you have prepared CARO, what I will request is at least go through the question bank of CARO. We will also discuss the question bank of professional ethics. I know you are very well prepared for professional ethics, everyone has taken extra efforts, but I want you to go to the question bank and see whether you are able to interpret the question, recollect the correct clause number, then move ahead with a small standard series that I have put at the end, that is SA 700 series. I have not included all the standards. 700 series is important. ICS is focusing a lot on audit report, so I will insist go through that particular series as well. If you have already prepared, you can skip that particular part, but prepare the other chapters and see the question bank of professional ethics and company audit. Without wasting any further time, let us move on to the discussion of the other chapters. So let us begin with a very important chapter, NBFC. It has been in the A categories of the chapter, asked frequently, very important, and yes, a few amendments as well. So NBFC, I have categorized this into 3 parts. We will be studying the whole chapter in 3 parts. All the other chapters will be dividing into parts, so it gets easier for you to understand. Part 1, we are going to discuss the meaning, registration, types of NBFC and bank versus NBFC. Type 2, we are going to discuss the NBFC prudential norms, classification of frauds by NBFC, audit checklist and differences between the Division 2 and the Division 3. Part 3, we are going to talk about compliance with CARO 2020, auditor's duty and the audit procedure. So without wasting any time, let us dive on to part number 1 and let us understand what are we supposed to do in these 4 questions. So part 1, what we are going to discuss is 4 things: meaning, registration of NBFC, types of NBFC and banks versus NBFC, and we'll discuss the questions as well. So NBFC, definition of NBFC is given under 45 IF of the RBI Act. What they say is, what is an NBFC? A financial institution which is a company, a non-banking institution which is a company with a principal business, of receiving of deposits or lending in any manner. So firstly, let us understand what do you mean by principal business. So principal business of receiving deposits and lending in any manner. When you will call this as principal business? When the financial assets constitutes more than 50% of the total assets. Now what do you mean by financial assets? Financial asset means what? Loans, investment in securities, advances. So let us say, for example, if they have total 50 crore of assets, out of this 50 crores, more than 25 crore of assets should be financial assets. Secondly, income from financial assets should constitute more than 50% of the gross income. Let us say gross income is, for example, let us say 5 crores. Out of this 5 crores, at least 2.5 crores should be out of the income from financial assets. So what can be the income from financial assets? On loan, what we can get is interest. Again, investment in securities, what we can get is dividend. So this income from financial assets constitutes 50%. This is and condition. So company's financial assets constitutes more than 50% of total assets, and income from financial assets constitutes more than 50% of the gross income. Thirdly, such other non-banking institution or class of institution as the RBI with the previous approval of central government may by notification specify in the official gazette. So a financial institution, NBFC, which is a company, a non-banking institution which is a company whose principal business is receiving deposit and lending in any manner, and whoever may be notified by RBI in the official gazette. Now, who requires a registration? So they said no non-NBFC shall start carrying on its business without obtaining a valid certificate of registration who has a net own fund of 25 lakh. This limit has been increased to 2 crores since April 1999. So for our purpose, we will consider it as how much? 2 crores. If you have net own funds of 2 crores, you need to obtain a registration. Thirdly, so everyone requires a registration. However, they said to obviate dual regulations. So there are certain laws and regulation which already regulates an NBFC. Now there is one law and regulation already regulating that NBFC. Also RBI will regulate. Hence, to obviate dual regulation, they have exempted a few NBFCs from registration with RBI. Which are those NBFCs? So there are 14 in all. First is housing finance. Why? Because they are regulated by National Housing Bank. Merchant banking companies, because they are regulated by SEBI. Stock exchanges, which are again regulated by SEBI. Companies engaged in the business of stock broking, again regulated by SEBI. Venture capital fund companies, again regulated by SEBI. Nidhi company, regulated by MCA and Government of India. Insurance company, regulated by IRDA. Chit fund companies, regulated by Chit Fund Act. Microfinance company, securitization and reconstruction company, mutual benefit companies, mortgage guarantee companies, alternate investment fund, and core investment company, which is not a systematically important core. We'll discuss what is systematically core important once we goes to type. But in case of a core investment company, whichever core investment company has asset size of less than 100 crore, asset size of less than 100 crore are exempted, they need not have a registration. Or core investment company which has an asset size of more than 100 crore but are not accepting a public deposit are exempted from registration with RBI. So these are the 14 NBFCs which are not supposed to obtain a registration with RBI just because they have some other body regulating them. Third, what are the types of NBFC? So in NBFC can be classified as a deposit taking NBFC or not deposit taking NBFC. That is, they are accepting public deposit or they are not accepting. Whichever NBFC is not accepting deposit will be called as ND. Second is non-deposit NBFCs by their size. So whichever is not deposit taking are classified into size, systematically important and non-systematically important. Usually systematically important NBFCs are NBFCs which are asset size of 500 crores or more. So if it is a ND, I mean systematically important, we will write NDSI. Next, by kind of activities they undertake. So firstly, they were classified whether they accept deposits or they don't accept deposit. Secondly, they were classified as whether they are systematically important or not systematically important. Now, they are classified based on the activities that they do. They are classified into 7 categories. Firstly, investment credit company, which gives loans, advances to everyone, which invests into others, will be called as investment credit. You do not have the whole content you are given in the module of what are these types of NBFC. They expect you to know this on the basis of your inter-CA knowledge in the subject of accounting. You all had NBFC. So investment credit company, infrastructure finance, which obviously deals with infrastructure, systematically core investment company, like I mentioned, whenever they have asset size of more than 500 crore, infrastructure debt fund, non-banking financial company, which deals with infrastructure debt. Next is non-banking company, microfinance institution, which gives loans to lending to small unorganized sectors. Next is non-banking financial company factors, which does factoring. For example, in case of debtors, they provide factoring services. And lastly, non-operating finance holding company, which is again made up by promoters, which is made up by whom? The promoters of the company. So they can set up a different bank and access things. So these are the types of NBFC. But now, however, as per the new amendment, they have classified all the NBFCs into 4 layer. So pursuant to announcement of scale based regulation, which based? Scale based regulation, a revised regulatory framework of NBFC on 22nd October 21 to be effective from 1st of October 22. RBI has revised different facets of existing NBFC classification and regulation like capital requirement, governance, prudential, etc. based on 4 layers. So now they are classified in 4 layers. Which are the 4 layers? First layer is called as the base layer. Second layer is called as the middle layer. Third layer is called as the upper layer. And the fourth layer is called as the top layer. Firstly, let us understand what do you mean by base layer. Base layer, they have NBFCs which are non-deposit taking. So non-deposit taking NBFC which has asset size of less than 100 crores. Non-deposit taking NBFCs which have an asset size of less than 100 crore will be classified in what? Base layer. But however, if you are deposit taking, you will be classified under what? Middle layer. So all deposit taking NBFCs irrespective of the asset size. Then they have given us a few NBFCs based on the activities they carry out. What are the activities that they carry out? So in case of NBFC peer-to-peer, what happens is there are people who requires, whoever has need, whoever wants to lend the money, whoever wants to borrow, are aggregated together. They come under the same group and give credit to each other. It is NBFC peer-to-peer. NBFC account aggregator. Here, they allow the institutions to share the data. Take a multiple organization in the financial sector. These are known as the consent brokers, where they give data about, borrowers to each other. So this is NBFC account aggregator. Third is NOHFC, which we have already discussed, where promoters can, set up a different bank. So non-operating finance holding companies and NBFCs not availing public deposit and not having any customer interface will be classified under base layer. So first, base layer, who will be a non-deposit taking, which has an asset side of less than 100 crore. Based on the activities, firstly is NBFC peer-to-peer platform. Next, NBFC account aggregator. Third is NO, non-operating finance holding company, and NBFC not availing public funds and not having the customer interface. Next, when we talk about middle layer, all a deposit taking NBFC, irrespective of the asset size, whether it is less than 1,000 crore or more than 1,000 crore. But however, if you are non-deposit taking NBFC with asset size of more than 1,000 crore will be covered here, because if you are less than 1,000 crore, you are covered in the base layer. Now, NBFCs again are divided on the based of activities undertaken by them. Firstly is standalone primary dealers. Second, infrastructure debt fund, NBFCs, core investment companies, and housing finance companies and infrastructure finance companies. So here, based on the activity, there are 5. One is standalone primary dealers. Second is infrastructure debt fund, core investment company, housing finance, and infrastructure finance companies. My friends, all these companies, what does the standalone primary dealer do, what does an infrastructure debt fund, all those things they are not included in our syllabus. And this being a quick revision lecture, I'm not going into detail. In our normal lectures, we go into depth, we discuss everything, what are these types of companies, we discuss everything. For example, I have written everything for the students who have attended the full time, what is a systematically core investment company, what is an infrastructure debt fund, what is a NBFC microfinance. But I'm not taking you in the detail of all this concept. Reason being, this is not part of your syllabus for now. So all the November 23 students, you basically focus on how are you supposed to classify this. So right now, if you have any one of you all have a doubt, we have a doubt solving mechanism. You can post a message on the helpline. I will revert you back there, but I'm not going in detail of what NBFCs. So standalone primary dealers. Next was infrastructure debt fund NBFCs, core investment company, housing finance company, and infrastructure finance company will be classified under the middle layer. Coming to the upper layer, NBFCs which are specifically identified by RBI. So they will specifically identify, okay, this particular NBFC will go in the upper layer. And the top 10 NBFC in the terms of their asset size, like how do we have market capitalization based on that? So everyone will have their asset size. Top 10 NBFCs will fall under the upper layer. So top 10 plus all the NBFCs that are specifically identified by RBI will go under upper layer. So upper layer is very simple. Next comes top layer. Under top layer, what they say is top layer will ideally remain empty for now. So there are no NBFCs for now classified as top layer. This layer can get populated by RBI if RBI is of the opinion that there is substantial increase in the potential system risk of the NBFCs in the upper layer. So whichever NBFCs are classified in upper layer, if RBI is of the opinion that the risk is increasing, they will transfer those upper layer NBFCs to the top layer. Such NBFCs shall move to the top layer from the upper layer. So what is the basic logic of creating these 4 layers? Now RBI will take stringent steps, so they will classify them into 4 categories. Base layer are NBFCs where a lot of laws and regulation may not be required. Middle layer, something else is required. Upper layer, they want to monitor it very closely. And on top layer, they have kept a category. In case if they think so, they require more monitoring as compared to upper layer also, they will transfer them to the top layer. Hence, the classification has been changed and has been classified into 4. One is base, middle layer, upper layer, top layer. However, few important things to be noted. Few NBFCs, that is NBFC ICC, that is investment credit, MFI, that is microfinance, NBFC factors, mortgage guarantees could lie in any of the layers. Okay, so it can be in a base layer, middle layer, upper layer, or even the top layer. It can be in any layer. But however, government-owned NBFCs shall be placed in the base layer or middle layer as the case may be. They will never go to the upper layer. They will never go to the top layer until further notice. So for now, they think so government NBFCs, we did not control them so much. They will always be in the base layer or the middle layer as the case may be. Third, NBFC P2P, that is peer-to-peer, aggregator, NOFHC, NBFCs without public and customer interface will always remain in base layer. They are very small NBFCs. We need not regulate them so much, control them so much. So we need not never shift them to the middle layer or upper layer. They will always be in the base layer. However, NBFC D, CIC, IFC, HFC will be included in the middle layer, upper layer as the case may be. They will never go in the base layer. So this will always be in the upper or the top layer. SPD, IDF, NBFC will always be in the middle layer. So what they have told you once again, NBFC ICC, MFI, NBFC factors, NBFC mortgage guarantee companies could lie in any layers. It can be base layer, top layer, middle layer, any layer. But government-owned NBFC will always be in the base layer or middle layer. They will not go to the upper or top. NBFC peer-to-peer, NBFC AA, NBFC NOHFC, NBFC without public and interface will always be in the base layer. So can I conclude all these NBFCs which they have classified already under the base layer will always be under base. They will not go to any other layer. Next, however, they said NBFC ICC, NBFC MFI, factors, mortgage guarantee can be in any layer. If it is owned by government, it will be in base layer or the middle layer only. Next, NBFC D, CIC, IFC, HFC, middle, it can be in middle or upper layer. SPD, IDF will always be in the middle layer only. So hence what they are trying to say is now from 1st October 22, all references to NBFC D shall mean NBFC BL. What do you mean by BL? Base layer. All references to NBFC D and NBFC NDSI, that is non-deposit systematically important, NBFC P2P shall be in NBFC ML or upper layer as the case may be. It is classified that NBFC ND, that is non-deposit systematically important, having asset size of 500 or crore and above, but below 1000 crore, except those featuring in the middle layer will be known as NBFC BL. Okay, so this is a new thing that they have added. How do we classify the NBFC into the 4 layers, that is base, middle, upper and the top layer. So this was our types of NBFC. Moving ahead with our question number 4. What is the difference between a NBFC and a bank? So NBFCs cannot accept demand deposit. However, you can always accept term deposit. I hope you understand the difference between demand and term. Second, they do not part of the payment and the settlement system. So they cannot issue checks on their own. It does not form part of the payment system. So there cannot be clearing or anything as such. Also, there is no DICGC. So deposit insurance facility of the Deposit Insurance Credit Guarantee Corporation is not available to the depositors of NBFC. So in case of a bank, you get a guarantee that you will get your money even if the bank goes bankrupt. Such a insurance facility you do not get in case of a NBFC. Lastly, in case of NBFC, no exposure to priority sector. So priority is agriculture, education. So government always comes up with a priority that you should focus on giving loans to agriculture, giving loans to education sector, giving loans to, for example, SMEs. But however, in case of NBFC, there is no such regulation. NBFCs are free to give these loans and advances to whomever they wish for. So these are the 4 parts we covered so far very quickly. One was the meaning. Second was registration, third was types of NBFC, and fourth was bank versus NBFC. Before we move ahead to the next part, let us go through the question bank of this particular part and test our knowledge whether we have understood this particular part or not. So let us go to the question bank here. So what does this question say? Satyam Private Limited is a company engaged in trading activities. It has also made investment in shares of other companies, advanced loans to group companies amounting to more than 50% of its total assets. However, trading income constitutes majority of its total income. So, to be an NBFC, you have to fulfill 2 criteria. So, one, financial assets should be more than 50% of asset. Income from those financial assets should be more than 50% of your income. Now, Satyam Limited is fulfilling the criteria on the asset side, but however not fulfilling the criteria on the income side. Therefore, the company cannot be classified as deemed NBFC. Next, Shubham and Associates are going to start the audit of NBFC. They have not performed much work for the NBFC in the past year. You are required to explain the requirement related to registration and regulation of NBFC, which an auditor needs to keep in mind while planning the audit of NBFC. So we have already studied registration. Who needs to obtain a registration? What should be the net own fund? Who are exempted from registration? The same answer you'll have to write it here. Next, ABC Limited is a company registered under the Companies Act. The company is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities by government or local authorities. For the year ended 31st March, following is the extract from the financial statement. Their paid up share capital is 40.53 crores. Non-current assets, current assets. Total assets of the company 530 crores. Intangible, profit for the year ended, income from interest and dividend, gross income. Now, directors intend to apply for registration as NBFC under Section 45 IA of the RBI Act. So, are they supposed to own it? What should be your net own fund? If the net own fund is greater than 2 crores, they will have to apply for the registration. Now, if you see the answer here, the net fund exceeds obviously how much? 50 crores. So, I mean the net own fund exceeds how much? 2 crores. And also it fulfills the test of 50% assets should be capital assets and 50% of the income should be from the financial assets. So 50% yet income is 102, 50% will be around somewhere 51 point something. Here we have 52. So income criteria also they are fulfilling. Since the net own fund is also greater than 2 crores, they will have to obtain a registration. The net own funds of the company exceeds 2 crores and the financial activity is principal business of the company based on 50/50 test. Company is required to register as the NBFC. Next, similar. So here in this particular case, we discussed about ABC Limited. Now there is a question on Sudarshan Limited, similar case study. Is company registered under the Companies Act? Companies engaged in the business of loans, advances, acquisition, shares, stocks and securities by government and local. Following is the extract. So again they have given, so we know what is the paid up share capital, we know the what are the non-current asset, current assets, income from interest. So here in this particular case, again the net owned fund exceeds how much, 2 crores, and also fulfills the 50/50 test. In this case also it is applicable. Next, write a short note on categorization of NBFC carrying out the specific activities. So now what they are trying to ask is the new amendment that I taught you, where we were classifying this as the base layer, as the middle layer, and the top layer, as well as the upper layer. So this is what they are trying to ask you. So when they ask you question, categorization of NBFC carrying out specific activities, so this is the answer that they have given. Hence I have included, the answer is the same, though I have reprinted the answer. This is for you to understand what is the question that they are going to ask. So with this we are done with the part 1 of NBFC, a very simple and a sweet topic where we discussed about the meaning, the registration, types of NBFC, and the bank versus NBFC. Let us move ahead with our discussion of part 2. So part 2 we are going to discuss the NBFC prudential norms. We are going to discuss classification of fraud by NBFCs, audit checklist, and the difference between division 2 and division 3. So 4 questions: NBFC prudential norm, classification of frauds by NBFC, audit checklist, and difference between division 2 and division 3. So now moving ahead with our second part, that is NBFC prudential norms. So NBFC prudential norm will be having a discussion again into 3 parts. What are the capital requirements for NBFC? How do we recognize income? And what are the provisioning requirements? Starting firstly with the capital requirements. So they require minimum capital ratio of tier 1 and a tier 2. Tier 1 and tier 2 capital should be at least 50% of its aggregated risk weighted assets. So right now in this video I have not covered what is aggregated risk weighted assets, on which they have never asked you a question, but for illustration purpose you can open your module. In your module they have given you how do we assign a risk to particular asset, how do we calculate a risk weighted assets. Okay, so tier 1 and tier 2 should be 15% of the aggregated risk weighted asset. Once again, how do we calculate aggregate risk weighted assets? Not asked so far in the question, hence for exam point of view not very important, but for understanding they have given in the module. Out of this tier 1 and tier 2, tier 1 capital, so tier 1 tier 2 is 50, tier 1 capital should at least be 10%. So in other than a bank, MFI, what is MFI? Microfinance, and IDF, that is infrastructure debt fund. Tier 1 itself should be 10%. See, tier 1 is usually the pure capital of a company, that is the share capital. When we add tier 2 is a lot of times called as impure. You have done all this thing in your FR and your accounts and your inter-C level. Tier 2 is usually impure, which includes your reserves and surplus. Tier 1 itself, they are saying, should be 10%. Now, whichever NBFC is lending against gold jewelry, in that case, their tier 1 capital should at least be 12%. See, lending against gold is a risky business in India. People keep their gold as a last resort. So, okay, so they were going to, keep it as a pledge, as a last resort. So, those people who are taking loan against gold, there is a high chance of that the opposite party may not, repay it on time, and hence the tier 1 capital should at least be 12%. So tier 1, tier 2 should be 50, out of which tier 1 itself should be 10%, except for in case of MFI and except in case of IDF. In case if we are lending against gold jewelry, then in that case the tier 1 should at least be 12%. So here I have added what do you mean again loans? 50% of the loans comprises of such financial asset where more than 50% is given against loan. So this was our capital requirement. Moving to income recognition. So we will have to recognize income as per the accounting policies. Interest, discount, higher charges, and any other on NPA shall be recognized when actually realized. So what does your AS9 say? Whenever there is, where there is no certainty, we should recognize this on cash basis. Whenever it is an NPA, non-performing asset, the certainty is obviously less. Hence, you will recognize only on cash basis. So this is nothing new. This is nothing but what AS9 has taught us. Any income recognized before the asset become NPA and remaining unrealized shall be reversed. So if we had already recognized and later on the asset become NPA, the income that is still not realized, we are going to reverse the same. Next, we will classify the asset into standard, substandard, doubtful, loss. Quite similar to what we did for banking, but in case of here, how do we classify standard? Substandard is a different thing. So in case of standard, there is no default in the repayment. In case of substandard, NPA means it is less than 18 months. So in case of banks, we used to tell them NPA was less than, different timings, but here if it is NPA is less than 18 months, there in case of bank we used to say NPA is less than 12 months. Or asset where the terms of agreement regarding interest, principal have been renegotiated, rescheduled or restructured after the commencement of operation until the expiry of 1 year of satisfactory performance under the renegotiated or the rescheduled or the restructured terms. So if, let us say, if we have rescheduled the loan, renegotiated or given a fresh loan, if the opposite party keeps on paying, if that particular asset services the debt for 12 months, for 1 year satisfactorily, only then we will classify this as normal. Until then, we will classify them as what? Substandard asset. Doubtful, if it has been an NPA for more than obviously 18 months. So if less than 18 months, it is substandard. And if it is more than 18 months, then it will be classified as doubtful. Loss means where we know the internal or the external auditor or the concurrent auditor is of the opinion that we will not be able to realize. We will have to write off this particular asset. Or the asset which is affected by potential threat of non-recovery due to erosion in the value of security. So let us say they had kept Paytm shares. Now the Paytm shares has seen a dip of almost more than 50-60%. Then there is an erosion in the value of security. Or we think so there is some fraudulent act going there. Or omission on the part of the borrower. So they have written it off. So in this case, we will classify the asset as loss asset. So 4 things here. Firstly, was standard asset. There is no default. Substandard, NPA for less than 18 months. If we have rescheduled, renegotiated, till the time there is 1 year satisfactory performance, they will be classified as substandard only. Doubtful, if it is NPA is exceeding for more than 18 months. Loss, in case the internal auditor or external auditor has asked us to write off this, or there are, for example, accounts which have adversely affected by the potential threat, or there is an erosion in the value of security, or due to any fraudulent or omission on part of the borrower. Next, now when do you call an asset as a non-performing asset? See, here we said NPA for less than 18 months, NPA for more than 18 months. But when do you call an asset as NPA? So an asset in respect of which interest has remained overdue for more than 6 months. So for interest, they said more than 6 months. A term loan inclusive of interest, unpaid interest when the installment overdue. So in case of term loan also, they have said 6 months or more. In case of a demand loan also, again it is period of 6 months or more. In case of bill which has remained overdue for 6 months or more. Interest in respect of income on receivables under the head other current assets, again for 6 months or more. Any other due on account of sale of assets or services, again 6 months or more. But now, however, when we talk about lease rental and hire purchase, it has been written as 12 months or more. So in every other cases, it was 6 months. All you need to memorize here is in case of lease rental and hire purchase, it is 12 months or more. Lastly, in respect of loans, advances and other credit, the balance outstanding under credit facilities made available to the same borrower beneficiary where any of the credit facility becomes NPA. So if one account, if for one particular facility an account is classified as NPA, every other facility will be classified as NPA. What do you mean by that? Let us say to Mr. Ramesh, we have given him a personal loan. We have also given him a car loan. If he is NPA for car loan, we will classify him as NPA for personal loan as well, even if he is not paying his, even if he is paying his personal loan on time. So this was our second discussion, that is our income recognition. So we studied what is capital requirement. We studied what is the income recognition. Moving ahead with the third part, that is provisioning requirement. In case of loss asset, we will do a provision of how much? 100%. In case of doubtful, If it is unsecured, there will be 100% provision. If it is secured up to 1 year, a 20% provision. 1 year to 3 years will make a provision of 30%, and more than 3 years 50%. In case of substandard, we'll make a provision of 10%. In case of standard, it will be a provision of 0.4%. However, to particular applicable NBFCs, in case of standard, it will be 0.25%. So once again, a loss is 100. In case of doubtful, and in case of unsecured, it is 100%. In case of secured, up to 1 year, it is 20. 1 year to 3 years, it will be 30, and more than 3 years, it will be 50. However, in case of substandard, it will be 10%. Standard assets will be 0.4. But however, to select applicable NBFC, which applicable NBFC is not there in our syllabus, will be 0.25%. So this was our provisioning norms. Okay, so we studied 3 things here. One was capital requirement. Tier 1 and tier 2 should be 15. Tier 1 itself should be 10%. However, in case we are lending against gold, it should be 12%. Income recognition as per the accounting policies. In case the asset is NPA, we will recognize on as and when it is received, and we will classify the asset in standard, substandard, doubtful, loss. Standard, there is no default. Substandard, NPA for less than 12 months, 18 months. Doubtful, when NPA is greater than 18 months, and a loss when we know we are not going to receive the money. And then we classified as NPA, except for lease rental, where it is 12 months, where everything else it will be 6 months. And provision requirement, in case of loss asset, it will be 100. In case of doubtful, unsecured will be 100. Secured portion up to 1 year will be 20, 1 to 3 years will be 30, and more than 3 years will be 50. Substandard will be 10%, standard will be 0.4, and standard applicable NBFC will be 0.25. Next, classification of frauds by NBFC. Classification of fraud by NBFC. So there are various frauds. How will we classify this fraud? What we will say is, I see a menu. When do you commit a fraud? When do you go? When do you cheat your diet? When you see a menu which is very appealing. So whenever we are supposed to classify frauds, what we will say is, I see a menu. What is I? So first is whether there are any irregularities in the foreign exchange. Secondly, whether there is any cheating or forgery, any other type of fraud. So this will actually come at the last, but since there was a code that is being formed, we have written it here. Whether there is any misappropriation or criminal breach of trust. Whether there is any fraudulent encashment through the forged instruments, manipulation of books of accounts, and through fictitious accounts and conversion of the property. Whether there is negligence and the cash shortages, and whether there are unauthorized credit facilities extended for reward or for illegal gratification. So once again, what is the classification of fraud by NBFC? One is whether there is any irregularity in the foreign exchange transaction. Second, whether there is any cheating or forgery. Any other type of fraud apart from this. Misappropriation and the criminal breach of trust. Fraudulent encashment, negligence and cash shortages, and unauthorized credit facilities extended for reward or illegal gratification. I am not going into depth of this. You have understood this. So this was our NBFC prudential norm. Question number 6 was a very simple question, classification of fraud. Next is a audit checklist. What should we have in an audit checklist? So we should have a podcast. We should have a podcast. On what topic? We should have a podcast on abacus. What do you mean by P? Firstly, we should physically verify all the shares and securities held by the NBFC. Whether any security is lodged with an institution or bank, or a certificate from bank must be, to that effect, must be verified. Next, we should verify whether the loan has not been given against the own shares. Next, dividend income in case of NBFC is usually recognized on cash basis. However, if they wish to recognize on accrual basis, they can only when the right to receive the dividend is recognized. That is when it has been declared in the AGM. Next, in case of C, we need to check the bills, contracts received from the brokers, and with reference to the prices on the stock market quotation on the respective date. So what is the prices that they have given in quotation, in the contracts, and I will Google on that particular day what were the stock prices for that particular stock, and we'll come to know about it. Next, we will have to check whether the investments have been valued in accordance with your AS 13. In case of subsidiaries and group companies, we should obtain a list from the management and verify the investment made in the subsidiary and group during the year. Now, ascertain the basis of arriving at the price paid for the acquisition of such share and whether the valuation is as per the prudential norms. So, whenever we are making investment into subsidiary and groups, we will verify the same. Next, whenever the advance have been given, we need to see whether the advance are properly sanctioned or not sanctioned. Whenever you're making an investment, we should verify the board meetings, whether the board resolution has been passed. We can obtain a management certificate for the same. Next, whether the NBFC has adequate system for the proper appraisal and the follow-up loan. If we are given a loan, whether we are checking the credit worthiness of them. We should verify the charges received or paid in respect of the securities lent. In a case of the unquoted debentures on bond, if we have made an investment in unquoted debentures bond, it should not be treated as investment. It should be treated as the long-term loans or the credit facilities for the purpose of asset recognition, income recognition, and the asset classification. And we should verify the securities of the same type or class that are received back by the lender at the specified period together with all corporate benefits thereof. So these are just illustrative points. There are many points. They have given few more points in the module as well. But however, they say these are not the exhaustive list. This is just a mere checklist. So you can write this particular points in the examination, that what is an audit checklist. So far we covered three things. Firstly, what we covered was prudential norms. We studied what are the capital requirement, income recognition and provision norm. Then we studied how do we classify the frauds, which is a frequently asked question, though seems very simple, a very frequently asked question. And then what can be audit checklist be. Next, what is the difference between the division 2 and the division 3? See, division 2 is Ind AS for other than NBFC, and a division 3 is Ind AS of NBFC. So I am not discussing the whole of schedule 3 and everything. That is part of your FR. This is also actually a part of your FR, but this has been asked multiple times in the examination. Why, I do not know. ICI allows this particular question in paper of auditing and has been asked multiple times. So we are discussing this particular point. So difference between division 2, that is Ind AS for other than NBFC, and a division 3, that is Ind AS for NBFC. Now, what is the difference? NBFC have been allowed to present the items as per their liquidity, in the order of liquidity, which asset is more liquid. However, when we go to the schedule 3, that is for companies, I mean other than NBFCs, in that case we classify things into current and non-current, but here we classify in the terms of liquidity. Secondly, whenever we have NBFCs are required to disclose under receivables debt due from any LLP where a director is a member or a partner. So if my director is a member or a partner in an LLP, the money that is to be received from that LLP has to be separately disclosed. Second, we need to separately disclose what? Every income that is more than 1% of the total income. See, when we go to other than NBFCs, if you recollect your schedule 3, everything that exceeds 1% of the revenue from operations or a 10 lakhs, whichever is higher, was to be disclosed separately. But in case of NBFC, whatever exceeds 1% of the total income has to be disclosed separately. Next, we have to disclose items from revenue from operations and other comprehensive income on the face of P&L itself and not as a part of notes to accounts. What we used to do for, in case of other than NBFCs, we used to show this in notes to accounts, but in case of NBFC, we will be showing this on the face itself. Next, separate disclosure of trade receivable which have significant increase in the credit risk and the credit is impaired. So wherever the risk is higher, we will have to show this separately. And conditions or restriction for distribution attached to the statutory reserves, the reserves that we are supposed to keep for a specific period, we need to disclose it separately. So these are the 6 main point of differences. One is, in a case of NBFC, they can show their balance sheet in the order of their liquidity. In case of NBFC, they need to separately disclose the amount that they have given to a director, given to a LLP where the director is a member or a partner. Thirdly, they need to disclose everything which is greater than 1% of the total income. NBFCs are also required to disclose revenue from operations and other comprehensive income on the face itself rather than as schedules. Next, trade receivable which has a significant increase in the risk has to be disclosed separately, and all the restriction and the distribution of the statutory reserve also have to be disclosed there. So this was the differentiation between an NBFC and other than NBFC. Let us see the questions based on this particular part. You are the auditor of MP Limited, NBFC, registered with the RBI as the investment company. How would you proceed to ensure compliance of the prudential norm? So here, for your benefit, I have again reprinted the answer. You can go through this particular answer. We have covered this under the NBFC prudential norm. Moving ahead with the next question. CA Nadar is conducting the statutory audit of RHL Limited, a non-banking financial company. It has branches in various parts of India. The company, with a focus on housing finance, has outstanding non-convertible debentures worth rupees 150 crores. The company reportedly missed the interest payment in INR 15 crores on its debt because of inadequate liquidity. As a result, RHL faced a series of downgrades by rating agencies on its debt over the last 2 months. Rating was cut to D from A4, implying that the company was in default or expected to be in default soon. What aspects CA Nadar should look into the relation of the activity of mobilization of public deposit, particularly in relation to downgrading of credit facilities by the RHL Limited? Here, let us go through this particular answer. The audit procedures in relation to mobilization of public deposit. So, the ceiling of quantum of public deposit has been linked to the credit rating as approved by the credit rating agency. So, how much public deposit you can accept depends on the credit rating that you get. In the event of upgrading or downgrading the credit rating, the auditor should bear in mind that NBFC will have to increase or reduce the public deposit in accordance with the revised rating assigned to it within a specified time frame, should ensure NBFC has informed the same to RBI in writing. Now, in the event of downgrading the credit rating, when the interest is downgraded, obviously they can accept less public deposit. Not NBFC, being an investment credit company or a factor, shall regularize excess deposit as provided thereunder. With immediate effect, stop accepting fresh public deposit. All existing deposits shall be run out to maturity. Report the posting within 15 days to the regional office of RBI. No mature deposit shall be renewed without excess or voluntary consent of the depositor. So this is whenever there is a downgrading. So mark this question important. Just go through this particular question once. Next, write a short note on classification of fraud. So we have already seen the answer should be I see a menu. Whenever you see a menu, you commit a fraud. Next, G has been appointed as an auditor of LMP Limited, a NBFC registered with RBI. Mr. G is concerned about whether the format of the financial statement prepared by LMP is as per the notification issued by Ministry of Corporate Affairs, dated 11th of October 2018. The notification prescribed the format in Division 3 under Schedule 3 of the Companies Act, applicable of the NBFCs complying with the Ind AS. Mr. G wants to know the difference in the presentation requirement under Division 2 and the Division 3 of the Schedule 3 of the Companies Act. So here all you are supposed to write is the difference between Division 2 and Division 3. Likewise, the question is similar here. At the end, what they are asking you is differences between Division 2 and Division 3. So here what you will write is Division 2 and Division 3. So with this, we are also done with our discussion of Part 2. Moving ahead with the discussion of Part 3. So Part 3 has been divided again into 3 parts. One is compliance with CARO 2020. What is the auditor's duty in response to the NBFCs? And lastly, the audit procedure. So CARO 2020 we are not discussing here because we have already discussed CARO 2020 very much in detail. So you will have to refer CARO 2020 for this. I am not discussing compliance with CARO here. Next, auditor's duty. So apart from reporting under section 143 of the Companies Act, the auditor shall report to the board of directors of the company. The auditor shall make a separate report to whom? Board of directors of the company on the matters specified in para 3 and 4. So this report is being given to the board of directors. So firstly, matters to be reported in case of all NBFC para 3. So what do you mean by all NBFC? Whether they are deposit taking NBFC, non-deposit taking, every NBFC you need to report these matters. What are you supposed to report? Clause number 1, whether the company has obtained a certificate of registration from the bank. Conducting NBFC without valid certificate registration is an offence. Secondly, whether they are still entitled to hold such certificate of registration. Thirdly, whether NBFC is meeting the requirement of the net own fund as laid down in the direction. So, 3 clauses. Firstly, whether they have a valid certificate of registration. Are they entitled to hold that particular certificate of registration? Whether they are meeting the requirement of the net own fund laid down in the direction issued by RBI. 3 clauses. It is in case of all NBFCs. Certain important points to note here. Every NBFC shall submit a certificate from a statutory auditor engaged in the business of NBFC, requiring to hold a certificate of registration or RBI and is eligible to hold it. So, every NBFC is supposed to submit this certificate from the statutory auditor. Now, certificate from the statutory auditor in this regard with reference to the position of the company at the end of the year, we submitted to the regional office of the Department of NBFC, non-banking supervision, under whose jurisdiction the non-banking company is registered within 1 month from the date of finalization of the balance sheet or maximum up to 30th of December of that year. So, this certificate is to be given by the statutory auditor to the regional office of the Department of NBFC under whose jurisdiction it is registered within 1 month from the date of finalization or maximum up to 30th of December. So, in case of all NBFC, we are supposed to give report 3 clauses, whether they have a certificate of registration, whether they are eligible to hold it, and whether they meet the requirement of the net owned fund. Matters to be reported in case of NBFC accepting deposit. So, this is only if they are accepting deposit. Firstly, whether the public deposit accepted by the company together with the other borrowings from the public issue of unsecured non-convertible debenture on bonds from its shareholders if it is a public limited company, and which are not excluded from definition of the public deposit NBFC acceptance in public deposit direction are within the limits admissible to the company. So, what they are trying to say is the auditor shall include a statement on the following: whether the public deposit accepted by the company with other borrowings from whom? From public issue of unsecured non-convertible debentures from its shareholders, and which are not excluded from the definition of the public deposits. So, this was point number 1. We have to report around 12 points here. Second, whether the public deposit held by the company is excess of the quantum of deposit permissible to it. So, if they have accepted deposit more than what is permissible, we need to report it here. Whether the NBFC is accepting public deposit without minimum investment grade credit rating. So, if they don't have the credit rating, they cannot accept deposits. Whether the capital adequacy ratio is as disclosed in the return submitted to the bank. Fifth, in respect of NBFC referred to in clause 3 above. What do you mean by clause 3 above? Accepting public deposit without minimum investment credit rating. So, whether the credit rating for each type of fixed deposit scheme has been assigned by one of the credit rating agencies. So, every type of deposit that you accept, you require a separate rating. Whether the aggregate amount of the deposit outstanding at any point of time during the exceeded limit specified by the such credit rating agencies. So, here what we have discussed is 5 points so far in case of deposit that they have accepted. Secondly, whether the deposit that they have accepted is it in excess of the quantum of such deposits. Whether the NBFC is accepting public deposit without the minimum investment grade criteria. Whether the capital adequacy ratio as disclosed in the return submitted to the bank has been correctly determined. Whether credit rating for each deposit has been separately obtained, and whether the amount of deposit outstanding at any time during the year has exceeded the limit specified by such credit rating agency. Next, whether their company has violated the restriction on the acceptance of public deposit as provided by the NBFC acceptance and deposits. Whether the company has defaulted in paying to any its depositor, whether it may be interest or whether it may be principal. whether the company has complied with the prudential norms. We have already discussed the prudential norm in the previous part. Whether the company has complied with the liquid assets requirement, whether the company has furnished the bank with the stipulated returns on the deposit, whether the company has furnished to the bank within the stipulated period quarterly returns on prudential norms, and lastly, in case of opening of new branches or offices to collect deposit, or in case of closure of the existing branches, the company has complied with the requirement contained in the NBFC acceptance and deposit requirement. So in case if it is a NBFC deposit accepting, we are supposed to report on this 12 points. So para 3A was in general whether you are accepting deposit or not accepting deposit, you will report on these 3 clauses. But however, if you are deposit accepting, these are the 12 points that you need to report. In case if you are not accepting deposit, then very limited things that you are supposed to report. You need to report whether the board has passed a resolution for non-acceptance. So they will have to pass a resolution that we are not going to accept deposits. Whether the company has accepted any deposit during the year. So you are not deposit taking, still have you accepted it? We will have to report. Whether the company has complied with the prudential norms as well. Now, in respect of systematically important non-deposit taking, that is an asset side of 500 crores or more, whether the capital adequacy ratio as disclosed is in accordance. Secondly, whether the company has furnished to the bank annual statement of the capital funds, risk assets exposure and the risk asset ratio within the stipulated time. Whether the NBFC has been correctly classified as MFI, that is microfinance. And lastly, in case of para 3D, matters to be reported of companies not required to hold certificate of registration. So 3A was for every NBFC, 3B was if you are accepting deposit, 3C was if you are not accepting deposit, 3D if you do not have to hold certificate of registration. So apart from the matters enumerated in A to I above, where the company has obtained a specific advice from the bank that it is not required to hold certificate of registration from bank, the auditor shall include a statement that company is complying with the conditions stipulated as advised. Next, obligation to submit an exception report under para 5. So where in case the auditor is of the opinion that he wants to give any unfavorable or qualified opinion that the company is not complied with the provision of chapter 3B of the RBI Act, the NBFC acceptance and public deposit, NBFC systematically important non-deposit taking Reserve Bank Directions 2016, NBFC systematically important non-deposit taking company and deposit taking para 3. So here if this in case if there is an unfavorable or a qualified remark, we need to give them an exception report. So if there is a qualified or unfavorable remark, we need to give this to the regional office of the Department of NBFC supervision of the bank under whose jurisdiction the registered office is located. And a duty of the auditor to submit exception report shall report only the contraventions of the provisions of the RBI directions. So in the exception report, we will report only the contravention. We will not report anything wherever they are in compliance. We will have to report only where there is a non-compliance. So this was the auditor's report. What is the duty of the auditor? So apart from 143, we need to report under para 3 and 4. So para 3A was report in case of all NBFC. 3B was in case if you are accepting deposit, 12 points we were supposed to give. 3C was in case if you are not accepting deposit. 3D was in case if you are not supposed to hold certificate of registration. And para 5 was to give an exception report. Moving ahead with the last question, that is audit procedures. So firstly, the auditor should ascertain the business of the company. He should verify the MOI and AOI. You will understand what is the principal business activities. This principal business activities any which way is essential because based on this we will classify the NBFC into the top layer, upper layer, base layer, middle layer. We will also see whether provisions relating to the limit of acceptance of deposit contained in the NBFC public deposit direction are complied with. Secondly, we will evaluate the internal control because based on the internal control, we will decide what is the control risk. Based on that, we will be determining the nature, timing, and extent of the audit procedures. We will see how effective the controls are. We will see he should ascertain whether NBFC has effective system of periodical review of advances in place and should facilitate effective monitoring. Thirdly, in case of registration with RBI, we should see whether they are complying with the registration requirements of the RBI. Whenever they are registered with RBI, they need to invest specified percentage as prescribed by RBI. They also need to maintain certain liquid assets. We need to check quarterly basis whether they have been complying with the same. Next is acceptance of the public deposit direction. So whenever they accept deposit, the ceiling on the quantum is dependent on the credit rating. Check whether they are accepting the deposit as per the credit rating given to them. Check whether the interest calculation on the public deposit is accurate. Whenever you accept a deposit or whenever you renew a deposit, whether a written application is taken from the depositor or no. Then verify a deposit register maintained by the NBFC and a test check the particulars that have been entered therein. Next, whether the investment made in the approved liquid assets by the NBFC have been lodged in the safe custody with the designated scheduled commercial bank. Check whether the NBFC is filed with the prescribed returns in a timely basis. And in case of NBFC not accepting or holding deposit, check whether a board resolution has been passed or not. In case of group holding investment companies, check that the NBFC has passed a board resolution to effect that company has invested or would invest or hold its investment in shares and securities of group companies. The last part, NBFC prudential norm. We should check the prudential norm encompassing income recognition, income from investment, accounting, provisioning for the bad debts. Auditor should ensure that the board of directors of ARB NBFC granting and intending to grant demand or call loans should frame and implement a policy for the same. So if they are going to grant any demand or call loans, they should have a policy regarding the same. You should verify that the advances and the credit facilities have been properly classified as standard, substandard, doubtful, and a loss. In case of NPA, the income should not be realized. It should be on receipt basis. We will not recognize it on accrual basis. We will recognize as and when received, that is on cash basis only. Check whether all the accounts that have been classified as NPA in the previous year continue to be shown as a current year also. So these were the audit procedures that we need to apply. Let us check the questions asked on this particular part as well. What are the specific matters to be included in the auditor's report in case of NBFC not accepting? So we will write only about para 3C for people who are not accepting deposit. Next. Karma Private Limited is a non-deposit taking systematically important NBFC registered with the Reserve Bank of India. The statutory of the auditor of the company is required to report to the board of directors. What should be the content of the auditor's report? So here we will have to write the whole content. So here in cases it is systematically important NBFC registered with RBI. The statutory auditor company is required to report to the board of directors. You will have to write everything. This is RTP question, hence little more of content, or else they will ask you specific points. R and Associates, a firm of chartered accountant, is appointed as auditor of NBFC. During the audit team comes across observation exceptions, and Mr. A, junior member of the audit team, due to his limited understanding about exceptions, are required to report in the audit report. Would like to understand in detail the obligation on part of the auditor in respect of exceptions. So we have discussed in para 5, if there are exceptions, we will have to give the exception report as well. Next, Abhimanyu Finance Limited is a NBFC and was in the business of accepting public deposit and giving loans. The company was having a net own fund of 1 crore 50 lakhs and was not having registration certificate from RBI and applied on the 30th of March. The company appointed Mr. Kabra as the statutory auditor, advised the auditor with reference to the audit procedures to be taken in regards to CARO 2020. So though I have printed the answer here for your reference, you can go through, but we have discussed all this in accordance with CARO 2020. Last question. HG and Company is the statutory auditor of KFN NBFC. While preparing the audit procedures to be done during the audit of entity, there was a difference of opinion between Mr. H and his partner, Mr. G. Mr. G is of the opinion that evaluation of internal control and verification of registration with RBI should not be part of the audit procedure, as is part of the internal audit only. Is the contention of Mr. G correct? Also state what broad area should mandatorily become part of the audit procedure. So the last question number 11 that we discussed, we will have to write the whole audit procedure that we are supposed to perform. So with this, we are done with our discussion of NBFC. My friends, this is a quick rapid revision lecture, assuming you are watching this on 2x on the last day, or maybe one last time before the examination. So we have kept it very crisp. We have not gone into the depth of it. If you do not recollect a concept, you can go to the recorded access that you have. This is just so that you can go it on 2x and revise the whole thing one single day. If you sit in front of this YouTube channel, you will be in a position to revise everything and go with a lot of confidence. Have added a lot of question banks, so you can interpret the questions and understand what they will ask in the examination and what you're supposed to write. So with this, we put an end to our discussion of NBFC. Let us move ahead with our discussion of the next chapter. Right, so moving ahead with our next chapter, that is internal management operational audit, one of the easy topic, but you will have to make sure that you do not invest a lot of time on this. Comparatively, the weightage is going to be around 5 to 6 marks. So make sure you watch this video in a very crisp manner. We will complete the whole chapter, but a scoring chapter, not very difficult questions are asked, but you need not spend hours and hours on this. So starting firstly with the first topic, internal audit. So internal audit has 9 questions. Firstly is the meaning, who is eligible and to whom it is applicable, important question. Then it comes to areas of responsibility, scope. So within scope, they ask you specific individual points. Then we'll go ahead with the qualities of an internal auditor, internal audit report, features of a good quality report, what is the relationship between internal auditor and external auditor, and difference between internal auditor and external auditor. Not that the questions that I have not marked as a star mark are not important and you can skip those questions. You never know with the institute, but the points that I have marked important, you cannot skip it. Make sure you study at least those questions in case if you are, there is a time crunch there. Firstly, starting with the meaning. So as defined on the standard of auditing, internal audit is an independent management function. See, it is not independent examination. What you're saying, it is independent management function, which involves continuous and critical appraisal of the functioning of an entity. Why? With a view to suggest the improvements thereto. So firstly, it is to suggest the improvements. Secondly, it is to add value and strengthen the overall governance mechanism of the entity, including the entity's risk management and internal control system. So once again, this is nothing but the definition. You can use this as what? Introduction. Next comes eligibility. Who is eligible? So who is eligible? He can be a chartered accountant, he can be a cost accountant, or any other professional. Any other professional as may be decided by the board. So can he be a chartered accountant? Yes, he can be a chartered accountant. Can he be a cost accountant? Yes, or any other professional, whichever is decided by the board. Now, to whom is this particular section 138 applicable? Very simple. It is applicable to every listed company, unlisted public company having a paid up share capital of 50 crores or more during the preceding financial year, turnover of 200 crores or more. We will just use a very simple trick and technique to memorize this, but let us just go through it. Then outstanding loans and borrowings of 100 crores or more, and lastly outstanding deposits of 25 crores or more. How will you memorize this? What we will say is double profit before tax. Double profit before tax. What is D? D is nothing but what? Deposit. What is P? Paid up share capital. Paid up share capital. Next, what is B? Borrowing. And lastly, what is T? Turnover. Deposit should be 25 crores or more. Now, what is our code? Double profit before tax. Now, start doubling everything. 25 ka double, 50. 50 is double, 100. 100 is double, 200. So double profit before tax. First is D, deposits 25 crores or more, paid up share capital 50 crores or more, borrowing turnover 100 crores or more, or the turnover 200 crores or more. So here what we are talking about is the applicability. So first was it is applicable to every listed company. Second, every unlisted public company having a deposit 25 crores or more, paid up share capital 50 crores or more, borrowing 100 crores or more, or turnover 200. But when it comes to private company usually does not accept deposit, does not have such paid up capital. They can have, but usually not a lot of private companies have paid up share capital 50, so they have not added those limits. Here what you will check is only your borrowings and your turnover. So borrowing should be 100 crores or more, the limit remains the same, or the turnover should be 200 crores or more. Okay, so in that case it will be applicable to the private company as well. So this is applicability. Mark this as important. They may ask you MCQs as well based on this particular topic. Now, primary areas of an internal auditor's responsibility. So what is the responsibility of internal auditor? So far we are done with what? The meaning. We are done with eligibility. Next comes what is the responsibility of the auditor? So what you will say here is a mice. Firstly, A, to maintain adequate internal control system by continuous examination of the accounting procedure. So we want to see the receipts that we have, the disbursement that we are making are adequate. So there is no, so there is a safeguarding of the asset. There is no misappropriation of cash. Someone is not inflating the payments, making fictitious payments. So we need to check whether there are adequate internal control system for the same. So system of internal control by continuous examination of the accounting procedures. So first focus should be on accounting procedures. Secondly, M is he should be closely associated with the management. So he should be well informed with every decision that the management is taking. He should be very well aware of what are the changes in the policies that are made. So he should be very closely associated with the management. So firstly, he should do a continuous appraisal of the accounting procedures. Secondly, he should be closely associated with the management. He should try to work independently with the accounting staff. So see, if he is not independent of the accounting staff, there will be self-review threat, familiarity threat. So he should be independent of the accounting staff. Secondly, he should do a lot of critical appraisal of the policies of the management and draw deficiencies whenever it is required to be. So whatever the policies are framed by the management, he will evaluate whether there is any deficiency, we need to do anything. And he should not involve himself in the executive function. See, he himself is part of the executive functions and he himself was auditing. Obviously, there will be a self-review threat. So he should not be part of the executive function. So what they said here is, firstly, what is A? He will do continuous examination of the accounting procedures. Secondly, what is M? He should closely associate himself with the management. What is I? To operate independently. What is C? Critical appraisal of the various policies of the management. And what is E? Should not involve himself in the performance of the executive functions in order that his objective outlook does not get obscured. So this is the primary areas of responsibilities of the internal auditor. So basic three questions. We studied what is the meaning. We studied who is eligible, so chartered accountant, cost accountant, or any other professional. We saw the applicability, applicable to the listed company. Public company, unlisted public company, if deposits is 25 crore or more, profit is 50, paid up share capital is 50 crore or more, borrowing is 100 crore or more, turnover is 200 crore or more. Then in case of a private company, borrowing is 100 crore or more, turnover is 200 crore or more. Areas of responsibility is nothing but a mice. What is a mice? Critical appraisal of the accounting procedures, closely associated with the management, work independently, see critical appraisal of the policies that management has made and find out the deficiencies and not to involve himself in the executive function. Now moving ahead with, see, this is divided the chapter into three parts. Internal audit into three parts. Part 1 was basic concepts such as meaning, eligibility, areas of responsibility. Now moving ahead to the second part. What is the scope of internal auditor? What are the qualities that he must possess? And the internal audit report elements. Okay. So moving ahead with the fourth part, that is scope. What is scope of an internal auditor? So what you will say here is UG CRISP. So all those who cannot memorize the code words, or so they can memorize it in point form. For whomever needs a code word, I have given this particular point. So firstly, when we talk about U, what do you mean by U? Review the utilization of resources. So we need to see whether the resources are used economically as well as efficiently, whether there is no unutilized capacity here. So in such points, I mean, whenever such chapters are there, you should know the head point. And inside the head point, it is not necessary that you memorize everything word to word. Around 50% language will do the work. So even if you recollect the main point, so for example, here from the first point, even if you can use the word economically and efficient use of resources, you will be in a position to get the marks. Next, when there is a wide divergence in the actual performance and corresponding standard. So if there is a difference between actual and the standard, we may have to understand the reasons. And as a part of evaluating the resource utilization, identifying various facilities which are underutilized is important function. So we need to write 3 points here. Firstly, efficient and economic use. Secondly, if there is a difference between standard and the actual, we need to understand what are the reasons behind the same. And it is important for us to understand whether there is an underutilization of the capacity. So this is our utilization of resources. Next is G, review of the accomplishment of the goal and objective. So we need to see whether we are achieving the stated goals and objective. Basically, it is talking about the effectiveness. See, audit is always based on 3E: efficiency, economy, and effectiveness. Effectiveness means whatever the goals and objective of the organization, are we achieving those? So internal auditor should review the overall objectives of the enterprise to evaluate whether they are clearly stated and are attainable. So are these goals actually attainable by us? Secondly, the internal auditor should examine to the extent possible objectives are expressed in a precise quantifiable terms to facilitate detailed planning to be made for achieving them. So whatever as goals should be quantifiable. What do you mean by quantifiable? We want to achieve a very good success. We want to progress as compared to where we were last year are not quantifiable. For example, whether we want to achieve sales of 10% as compared to what we were in the last year, these are the desired number of customers that we are targeting. It should be quantifiable so we can evaluate whether we have achieved that. There should be sufficient flexibility in plans to permit such improvements in their implementation so as to benefit the enterprise as a whole. So this is review of accomplishment of goals and the objectives. So firstly, U is utilization of resources. Next, G is review of accomplishment of goals and objectives. So here we are put on with 2 points, U and G. Next is C, review of custodianship and safeguarding of assets. So we need to see all the assets that we have are fully accounted for. No assets are omitted from accounted. There is no manipulation there. No one has taken over the asset for the personal use. So we need to review the custodianship and the safeguarding. So first we will see whether they are fully accounted. We will see whether the intangible assets, review the control system for intangible, because these days a lot of companies have a lot of intangible assets. So we'll have to verify things for intangible, and he should verify the existence of the assets, that he perform physical verification. So first U was utilization of resources, G was goal accomplishment, C is custodian and relation and safeguarding of the assets. Next, R is review relevance and reliability of the information. So we need to check the information that we have. Is it accurate? Is it reliable? We'll have to consider the usefulness of the reports as well as the records should be evaluated with reference to their cost. The amount that we're spending in getting that particular information, is it relevant for us? Then internal auditor should also examine the exception report. Exception report means wherever whatever discrepancies we have found, those discrepancies are highlighted. So this is review and reliability of the information. So once again, U was utilization of resources, G was accomplishment of the goals and the objective, C was custodian and safeguarding of the asset, R is review of the relevance and the reliability of the information. Next, I is review the internal control system and procedure. That is what an internal auditor is supposed to do. So he will see the internal control system is in consonance with the structure, considering the size of the organization. We will see whether we have inbuilt operating function, because those are cost effective, and we will review and analyze every internal control with respect to the cost and benefit as well. Next is review of the policies and the plans. We need to verify the policies, plans, laws and regulation that operations are carried out in a coordinated manner. And at last comes review of the organization structure. So this is important because they will ask you a question based on this single point, review of the organization structure. Independent question can come on this particular point as well. So here in scope, organization structure is important. Okay, you expect a single question only on this particular point. If they ask you, then what we will write is, we will write there should be a group balance. What do you mean by group balance? Firstly, review the manner in which the activities of the enterprise are grouped for managerial control. So, or marketing related activities together, or finance related activities together. So, review how it is grouped. Secondly, from R, you should review the responsibility and the authority are in harmony. The person who has a lot of responsibility, he should also have some authority. Person who has authority, he should also have some responsibility. So there should be perfect harmony between responsibility and harmony. Next, examine the organization chart to find out whether the structure is simple and economical. The hierarchy should not be so much that it gets expensive, it is not simple to operate. Next, the responsibility of the managerial staff at the headquarters do not overlap with those chief executives at the operating units. So, firstly, they said you see whether the grouping is properly done of activities. Secondly, from R they said responsibility and authority should have a harmony. O, or evaluate the organization chart whether it is simple and economical. Next, the responsibility of the staff at the headquarters as well as the branches do not overlap. U, whether there is a unity of command. So, for example, for one single task, there are three people giving three different commands. So, whether they are at par. So, if there are three people giving command, there should be unity among whatever they are trying to say. Wherever there are dual responsibilities cannot be avoided, primary one should be specified and specific responsibility for each senior is fixed. So, for example, if I am teaching auditing, as well as for example, if I am managing this digital marketing of JKC, then my primary area should be fixed. What is the primary area focus? For example, let us say teaching. So, if there are dual responsibilities, we should fix the primary responsibility. Yes, so this was group. Lastly, whether there is a satisfactory balance between the authority and a responsibility of important executive. So here it was similar, authority and responsibility, but it was for common the whole organization. But here they are talking about the important executives. So whenever they ask you about only organization structure, what you would say is group balance. GS, whether the activities are grouped. R is whether there is a harmony between responsibility and authority. O1 is organization structure is simple and economical. O2 is the responsibility of the managerial staff at the headquarters do not overlap with the chief executive officers at the operating unit. Next, U, there should be a unity of command. And lastly, P, if there are dual responsibility, primary responsibility should be specified and there should be a balance between authority and responsibility for important executives as well. So this was our answer of scope. In scope, we studied that this particular part is important, that is review of organization structure. Next is qualities of an auditor. What are the qualities that an internal auditor must have? So he must possess basically 7 qualities. Okay, so in Hindi we say whenever there is a there is a marriage or something, when we are finding a guy, then in that case we said the ladke mein 7 gun hone chahiye. So in case of internal audit, the auditor should have 7 qualities to be an internal auditor. Firstly, internal auditor should have special expertise necessary for evaluating management control system. So he requires expertise to evaluate what? Management control system. Secondly, obviously he should know accounts and finance. If he is not well versed with accounts and finance, he cannot be an internal auditor. Thirdly, he should know technology because he will require technology in evaluating a lot of things. So he should be well versed with technology. Fourth, they said they should have basic knowledge of commerce, laws, taxation, cost accounting, economics, quantum methods, EDP. So can I say he should have knowledge of CA foundation and CA inter-subjects. So for example, commerce, law, tax, costing, economics, you studied at inter as well as the foundation level. So he should have this particular knowledge. Next, understand the management principles and techniques in is another essential qualification. So he should understand management principles. Next, he should have ability to deal with people. And lastly, he should possess a quality of confidentiality, that he should not go and give the confidential information to the outsiders. So he should have 7 qualities. Firstly, he should know the management control system. Pause the video and repeat it along with me. Okay, so memorize everything at your itself. Management control system. Secondly is the accounting functions and the finance function. Third is technology. Fourth is you should know the CA foundation and the inter subjects. Then what he should know, management principles, he should be able to deal with people and he should maintain confidentiality. So these are the qualities of an internal auditor. Next, moving ahead with the elements of the internal audit report. So I'm just doing the main headers here. We are not going into very much detail here. What should he have is title. So how we have a title in case of an independent auditor's report. In case of internal audit as well, we'll have a title. Then we'll have addressee, which is usually to the management. Report distribution list, to whom are we giving this? What is the period of coverage of this particular report? Opening paragraph or the introductory para, the identification of the processes or functions or items of the financial statements that are audited. A statement of responsibility of the entity's management and responsibility of the internal auditor will write in the opening para. Then objectives para, what were the objective of the internal auditor? Then we will write about the scope. We have already studied the scope above, but we'll write what is the scope of the internal auditor. A reference to the generally accepted audit principles in India. For internal audit, we usually have SIA. A description of the engagement background and the methodology of the internal audit, and description of the population and sampling technique. Post this, we will also give a summary, executive summary, because there is too much content in the internal audit report. So we'll prepare a summary, so which will contain only the highlights, key observations. Next, we will write about the observation, findings, and also the recommendations, because if you recollect the definition, we want to make suggestions to the management, so we'll give our recommendations. Comments of the local management, so the operational unit management give their own comment. Then we will give the action taken report. So we have given certain suggestions whether they have taken any action. So mark this important. On this particular point, they ask an MCQ. Action taken and not taken pursuant to the observation made in the previous internal audit report. Date, place, signature, membership number. So this is what we will write in the internal audit report. So far what we have understood is meaning, who is eligible, to whom it is applicable. Then what is the areas of responsibility, that is MICE. Then what is the scope, was UG, CRISP. Next, in case of organization structure, we studied group, balance. Then what are the qualities? The auditor should have possess 7 qualities. And what are the what is the internal audit report elements? So now, what are the good features of an internal audit report? So firstly, they said there should be objectivity. The report should be obviously very unbiased. If the report is biased, since the internal auditor is internal, he may be biased. Hence, what we require is it to be objective. Secondly, it should be straightforward. There should be absolute clarity. So as far as use of technical terms and jargon should be avoided. So whoever is reading the report, he should give absolute clarity of what is he trying to say. Thirdly, there should be accuracy. So we should wherever possible quantify. A lot of times we may have to use approximation since we are not able to quantify. If we have used approximation, assumptions, we should also state the fact, on what basis have we taken those assumptions. Next, it should be concise. Only the vital information should be given. The user should not be bombarded with a lot of information. So it should be concise. Then there should be a constructive criticism and not destructive criticism. Okay, so for example, let us say if I find a student who's using a cell phone in his classroom, so I will not do destructive criticism that you are going to fail only, you are wasting your parents' money, this will not help. I will have to use constructive care. You have been doing so well, waking up early at 7 a.m. in the morning and coming for the lectures. You are doing almost all the hard work that your student can put in. Don't get distracted by small things in life. You can achieve something bigger. Such constructive criticism may be appreciated, but destructive criticism will not be appreciated. Next, it should be readable. The font size that it is used, the way the paragraphs are made, the way the title is given, it should be appealing, it should be readable. Next, the timeliness. See, information over a period of time will lose its relevance. Hence, what we should see is timeliness. And lastly, we should see the findings, we should state the conclusions, what is the findings. In case of internal audit, we also want to give a recommendation of where they can improve. We will give the recommendation. In the report, we will also write what is the auditor's views. So what is the views of the management in this particular case. We will prepare an executive summary. We will also state the supporting information so it is more convincing. We will have to give a draft report. Before writing the final report, he will always give a draft report, discuss the same, and then give the final report. So when we talk about the features, firstly, there should be objectivity, it should be unbiased. There should be absolute clarity, don't use technical terms or way too much of jargons. There should be accuracy, quantified. Assumptions are used, then state the assumptions. It should be concise, only vital information. Constructive criticism and no destructive criticism. Next is there should be a readability, the font that is used. Timeliness, if the report is received way too late, it will not be helpful. If the statutory auditor giving the report before the internal auditor, will not make sense. Next, the findings and the conclusion should be given. We should give a recommendation. We will give the auditor's views, the summary, supporting information, and lastly, before giving the final report, we should make a draft report. Question number 8, I am not taking very much in detail here because the relationship between internal auditor, external auditor, we have covered when we were discussing SH 610. So there is the external auditor can use the work of internal auditor, but however he will be solely responsible for expressing an opinion. So all these things we have basically covered under SS 610. So not wasting your time on that. Moving ahead with the last question, that is the internal auditor and external. But the relation between internal auditor and external auditor is important. So you do not skip it. I am assuming since we have done it in SS 610, I am not wasting your time here once again, but do read it. Examination point of view important. Next is distinguish between the internal auditor and the external auditor. So when it comes to internal audit, it refers to an ongoing audit performed within an organization by a separate internal audit department. But when we talk about external audit, it is an audit performed by independent body. See, it was within the organization. Here, this is not part of the organization. Hence, the name internal and external. Examination, internal auditor examines operational efficiency of the organization, whereas external auditor focuses on verifying the accuracy and validity on the financial statement. Here, internal auditor is appointed by the management. Here, it is external auditor is appointed by the members, that is the shareholders. Who are the users of the internal audit report? The management. But in case of the external audit, it is all the stakeholders. Who are the stakeholders? Like we always say, who are the stakeholders? See Mowgli. Customer, management, owner, government, lender, and other interested party. Period. It is conducted throughout the year. External audit is done once a year, but however, when we have concurrent audit, continuous audit, it may go on continuously as well. Opinion is provided on the effectiveness of the operational activities of the organization. So whether the operational activities are effective. But in case of external audit, it is given on the truthfulness and fairness of the financial statement. Internal auditor may or may not be an employee of the company, but external auditor has to be an independent person. So a simple distinguish but expanded from the exam point of view. So in case of internal audit, we have covered 9 topics. First part was the introduction, that is your meaning. Second, who is eligible and to whom it is applicable as per section 138. Areas of responsibility. Let us go through the areas of responsibility. What was the areas of responsibility? A mice, So he should evaluate the accounting procedures. M, closely associated with the management. He should operate independently. Critical appraisal of the various policies, not to involve himself in the executive function. Scope of the internal audit is UG scripts, that is evaluate the utilization of resources, accomplishment of goals and objectives. Next, C is custodianship and safeguarding of the asset. R is review the relevance and reliability of the information. Then internal control system and procedures, and plans, policies and procedures. One independent question that they can ask is, how do you review the organization structure? What you will say here is group balance. Firstly, how the activities are grouped. There is a harmony between responsibility and the authority. O1, we will verify the organization structure, whether it is simple and economical. O2, responsibilities of the management at the headquarters do not overlap with those of the chief executive operating units. Next, P, where dual responsibilities cannot be avoided, primary one should be specified and specific responsibility should be assigned. And lastly, balance, there should be a balance between responsibility and authority. Next is, what are the qualities? We should have 7 qualities. He should know the management control system, accounts and finance, technology, CA inter and foundation subjects, management principles, how to deal with people, and he should maintain confidentiality. Then what are the elements of the internal audit report? There should be a title, addressee, report distribution list, period of coverage of the report, opening or the introductory para. Next, objectives para, scope para, executive summary, the observation, comments, action taken report, date, place and signature. What are the features? The report should have objectivity, it should be unbiased, it should be clarity, accuracy quantified, where assumptions are used, give the assumptions, conciseness, only vital information, no destructive criticism, readability should be taken care of, timeliness, findings, conclusion, recommendation, auditor's views, summary, supporting information and the draft. And finally, we saw what is the distinction between internal audit and the external audit. So this was our discussion about internal audit. Let us just quickly go through the question bank of internal audit and move ahead with the management audit. So let us go through the question bank of internal audit. Firstly, they are saying write a short note on summary return report. So we'll write what are we supposed to include in the report. Next, state the aspects to be considered by the external auditor in evaluation of the internal audit function. This I am not discussing. This is part of our essay 610, though I printed the answer and given you for your own consideration. So we'll see the organizational structure, whether that particular internal audit function is independent or not. What is the scope, if whether any restriction has been put on the scope of that internal auditor. Does he have the adequate technical competence? Does he have the professional due care? Is he grossly negligent? And accordingly, we'll use the work. Now, AB Private Limited has outstanding loans or borrowings from bank exceeding 100 crores. Wants to appoint internal auditor. Please guide him as per the applicability. So, section 138, we have discussed the applicability. So, if you recollect, in case of, see, this is in case of a private limited company. In case of private limited company, what was a code? Double profit before tax. Deposit and paid up share capital will not consider. If borrowings is, this was 25, 50, 100, 200. If the borrowing is 100 crores or more, then in that case they will have to appoint. So here the borrowing is exceeding 100 crores, they will have to appoint the internal auditor. Now, the main objective of operational audit is to verify the fulfillment of the plans. So here by default, by error, actually operational audit question has been put into the part of internal audit. We will discuss this when we go to operational audit. Moon Limited, of which or you are the statutory auditor, have an internal audit being conducted by an outside agencies. State the factors that weigh consideration and opting to make the use of direct assistance. So direct assistance is covered under essay 610. How can we use the work of an auditor under direct assistance? Now, JKH Private Limited, who is into the business of imparting coaching to the CA students, they did not appoint any internal auditor for the year ended 31st March. As on 31st March 22, the company had a paid up capital of 50 lakhs and reserves of 10 crores. Its turnover for the 3 preceding year ended 31st of March was rupees 75 crores. 145 crores and a 260 crores respectively. As an auditor of the company for the year ended 31st of March 23, how would you deal? So you will, in case of turnover, the turnover has to be 200 crores or more. So here they are saying applicability. So company has the statutory liability to appoint the internal auditor. If the company does not appoint the internal auditor, we'll have to report under CARO 2020 since the turnover. So what was the code? Double. So here we are talking again of private company. So double profit before tax. We don't see deposit and paid up share capital. Borrowing is 100 crores or more. Turnover is 200 crores. Since the turnover in the preceding year is 200 crores or more, CARO, internal audit is applicable. WWF is a public company having 40 lakhs as paid up capital in the previous financial year, which raised to rupees 60 lakhs in the current financial year. The company had a turnover of the preceding 3 years as 49 crores, 145, 150. During the previous year, borrowed a loan from the public financial institution 100 crores, but squared up to 20 crores by the year end. The company does not have internal audit system. See, since the borrowing is greater than 100 crores, it will apply. Though they have squared of 20 crores, we see borrowing at any time during the year. So in the whole year, if it has exceeded 100 crores, this particular internal audit will be mandatory. So management of the is intention that internal audit is not mandatory is not correct. If they do not have the internal audit, we'll have to report under CARO 20 as well. The internal auditor makes an appraisal of the organization structure to ensure that it is in harmony with the objectives of the entity, besides checking the financial transaction and operational activity. So when we check the organization structure, I had already discussed that they will ask you a separate question based only and only on the organization structure. We have discussed this in the part A. One of the independent directors sought information regarding the appointment of internal auditors for the group companies in accordance with the Companies Act 2013. Certain financial information are given below. Now, in case of a listed company, the turnover is 190, loan is 50, deposits is 24. In case of unlisted public company, equity is 60, turnover is 190, borrowings is 50 and public deposit is 24. In case of unlisted private, it is turnover is 190, borrowings is 50 and public deposit is nil. We are required to evaluate the requirements of the Companies Act regarding appointment. So in case of listed company, it is always applicable. So in case of listed company, every listed company is required to appoint. Here we are not going to check the limits. In case of public company, the code was double profit before tax, deposit 25 crore or more, paid up share capital 50 crores or more, borrowings 100 crores or more, and turnover 200 crores. So though the deposit is less, but the paid up share capital in case of Ajit Limited is greater than 50, and therefore they are also required to appoint the internal auditor. So here, in case of Adi Limited, which is a listed company, appoint. In case of Ajit Limited, they will have to appoint. Now, in case of Nemi Limited is an unlisted company. Now, in this case, since the deposit is less than 25, they are, see deposit and paid up share capital will not see. Borrowing is less than 100, turnover is less than 200, and hence they did not appoint. So, in this particular case, in Nemi Limited, that is not required to appoint the internal auditor. Next, question number 10. ABC Private Limited was involved in the business of manufacturing of pipes and holdings for the financial year 21-22. The company had the following turnover from its various segments. Firstly, steel, iron, pipe manufacturing turnover was 140 crores, profit was 10 crores. Holdings and civil structure accessories was 25, profit there was 50 lakhs. PVC yellow pipe manufacturing was 65, profit there was 8 crores. During the financial year 22-23, the company's performance was considerably lower compared to the financial year 21-22 due to competition and high prices. Now, turnover for the year, so this was 21-22. Now they have given us the turnover for the year 22-23 and the profit as well. The company was fully financed through its own capital both the years. Kindly assess whether the company is required to appoint the internal auditor as per the section 138 and rule 13 for the financial year 22-23. Now again they will have to write the applicability. Here in the situation, the company is a private company, so if they have having a turnover of how much, 230 crores. So here they said they had a turnover of, if you add 140 plus 25 plus 65, so 140, this comes to, so here it is 230 crores. If you see in the current year, it is 60 plus, so it is 60 plus 15 plus 35, so the turnover here is 110. Now for here it was 230 and 110 in the financial year 22-23. Every private company having a turnover of 200 crore during the preceding financial year must appoint the internal auditor. As the turnover of the company exceeds 200 crore, the company is required to appoint internal auditor for the financial year 22-23. So we'll check the preceding year, not the current year. If the preceding year has a turnover of greater than 200 crores, you will have to appoint the internal auditor. So this was our discussion of the internal audit. So far out of the whole chapter, what we have covered is internal audit, management and operational. If you can understand, in case of internal audit, mainly what they were focusing on was the applicability of the internal audit, that is section 138, and questions related to SA 610 that we have covered under SA 610. Let us move ahead with our discussion of the management audit. So again, if we divide management audit, we have 10 questions so far. First is meaning. So first part is all basics, okay? Meaning, what is the scope of management audit? Why is it management audit desirable? How do we organize a management audit and how do we conduct it? Then it is about the types of management audit that we have. What are the various types of report? What is the elements of the report? And the most important topic, what are the behavioral aspects in case of management audit? So let us jump into the first part and start with the meaning. See, what is management audit? It is audit of management. See, when we go to operational audit is audit for management. Here it is audit for management. No, it is audit of management. So we are auditing whether management is playing their role correctly. So this is the meaning. Next, what is the scope? They say management audit is wider in scope compared to the operational audit. We will understand this quite in detail when we do operational audit. But whenever we are auditing management, we will also audit the operations to evaluate whether they are doing the work correctly. Hence, it is always be wider in scope, but we will take up this discussion when we do operational audit. In management audit, the auditor has to make test to the level of top management. In what? Whether they have done the formulation of the objectives correctly, whether the plans and policies are appropriate, the decision making. So we are testing the top level management. Now, from the view of the management auditor, he requires knowledge of the following. Firstly, he should understand the purpose for which the organization is created, whether the stated objectives are achieved or not achieved. Secondly, management structure. So firstly, he should understand the purpose, then he should understand the structure, who is going to delegate the authority, who is involved in planning, who is responsible for what job. Then what are the reports required for proper management and the reports actually received. So management requires a lot of MIS reports and everything. So what are the types of report required? What are the reports actually received? Next, what are the internal controls in an organization? So firstly, we understood what is the purpose. Secondly, the management structure. Thirdly, he should know the purpose. Fourthly, he should understand the internal controls. Next, the nature of the production of the business concerned in a broad way, so that he can understand what will be the flow and what flow and the content leading to the production and the mutual relationship. You should know about production planning. Basically, see, when you are auditing top level management, you should know the business in and out. You should know the factory layout, what the design, what is the install capacity, to understand whether we underutilization, whether the resources are used efficiently, what are the personal policies, how are we, whether there are any training facilities, how are we employing those people, material management including the source of important raw material, the sales management and the sales planning, and lastly the decision making process. So this is nothing but what? The scope. So firstly, it is about the meaning. Second, we studied scope. Now, why is management audit desirable? Why is management audit desirable? So the principal reason of management audit is to undertake detecting and overcoming the management deficiencies. So we can overcome the management deficiencies. Secondly, evaluate how well the management accomplishes its stated objectives. So how effective they are, whether they are achieving the objectives or not. Next, to identify the difficulties that the management is facing. Next, benefit of management auditing is that it represents another management tool to assist the organization in completing the desired objectives. When the management is aware that they are being audited, they will achieve their stated objective. And in case of ailing industries, it is very helpful. So somewhere it helps us in overcoming the management deficiencies. It helps us in achieving the goals and the objectives. Thirdly, we can identify management and related operational difficulties can be spotted. Next, they can achieve the desired objectives and helpful in case of ailing industries. Now, how do you organize the management audit? Firstly, we devise the statement of the policy and scope discussion with the top level management. Then location. See, location does not mean we are talking with the place. So for example, in case of management, there is going to be top level management, middle level management, lower level of management. So location of the audit personnel within the organization. So here we are obviously going to discuss with this with top level management. Then allocation of the personnel. So we'll have to select the people from for forming a team, we'll have people with technical and the experience. Next, time allocation, how much is the time that we should allocate, what is the cost allocation, and frequency of reporting and conducting the audit to be fixed in consultation with the top management. So these were very basic concepts of what is the meaning, scope, why is it desirable, and organizing. Next comes conducting the management audit. So we can conduct the management interview, we can get the facts through the interviews. So we can ask them direct questions, ask a number of direct questions to get your desired answers. Next, measuring the performance through the management questionnaires. So in case of interviews, a lot of times the top level management may not be available to you, to give you sufficient time for direct interviews. In that case, you can send them a questionnaire, a direct questionnaire, asking them to fill it. Either they will answer it yes, no, or not applicable. So there are two ways, either we can get it through an interview or either we can do it via questionnaire. Now, categories of the management auditor. Firstly, the reports prepared by the management audit staff. So this is categories of the management audit report. So reports prepared by the management audit staff under their visit to a unit. Secondly, periodical reports that we make. Thirdly, reports of special investigation and the annual report that we made. So these are the categories of the audit report. Next, types of report. So it can be an oral report wherever it is an urgency, wherever we need to communicate something ASAP, then we need not wait for a written report, we can give an oral report. Interim report, which can be given quarterly basis or semi-annually basis as per the terms of engagement. Next, regular reports. And lastly, summary report. Summary is also called as flash report. Mark this is important for MCQ. Flash report. So here also what we are doing is we are having a summary lecture or quick revision lecture. So a long report form where there is a lot of content may not be very much useful. Hence we will prepare a summary report as well. So types of report are oral report, interim report, regular written report. Now what are the elements? So similar to the internal audit, we will have a title. The management audit should have a short but a descriptive title so that its subject can be easily identified. Then what are the objectives of this particular management audit? What is the scope? We'll have to write it. The findings, conclusion, or opinion. What are the recommendations that we have given? What are the views of the auditee? That is, what is the view of the management? And finally, the summary. Now, important topic is point number 9. Behavioral aspects encountered in the management audit. So there is always going to be a staff and the line conflict. What do you mean by staff and line? The auditor versus the auditee will always have a difference. The staff line relationship is inherently prone to conflict. Managements are staff. So management auditors are called as staff. is the staff, and line people are nothing but the top level management. The line people, in sense, all the members of the other department of the organization are likely to regard management the same as other people. So for example, auditor will always think that his approach is the best approach. He has been appointed to audit the top level management. The suggestions given by him has to be implemented. An auditee may of the opinion that I am the best of this particular field, I am the CMO, I am the CFO, I know the best what is to be done, who are you to tell me? So there may be a lot of staff line conflict. So staff line conflict can arise due to multiple reasons. So what can be the fears here? So in this case, there can be a fear in case of the management. There can be a fear of criticism, that in case if this audit happens, there will be a lot of bad mouthing. There will be a lot of criticism. A fear of change. A lot of people do not want to change the way they have been working so far. So for example, whenever a technology was there, new technology was introduced, people still wanted to work the way they were working. There's a lot of resistance to change. So in case new suggestions are given, they are reluctant to the change. Next, there is a fear that there may be some punitive action. The superiors might take some action against them. Next, insensitive audit practices. So somewhere, it only focuses on the, where the management has made a mistake. It is only on destructive criticism rather than constructive criticism. And hostile audit style, where somewhere the auditor is focusing only, he does not give the opposite party to, give his point of views. The management does not have an option to put forward their point. They do not have a right of being heard. So these are the fears that they have. So amount of the fear that this action may reported are likely to cause adverse effects. So what are the fears we have seen? Now how do we solve this particular problem? So we should create an atmosphere of trust and friendliness. The management as well as the auditor should have a friendly environment where auditor can give his own suggestion, the management can reciprocate. There should be more of constructive criticism rather than destructive criticism. Reporting methods. So to achieve his objective, the auditor has to make a concentrated effort to convey his effectiveness by his role by adopting a firmly but a firm tone, friendly but a firm tone. So I be friendly enough, but he will not disagree with me. They say it is always possible to disagree without being disagreeable. And lastly, we'll have a participative approach. We'll ask the management, what are the good things? What are the areas where you are lacking? What do you think? Where should we make the improvement? So whenever there is a participative approach, there is a probability that they may themselves come up with the mistakes that they are doing, where are the deficiencies. So this is the solutions to the behavioral problem. So this was a discussion of the management audit divided into 10 questions. What is the meaning? Scope. Why is it desirable? Organizing management audit, conducting management audit, categorizes of management audit, types of report, report elements, behavioral aspects, and other solutions to the problem. So moving ahead with operational audit, we will discuss the question bank of management audit once we are done with operational audit, because a lot of questions ask you what is the difference between management and operational. Hence we need to firstly cover operational audit. Now in operational audit, there are 8 questions and 1 question of review of systems and procedure, which is independent. So firstly, we will understand the meaning, relationship of operational audit with internal audit, relationship of operational audit with management audit. What are the objectives of operational audit? What are the types of operational audit? Why is operational audit desirable? What are the qualities that you need to be an operational auditor? And difference between the financial audit and operational audit. So very simple, very short topic once again. The operational audit is a systematic process of evaluating the organization's effectiveness, efficiency and operations, economy of the operations under management control, and reporting to the appropriate persons the results of evaluation along with the recommendation. So we are going to check the effectiveness, whether they are achieving the stated objectives, efficiency, whether there is any waste of resources, economy, whether we are using the resources economically, we are not spending way more than what is required. So this is the meaning. What is the difference between internal audit and the operational audit? So internal audit is independent appraisal of activity within an organization to review for a review of operations as service to the organization. So somewhere what they are trying to say is an auditor is concerned with the appraisal of operation, he becomes an operational auditor. So when you try to appraise the operations, whether the operations are going on effectively, it is operational audit. But whenever you are doing an examination of internal control, appraising the internal controls, you are an internal auditor. So there may probably not be much difference. Why? In viewing the operational audit as review and appraisal of operation of the organization carried out by a competent independent person. So operational audit will always include appraisal of the controls as well. So somewhere usually can I say that operational audit here is greater than the internal audit, has more scope as compared to the internal audit. Now management audit and operational audit. See, management is concerned with the quality of managing, whereas operational audit focuses on quality of operations. Management is audit of management, how the management is doing the work, whether top level management is doing the work effectively, and whereas operational audit is audit for the management, whether the operations are operating effectively. The basic difference between the two is not in the method but in the level of appraisal. In a management audit, we are auditing the top level management. Who's attached? The top level management, whether their formulation of objectives is appropriate, whether the plans and policies, their decision making is appropriate. Whereas in case of operational audit, we are checking whether the operations are operating effectively. So it is safe to conclude that management audit includes the coverage of the operational audit. Why? Because when you're doing audit of management, you will have to evaluate whether the operations are operating effectively. I mean, if the management is doing their work diligently. So whenever you do management audit, it is going to cover operational audit. So can I say management audit is greater than operational audit? Operational audit was greater than internal audit. So this was meaning, relationship with the internal auditor, relationship with the management auditor. Now, what are the objectives here? Firstly, appraisal of controls, whether the controls are operating effectively. Appraisal of the performance. Appraisal of the objectives and plans, the objectives framed by the management, the policies framed are appropriate. And appraisal of the organization structure. Types of audit can be divided into three. One is functional audit, one is organization, and third is special. Functional means we are auditing one particular function. So it can be a billing function or it can be our HR function. It is one particular function of the organization. Organization audit means we are auditing one particular branch, one particular department, one particular subsidiary, one particular segment is called as organization. So function was focusing on one particular type of function, one particular type of activity. But organization is focusing on organization unit. It can be a department, branch, or a subsidiary. Special assignment is in context of certain thing. For example, let us say we are doing it in context of the IT system. For example, we think so there is a fraud in a division. So it is specifically for one particular task. It will be called a special assignment. So it can be divided into function, organization, special. So objectives was appraisal of controls, appraisal of performance, appraisal of objectives and plans, appraisal of the organization structure. Now, types of operational audit are functional audit, organization audit, special assignments. Why operational audit is desirable? Executive managers are too preoccupied with the implementation of plans and achieving the target. They're left with little or no time at all to locate the problems. So the managers who are into execution, the executive managers are very occupied. They will not look into where the problems are. They are busy completing their day-to-day task. Managers or their aides generally relied upon transmitting information than booking for information or analyzing the situation. So they are somewhere responsible for transmitting the information. Also, the information that is transmitted by the management may be biased a lot of times. Hence, operational audit is essential. In case of conventional audit, for example, internal audit. So internal audit a lot of times becomes very routine. It becomes very mechanical. Also, they might lean towards the accounting and a financial information. Hence, if operational audit is required, even though we have internal audit. If we have surveys and special investigation, there a lot of times, obviously, they are very useful. But they might be costly, they might be time consuming, also they might occur only in special occasion. Hence, for all these reasons, what is required is operational audit. So what were the 5 reasons? That the executive managers will be busy, they might be preoccupied with day-to-day business, they might be able to locate problems. So managers or their aid might generally be relied upon transmitting the information rather than booking for information. Also, the information that they transmit may a lot of times be biased. Internal audit may become routine, mechanical, and focused towards the accounting and the financial information. And surveys and special investigation are useful but are occasional, maybe cost and time consuming. Now, what are the qualities that you need as an operational auditor? So you should be quite inquisitive. You should, always be curious to know more about anything. You should be curious to know how, why, and how of everything. You should be in a position to visualize things. Only then you will be able to do operational audit. You should be persistent and should possess the attitude of skepticism. That is, you should be alert throughout the operational audit. You should not give up easily, feel satisfied. So you should have a constructive approach rather than fault finding approach. If you have constructive criticism as compared to destructive criticism, you would be able to obtain cooperation from the persons who are involved in the operation, and they will help you. So what are the qualities that you need? He should be inquisitive. Second, he should know who, why, and how of everything. Persistent and should possess the attitude of skepticism. Should not give up easily. Should use constructive approach, and you should use constructive criticism. So these are the 6 qualities that he must have. Now, review of systems and procedures. So they are just explaining what is a system. So it is nothing but a set of objectives together with relationship between objects and their attributes connected or related to each other. Procedures are policies implemented by the management. Now, whenever you are studying the system and the procedures, the auditor should ask himself 4 questions. Is the function properly located? So the personnel who is doing that particular job is fitly located. Is he capable of doing the work? So does he have the necessary training and experience to perform the work? Has a definite program been established and has been taken for the attentive accomplishment? And is the productivity satisfactory? Moving ahead with the last question. So what we are done with is objective, types, why operational audit, reviews, qualities. Moving with the last question, that is difference between financial audit and operational audit. The financial audit is basically concerned with the opinion whether the financial statements are true and fair. However, operational audit is based on the effectiveness, efficiency of the operations. Area, it obviously, the area is whether the financial state is the financial statement, but whereas in case of operational audit, we are going to focus on the operations. Reporting is to the stockholders, bankers. So can I say the stakeholders? Yes. But in case of operational audit, it is to the management. End task in case of financial audit is to express an opinion. But here it is to give them suggestions, the recommendations via which they can improve. So once again, purpose is to give an opinion on the historical information. In operational audit is about the effectiveness, efficiency of the operations. Area, in case of financial audit, it is for the financial statement, whether it is true and fair. So financial statement are restricted to the matters directly affecting appropriateness of the financial statement. But operational audit covers all activities that are related to efficiency, effectiveness of the operations. Reporting, it is to the stakeholders, but here it is to the management only. End task in financial audit, we want to just give a report. But however, in case of operation, we also want to give suggestions that can help us in improvement. Now, before going to the questions of operational audit, I will take you to the questions of management audit that we are here to discuss, because a lot of questions had management audit and operational audit together. So let us go through this. Now, ABC and Company Chartered Accountant have been approached by PQR Limited, a company engaged in iron and steel manufacturing industry. The company has been facing the following operational issues. The penal interest for delayed payments to the overseas vendors despite having enough cash flows. Next, despite having regular production and enough inventory, delays in shipping final goods to the customers leading to deteriorating vendor asset rating. As a partner of ABC and Company, through detailed discussion with the senior manager of PQR, you have concluded that all these delays are because of the long decision-making cycles in the company. As a consultant to the company, what would you recommend? Management audit or operational audit? So here, management audit is audit of a management. Operational audit is audit for management. Here, since they have said that all the delays were because of the long decision-making cycles by the company, so management is at fault. So it is not the operations are not operating effectively, the management is not taking quick decisions. So hence in this particular case, we will have to do management audit as compared to operation. However, let us go through the answer. Since the delay in the payment and consequential penal interest and the delays in the shipping and the consequent deteriorating vendor are happening because of delay in decision making process, therefore it appears that it is not just an internal control or operational issue but issue of the management process. Therefore what we must do is management audit and recommended in this case. I hope you are understanding what type of questions they will ask. This can be a case study, this can be a MCQ as well, where you will be given option which type of audit you must perform. Let's do such similar questions here. PQR has come across many instances where it could buy products at a lesser cost than the actual procurement price it paid. The management believes that the adequate purchase policy is in place, including the requirements of the three quotations from the registered vendors, appropriate vendor and rating mechanism. However, the on-ground implementation of the purchase policy might be defective. Further, it is observed that there might be some employees involved in choosing higher cost vendors as well. The company approaches you to advise the type of audit it should get done, management audit or operational audit. See here in this particular case, there is nothing indicating that management is not taking their decisions effectively. Here they are saying the management believes that the purchase policy is in place, the requirement of three quotation from registered vendor, appropriate and rating mechanism. However, ground implementation of the purchase policy might be defective. So policy is in place, but however implementation is defective. So whenever we are talking about the implementation, so somewhere the operations are not operating effectively. Hence in this case what we must do is operational audit. So since the management decision that are creating operational bottlenecks, the purchase policy and the procedure seems to be in place, the missing part is the operational implementation by the process employees. Hence what we will do here is operational audit. Question number 3, write a short note on management audit question as. So we can write a question answer we have already covered in the part A there. Somi Craft Paper Limited, a public limited company, there is a proper system of operational audit in the company. You as an advisor of the company have suggested desirability of management audit. Management is of the strong opinion that there is no difference between management audit and operational audit. Elaborate. So here they are saying there is no difference between management audit and operational audit. So obviously there is a difference between the two. So there they are saying there is a proper system of operational audit. Here you are asked to show the difference between the two. So management audit and operational audit are complementary. So we have studied this when we did operational audit. What is the difference between the two? It is the level of management. So somewhere this we have covered when we did operational audit. Next, Mox Limited is a manufacturing company and started its business in the year 2000. The net profit after tax of the company was 15% up to the financial year 2021. But the financial year 21-22 and the 22-23, the company profit declined, and when there was an increase in the sales and production of the goods by the company, so the management of AS Limited felt the need to get management audit conducted with the objective of detecting and overcoming the managerial deficiency. Discuss the steps to prepare the management audit report. So here we will write the steps to prepare the management audit report. Next, question number 6. The management of auditor has to analyze the nature and causes of behavioral problems in discharge of the review of functions to arrive possible situations to overcome these problems. As a management auditor of Real Limited, how will you demonstrate in arriving at a solution to behavioral problems and create an atmosphere of trust and friendliness, so that the audit reports will be understood in their proper perspective? So here what they are talking about is the behavioral problem. What is the solution? So we have discussed the solution of the behavioral problem. We will write all those solutions here. Next, XYZ Limited is a manufacturer of soaps and cosmetics having business operations in Delhi. XYZ Limited is planning to expand its operation across India. Before expansion, top management of XYZ is willing to appoint CAT for conducting management audit. However, the top management of XYZ Limited is afraid that management audit may lead to breeding of antagonism on the part of the company. The top management of XYZ approached CAT and explained them the causes of this. So here we have discussed the causes. There can be a fear of criticism, there can be a fear of change, there can be fear of punitive action, insensitive audit practices, and a hostile audit style. So these are the fears. So this also please mark it as important. Both this particular question number 6 and 7 are very important. Now moving to the questions of operational audit. The operational audit is carried out effectively when the operational auditor responds with the positive traits in the scenario that is blended with the behavioral issue. Explain a few positive traits that would conclude the operational audit as a success. So here what are they expecting from us is quality of auditor. So what are they expecting us from here is quality of auditor. Secondly, question number 2. Perfect Steel Limited has reported a higher turnover of around 560 crores in the year 19 as compared to the earlier year, but its sales return has also increased to 10% from 4% up to last year. Management is concerned about the high sales and feels a need to get operational audit done for the sales and production department of the company. The company is also having an internal audit department in the company. Elaborate the possible reasons why management is getting the operational audit done when the internal audit has been done for both the department. So here we need to tell them what is the need for operational audit. Secondly, they are asking us to discuss the difference between both the approach. So what is the difference between the management audit and operational audit? So here this we have discussed in the part A. Question number 3. ABC and Company Chartered Accountant have been approached by the PQR Limited, a company engaged in the iron and steel manufacturing industry. The company has been facing the following issues. Penal interest for the delayed payment to the overseas vendor despite having enough cash flows, and despite having regular production and enough inventories, delaying in shipping the final goods, the customer leading to its deteriorating vendor rating. As a part of Messrs. ABC and Company, through detailed discussion with the senior manager of PQR, you have concluded that all these delays are because of the longer decision-making cycles in the company. As a result of the company, you would recommend a management audit or operational audit. Now, since they have told you this is because of the long decision delay making, we also discussed similar question in the management audit. Here, what is required is the management audit. Next, PQR Company Limited has come across instances where it could buy products at a lesser cost than the actual procurement price. The management believes that adequate purchase policy is in place, including the requirement of 3 quotation. So the same question we had discussed in the management audit. So here what is required is the operational audit. So this is a repetitive question. You can strike this particular question off. Next, the marketing department of XYZ has consistently showing a lesser performance, whereas the cost department is increasing spurts over the years. The management believes since the marketing department is under the regular radar of the CFO, an audit might result in an employee hostility. Also, the operational audit of the marketing department was done 2 years back. However, the recommendation of the previous audit were not followed by the concerned employees. Please advise the management if another audit is the solution and whether one-time operational audit is enough. Further advice on the ways to deal with the employee hostility. So see, operational audit is not a one-time activity. It is obviously a continuous cycle. So here what they say is it is a continuous improvement cycle. It can be depicted through what we should do is plan, do, check and act. So operational audit should be done at least once in 3 years. So in the following case, what they are trying to say is operational audit should be done in the current scenario. However, to deal with the employee hostility, when there is employee hostility, we should try and use participative approach. Now, in this approach, auditor discusses the ideas for improvement with those managers that have to implement them and make them feel that have participated in the recommendations made for improvement. By soliciting the views of the operating personnel, the operational audit becomes cooperative enterprise. This participative approach encourages the auditor to develop a friendly attitude towards the auditors and look forward to their guidance in a more receptive fashion. ठीक है, so यहाँ पे what we should do is we should use this because it will develop a team spirit. Both the auditor as well as auditee will work towards a common goal and there will be no feeling of hostility. Next, question number 6. Employees of GIG Limited have to travel frequently for business purpose. So the company entered into contract with Simoni Travels for managing booking, cancellation and other services required by their employees. As per the contract terms, Simoni Travels has to raise the monthly bills for ticketing booked and cancelled during the period and same paid by GIG within 15 days of the bill date. The bills raised by the Simoni Travels were of huge amount. So the management of GIG decided to get audit conducted through the process of followed booking, cancellation of tickets and verify accuracy of the bills raised by the travel agency. Which do you feel the management should opt for? Also, briefly discuss the qualities of the auditor should possess. So here we are asked two things. Which do you feel the management audit should opt for and what are the qualities the auditor should possess? So here the qualities of an operational auditor are given. In the case the question mentioned management should opt for operational audit because it is about the audit of the operations. It is not about how the management is managing. And once you identify this particular answer that it is operational audit, you will have to write the qualities of operational auditor, or else if you end up writing management auditor, then you write the qualities of management auditor. So important is first to identify this is operational audit, then write the qualities of the operational auditor. Perfect Steel Limited has reported higher turnover of 560 crores in 21-22 compared to the earlier years. So this is also again a repetitive questions that we have done, so need not refer this. In the review of the systems or procedures, the management must concern himself with the purpose as well as design, elucidate how as a management would study the system. So we have discussed that we should ask 4 questions. The auditor should be in a position to ask 4 questions. So we will refer the answer of review of systems and procedures. Next, CA Gudia has been appointed as management auditor. The principal reason for her appointment is that current managerial decisions are not up to the mark, especially in relation to the investment made by the company. Company is going to make huge investment in one of the ventures identified. Management auditor was required to ensure that the systems and the procedure of the company are working effectively and meeting the requirement. What aspects should be considered by CA Gudia to determine that the systems and procedures are meeting the current requirement? So again the answer will be to evaluate the systems and procedure. XYZ, a manufacturing unit, does not accept recommendation for improvement by the operational auditor. Suggest alternative way to tackle the hostile management. So whenever there is hostile management, we should use participative approach. We discussed in the earlier answer as well. We should develop a friendly attitude towards this. It will in this case both the auditee and auditor will come together and work towards a common goal and there will be no hostile environment. The marketing department of Ishita Limited has been consistently showing a lower performance, whereas the cost of the department is increasing. So again, this question is a repetitive question which we have discussed about the frequency of the operational audit and dealing with this. So need not do it once again. So with this, we are done with the topic of internal audit, management audit and operational audit as well. So every topic, if you divide it into multiple simple parts, it will be much easier for you to revise. So first you do internal audit, then operation and then do management audit. It gets easier for you to revise everything. So with this, we put an end to this particular chapter. Let us move ahead with our discussion of the next chapter. So let us begin with the next chapter, that is peer review. Yes, a few updates, few amendments in this particular chapter. So firstly, a few basic terminologies. What do you mean by peer? Peer means a person of similar standing, and review means conduct of re-examination or retrospective evaluation of the subject matter. What do you mean by peer review? So peer review is examination and review of systems and procedures to determine whether the same have been put in place by the practice unit for ensuring quality of assurance services. As envisaged by technical, professional, ethical standards. What are professional, ethical, technical standards? We'll discuss. Next, who is a reviewer? Reviewer means a member duly approved and empaneled by the board on fulfilling the qualification prescribed for reviewer as per the guidelines 26 of this guidelines. Who is a branch peer reviewer? A reviewer appointed to conduct peer review of a branch of a practice unit is nothing but a branch peer reviewer. What do you mean by new unit? This is a new addition here. Means whose date of establishment is less than 12 months immediately preceding the date of the receipt of application of peer review, which may or may not have rendered any assurance services during the said period. So, 1 means whose date of establishment is less than 12 months immediately the preceding date of application of peer review, and they may or may not have rendered assurance services, or practice unit is in existence for a period exceeding 12 months but not rendering any assurance services. So it is established less than 12 months, may or may not be providing assurance services. If it is more than 12 months, they have not rendered any assurance service. They are called as what? New unit. Now there is peer review guidelines. There is a practice unit. Practice units means a firm of chartered accountant or a member in practice, whether in individual name or trade name or such other entity recognized by the institute from time to time. Then there is a peer review board. We will discuss how do we constitute a peer review board. Moving ahead with the objectives of the peer review. It is to see whether we comply with the technical, professional and ethical standard as applicable, including the regulatory requirement, and whether they have in place proper systems including documentation thereof to amply demonstrate the quality of assurance. What do you mean by demonstrate? So they can, someone can review whether they are complying with the technical, ethical standards. So to comply with professional, ethical, technical standards and systems including documentation that can demonstrate the quality of services. The objective of peer review is not to find out the deficiencies but to improve the quality of the services rendered by the members of the profession. Next, what is included in the scope? So the statement on peer review lays down the scope to be conducted as under. The peer review process shall apply to all assurance services provided by a practice unit. So once the practice unit is selected for review, its assurance engagement records pertaining to the peer review shall be subject to review. The reviewer shall cover the compliance with technical, professional, ethical standards, with the quality of reporting, the systems and procedures for carrying out the assurance services, training programs for the staff, including the article and the audit assistant concerned with the assurance functions, compliance with the directions or guidelines issued by the council members, including what is the fees to be charged, number of the audit undertaken, register of assurance engagement conducted during the year, compliance with the direction or guidelines of the council in relation to article assistant and audit assistant, including attendance, their work diary, stipend. Also, the self-evaluation of the audit quality maturity model or any other guidelines issued by the Center of Audit Quality or any other professional, technical, ethical standard and standard issued by the governing profession of the chartered accountancy, and any other services rendered or functions performed by practitioner not prescribed by the council to be assurance engagement. Next, as it is clear that the statement of peer review aims to confine the scope to the preceding 3 years, since it would establish consistency. So all the assurance engagement performed in the preceding 3 years will be subject to review. Now we have been saying comply with the technical, professional, ethical standard. What do you mean by technical, professional, ethical standard? The accounting standard issued by ICAI. The accounting standard issued by ICAI applicable for entities other than the companies. Then accounting standard prescribed under section 133 applicable to the companies. Then Ind AS prescribed under again section 133 of the Companies Act. Then standard issued by ICI, for example, engagement quality control, the statement, the guidance note, standards on internal audit, guidance, notification, directions, announcement, pronouncement, professional standards issued from time to time. And lastly, the framework for preparation and presentation of financial statement, preface to the standard on quality control, auditing, review and other assurance and related, and framework for assurance engagements. Now the practice units were subject to the review. Earlier, the practice unit were classified as level 1 category, level 2 category. However, they have changed everything. Under the review guidelines, has been replaced by the review mandate implementation. So, as per clause 5 other review guidelines, criteria for review are defined on the following basis. One is for whom mandatory review is needed. Secondary, voluntary review, or in case of special case. So, in case of mandatory, peer review can be mandated for such practice unit as may be decided by the council. We will study it further in the next page. Voluntary, any practice unit may suo moto. Suo moto means on their own, apply to the board for the conduct of its review. Special case, the board on specific information received from the secretary, ICI or disciplinary directorate or any other regulator, which is in the opinion that requires a peer review of the practice unit, conduct a special peer review. Now, whom it is mandatory. So, with effect from 1/4/22, practice unit which propose to undertake statutory of enterprise whose equity or debt are listed in India or abroad. So, if you want to do audit of entities who are listed entities, then peer review is mandatory from 1/4/22 itself. Now, practice unit who propose to undertake audit of unlisted public company having paid up share capital of not less than 500 crore. So, paid up share capital of greater than or equal to 500 crores or having annual turnover of not less than 1000 crore. So, turnover of 1000 crores or having an aggregate outstanding debentures, deposits not less than 500 crores. So, borrowing is 500 crores or more. As on 31st of March of the immediately preceding financial year. For this practice unit, there is a prerequisite of having peer review certificate. So, for this particular if I am auditing such entities, I need to have peer review certificate by 1/4/23. Or a practice unit rendering attestation service. So, attestation can be anything, audit, review, assurance, wherever you are providing an opinion, and having 5 or more partners. For this practice unit, there is a prerequisite of having a peer review. So, either if I am auditing a entity which is an unlisted company whose paid up share capital is 500 crores or more, or turnover is 100,000 crores or more, or borrowings is 500 crores or more, or if I have 5 or more members in my practice unit, then I need to obtain peer review certificate by 1st of April 23. Practice unit which propose to undertake audit of entities that have raised funds from public or banks or financial institution over 50 crore rupees during the period under review, or any body corporate including trust which are covered under the public interest. So, if there is an entity who has raised funds for 50 crores or more, or if there is a trust which are covered under public interest, if I am auditing such entities, I need to have a peer review certificate by 1st of April 24. Or if I am a practice unit rendering attestation services and having 4 or more partners. So, if I have 4 or more partners, I need to have this particular certificate by 1st of April 24. Next, practice unit proposed to undertake audit of branches of public sector banks, need to have it by 1st of April 25, or having 3 or more partners. So, in case of public sector banks, branches of public sector banks by 1st of April 24. So, once again to cover, let us just go through. If you are a practice unit undertaking audit of listed entities, then by 1st of April 22. If you are undertaking audit of unlisted public companies having paid up share capital of 500 crore or more, turnover of 1000 crore or more, or borrowing of 500 crores or more, or if your practice unit is providing attestation function and having 5 or more partners, then from 1/4/23. Next, practice unit which proposed to undertake the statutory audit of entities have raised from the public or the banks or financial institution over 50 crores during the period under review, or the trust which are covered under public interest or having 4 or more partners from 1/4/24. If I am auditing entities of branches of public sector banks, then 1/4/25, or practice unit having 3 or more partners. For auditors from this category, peer review is already mandated by SEBI. So if you are doing audit of listed entities, it was already, peer review was already mandatory. At each phase, before undertaking the statutory audit, the concerned practice unit should possess a peer review certificate. So before I start with the audit, I need a certificate. Provision relevant to the statute or rules regulation which are applicable in the context of specific engagement being reviewed, including instruction, guidelines, notification issued by regulatory bodies, is covered in the scope of assurance engagement. Now, what do you mean by assurance engagement? As defined in the framework of assurance engagement issued by the institute, as may be amended from time to time, means when a practitioner expresses a conclusion. So whenever we are giving an opinion, is called as assurance, designed to enhance the degree of confidence of the intended users other than the responsible party. See, who is the responsible party? Management. When we give an assurance, it increases the confidence of the intended users other than the responsible parties. So who are the other responsible party? Who are the other stakeholders? The customers, owner, government, lenders. So other parties may have reliance on the same. But however, this particular assurance services does not include management consultancy service. Do we provide any assurance while we do management consultancy service? Hence, no, this is not an assurance engagement. Representation before various authorities, again we are not expressing an opinion, hence not an assurance engagement. Engagement to prepare tax returns or advising clients, again no opinion. Engagement for compilation of the financial statement. Engaging solely to assist in the client in preparing, compiling or collating the information other than the financial statement. Testifying as an expert witness, providing expert opinion on points of principle such as accounting standards or applicability of certain laws, and engagement of due diligence. So wherever we are not expressing an opinion, this is not covered under the assurance engagement. Next, a peer review board. The board shall be constituted by the council. The board shall consist of minimum 6 members and maximum 12 members. So minimum has to be 6, maximum has to be 12. Earlier they had not stated what was the minimum, they had only stated maximum. To be appointed by the council, of whom not less than 50% shall be the members of the council. So out of 12, minimum 6 and maximum 12, 50% should be members of the institute. Now the remaining 50%, the council will only nominate. The council may nominate members to the board from outside bodies or from amongst prominent individuals of high integrity and reputation, including but not limited to the regulatory authorities, bankers, accumulations. So they are given example who can be appointed. Now the council shall appoint chairperson and vice chairperson from amongst its elected council members. So chairperson and vice chairperson has to be a member of the institute. So once again, minimum was 6, maximum was 12. 50% should be members of the council, rest 50% council will only nominate. The chairperson and vice chairperson has to be the member of the institute. What will be their tenure? The 2/3 of the members shall be for 3 years or end of the term in the council, whichever is earlier, or other period as may be prescribed from time to time. So for example, let us say if there is a member, he is going to be a member of the council for the next 2 years. So 2 years or 3 years, whichever is earlier. So in this case 2 years. He is going to be a member of the council for the next 5 years or 3 years, whichever is earlier. So in this case it will be 3 years. However, chairperson and the vice chairperson may be rotated every year by the council of the institute. If there is any vacancies on the board, it shall be filled by the council. A member of disciplinary committee or disciplinary board of the institute shall not be a member of the board. So if you are a member of disciplinary committee or disciplinary board, it will lead to conflict of interest. Hence, you should not be part of the peer review board. Next, what are the meeting requirements? No business shall be transacted unless there are at least 1/3 of the members, but not less than 3 members. So for example, let us say minimum number of members in the board was 6, maximum was 12. For example, let us say if they had only, let us say, 6 members, so 1/3 of 6 is going to be 2. So they said it should be 1/3, but it should not be less than 3. So 1/3 or 3, whichever is higher, so they should at least have how much? 3 members. So in case if there are 12 members, so 12 ka 1/3 comes to 4th, or 3, whichever is higher. So here there have to be at least 4 members present in the meeting, including the chairperson, and in his absence there should be at least vice chairperson. So what should be the quorum for the meeting? 1/3 of the members or 3, including the chairperson, or in his absence the vice chairperson. In the absence of the quorum, within half an hour of the time fixed of the meeting shall be adjourned to the date, time and place fixed by the chairperson, and in his absence the vice chairperson. So here it is not adjourned to the same date, same time, same place, next week or next month. The chairperson or the vice chairperson will decide. The board shall meet as and when required for this transaction. However, at least one meeting shall be held in each calendar year. So in every calendar quarter, at least there should be one meeting at least. Now the report shall be submitted to the council prior to the date of the meeting of the council. Now, who is eligible to be a reviewer? So to be a peer reviewer, he shall be a member in practice with at least 7 years of assurance engagement experience. So in the earlier peer review, they had said 7 years of audit experience. They have changed it to assurance. So it can be review, assurance, audit, anything. So 7 years of assurance engagement experience. In case he has moved from industry to practice, is currently in practice, he should have at least 10 years of assurance engagement experience in industry. So he should be related to doing assurance engagement when he was in industry, and at least 3 years of audit experience in practice, assurance engagement experience in practice. Should have undergone the requisite training and cleared the requisite test for peer review as may be prescribed. So he should have completed the requisite test as well. A member on being appointed as a reviewer shall be required to furnish a declaration as prescribed by the board at the time of empanelment and a declaration of confidentiality as per the Annexure A. A member will not be eligible to be appointed as a reviewer of the practice unit in case if there is any disciplinary action proceeding is pending against him, he has been found guilty of the professional or other misconduct by the council or the board of discipline or the disciplinary committee. He has been convicted by a competent court within or outside India. He or his partners have any obligation or conflict of interest, and he has undergone training articleship under the partner or the practice unit. So if you have undergone training from the partner of the practice unit, then he might influence your decision, or you may probably want to take a revenge and make sure he all the bad things that he did to you, you'll return him back. Or reviewer shall not accept professional assignment from the practice unit for a period of 2 years from the date of appointment. So once I have done a peer review, I will not accept any referral work from that practice unit for a period of 2 years. See, this can be given as a bribe. Can you please give a good peer review certificate? I will refer you a few clients. No. Further, he should not have accepted any professional assignment from the practice unit for 2 years before the date of appointment. So I cannot accept before, or I cannot accept after. See, if I already accepted 2 years prior, then in that case he can again influence my decision. He can say, see, I have helped you so much, I have referred you so many clients. Or if he's telling me, I will give you later on, so not prior or not later. Then you need to have a qualified assistant. A reviewer may take a help of a qualified assistant while carrying on the review. Board decided to clarify that reviewer is permitted to take assistance of only one assistant, who shall be a chartered accountant and a person who does not attract any disqualification prescribed under section 8 or section 21 of the CA Act. So like only one assistant, and he should also be a chartered accountant. The name of the qualified assistant which the reviewer would like to assist him shall be identified and intimated to the board as well as the practice unit before we commence with the peer review. So if I am using a qualified assistant, I will inform the practice unit as well as the board. Such assistant shall also have to sign a declaration of confidentiality. Now, there should be no direct interference by this qualified assistant with the practice unit or the board. He will just be helping the reviewer. He will not communicate with the practice unit nor with the board. Next, we have to maintain strict confidentiality by all those involved in the peer review process, namely the reviewer, members of the board, and any qualified assistants of the practice unit. All persons governed by the secrecy provision shall at all times preserve and aid secrecy with regard to any matters. Reviewer shall not make use of or disclose contents of the peer review report or confidential information about the process of the review. If there is a non-compliance of the secrecy, the above clause shall amount to professional misconduct as under section 22 of the CA Act. A declaration of confidentiality shall be signed by the person who are responsible for the conduct of the review, that is reviewer and the qualified assistants, and filed with the board. Next is the approach of the reviewer. I am not revising it, you can just read through this. I am directly taking you to the procedure for the peer review. So, I have given the whole procedure here, though I will make you write a small chart on the peer review process so you can revise everything at one single go. Now, initiating the peer review. So, the practice unit shall submit application cum questionnaire in form number 1 to the peer review board. On receipt of the application, the board or the recommended name of 3 reviewers to the practice unit within 3 working days. So, board will give a recommendation of how many reviewers? 3 reviewers to the practice unit in 3 working days. So, here we have taken 3 working days. The practice unit out of the 3 reviewers will select one reviewer within 1 working days. Now, board shall appoint a peer reviewer selected by the practice unit in accordance with the guidelines. The board shall intimate to the reviewer to submit a declaration of confidentiality in form number 2 to practice unit within 2 working days from the receipt of choice of name. Now, the practice unit shall provide a copy of application cum questionnaire in form number 1 to the reviewer within 2 working days. So, we will have to give it to the reviewer as well. So, here we had given the application cum questionnaire to the board. Here we are giving it to the reviewer within 2 working days. Now, the reviewer may seek additional clarification in form number 6 from the practice unit on the information not furnished in the questionnaire. They will have to give this within 1 working day. Now, the reviewer within 2 working days of receiving the information from the practice unit, select the assurance service engagement that he wants to review and intimate the same to the practice unit as well as the peer review board in form number 5. So, again 2 working days here. Reviewer shall plan an on-site review where he will go to the practice unit, and the practice unit shall be given at least 2 days to keep the necessary records ready. The reviewer and the practice unit shall mutually cooperate to complete the entire process within 20 working days from the date of receipt of the application and within 7 days in case of new unit. So far we have taken 3 plus 1 4, 4 plus 2 6, 8, 9, 9 plus 2 11, 11 plus 2 13. We have already taken 13 days. So, out of 20 days what we are left with is only 7 days. Now, in case of execution, the peer review should not extend beyond 6 working days, and in case of new unit only 1 working day. There should be compliance with the general controls review of the following factor. We'll see whether there is independence, maintenance of professional skill and standards, whether outside consultation has been obtained, staff recruitment, supervision, development, office administration. Next, selection of the assurance services for review. Now, how many assurance services to select depends on various factors. For example, the reviewer may initially select a small sample but may later on enlarge the initial sample size at the planning stage. Now, review of records. The reviewer is required to adopt a combination of both substantive approach as well as compliance approach. In compliance approach, we will see whether the controls have been established. Substantive approach, we will review the working papers. In case of a new unit, review should be conducted based on the antecedents of the partner and policy parameter. Verify the same from the application cum questionnaire form. Now, on-site review should be restricted to only and only 1 day. So, this was firstly our initiation stage. Second was the peer review procedure to be followed by the reviewer. Third was the execution stage. Next is the reporting stage. After on-site review, what can be the opinion? After on-site reviewer's opinion, practice unit has adequate system procedure in compliance with the professional ethical standards. So they say they are in compliance. We will submit a peer review report to the board along with form 9 copy. The same is to be forwarded to the practice unit. But however, if there is deficient or non-compliance and he wants to seek additional clarification, communicate to the practice unit in a preliminary report. PU to submit the representation within 2 working days to the reviewer. Now, if the reviewer is satisfied, then unqualified peer review report in the form 9 to the board. However, if they are not satisfied, he will give a qualified report plus reasons for the same in form 9 to the board and forward a copy to the practice unit in both the cases. Second, report to state the system of quality control designed to carry out assurance in accordance with the professional ethical technical standard. Reviewer to also submit the following documents. So we should submit the annexures of the report as prescribed by the board, copy of question as needed from the practice unit, list of the samples selected by him, preliminary report if issued along with the practice unit submission on the same, and practice reviewer to excuse that all the documents are duly signed. Last comes review of report by the peer review secretariat and issuance of the peer review certificate. The peer review secretary assured that report is accompanied by all the documents, so it should be assured that all the documents are received. In case quality report board may decide to follow on a reviewer for a period of 1 year, the board may reduce the period of 1 year but not less than 6 months. So if the review board is of the opinion that there should be a follow-on review, they will conduct it within 1 year. This 1 year can be reduced to 6 months. Peer review secretary shall place the report before the board and the subcommittee for issuance of a peer review certificate. The peer review certificate that has been obtained is valid for 3 years. In case of new unit, the validity will be decided by the board, and what should be the extension, we have to make an application in form number 8. So this was our process of the peer review. I have given the detailed procedure as well in the textbook, but this in a very quick, in a short manner, we have revised of what should the peer review process be. After this, there is also quality review. Make sure you revise quality review as well. Let us move ahead with our discussion of the next chapter. So let us begin with the next chapter, that is due diligence, investigation and forensic audit. For example, let us say Future Group, Reliance Retail wants to acquire Future Group. So they are considering whether they should buy Future Group, if yes, for what particular amount. So this whole process is nothing but due diligence. For example, either of you all end up asking me, sir, shall I invest in InfoEdge? Shall I buy the shares of InfoEdge? Shall I hold the shares of InfoEdge? Shall I sell the shares of InfoEdge? The process that I am doing and recommending you is nothing but due diligence. So due diligence is a process of investigation performed by investors into the details of potential investment, such as examination of operations and management and verification of material fact. It entails conducting inquiries for the purpose of timely, sufficient and accurate disclosure of all material statements which may influence the outcome of the transaction. So what is the difference between the due diligence and audit? See, in case of audit, we express an opinion on the financial statement, whereas due diligence refers to an examination of potential investment to confirm that all material facts of the prospective business opportunities. So whether the business is what it appears to be. It involves reviews of financial as well as the non-financial records as deemed relevant. So in case of audit, it is to express an opinion on the financial statement, whether it is true and fair. Here it is examination into the potential investment, whether we should acquire this company, if yes, at what prices, and it involves the review of both financial and non-financial. Simply put, due diligence aims to take care that reasonable person should take care before entering into agreement or transaction with another party. Now, what is the importance of due diligence? Firstly, when we perform due diligence, we'll come to know whether the business is what it appears to be. So outside, a lot of times it might look very rosy, okay, the company is making, having a lot of good brand value, having a lot of sales, but when you check into detail, maybe the company is suffering huge losses. Secondly, to identify whether there are any deal killer effects. If Reliance Retail is acquiring, let us say, Future Group, there is a chances that we might acquire a very huge task force, a huge labor force, and we might have to lay off a lot of people, and a company does not want to do that. If they lay off a lot of people, it will impact their brand value, their goodwill. So whether any there is deal killer effect. Or for example, let us say Apple is considering investing into, let us say, for example, Vivo. Now let us say Apple is very environment friendly company which focuses a lot of environment. Vivo unfortunately does not. For example, now there is a deal killer effect because Apple wants to turn eco-friendly, they are not harming the environment by 2030, but if they acquire Vivo they will not be able to do that. Then this might be a deal killer effect. To gain information that will useful in valuing the assets, defining the representation and warranties, so we come to know whether the assets are appropriately valued, the liabilities, because based on this what we will calculate is purchase consideration. Verify that the transaction complies with the investment or the acquisition criteria. So whenever we acquire a company, every time we'll have a acquisition criteria. For example, if Tata is investing into startups, they might have an acquisition criteria that we want to invest in health sector or infrastructure sector. So for example, they don't want to enter into edtech business. So every investor has some criteria. So we need to see whether we are complying with this criteria. So what we studied here is, firstly, what is the meaning. Second was, what is the difference between audit and due diligence. So this was audit versus due diligence. And thirdly was importance of due diligence. Okay, so meaning audit versus due diligence and importance of due diligence. Now next is classification of due diligence. So it is classified into commercial or operational due diligence, financial due diligence, tax due diligence, information system due diligence, legal due diligence, environment due diligence, and personal due diligence. Next is classification of due diligence. It can be classified into commercial due diligence, finance due diligence, tax due diligence, information system, legal, environment, and personal. What do you mean by the commercial due diligence? It is basically whether this particular merger, whether this particular thing, it will help us in generating operational synergy, whether it will be an advantage. For example, if Reliance Retail and Big Bazaar is coming together, if they have their, for example, let us say their stores in the same locality, it will not create operational synergies. For example, let us say if Reliance Retail has store at one place in the 2 kilometer radius, if Future Group has some store, then it will create some operational synergy. But if they are in the same mall, same premises, it may not create operational synergies. Second, the financial due diligence, it involves analysis of books of accounts and whether it is making financial sense or not. Tax due diligence, with the help, when you acquire this, it should not result in additional taxation. For example, when you acquire, the second company is sold, so it may result in capital gains as well. Information system due diligence is important. Let us say Future Group is using SAP and let us say Reliance Retail is using some other information system. Getting both of them at par using on one single information system is a difficult task to do. Legal due diligence, a lot of times, there might be violation of the let us say competition act, violation of environmental act, so we have to consider the legal due diligence. Next is environmental due diligence. We took an example of Apple, that Apple may not be keen to buy Vivo because it will affect their environmental goals. Personal due diligence, again an important part, which is very crucial when we have a amalgamation or a merger, whether both the employees would want to work together. Do we require both the set of employees? Does both the role exist, or we may have to lay off? So we'll have to consider the personal due diligence as well. Now in case of financial due diligence, they have said in order to achieve its objective, the due diligence process can include any or all of the following objective. So we should have a firstly study the brief history of the business, description of the business, what exactly is the business doing, background of the promoters, because a lot of times if you are not very comfortable with the promoters, they have been on a lot of litigations against them, they have been known for betraying people, you might not be keen to invest them. The accounting policies and the practices follows, because when there is a merger, we'll have to harmonize all the accounting policies. The management information system, the details of the management structure, trading results both of the past and the present, both of the past and the recent past, assets liabilities as per the balance sheet, the current status of the income tax assessment, whether there are any proceedings against them, cash flow patterns, brief description of the commercial and other activities carried out by the organization, the projection of the future profitability, and the full-fledged due diligence is conducted. So here they have given how do you conduct a full-fledged due diligence. So you will understand the brief target of the company and the background of its promoters. They have given a lot of examples, the accounting policies, the review of the financial statements. Okay, so in the review of the financial statement, let us discuss an important question, that is a hidden liability. So whenever you are verifying the assets and the liabilities, a lot of times they may have hidden liabilities. How would you know whether there are any hidden liabilities? So why would they want to reduce the liabilities? Because purchase consideration is nothing but your net asset minus net liability. So a lot of times they may, try to suppress the liabilities. So how will you come to know whether there are any hidden liabilities? So for example, company may not show any show cause notice which have not matured into demand. So there is a show cause notice. However, there is no demand so far. I mean, it has not materialized so far, but they are hiding that particular show cause notice from you. Company may have given a letter of comfort to the bank which they are hiding. Since these are not guarantees, this may not be disclosed in the balance sheet of the target companies. Next, companies may have sold some subsidiary business and may have agreed to take over and indemnify all the liabilities and the contingent liability which they may have not shown. Products and other liability claims, for example, warranty liability, product returns, discounts, tax liability under the direct and the indirect taxes, long pending sales tax assessment, pending final assessment of custom duty, agreement to buy the shares sold. So with all these things, you will understand whether any liabilities has been hidden or not. Future lease liabilities, environmental problems, claims, third party claims, unfunded gratuity, superannuation, leave salary, incorrect gratuity valuations, huge labor claims under the negotiation when the labor wage agreement has already been expired, and unresolved labor litigation. Also, a lot of times, since they are trying to suppress the liabilities, they might also try to overvalue the asset. How will they overvalue the assets? So they may show uncollectible receivable which should have been provided for, obsolete non-moving inventories and inventories above the NRV. So it should be not be valued at cost, it should be valued at NRV. In case if it is obsolete, the value will come down. Underused or obsolete plant and machinery and their spares which have been impaired due to sudden fall in the market value. So there has been an impairment, however they have not recorded the impairment and they may overvalue the assets that are much more than the current market value due to the capitalization of expenditure, foreign exchange fluctuation, or capitalization of expenditure mainly in the nature of revenue. Next, litigated assets and property. Investment carried at cost through realizable value is much where it is very low. Investment carrying a very low rate of return. Infructuous projects, deferred revenue expenditure, group company under reconciliation, and intangible assets of no value. So these two are important answers where they might, given the, not disclose the liabilities, or they may have overvalued the assets. Next, then you can have a tax due diligence. We have already discussed. We will also check the cash flows of the company. We will also check the financial projections of the company and management and employees, which we have already covered in the types of due diligence. So I'm not taking you in detail over there. What can be the work approach for due diligence? So the work approach, firstly, we should assess the business fair value passes through. Secondly, review and reporting on the financial statement that are submitted. You should go and do the first business, visit the first site, do the business first hand review, then work through the process with the acquisitioning company and decide what are the key areas, define those key areas. Based on this, you should help prepare an offer on the completion of the due diligence. Now, how do you conduct due diligence? You should always be open-minded. Do not assume that anything will be found wrong. Secondly, you should get the best team of people. Wherever required, you can get experts in the field of finance, tax, legal, marketing, technology. You also talk to the customers, suppliers, partners, employees. Then do a risk management approach and prepare a comprehensive report detailing the compliance and the substantive issues. Lastly, what are the contents of a due diligence report? Firstly, the contents of the due diligence report will vary with the individual circumstances, so it may not be fixed. Firstly, examples of heading of a due diligence report. Then we may have a executive summary. Executive summary is nothing but kind of a comprehensive summary where we include the main points. Then we will write an introduction. We can give a brief background about the target company whom we are going to acquire. What are the objectives of this due diligence? The terms and reference to the scope of verification, the brief history, what is the shareholding pattern, what were our observation, assessment of the management structure, assessment of the financial liabilities, assessment of the valuations, comments on the properties, terms, lien and encumbrances, assessment of the operating results, assessment of tax statutory liabilities, possible liabilities on account of litigation and legal proceedings, assessment of the net worth, interlocking investments and obligation, SWOT analysis, comment on the future projection, status of the charge, suggestions on the ways and means including affidavits, and suggestion on various aspects taken care before and after the proposed merger. So somewhere they have included all the assessment that they have made. So somewhere the report on due diligence have not been asked very frequently, but we cannot comment. So a lot of students ask me, sir, can we write few points out of this? You should try to write as many points as possible out of this. So this was our discussion of due diligence. Let us move ahead with the question bank of due diligence. KDK Bank received an application from a pharmaceutical company for takeover of their outstanding term loans secured on its asset, availed from an outstanding and with the nationalized bank. KDK Limited requires you to make a due diligence audit in the areas of pharmaceutical companies, especially with reference to the valuation of assets. What may be your ideas of analysis in order to ensure that assets are not overstated and overvalued? So in case of hidden liabilities, what you will be writing here is overvalued. So if you recollect this answer, here we discussed that assets can be overvalued. So this is the answer that you will have to write it here. Next, Ekbote company is currently a large organization trading in the items of office furniture. The entity wants to expand and hence are looking at acquisition of Rawat company, which deals in the items of household furniture. Ekbote company hires a chartered accountant to conduct due diligence to consider whether there is potential for additional value to be bought out the target company by improving its operational function, and also there are serious operational risks about which the potential buyer should be concerned. Which of the due diligence review would be helpful to achieve the objective? You are required to briefly discuss the contents of the due diligence report. So here what we will write is contents of the due diligence report. LMN Limited entered into a deal with SP Limited for buying its business for manufacturing wooden products goods. LMN Limited has appointed your firm for conducting due diligence review, and they want to know the cash generating abilities of SP Limited. What points will you check in order to ensure that manufacturing unit of SP Limited will be able to meet the cash requirements internally? So here they have asked us what points will you check to ensure manufacturing unit will be able to meet the cash requirements. So here what we will check is whether the company is able to honor its commitment, whether they are able to pay the trade payables. How well is the company able to convert its trade receivable and the inventory? So what is the inventory turnover ratio, debtors turnover ratio? How well the company deploys its funds, so whatever funds they have received, how are they deploying it? Whether there are any idle funds lying, and what is the investment pattern of the company, and are they easily realizable? So firstly we are going to check whether they are able to honor. What is the debtors turnover, inventory turnover ratio? How are they deploying their funds? Are there any idle cash, and what is the investment pattern? Next, write a short note on examples of headings of due diligence report. So here we will write the contents of the due diligence. A Limited, who is a leading manufacturer of kids clothes, is interested to acquire B Limited, B Limited is currently a manufacturer of women clothing. As a professional consultant in due diligence and valuation, entrusted you to value B Limited. The valuation of B Limited is dependent on the future maintainable sales. Discuss factors you would consider in assessing the future maintainable turnover. So here they are asking about future maintainable turnover. So firstly what we will see is the trend. We'll see whether there is a marketability of that particular product. What is the political and the economic consideration? We will see whether what is the competition. So here they had asked us to check the future maintainable turnover. What is the past trend? We will see. We will see whether there is still any marketability. If marketability is there, future maintainable turnover will may be higher. Political and the economic consideration and the competition in the market. Now question number 6. CA Santana is acting as a credit manager in the branch of DFC Bank Limited. A company has approached the branch for a request of sanction to a sanctioned credit facilities worth rupees 10 crores for meeting the usual business requirement. It is a prospective client. She checks the past history of the company, background of the promoters, shareholding pattern and a nature of business. Assessment of the financial result of the past years and future projection is also undertaken. She also carries out SWOT analysis of the company. Besides, the assessment of the net worth of the directors is also undertaken. Status of the CIBIL score and position of the name of the promoters, directors in RBI defaulter list is also verified. She makes discrete inquiries from few clients of the branch manager engaged in similar line of activities regarding the credit worthiness of the company, its promoter and its directors. Based on the above, identify the activity being performed by C.S. Santana and discuss its nature. Would your answer be different if its activity was performed by a person non-qualified as a chartered accountant? Can a non-CA perform such activities? Yes. And name any 3 areas where identified activity can be undertaken. So, what is the activity undertaken by them? It is nothing but what? Due diligence. Can a person who is not a chartered accountant can do this? Yes, there would be no difference in the answer if the above activity was taken up by another person. Areas where it can be done for a corporate restructuring, venture capital as well as the offerings. Next question number 7. AB Limited wants to acquire the unit of AB Limited. AB Limited is uncertain about the future viability of the unit under consideration. You are appointed to investigate the economic and the financial position of the unit. What are the factors that you should consider while studying the economic and the financial position? So, firstly, we'll see the adequacy and otherwise fixed or working capital. Are this sufficient for the growth of the business? What is the trend of the sales and the profit in the future? Whether the profit which the business could be expected to maintain, whether that profit will sustain, and whether the business is operating at 100% capacity. So this were the questions of due diligence. Let us move ahead with our discussion of forensic audit. In this particular topic, in case of due diligence, investigation, forensic audit, today I am revising with you due diligence as well as the forensic audit. So let us move ahead with our discussion of forensic audit. So moving ahead with forensic audit, the term forensic is derived from which word? The Latin word forensis before the forum. Then forensic accounting, forensic investigation, forensic auditing, more or less all the terms are similar. We will go through the definition of forensic auditing. In a forensic audit, one searches from the point of view where number and financial statements do a mesh. It is a meticulous review of the financial documents conducted when the fraud is suspected. Some entities do them as precautions to prevent the fraud from happening and to catch it before the loss magnifies. The fraud audit, however, is not an investigation. Fraud auditing is used to identify fraudulent transactions, not to figure how they were created. The fraud auditors often go outside the books of accounts to find a fraudulent transaction. Next, what are red flags? Red flags are nothing but indicators or warning of any impending danger that there may be something wrong. Red flags can again be categorized into financial performance red flag, accounting system red flags, operational red flags, and behavioral red flags. Now, forensic audit is often divided into the fraud detection, computer forensic, fraud prevention, and providing the expert testimony. So in case of fraud detection, investigation and analyzing financial evidence, detecting financial frauds and tracing the misappropriation of assets. Computer forensics, a lot of time it is related to, for example, recovery of data, identifying which particular date this particular data was made, retrieving the data that is lost. Fraud prevention, it is used to prevent the fraud. Providing expert testimony, a lot of times where there is a forensic audit going on, we find the evidence and go to the court of law, and we are presented there as a witness. Who retains the forensic auditor? So a lawyer will retain, the police force will retain whenever they think so there is something going wrong. Insurance companies to identify what is the claim, at what amount it should be settled. A lot of times government regulatory bodies and agencies, just such as CBI, banking companies will appoint us, the courts will appoint us, and the whole of business community. What is the importance of forensic audit? Obviously it helps us in fraud prevention, it helps us in the fraud detection, and it helps us for the risk management. So what are the three advantages? Fraud prevention, fraud detection, and the risk management. What are the types of services rendered by the forensic auditor? So forensic auditor can act as a criminal investigator. He can provide services for professional negligence cases. For example, if there is an employee, for example, providing portfolio management services and has not acted diligently, which has caused a lot of loss to the organization. So we can work for the professional negligence cases. We can work for arbitration services. For example, two parties have disputes, so we can be an arbitrator, we can be a mediator. Fraud investigation, so it can be helpful in case of risk assessment and risk mitigation. In case of insurance claims settlements, the policy holder, and if there is a dispute between the insurance company and the policy holder, we can help them settle the dispute. What should be the amount? Not only in case of insurance, whenever there are dispute amongst the parties, we can help to settle those disputes. So there are 5 questions that we discussed here. First was, what is the definition? So in due diligence, we did 8 topics. Here in types of forensic, first is meaning. Second is, what is a red flag? Forensic auditor is involved in. Then thirdly, we discussed who retains the forensic auditor. So spare me, the pen is not working well. My writing are bad, but they are not so as bad as it seems. Next, importance of the forensic auditor. Next, question number 5, the services rendered by the forensic auditor. Next, topic number 6, what are the steps in the forensic audit? So firstly, there will be an initiation process. We will remove all the doubts as to what the real motive is this forensic audit. We should have a conflict check, whether the check should check to be carried out as soon as the relevant parties are established, whether there are any conflict of interest. Next, second step is developing the plan for this particular forensic audit, identifying the evidences on which we can base our opinion, perform the analysis, and finally is reporting. Usually in case of auditing, we end at reporting stage, but in case of forensic audit, there will be one more stage, that is court proceedings. So it has been divided into 6 parts. First is initiation, second is developing the plan, third is obtaining the evidence, fourth is perform the analysis when you get the evidence, fifth is reporting, and finally the court proceedings. Now a lot of garbage questions I have asked, but you will have to memorize this. What are the characteristics of the forensic auditor? So this was the process. Now they are asking characteristics of. So he should have a lot of out of the box thinking. He should have a lot of strong visualization, imagination. He should be very curious, inquisitive to know about a lot of things. He should be persistent. He should not give up very easily. He should be detail oriented. Inquisitiveness, once again, he should be creative in his approach. He should take his own discretion. He should be alert, that is, have skepticism, be confident enough, and have sound professional judgment. So these are the characteristics of a forensic auditor. Similarly, they have asked what are the skills that he must possess. So, similarly, he should know all the auditing procedures and the related methodology. He should know all the accounting and the business reporting system. He should be aware of the information technology, the data analytics. He should be aware of the criminology, legal framework, because we are going to be presented as a witness, litigation process and the procedures, investigative techniques. He should be able to gather all the evidences and network amongst the professional, because a lot of times he may require some contacts from the regulatory bodies, law or industry. Now, what are the techniques for the forensic audit? So what are the techniques? The general audit technique is called as the testing defenses. Second is the statistical and the mathematical technique. So the general audit technique, testing the defenses. So we will check where are the where are the weaknesses. Wherever the weaknesses, we know the whoever has committed a fraud will make use of this. So we will test the defenses. Second, in case of statistical and mathematical, we can use the trend analysis, and we can also use the ratio analysis method. Then we can use technology based digital forensic techniques, where you can see the phone logs, the accounting records, the audit trails. We can also use CATs and a data mining. Say whenever data analytics, data mining is applied in audit, we use a tool called as CAT, that is computer assisted audit technique. We can also have laboratory analysis of physical and electronic evidences. For example, hard disk imaging, searching for the erased file. Protection validation service, for example, fingerprint analysis, or when this particular document was made, that is document dating. The forensic audit report will firstly have an executive summary about the background of the company, the origin of the audit, what was the objective, what was the proposed audit output, and the audit implementation approach. Then we will talk about the risk analysis. What was the environment risk? What was the risk related to the financial management, customer, products, or competitor? What was the risk related to information technology, our whole business process, human resource risk, environment and external environment forces, influence of the economics and the relevant models, political and the legal scenario, and technology. Then we will write about the audit processes. What was the preliminary understanding of the scope and the incident coverage, identification of all related data elements, preparation of list of person of interest for interview whom we are going to ask things, and obtain management approval for the scope. Then all the evidence that we have collected, we will conduct the interviews, analyze the findings, and validate the interface and conclusions. Then evidence of the risk event. What are the reasons because of which there may be risk? There may be conflict of interest, bribery may be one of the risks, extortion, theft, fraudulent transaction, inventory frauds, misuse of assets, and financial statement. Then we'll give what are the recommendations, and lastly the governance and the recommendation implementation. The most important answer, what is the difference between the forensic audit and other audit? In case of the normal audit, or that is financial audit, we want to express an opinion whether everything is true and fair. Here we want to check whether fraud has actually been committed. Techniques, we can use the substantive audit procedures, the compliance audit procedures. Here it will be more of investigative and substantive. We will not be focusing only on the compliance. Normally it is usually for the accounting period. In case of forensic audit, there is no such limitation. It can be for 1 year, 2 year, or maybe 2 months. For verification of stock, estimation of realization value of assets, provision, a lot of times we may rely on the management representation. But however, in case of forensic audit, independent verification of the same is required. For off-balance sheet items used towards the arithmetical accuracy and compliance with the procedures, here we will check the regulatory and proprietary of this transaction. In case if we find anything adverse, we may qualify our opinion, give an adverse opinion, but here it will lead to legal determination. There may be proceedings. So this was the difference between forensic audit and financial audit. Let us begin with the question bank of forensic audit. Explain how forensic audit differs from an assurance engagement. Or you have been requested to carry out the forensic investigation of a listed entity by the board of directors based on a whistleblower complaint received. Before the commencement of the forensic investigation, you and your team are discussing the various aspects relating to the scope and procedures to be carried out. What should be the items of discussion with respect to the differences between the forensic investigation and other audit? So all you need to write what is the difference between forensic investigation and the financial audit. Next, you have been appointed as forensic accountant in Messrs Secure Limited to carry out various analysis of your assignment to arrive at a particular result. Specify the various analysis you might have to be carried out by you to arrive at the result. So what you will have to do is summarize a large number of transactions, perform robust procedures to trace unidentified assets, calculate the economic damages if required, the loss of goodwill, estimate the present value of the financial losses or the fraud involved in case of such irregularity frauds took place for a long period of time, perform statistical regression or sensitivity analysis, and use computerized application softwares and graph to explain or analyze frauds. Question 3. CA Robo has been appointed as forensic auditor by BMY Bank for one of its borrower account wrong limited. CA Robo started the audit by first reviewing the transaction of the borrower in the bank as per the bank records to identify any hidden patterns in that information. She has to review huge volume of data as per the number of transactions per day were in hundreds, and the data was to be reviewed for at least 3 years. She was stuck as to how to proceed to identify hidden patterns in the information, if any. Guide CA Robo suggesting what technique can we use for identifying hidden patterns. So here what they can use is data mining. So you can tell them you're supposed to use this data mining and explain what is data mining, what are the 3 ways of using data mining, discovery, predictive and deviation links, and so on. Question number 4. GSB Limited is into the business of construction for the past 25 years. Management of the company came to know that the building materials sent to the construction sites are of subsidized quality, whereas the payment released by the accounts department of the company are on the higher side. Forensic accountant was asked to carry out the detailed investigation. Forensic accountant completed his investigation and now preparing his report. What are the broad areas of information that needs to be incorporated in the report of forensic accountant? So here they have given what all do we need to include in the report of forensic accountant. So broad areas of information to be incorporated in the report of forensic accountant. Firstly, issuing an audit report is the final step of the fraud audit. The report may include sections such as nature of assignment, scope, investigation, approach, use. So all you need to write is what is the content of the forensic audit report that we have already discussed above. Act Silk Industries is a leading textile manufacturing listed company. In the course of evidence collection and analysis, it was observed that company is involved in a siphoning of funds through the payment to the shell companies. Hence, SEBI appointed B&S chartered accountants, forensic auditors of the company, enumerate in the brief steps to be taken by BS in forensic investigation process. So here what we need to write is the steps to be undertaken in the forensic investigation. BR Construction was into the business of building tools and other infrastructure facilities for the government. Mr. Tiwari, one of the senior officials, was looking after the procurement of cement required at the construction sites. There was substantial increase in the price of the cement bags bought at as compared to those bought prior to the appointment of Mr. Tiwari. The management of the company decides to get forensic investigation done for the transaction handled by Mr. Tiwari. What should be kept in mind by the management while appointing forensic accountant? So here we will have to write what are the characteristics and skills that are to be possessed by the forensic accountant. So very easy to go topics. TQR Limited is engaged in the business of garment manufacturing, having registered office at Mumbai and branches across India. Mr. Sham, one of the senior managers, was involved in creating false documents, and legitimate documents were altered to support fictitious transactions. Consequently, the management appoints you to get forensic audit done on the digital footprint of transaction handled by Mr. Shyam. The use of sound techniques will enable to discover the defalcation on a timely basis. As forensic auditor, how would you deal and suggest it based on technology, digital forensic technique? So here what you need to explain is what are the digital techniques that we use. Lastly, write short note on the services rendered by the forensic accountant. So what are the types of services we provide? So this was our short discussion of chapter of due diligence, investigation and forensic audit. So let us begin with the new chapter, my friends, audit of consolidated financial statement. So there are certain prerequisites before we start with this particular chapter. There are certain things that you must be aware of. Section 129 of the Companies Act. Then your AS 21, your Ind AS 110 and your Schedule 3 of the Companies Act. So all four things will be covering here. So if you are aware of these four things, the chapter will be very smooth. But in case, let us say if you are not aware of these four things, no problem at all, my friends. Still you can see this particular lecture, you can see this particular chapter, you will be able to understand. But if you are done with these things, then in that case the chapter will go very smooth. So what does the consolidated financial statement include? So the consolidated financial statement will include the consolidated balance sheet. It will include the consolidated P&L, the cash flow statement, the statement of equity and explanatory notes annexed. The formats for the preparation of the balance sheet, P&L and a statement of change in equity are prescribed under the Schedule 3. So we have already mentioned that we should know what is the requirement of Schedule 3. Next, the Accounting Standard 21 CFS and Ind AS 110 Consolidated Financial Statement lay down the procedures. So we have already discussed that we should know AS 21 and Ind AS 110. Now in the next video, what we are going to understand what is the requirement of Section 129 of the Companies Act. So let us begin with the Companies Act. What is the requirement of Companies Act? Section 129 of the Companies Act, where a company has more than one or more subsidiaries, including the associate company, joint venture, it shall, in addition to its own financial statement, prepare a consolidated financial statement of the company. So it is the requirement of Section 129 that you must prepare consolidated financial statement. Next, Section 129(4) of the Asset Act provides that provision applicable for the preparation and adoption and audit of financial statement of holding company shall mutatis mundis. What do you mean by mutatis mundis? As it is, shall also apply to the CFS. So all your policies for preparation, adoption and audit of financial statement that applies to your holding company will, as it is, where it is applied to the subsidiary. Let us say if you are a company established in India, let us say if Ind AS 110 is applicable to the holding company, if your subsidiary is, let us say, in US, still they will have to comply with your requirement of Ind AS 110. Next, consolidated financial statement shall also be approved by the board of directors. So the way you approve the standalone financial statement, and they are also approved by the AGM. Likewise, the consolidated financial statement also have to be approved by the board of directors and also had to be laid before in the annual general meeting. So the CFS shall also be approved by the board of directors before they are signed on behalf of the board, along with its standalone financial statement, and shall also be laid before the annual general meeting of the company along with the laying of its standalone financial statement. Now, the company shall also file along with its financial statement a separate statement containing the salient features of the financial statement in which form AOC 1. Next, they should prepare the consolidated financial statement in accordance with the Schedule 3 as well as the accounting standard. But however, if you are not required to prepare your consolidated financial statement as per the accounting standard, then you must comply only and only with the Schedule 3. So let us read the last 2 points. According to the Companies Accounts Rule 2014, the consolidated financial statement of a company shall be made in accordance with the provisions of Schedule 3 of the Act and applicable accounting standard. A company which is not required to prepare consolidated financial statement under accounting standard, it shall be sufficient if it complies with the provision of the consolidated financial statement provided in Schedule 3 of the Act. However, The requirement related to the preparation of the consolidated financial statement shall not apply to a company if it meets the following condition. So there are three conditions. If you comply with these three conditions, then CFS is not applicable. So what is first condition? Let us say if you are a partially owned subsidiary or a wholly owned subsidiary. None of your members have objected that CFS is not required. They require CFS. So you have decided you are not going to make consolidated financial statement, and none of your members have objected to it. Second, you are not a listed entity nor in the process of listing, whether in India or outside India. Third, your ultimate holding, your intermediary holding is filing the consolidated financial statement with the registrar. So three things. Firstly, you are a wholly owned subsidiary or a partially owned subsidiary, and none of your members have objected that when you are not preparing the consolidated financial statement. Second, you are not listed whether in India or outside India. You are not even in the process of listing. And thirdly, your ultimate or your intermediate holding is filing the consolidated financial statement as per the accounting standard with the registrar. So let us read three points. It is a wholly owned subsidiary or a partially owned subsidiary of another company, and all its other members, including those not otherwise entitled to vote, have been intimated in writing, for which proof of delivery of such intimation is available. So what you can do is you can use RPAD. What is RPAD? Registered Post Acknowledgement Due, or you can use Speed Post. However, you cannot use basic certificate of posting, because in that case you do not have a proof whether the opposite party has received this particular communication. So you need a positive proof of delivery is available with the company, and do not object to the company not presenting consolidated financial statement. That is your condition number one. Second, it is a company whose security are not listed or not in the process of listing on any stock exchange, whether in India or outside India. Its ultimate or intermediate holding company files consolidated financial statement with the registrar and are in compliance with the applicable accounting standard. So in this case, if you comply with all the three conditions, CFS is not necessary. Apart from this, central government may on its own or on application by class or classes of company may exempt any few class of company if they think so it is necessary in the public interest. So as per subsection 6 of section 129 of the Companies Act 2013, the central government may on its own or an application by class or classes of companies by notification exempt any class or classes of companies from complying with any requirement of section 129 or the rules made thereunder, if it is considered necessary to grant such exemption in the public interest, and any exemption may be granted either unconditionally or subject to such condition as may be specified in the notification. So this was requirement of section 129. Firstly, they said you are supposed to make consolidated financial statement. All your policies, procedures that is applicable to the preparation, adoption and audit of the financial statement of holding will mutatis mutatis apply to CFS. Then the board also has to approve the CFS, and it also has to be laid down in the annual general multi. For the salient feature Unity Form AOC 1, you also need to comply with the Schedule 3 as well as the accounting standard. But if accounting standard does not require CFS, then only comply with the Schedule 3. You need not prepare CFS if three conditions are fulfilled. You are a wholly owned subsidiary or partially owned subsidiary, in which case your members have not objected for not presenting the consolidated financial statement. You are not listed in India or outside India, or not even in the process of listing. Your ultimate or intermediate holding company files the CFS with the registrar. Apart from this, central government may exempt few other companies from CFS on its own or an application made by class or classes of companies. This was the requirement of section 128, that is Companies Act 2013 for CFS. Now, investment entity exemption is a very interesting point here. So what does this point say? An investment entity need not present consolidated financial statement if it is required in accordance with para 31 of Ind AS 110 to measure all its subsidiaries at fair value through profit and loss. The parent shall determine whether it is an investment entity. So if you are an investment entity, then in that case you need not prepare CFS. You can value your subsidiary at a fair value. Now let us say, for example, I am sitting in a Shark Tank. Now there's someone who is, I'm a judge there, and someone is presenting their ideas. I said, okay, the concept is very good. I would invest, for example, let us say 25 lakh rupees and would take 51% of your equity. Now when I get 51% of the equity, that company will actually become a subsidiary of my company. Now I have invested in various such ventures. Now let us say if I have one venture who's selling coffee, I have one venture who's selling shoes, I will not consolidate everyone, because here I am an investment entity. I have invested into this particular entities. Later on I may sell this investment. Hence, Ind AS 110 gives you an option that you can value such investment at fair value rather than preparing a consolidated financial statement. So here what you can prepare is not a consolidated financial statement but value at fair value. Now who will be called as an investment entity? If you fulfill these three criteria, you will be an investment entity. You are obtaining funds from people to provide investment management services. So obtains funds from one or more investors for the purpose of providing investors with investment management services. Secondly, commits to the investors that its business purpose is two things: invest funds solely for returns from capital appreciation or investment income, or both. So I will commit them that you will get appreciation, or you may get investment income, that is in the form of dividend or interest, or you may get both, that is appreciation as well as income. Measures and evaluates the performance substantially of all its investment on a fair value. If you qualify these three things, then in that case you will be called as an investment entity and you need not prepare CFS. However, as per para 33 of the Ind AS, parent of an investment entity shall consolidate all its entities that it controls, including those controlled to an investment entity subsidiary, unless parent itself is an investment entity. Let us take two examples. Example A. Parent is itself an investment entity. Then let us say they have a subsidiary called as S, they have a sub-subsidiary called as S1. If parent is itself an investment entity, I need not prepare consolidated. So here CFS is not applicable. I will value all my subsidiaries with the help of fair value. Let us take example B. Parent entity is not an investment entity. Parent entity has a subsidiary S1. S1 is an investment entity. S has a subsidiary called as S1. Now, since parent is not an investment entity, does parent require to make consolidation? Yes. Is S required to do consolidation? No, because S is an investment entity. But however, now S1 will consolidate it with S, and then S will consolidate with P, because your parent is not an investment entity. So for the purpose of consolidation, S and S1 has to be consolidated. So here we will have to prepare the CFS. So this was investment entity exemption, a very important point. This is actually based on your Ind AS, but Institute has asked this question time and again in your audit paper, hence we have included it here. So this was investment entity exemption. Moving ahead with the special adjustments in CFS, there are two special adjustments. One is permanent consolidation adjustments, second is current consolidation adjustments. Firstly, let us discuss what are permanent consolidation adjustments. These are those adjustments that you make on the first occasion when the CFS is made, or the subsequent occasion whenever there is a change in the equity. If you recollect your CFS, if you have done at final level, very good. If you are still not done at the final level, even if you recollect the CFS done at the inter level, whenever we used to do, whenever there was an acquisition or something, firstly we need to determine whether there is a goodwill or capital reserve. See, if purchase consideration is greater than the net assets, then this will result into goodwill. However, if purchase consideration is less than the net asset, it will result in capital reserve. So the first point is a determination of goodwill and capital reserve. This is a permanent consolidation adjustment. Second, determining the amount attributable to the equity, or that is to the minority or non-controlling interest. If you recollect, we used to prepare a ledger for minority interest or non-controlling interest. If that ledger is to tally, only then we used to understand whether the CFS has been made correctly or not. These two adjustments are permanent consolidation adjustment, which we do it only on the first occasion or when there was a subsequent changes in the equity. So permanent consolidation adjustments are those adjustments that are made only on the first occasion or subsequent occasion where there is a change in the shareholding of a particular entity which is consolidated. There are two permanent consolidation adjustments: determination of goodwill or capital reserve as per the accounting standards, and determination of the equity attributable to the minority or non-controlling interest. Now, what is the auditor's role in this particular case? The auditor should verify that the above calculations have been made appropriately. So auditor should pay special attention to determination of the pre-acquisition reserves. So for this particular point, we need to see the date of the investment, because of the date of investment, we'll be able to classify what is pre-acquisition, what is post-acquisition. So we have to pay special attention to determination of pre-acquisition reserves. Second, the auditor shall examine whether the pre-acquisition reserves have been allocated appropriately between the parent and the minority. So we will check whether the appropriation is properly made between the parent and the minority. So firstly, we said we need to pay proper attention to determination of acquisition. Then we need to see whether the pre-acquisition are appropriately allocated between the parent and the minority. Next, the auditor should also verify changes that might have taken place in this consolidation adjustment on account of subsequent acquisition. So we need to check whether there are any changes because of the subsequent acquisition of shares in the component or disposal of the component in the subsequent years. So the three things that auditor need to take care of. Once again, determination of pre-acquisition reserves. For this, we'll have to see the date of investment. Second, whether this pre-acquisition reserves are appropriately allocated. And third, whether there are any changes which have taken place due to subsequent acquisition of the shares or the disposal in the component in the subsequent year. So this was a discussion about permanent consolidation adjustments. Now, current period adjustments are those adjustments that are made during the accounting period. See, permanent adjustments were made only at the initial occasion or where there was changes in equity. But current period adjustments are done every year. So these are basically eliminating the intergroup transactions that you used to do. The current period adjustments are those adjustments that are made in the accounting period for which consolidation financial statement is done. Current period adjustments primarily relate to elimination of intragroup transaction and account balances. So what are the types of transaction? Intragroup interest paid or received. So it is talking about the interest, eliminating the intragroup interest. And then unrealized intragroup profits on assets acquired, transferred. Next, record deferred taxes on unrealized intercompany profits. So this is talking about the deferred taxes. Next, intragroup indebtedness. Adjustments relating to harmonizing the different accounting policies. So if, for example, the component is following some other accounting policy and the holding is following some other accounting policy, both of them needs to be get at par. So harmonizing the different accounting policies. Next, adjustments to the financial statement for recognized subsequent events. So this is talking about subsequent event or transaction that occur between the date of the financial statement and the date of auditor's report on the CFS. Point number G is also similarly talking about the subsequent events. So adjustments of effects of significant transaction or other events that occur between the date of the component's balance sheet and not already recognized in the financial statement and date of the auditor's report on the CFS. Next, in case of a foreign component, let us say if one of our component or subsidiary or associate is not in our country, it is some another country, we again need to convert the component's audited financial statement as per our relevant Ind AS. So adjustments to convert the component's audited financial statement prepared under the component's local GAAP to the GAAP under which CFS are being prepared. Next, determination of the movement of equity attributable to the minority interest. Again, they are talking about the adjustments of the deferred tax. So these are the few current period consolidation adjustments that we do. Now, what is the auditor's role here? Auditor's role is very simple, that we will have to verify the memorandum record. See, for this, we prepare a memorandum account on which we do all these particular procedures, all these particular transactions. So auditor will have to verify all the memorandum records to verify all the above adjustments are made or not. So the adjustments required for the preparation of consolidated financial statement are made in the memorandum records kept for the purpose by the parent. The auditor should review the memorandum records to verify the adjustment entries made in the preparation of the CFS. Apart from the memorandum record, the auditor should verify all the above adjustments discuss. So this was our permanent consolidation adjustments and the current period consolidation adjustments. Now here, what is the responsibility of the parent entity? So here the parent entity's responsibility firstly is nothing but to identify the components. They will identify which components will go into the CFS. Second, it is their responsibility to identify the reportable segments. Thirdly, it is their responsibility to identify the related party transactions for reporting. It is their responsibility to obtain accurate and complete information from the component. Third, making appropriate consolidation adjustments, that is both the permanent as well as the current adjustments that we have discussed about. Harmonizing the policies, so if the component has a different accounting policies, then harmonizing the accounting policy is the role of the parent. Then gap conversion, let us say if we have a foreign component, then in that case conversion of the gap is also the responsibility of the parent entity. So what are the 7 responsibilities? Firstly, identifying the components. Secondly, identifying the reportable segments, identifying the related party transactions to be reported, obtaining accurate and complete information, making appropriate consolidation adjustment, harmonizing of accounting policies, and the gap conversion. Apart from the above, parent ordinarily issues the instructions to the management of the company specifying the parent's requirement relating to the financial information of the component. The instructions ordinarily cover the accounting policies to be applied, the statutory and the other disclosures requirement applicable to the parent, including the identification and reporting of the reportable segments, related parties and the related party transaction, and a reporting timetable. So this is the responsibility of the parent entity. So point number 1 we have already studied, that section 129(4) of the Companies Act requires that provisions of the act applicable to the preparation, adoption and audit of financial statement shall mutatis mutatis apply to the CFS. We have already covered this point earlier. Next, the principal auditor of a consolidated financial statement is responsible for expressing an opinion on whether the consolidated financial statements are prepared in all material respect in accordance with AFRF. So who is responsible? Obviously the principal auditor is responsible. Therefore, the auditor in objective in an audit of CFS are: firstly, to satisfy himself that the CFS has been prepared in all material aspects in as per the AFRF. So whether we have prepared the financial statement firstly as per AFRF. Second, to enable himself to express an opinion whether everything is true and fair. So second is to express an opinion. First was to prepare to whether it is as per AFRF. Second, to express an opinion. To inquire about the matters as specified under 143(1). Do you recollect 143(1), my friends? What was 143(1)? LT dies. What was L? L was talking about the loans, T was talking about the transaction, D was deposits, I was investment, E was personal expense, S was stock. Report on the matters given in the clauses A to I of 143(3). What was 143(3)? 143(3) was nothing but A, B, C, D, E, F, O. The auditor should also validate the requirement of the preparation of CFS of the company as per the AFRF. So the auditor's responsibility first is to satisfy himself that the financial statement, that is CFS, have been made as per the AFRF, to express an opinion whether the CFS are true and fair, to inquire as per 143(1), to report upon 143(3), that is ABCDFO, and auditor should validate the requirement for preparation of CFS as per the AFRF. So this is the responsibility of the auditor in connection with the consolidated financial statement. So now we also need to apply our planning procedures. So planning an audit of consolidation, the auditor should plan his work to enable him to conduct an audit in an effective and efficient manner. For this, what we will do is obtain an understanding of the group structure, the group-wide controls including the IT system. So firstly, we are understanding the structure and we are understanding the IT system. Secondly, we will obtain an understanding of the accounting policies of the parent. We need to see whether we need to harmonize the accounting policies. Based on this, we will determine the NTE of the audit procedures to be performed. We will determine the extent of use of other auditors' work. We will also coordinate the work to be performed. We will obtain a list of all the components included in the CFS, whether there is a change in that list, whether a new component is added or whether any component has been left out. So firstly, what we are doing is understanding the structure and the controls in the organization, including the IT controls. Then we will understand what are the accounting policies they have used, the nature, timing and extent of audit procedures, the extent of use of the auditor's work, the work to be performed, and obtaining a list of all the components included. Next is using the work of another auditor. So we have discussed this very much in detail in SS 600, but let us go through the main points here. With regard to the determination of materiality during the audit of CFS, the auditor should consider the following. So the auditor is required to compute the materiality for the group as a whole. The materiality should be used to assess the appropriateness of the consolidation adjustments. Also, the parent should also compute the materiality of the group level to determine whether the components financial statement are material to the group. So firstly, we computed materiality for the financial statement as a whole. Here we are computing materiality for a component. Next, the principal also computes materiality for each component and communicates to each component auditor if he believes it is required for true and fair view. The principal auditor also obtains confirmation from component, like independence, code of ethics, certain information required for consolidation and disclosure requirement. Now, in respect of completeness of the information that all components which should have been considered have been actually considered, the auditor should perform the following procedures. What I can do is I can review the working papers of the previous year. So I want to see whether all the components have been identified. I will review my working papers of the previous year. We will see the components in the previous year and identify whether all the components are still the same. Review the parents' procedures for identification of the various components. If they have a strong procedure, then my ROMMS is less. But if I think so they do not have a procedure in place, then my ROMMS will be high. Make inquiries of the management to identify any new components or any component which goes out of the consolidated financial statement. So I'll ask them whether any new component has come into picture or whether there is any component which is going out of the CFS. I will review the investment of the parent as well as the component to determine which are the subsidiaries. Review the joint venture and the joint venture agreements. Also review the other arrangements entered into by the parent that have not been included in the CFS. I will review the statutory records that are maintained under section 186 and 190 of the Companies Act and changes in the inventory that might have taken place during the period. So to identify that all the components have been identified, I will review the working papers of the previous year. I will review the procedure of the parents. I will make inquiries of the management to identify new components that comes in or goes out of the CFS. Review the investment of the parent as well as the component to determine. Then review the joint ventures, other arrangements that have been entered into, statutory records maintained by the parent, and changes in the shareholding that might have taken place. Next is return representation. SA 580 return representation requires the auditor to obtain return representations from management and where appropriate those charged with governance. The auditor of the CFS should obtain evidence that the management of the parent have acknowledgement its responsibility for preparation of financial statement in accordance with the AFRF and to the parent, and the parent management has approved the CFS. So we'll ask them to give us in writing that you have prepared the CFS also as per the AFRF and you have fulfilled your responsibility. In addition, the auditor of the consolidated financial statement obtains return representation from the management on material to the CFS. What matters? Firstly, the completeness of the component included in the CFS. So we're asking them in writing, please give it in writing that there is completeness. Second, identification of the reportable segments, identification of the related parties and the related party transaction required for the reporting, and appropriateness and completeness of the permanent and the current period consolidation adjustments. So we're asking them four things. Firstly, completeness of all the components included, no component has been left out. Identification of the reportable segments, identification of the related party and the related party transaction, and appropriateness of completeness in the current period consolidation adjustment. Next, reporting. When the parent's auditor is also the auditor of all components, issue audit report after considering the AFRF on the consolidated standalone financial statement. So when I am the auditor of all components, I will issue a report on the same. When parent auditor is not the auditor of all the components, while considering the observation 705-706 of the component auditor the standalone, the parent auditor shall comply with the requirement of SS 600. If I am the auditor of all components, nothing is to be done. If I am not the auditor of all components, I will have to comply with SS 600. Component auditor report on the financial statement under the accounting framework different than that of the parent request conversion into the Indian GAAP and conversion of adjustment should be done. So I will ask them to convert everything as per the Indian GAAP if the financial reporting framework is not acceptable. Components auditors report on the financial statement under auditing framework different than that of the parent. Audit the financial statement under the Indian auditing framework. So firstly they were talking about the accounting requirement. So if there is a component, let us say one of our subsidiaries in US, so we will have to convert everything from US GAAP to Indian GAAP, that is Ind AS. Here they are talking about audit. Now, audit of that particular component will be done as per the US requirement, but we need to audit as per the Indian requirement, that is the standards on auditing. So what we will do is we can send them a questionnaire, we can send them on how to do audit, we can send them the checklist as per which they will have to perform the audit procedures. Lastly, when the components are unaudited, if the component is material, then modify. Why do we have to modify here? Because we do not have sufficient and appropriate audit evidence. If we had size, then we need not modify. So what here in reporting we said, we will have to report if all the components are audited by me, that is okay. If not all the components, we'll also have to mention SS600. In case if the financial statements accounting does as per some another GAAP, then we need to convert to Indian GAAP. If auditing is done as per others framework, other standards, then we'll send them a checklist to do it as per our standards on auditing. If there is any component which is unaudited and if that component is material, then we will modify because we do not have SI. We may either give a qualified opinion or a disclaimer of opinion. This was a discussion about the audit of consolidated financial statement. With this, we are finally done with our discussion of audit of consolidated financial statement. So we are moving ahead with audit of public sector undertaking, which mainly revolves around audit of government. The good part about the chapter is the content is comparatively less and institute has been consistently asking at least a 4-mark question out of this. So such chapters are really good for us because we know the content is limited and we are surely going to get how many marks out of this? 4 marks. So without wasting any time, let us move ahead with our discussion of audit of public sector undertaking. So if we talk about the government audit framework, you need not read this. This is just an introduction. The audit of government is as per the Companies Act. Also, audit of government undertakings under the authority of CAG done through the Indian Accounts and Audit Department. So CAG basically derives its authority from Article 148 to 151 of the Constitution. So like we have sections under an act, in case of Constitution what we have is article. So firstly talking about Article 148. So Article 148 says who can appoint a CAG? Only a president can appoint a CAG. He can be removed only on the grounds of proven misbehavior or incapacity, or any other grounds he cannot be removed. Or else what will happen is if CAG is very close to finding a government fraud, or if he knows the government politicians are not carrying out the activities well, if he's about to report it to the public, then probably the parliament will remove him, the government officers will remove him, and hence they have said is that you cannot remove a CAG, you can remove him only on the ground of proven misbehavior and incapacity. Salary and also the other terms and condition of the services will be determined in the parliament. So this is Article 148, who was basically talking about the appointment. Next, Article 149. Article 149 says perform such duties and exercise such powers in relation to the accounts of union and state of any other authority or body as may be prescribed by or under any law. So all the government, union, state, whether it may be any authority, the audit will be carried out by CAG. CAG Duties, Power and Condition Act 1971 defines this powers and powers in this detail. So basically they are trying to say is they have power in relation to the accounts of union, states, other authorities or bodies. Article 150. On advice of CAG, President to prescribe such form in which accounts of union and states are to be kept. So when we talk about a normal company, we have to keep their accounts as per the AFRF, that is applicable financial reporting framework. Now what is an AFRF for the government departments? What is the AFRF for the union? What is the AFRF for the state? So CAG will advise in which form they should keep their accounts. So CAG will advise it to the president and president will advise to the union and state in which form they are supposed to keep it. Lastly, Article 151. Audit reports of CAG relating to the accounts of central state government should be submitted to the president. So when we talk about central government, it will be given to the president, who shall cause them to be laid before the parliament. See, this is basic civics. When we talk about state government, it will be submitted to the governor, and the governor shall lay it before the state legislator. So in a case of central, it will be given to the president, and president will lay it before the parliament. In case of state, it will be given to the governor, and governor will lay it before the state legislative assembly. So this is basic civics that we have learned. Next, CAG also derives its powers from CAG Duties, Power and Conditions Service Act 1971. The most important point here, on which ICI has not so far asked an MCQ, but they can ask one. Once the CAG is appointed, shall hold office for a term of 6 years or up to the age of 65 years, whichever is earlier. So for example, if a CAG is appointed when he is at the age of 55, he can hold it for 6 years? Yes. However, CAG was appointed when he was already of the age of 61. In this case, he cannot hold it for 6 years. He can hold it only and only for 4 years, because as soon as he is 65, he will have to retire. So 6 years or 65, whichever is earlier. Indian Accounts and Audit Department functions under the authority of CAG. Hereafter, we may refer Indian Accounts and Audit Department in a lot of circumstances as IAAD. So under IAAD, there are a lot of departments. Firstly, they set up an audit board. Firstly, what do they set up is audit board. So this is a unique feature of audit conducted by Indian Audit and Accounts Department is the constitution of the audit board for conducting comprehensive audit appraisal of working of public sector enterprises engaged in diverse sectors of the economy. These boards associate themselves with the experts and disciplines relevant to the appraisal. They discuss their finding conclusions with the management of the enterprise, with their controlling ministries and the department of the government to ascertain the viewpoints before finalization. So when the audit board does an examination of a public sector enterprise, they will communicate their results to firstly obviously the management of the enterprise, secondly the controlling ministry. So for example, it is a railway, so we will communicate it to the rail ministry, and we will also communicate to the departments of the government so as we can take a final decision on the same. The results of this comprehensive appraisal are incorporated by CAG in his report. So for it is not going to be feasible that CAG does audit of every single public sector enterprise, every government department, and hence what they set up is audit board, which is set up by IAAD. So these audit boards have no separate legal entity and they work under the supervision of CAG. So what happens is, president appoints a CAG. Under CAG, we have IAAD. Under IAAD, what we develop is an audit board. So audit board, whatever report they give, we incorporate their report in the CAG's report. So whatever the report is given by audit board will be incorporated in the report of CAG. So this is nothing but audit board. So honestly, so far no question has been asked on this, but we'll have to go through this. Next is action on the audit report. The scrutiny of the annual accounts and the audit report by the parliament as a whole would be a difficult task, considering their diverse and specialized nature, besides imposing excessive demand. So what they are trying to say is, we have so much diversity, we have so many things, it will be very difficult for CAG to perform everything. Hence the parliament and the state legislature have for this purpose constituted committees. So which committees they have constituted? PAC, that is Public Account Committee, Estimate Committee, and Committee on Public Undertakings, which is called as COPU, to which this audit reports and annual accounts stand transferred automatically. So what will happen is, whatever the report is given by the audit board will be given to PAC, will be given to estimates committee, will be given to COPO, that is Committee on Public Undertakings, and then they will see whether everything is correct. Because if the report has been given to the parliament, probably not every person sitting in the parliament will understand his audit reports, and hence it is given to such committees. Now let us talk about these three committees. Firstly, let us talk about the Public Accounts Committee. In case of Public Accounts Committee, here they will see whether the money were disbursed legally on the service or the purpose to which they were applied. So for the purpose for which they were given, for example, the money was given for building of metro, whether the money has been used for building metro or it has been used elsewhere. That the expenditure, whichever was incurred, was authorized. So no unauthorized expenses, because what happens in government department, the sanctioning authority may misuse its power and unauthorized funds may be used. It may be used for some specific purposes. That the reappropriation has been made in accordance with the provision made, that is distribution of the fund in the budget. We will have distribution of fund, that where are we going to spend this particular amount. For example, how much money is to be given for education, how much for infrastructure. So we need to see whether we have used it in that proportion. Whatever the provision has been made for infrastructure, we have used that amount. Whatever the provision has been made for education, we have used for that particular purpose. It is also the duty of PSC to examine that statement of accounts of autonomous and a semi-autonomous body, the audit of which is conducted by CAG, either under the direction of President or the statute of Parliament. Next comes Estimates Committee. Now what will the Estimate Committee do? All they are going to see is whether the funds that have been used have actually led to the public benefit, whether we are achieving the desired results, the purpose for which we had allocated the funds, have we achieved those desired results, or it has been a waste of money. So committee examine estimates with a view to report what economies, improvement in organization, efficiency, administration reform consistently with the policy underlying the estimates may be affected. Secondly, suggest alternative policy. So for example, if we think the policy is not working, we are not achieving the desired objectives, then they may suggest the alternative policy. They can also examine the money is well laid out within the time limit and suggest the form in which estimates shall be presented to the parliament. The committee does not comment upon the policy approved by the parliament. So the policy is approved by parliament. We are no one to tell them whether the policy approved is correct or incorrect. But the object is to state whether there is an evidence that particular policy is not leading to the desired result. And they will state this in front of the parliament, in front of the house, that it is leading to a waste. We are not reaching the desired objectives. Next is Committee on Public Undertakings, that is COPO. Committee on Public Undertaking exercises the same powers that was exercised by PSC. Where here we studied what does a PSC do. So it is very similar to what does a PSC do, but its functioning was over the government department. However, COPO discusses on public undertakings. So COPO exercises its powers on public undertakings, and whereas PSC used to have its function over the government department. The function of these committees are, again, to examine the reports and accounts of the public undertaking, to examine the report of CAG on public undertaking, to examine the autonomy and efficiency of public undertaking. What do you mean autonomy? So they are not being influenced in any way. It is not someone who's sitting above, who's taking the decision only for his personal benefits. It is autonomous, so somewhere it is used for the public benefit. And efficiency of public undertakings, to see whether they are being managed in accordance with sound business principle, prudent commercial practices. To exercise such functions vested in PSC and the estimate committee as not covered above, as may be allotted by the speaker from time to time. The examination of public enterprise by committee takes the form of comprehensive appraisal or evaluation of performance of the undertaking. So it is nothing but what we are evaluating, whether everything is going correct. The objective of financial committee in doing so is not only to focus on individual irregularity, but also defect in the system which led to irregularity. So we want to see what were the defects in the system because of which such irregularity were there. So we could strengthen the internal control and somewhere stop that irregularity from again happening. Next is, what is the CAG's role here? The CAG, the Comptroller and Auditor General, plays a key role in functioning of the Financial Committee of the Parliament and state legislator. He has to become recognized as a friend, philosopher, and a guide of the committees. So his report generally form the basis of this committee. It is CAG who is going to give the report, and then they are going to discuss. He scrutinizes the notes which the ministry submit to the committee and helps committees to check the correctness of the submission to the committee. So a lot of things are submitted by the ministry. So CAG will see whether everything that is submitted by the ministry is correct or not. Because if it is incorrect, then you know what this committee is going to do. Next, the financial committees represent their report to the parliament stage legislative with their observation and recommendation. Various department and government of the government are required to inform committees of action taken by them on the recommendation of the committee. So again, this is in general what they have said. This is nowhere a role of CAG here. And lastly, they said in respect of those audit reports which could be discussed in detail by the committee, written answer to be obtained by the department ministry concerned and sometimes incorporated in the report presented to the parliament. So this were the basic concepts. Honestly, so far no question has been asked on all this, but we cannot ignore the same. Only questions, MCQs and basic questions have been asked on article 148 and everything. So somewhere what you need to do is make sure you revise this well, or point number 3, point number 4, point number 5, so far no questions have been asked. Let us move ahead with our discussion of the next topic, that is objectives and scope of public enterprise audit. Now, what is the objective and scope of public enterprise audit? So firstly, audit of PSU is not constrained only to financial and compliance audit. We know that we are not going to check only the books of accounts and whether everything is true and fair. There are a lot of other aspects also involved to what? Public enterprise audit. Now, what is proprietary audit and what is comprehensive audit? I'm not discussing it here because we have a very detailed discussion. If you see the video list, we have a very detailed discussion on what proprietary audit and comprehensive audit. So I'm not discussing the both here. Next is organization's decision to be taken by a competent authority. So we as a CAG need to evaluate whether the decision has been taken by what? Competent authority who has the power to do it. In examining decisions of management, the auditor examines whether decisions taken by a competent authority after examination of all aspects on the basis of the relevant information. So all we need to see is whether it has been taken by the competent authority. The main objective of auditing is to help the government. It is not just to find out their deficiencies. So it is an audit. Audit is an instrument for accountability. But equally important purpose of audit of public sector is to help the government and enterprise management improve its efficiency and effectiveness. So we come to know where are we lacking, where we are not efficient, where we could improve our effectiveness. So the main logic here is to help the government and not only and only find out their flaws. This is achieved out by financial, operational deficiencies and inadequacies and ineffectiveness. So we actually, what do we carry out is performance audit. What do we carry out is a performance audit with the help of which we'll come to know whether it has been carried out efficiently, effectively and economically. So we'll also discuss what is performance audit in the further sections. Next, highlighting the issues of efficient and economic operation. So whether there are issues where we are not efficient and a non-economic operation, we need to highlight the same issues as well. Next is fiscal and managerial accountability. So broadly, if I can divide the audit, government audit in two parts. First is going to be fiscal accountability. It includes whether the provision of fund was correct, whether the sanctioning power was well utilized, no one has misused that, whether we have compliance with laws and regulation, and about the proprietary nature. Managerial accountability talks about the efficiency, economy and effectiveness, which is basically covered in what? Performance audit. So this was nothing but our objective. So firstly, what we said is audit of PSU is not constrained only and only to financial and compliance audit. We also have to do proprietary and comprehensive audit, which are going to cover in detail in the coming videos. We need to see whether the organization's decision was taken by a competent authority. It has to be done in such a way that it is helpful to the government. We need to highlight the issues of efficient and economic operations. And lastly, it can be broadly divided into two categories. One is fiscal management, where we see whether the provision of funds was adequate, sanctioning was correctly done, compliances with laws and regulation and proprietary nature. And whereas managerial accountability focuses on what? Whether it was efficiently managed, effectively managed, and economy. So this was our objectives of public enterprise audit. So moving ahead with a discussion of financial audit and compliance audit. Firstly, let us understand financial audit. What is a financial audit? Basically, when we give our opinion whether the financial statements are true and fair. So even in case of public sector enterprises, even in case of government audits, we'll have to give our opinion on the financial statement. So when we are giving our opinion on the financial statement, this is nothing but what? Financial audit. So express an opinion on the financial statement which enhances the degree of confidence of the intended users in the financial statement. So who will give an opinion? CAG will give an opinion whether the financial statement are prepared in accordance with the AFRF. So this is nothing but a financial audit. Now whereas when we talk about compliance audit, the compliance audit is an independent assessment of whether a given subject matter is in compliance with the applicable criteria. So we'll have to understand these terms first. What is a subject matter? Subject matter is nothing but your actual information, your actual financial statement information. Criteria is nothing but the standard that you have set. Do you recollect your standard costing? What do you do is you compare your standard and you compare your actual. So what you get is a variance. So somewhere this is what we are doing here as well. We are considering the subject matter against the criteria. Are we complying with the criteria? So compliance audit is an independent assessment of whether the subject matter is in compliance with the applicable criteria or not. This audit is carried out whether the activities, financial transaction, information comply in all material respect with the regulatory and other rules which govern the audited entity. So compliance audit, we consider two things. Is concerned with firstly the regularity and propriety. Regularity is nothing but what? Adherence of subject matter, that is actual information, to the formal criteria emanating from relevant laws, regulation and agreement applicable to the entity. Proprietary, observance of the general principles governing the sound financial management and ethical conduct of the public officials. While regularity is emphasized in compliance audit, proprietary is equally pertinent in the public sector's context, in which there are certain expectations concerning the financial management and conduct of officials. So what we are trying to say is only and only financial audit may not be relevant. We will also have to do compliance audit, so we know whether we are complying with the laws and regulation, we are complying with the criteria that we have set. So these are two different terms, that is financial audit and a compliance audit. Let us move ahead with a discussion of a very important topic, that is comprehensive audit of public enterprises. So comprehensive audit mainly focuses on the efficiency and the effectiveness of the public enterprises. So it is done with certain predetermined standards, objectives and criteria in hand. So when we start the comprehensive audit, the starting point of comprehensive audit covers three things: economy, efficiency and effectiveness. So what we are going to cover in comprehensive audit? Economy, efficiency and effectiveness in preparation of the audit program based on the decisions relating to the setting of the enterprise. So we will take this decision based on what? Firstly, the objectives. Secondly, the areas of operation. So what are the various work that this public sector enterprise is going? Which organization is it? What are the financial and the operational details, capital, operating budgets and other relevant reports. So audit program may differ from enterprise to enterprise. So the which areas are covered in comprehensive audit, like I said, will differ from enterprise to enterprise. But however, if we consider the broad list of areas which we may cover in comprehensive audit are what? We can compare the overall capital cost of the project approved against the approved planned cost. So what was the cost that was approved and what is the actual cost that we have incurred? We can compare the production or operational output versus the underutilization of the installed capacity. So what is the installed capacity and what is the output that we are producing? What is the achievement of the planned rate of return? This is a repetitive point. So whether we have achieved the planned rate of return, adequacy of cost control measures. So what are we doing to reduce our cost? To in case of government enterprises, we cannot increase the selling price. So what we need to focus is on reduction of the cost. Next, existence and performance of research and development programs. So we want to evaluate whether the research and development program are still into existence and whether it is making sense. Existence and adequate system of repairs and maintenance. Effective and economical purchases. We want to see whether it is efficient or inefficient in the project planning, and we want to see whether there is undue waste, unproductive time for men and machines, wasteful utilization and a non-utilization of resources. This is our comprehensive audit. This is our comprehensive audit. So this may differ from an organization to organization, but however, these are the broad areas that we will include in our comprehensive audit. Now, when we talk about proprietary audit, it stands for the verification whether the transactions are done with the public interest in mind, whether it is as per done the commonly accepted customs and as per the standard of conduct. So in a case of proprietary audit, we do not focus much on vouching and verification of documents, evidences. We want to see whether the transactions have been done in the public interest, whether there has been a prevention of the wasteful expenditure. So the prima facie here we want to see the money that is being spent, whether the same is in the public interest or not. So if we see the principles of proprietary audit, what they are trying to say is expenditure is not prima facie more than the occasion demands. Let us say we are making a public washroom. Now we are making a public toilet. Let us say what will be the amount involved. For example, not even making a public toilet. Let us say we are just repairing a public toilet. So maximum it will cost us 2 crore rupees. Maximum, even if we change all the fittings, every lighting, and probably the whole painting and everything is redone, maximum it will cost us 2 crores. However, they showed the cost is almost 10 crore rupees. So it is prima facie more than the occasion demands. So when we asked them, they said we fitted a lot of Jaguar fittings, Kohler fittings. Was all those things required in a public toilet? At the end, what people are going to do is fit in those public toilet. So somewhere, do we need such Kohler and Jaguar fittings? Probably they might have been not fitted this Kohler and Jaguar fittings. They might have fitted in the in the government officer's house. But here they showed that we have fitted this 10 crore rupees amounting Jaguar fittings and Kohler fittings, which were not required. So we need to see whether expenditure is prima facie more than the occasion demand. Also, every officer exercises the same degree of vigilance in respect of expenditure as a person of ordinary prudence would exercise in respect of his own money, as if the money was mine own. For example, if I was making a toilet in my own house, what would I have done? I would have called for one or two interiors. I would have done for designs. I would have called one or two contractors, asked them for the quotation. Then who was providing me with the best services at the best price, I would have given the contract to them. I would have not randomly given anyone the contract. So here what we need to see is the person, the officer who is in charge, he is exercising the same degree of vigilance as if the money is his own. Secondly, the authority exercises its power of sanctioning expenditure to pass an order which will not directly or indirectly accrue to its own advantage. So the sanctioning power, the sanctioning authority is being misused. We are sanctioning this contract to the person who is giving us the most amount of bribe. So just if some person is giving me a bribe that please pass my contract, I will give you, for example, 10% of the whole contract. I will not pass a contract in his favor, right? I have to use this sanctioning power of mine, which will directly or indirect accrue to his own benefit. Next, the funds are not utilized or for the benefit of particular person or group of person. It is not utilized only for those person. If you all remember, if you all have seen Gabbar is Back, what happened in Gabbar is Back? They catch hold of a Tehsildar. The Tehsildar said the water which was to be sent to all the farmers was sent to a particular MP in that particular village, which was not to be done. It is to be used for the benefit of all the people. So you will not utilize these funds only for the benefit of particular person or group of persons. Also, apart from the agreed remuneration or reward, no other avenue is kept open to directly or indirectly benefit the personal employees or others. So it is not going to directly or indirectly get me more bribe. So apart from the agreed remuneration, let us say government is paying me 30,000 rupees a month. I will just accept that 30,000 rupees. I will not say, okay, I will pass your contract, you pay me 10% more, you give me 1%, or you give me, 10 lakh rupees extra. I will not keep other such avenues open. This is called as proprietary audit. Now, there are a few other proprietary elements in the Companies Act that we have already discussed. So, out of this, we have already discussed 143.1, 143.6, and 143.7. So, we have already discussed the same in case of Companies Act, but still what I am doing is, here I am again attaching the videos of 143.1, 143.6, and 143.7. The students who have already viewed Companies Act and are well versed with it, they can skip the part and again move ahead. But who are not very sure with the same, again please go through 143.1, 143.3, and 143.7, because they ask similar questions based on the same year as well. So moving ahead with 143.1, that is a duty to inquire upon certain matters. So here we are supposed to inquire upon certain matters. Only if we are not happy with things, only if we think things are not correct, only then we will report. If everything is correct, do we need to report here? No. We are just supposed to inquire. We are supposed to inquire upon 6 different matters. Which different matters? 6 different matters, which is nothing but LT dice. Moving ahead with firstly loans and advances. Firstly, we need to check whether the loans and advances are properly secured. So if we have given any loan to someone, let us say we have given loan to, let us say, Mr. Majnu. So has he given any security? For example, if we have given a loan to Majnu worth rupees 1 crore, has he given a security for greater than 1 crore rupees? We cannot give loan to people who are not given a security. It may not be in the interest of the members of the company. If it is not secured, somewhere it may give you a clear indication that there may be money laundering here. Why there would be a money laundering? For example, let us say Akash has a lot of black money in his pocket. He asked me, sir, can you please give me some white money? So what I do is I give him a check of, let us say, 50 lakh rupees. At the same time, he ends up giving me cash of 50 lakh rupees. So now the transaction between me and him is settled. So he does not have to pay me, nor do I have to pay him, because I gave him a check of 50 lakh rupees and he gave me a cash of 50 lakh rupees. However, in the books of accounts of Akash, it will be shown that he has taken a loan of rupees 50 lakh rupees from Rohit Shroff, and in books of Rohit Shroff, it will show that I have given a loan of 50 lakh rupees to Akash. Now, if I have given a loan of 50 lakh rupees to Akash, have I taken any security from Akash? No. So whenever you see when you have seen loans and advances which are unsecured, it may give you an indication that there may be some money laundering here. Also, you need to check whether the terms and conditions are prejudicial to the interest of the members. So, for example, if I am charging 12% rate of interest to outsiders, here I have charged them only 6% rate of interest. Somewhere the terms and conditions are prejudicial. Members are losing out on that 6% that you could have earned. So, we need to check two things: whether the loans and advances are secured. Secondly, whether the terms and conditions are prejudicial. Now, in this example, Akash said, sir, you give me a loan of 50 lakh rupees in check, I give you 50 lakh cash. But however, that did not work. So now what Akash thought was, he wants to reduce his profit. He wants to reduce his profit. So what Akash thought was, he told me, sir, I will show in my books of accounts, commission account debit to commission payable to Rohit Shroff. This will just be a mere book entry. We will never do commission payable to Rohit Shroff account to cash bank. Because when we pass an entry commission to commission payable to Rohit, commission is a nominal account. This will go to P&L account debit balance. And when this goes to P&L account debit balance, the profit will reduce and so will the tax. So here in this case, we as auditor, we need to see all the transactions, whether the transaction are represented by mere book entries. So this was an example of mere book entry. So if I see an entry of only commission to commission payable to Rohit, but no commission payable Rohit to cash bank account, then it should give me an indication that this is nothing but a mere book entry. Also, we need to check whether the transaction are prejudicial to the interest of the members. So for example, if we are in real estate, the maximum commission or brokerage we offer is 1% of the value. However, we have shown 3% of the value. Somewhere this is prejudicial. If everyone else is paying 1%, you are paying 3%. Somewhere the members are losing out. So we need to see whether the transactions are prejudicial. Now, initially what Akash did was, he said, sir, you give me a check of 50 lakh rupees and I give you 50 lakh rupees cash. But however, when we did this, what happened was, in my books of accounts, it was shown that I have given a loan to Akash. And when income tax department saw this is a loan, they said on this you would have received interest. Interest is nothing but your income. And on income, you will have to pay income tax. Now in this scenario, I had to pay income tax. So I told Akash, I'm being helpful. I'm helping you just so that you can convert your black money into your white money. But on that, I only have to pay tax. So I am not willing to help you anymore because I will have to pay additional tax just to help you. So what Akash told me, sir, you do not tell the income tax department or anyone. In your books of accounts, you do not show that you have given me a loan of 50 lakh rupees. Let us just change the nomenclature. What you say is, you have given me a deposit of 50 lakh rupees. When you say you have given me a deposit of 50 lakh rupees, there will be no interest. If there is no interest, there is no income. And if there is no income, there is no income tax. So, in my books of accounts, what I did was, I showed that I have given a deposit of 50 lakh rupees to Akash. If Akash could apply so much of range, don't you think so income tax department and every other statutory department can? So as an auditor, we need to say whether the loans and advances made by the company have been shown as deposit. I hope you understood the logic why we are supposed to show this as deposit. Because if I show it as deposit, it will not be loan, and if there is no loan, no interest, no income and no income tax. So even this plan of Akash did not work. His initial plan was to show as a loan. This plan did not work. His second plan was to show as a deposit. It did not work. Now, Akash had a lot of capital gain in his books of accounts. Okay, so he had sold a lot of property, a lot of shares, a lot of gold, and he had a lot of capital gain in this year. If you all are well versed with your DT syllabus, capital gain can be adjusted against the capital loss. And on the net capital gain, we will have to pay the tax. Let us say Akash had a capital gain of 1 crore rupees. Akash had a capital gain of 1 crore rupees. So now what he did was, he purchased shares of Rohit Shroff Private Limited. He purchased 25,000 shares at the rate of 1,000 each. So he bought shares worth rupees around 2.5 crores. And then he sold the same 25,000 shares at the rate of 800 rupees. He sold the same 25,000 shares at the rate of 800, and he incurred a loss of rupees 200 per share, and he had purchased how many shares? 25,000 shares. Here, because of this, now he has a loss of 50 lakh rupees. Honestly, he does not have an actual loss. What he might have done is, he might have purchased the shares at 1,000. He might have sold the same shares at 800 rupees to an unknown party, and he would have taken 200 rupees per share in cash from that particular party. But however, in books of accounts, he recorded only 800 rupees, and hence it is showing a loss of 200 per share, that is 50 lakh rupees. Now he had a capital gain of 1 crore. Now we are shown a capital loss of 50 lakhs. Now he'll be paying tax only and only on what? 50 lakhs. Now again, Akash is aware about the same. Don't you think so other departments will be? And hence it is auditor's responsibility to see whether the company is not an investment company or a banking company, whether shares, debentures or any other securities have been sold at a price less than which they were purchased. So if you are selling the shares at a price less than which it was purchased, so if the purchase price is greater than the selling price, then you need to inquire what is the reason. But you need not inquire if the company is an investment company or a banking company, because investment company and banking company every other day while be buying shares, and it might be possible that they may be incurring losses. Even in a genuine case, for example, let us say I have purchased a share of Paytm. I purchased the share, for example, for 1,000 rupees. Now the prices are for 600 rupees. I have been waiting for since a year, if I could again reach a level of 1,000 rupees and have no losses. But I could not see any such reason. So somewhere what we did was, I sold the shares of 600 at 600 rupees, and I have incurred a loss of 400 rupees. Is there any defrauding? Is there any money laundering that I have done here? No, right? It was a genuine loss. So there might be scenarios when there may be genuine loss as well. Fine. So here is what we are trying to say is we will see whether we have sold shares at a price less than which they were purchased. Then we need to see whether personal expenses have been charged to the revenue account. For example, we send a director to a conference, let us say in Germany. We had a 7-day conference. But however, the director came back after 30 days. He did not just travel alone. He took his wife, also children, and all the expenses that were incurred in this 30 days for whole of his family was charged to the revenue account. Can these expenses be charged to the revenue account? Can their expenses of tours and travelism can be charged here? No. So now Akash came up with one more thing. See, initially what he tried was he tried to show this as a loans and advance. Did not work. He tried to have a fictitious journal entry. Did not work. He tried to show loan and advances as deposit. Did not work. He tried to show fictitious capital loss and adjusted again capital gain. Did not work. So now what he's saying is, sir, you give me cash. You give me cash. And I will allot you shares in my company. So you give me 50 lakh rupees cash and I allot you shares in my company. But I told Akash, I do not have 50 lakh rupees cash. All I have is white money. I get only and only white money. I have no 50 lakh rupees cash to give you. So Akash said, sir, you need not actually give me 50 lakh rupees. All you need to do is tell others that you have given me 50 lakh rupees cash. What I will do is I already have 50 lakh rupees black money in my pocket. I will deposit the same in the books of accounts and I will show as if you have given me this 50 lakh rupees. Because when the income tax department will ask me the source, where did I get 50 lakh rupees, I can show this was given by Rohit Shroff to buy shares in my company. So you just say that you have given me cash. So for this also auditor need to see whether it has been stated in the books and documents of the company that any shares have been allotted for cash and whether cash has actually been received. So we need to see if we have shown we have received cash of 50 lakh rupees from Rohit Shroff for allotment of share. We need to check whether cash has actually been received. But honestly speaking, this point has not been very much of relevance in these days, because if we do such a cash transaction, income tax department officer is definitely going to suck our blood. Also a lot of other departments, for example, if it is a listed entity, SEBI will never allow this. So somewhere such cash transaction has any which ways reduced, but if at all there is such a cash transaction, we as an auditor need to inquire about the same. So this was 143.1, that is duty to inquire upon certain matters. Still I stress on the word inquire. I am not saying report. We will inquire upon these matters only if we find something which is not true and fair, something which is wrong, only then we will report. If everything is correct, we need not report anything here. So this was 143.1, duty to inquire upon certain matters. Moving ahead with our discussion of 143.3, where we will discuss a duty to report upon certain matters. So what does 143.6 say? If CAG wishes to conduct a supplementary audit, then a CAG can order a supplementary audit within 60 days from the receipt of the audit report. So under 143.6, CAG has a power to conduct what? Supplementary audit. Under 143.7, CAG has a power to conduct a test audit. Next, additional information in the part 2 of the schedule 3. Now also there are some proprietary elements in CARO. So here what they have done is they have reprinted all the clauses of CARO once again. So here it is talking about para 3, clause 3. Then they are talking about clause 4. They are talking about clause 8, clause 9, clause 10, clause 11, clause 13, clause 15, clause 18. So for all the students who have already seen CARO, we have already covered all these things in detail. But what I am doing is again reattaching those clauses here. So all those students who have not seen CARO so far, will have to go through this. And also all those students who have already seen CARO, I would suggest once again go through these clauses. It will help you in revision of CARO. So let us go through all these clauses of CARO. Now, the third clause is talking about investment, guarantee, security and loans granted by the company. So firstly, we need to see whether the company has actually granted any loans, has provided loans, guarantees or provided security to any other entity. If the company has not given any loans, it has not done any investment, this clause will not apply. So firstly, we need to see whether the company has provided loans, guarantee or security to any other entity. This is not applicable to the company whose principal business is to give loans. So a lot of students tell me, sir, your banking company is an example. No, banking company is not an example here. Why banking company is not an example? Because to a bank, CARO does not apply at all. We have seen in the exclusion part, does a CARO apply to a banking company? No. So which company's principal business is to give loans? NBFC. So NBFC will not be covered here. So for NBFC, we had a different point altogether. So no reporting for NBFC will be done here. So if your main business is to give loans and take loans, we will not report here. However, if in any other case, if you have provided any loans, guarantee or security to any other entity, we will have to report here. So if you have provided any loans, guarantee or security, we will see how much loans, guarantee and security you have given to the group companies, that is subsidiaries, associate and joint ventures. And how much amount have you given to the other parties. So you need to divide the amount into two. How much has been given to subsidiary, joint venture and associate? How much has been given to the other parties? Then we need to see whether the terms and conditions are prejudicial to the interest. You need to see whether the terms and conditions. Firstly, for example, let us say we gave a loan to someone. We took no security from the opposite person. Is this prejudicial to the interest of the company? Yes, definitely it is prejudicial, because if the opposite person does not ends up paying, then company will incur a loss. Hence, if the opposite person has not given a security, it is prejudicial. Let's take one more example. First example we took, there is no security. Second, the rate of interest in the market is 12%. However, we have charged only 7%. Again, it is prejudicial because company will be losing out on that 5%. So probably that might be a reason that we have given it to the related parties or to the director or to the promoter. But however, the members are at loss. So we need to see whether the terms and conditions are prejudicial to the interest of the company. We also need to see if the opposite party is regular in repayment of the interest as well as principal. So all we are trying to say is whether they are paying their EMIs on time. If not, we will have to report here. So we saw three things so far. Whether the company has provided loans, guarantee or security. This is not applicable to a company whose principal business is to give loans. Secondly, we need to see the terms and conditions are not prejudicial to the interest of the company. And thirdly, we need to see whether the repayment of interest and principal is regular. If the opposite person has not paid and it is overdue since 90 days. My friends, if you recollect NPA of audit of banks, if it is overdue for greater than 90 days, it will be treated as NPA. But somewhere we are not talking about banks at all here, because this clause is not applicable to a banking company. CARO is not applicable to a banking company. But however, if it is greater than 90 days, it is a matter of concern. It is a matter of concern. So we need to see whether we have taken any steps for recovery here. So if the opposite person has not paid, we have not even sent him a notice. We have not sent him a legal notice. We have not taken any action. Then somewhere it might show us, it might give us an indication that the opposite person again might be a related party. He might be a director or a promoter. So for example, here we need to see whether the opposite person has paid, and if he has not paid for greater than 90 days, when any steps for recovery have been taken or not. Now one more new point has been added here, which was not a part of CARO 16. Loans and advances fallen due during the year has been renewed, extended or fresh loans granted to settle the overdues of the existing loan. So what we are trying to say is, let us say the opposite person was granted a loan of 25 lakhs. He was supposed to pay this over a period of 12 months. However, he could not. So we renewed his loan or extended his loan. We told him that, okay, you do not pay this in 12 months, you pay this in 24 months or 36 months. Or we gave him a fresh loan so that he could settle the old loan. So somewhere all these things are an example of renegotiation. This is nothing but an example of renegotiation, where we are renegotiating all the terms of loans once again. Somewhere it is showing an inherent weakness that all these parties may not be able to pay it on time. So as auditors, we are supposed to show what is the amount and also the percentage of the aggregate of the total loans. Let us say total loans and advances as 100 crores. And loans which are renewed extended is 5 crores. So here we will end up showing what is the percentage of the total loans, 5%. Again, this is not applicable to whose principal business is to give loans. So like if we are talking about NBFC, this clause is not applicable. Next, if the loans or advances are granted in the nature of loans, either repayable on demand or without specifying the term, to whom will we give the loans on repayable on demand or without specifying the terms? Usually we'll give it to the promoters, we'll give to the related parties, we'll give to the directors or employee of the company. So if we have given any loans which are repayable on a demand, so as soon as we ask it, they have to return it back, or without specifying any terms of period, then we need to specify what is the aggregate amount. We also need to specify the percentage of the total loans. Percentage of the total loans to the promoter and the related parties. So again, let us say for example, we have given us 2 crores such loan and a total loans is 100 crores. So here we will end up showing what is the total percentage, 2%. So users can get a clear idea. For example, out of 100%, 5% loans are such on which renegotiations are going on. So somewhere there is inherent weakness. 2% loans are such which are given to the promoters or the related party. So somewhere they'll get a better picture which was not available in the financial statement or the audit report. So investment guarantee, security and a loan has been divided into 6 subclauses. Firstly, whether the company has provided loans, guarantee or provided security to any other entity. It will not apply to the entity whose principal business is to give loan, for example NBFC. Then we will see what is the amount given to the subsidiaries, associate or joint ventures. Then we will see what is the aggregate amount given to the other parties. Then we will have to check whether the terms and conditions are prejudicial to the interest of the company. Repayment of interest and principal is regular or not. Next, investment, guarantee, security and loans granted by the company. If it is overdue for greater than 90 days, whether any steps for recovery have been taken. Next, loans and advances has fallen due during the year, has been renewed, extended or fresh loan granted to settle the overdues of the existing. Next, percentage of the aggregate to the total loans and advances, not applicable to whose principal business is to give loans. Next, if the loans or advances are granted in nature of loans either repayable on demand or without specifying terms of period, specify the aggregate amount and the percentage of total loans to the promoter and the related party. This was our clause 3, that is investment, guarantee, security and loans granted by the company. Moving ahead with the next part, compliance of section 185 and 186. This is part of your company law. Here all we are again talking about is the provisions related to the loans. If you recollect your company law that you have done in your syllabus, here 185 and 186 is again talking about what? Loans. Here we need not write anything else. So all we need to check is whether there is a compliance with section 185 and 186. Moving ahead with the disclosure of transactions not recorded. Let us say there was an assessment going on in the year of 21-22. Now we disclosed an income which was not recorded in the previous year. So we disclosed an income which was not recorded in the year 2021. So we surrendered on our own, or we disclosed an income while the tax assessment was going on. If that is the case, we need to check whether that unrecorded income has been recorded during the year. So whether any transactions not recorded in the books have been surrendered or disclosed. If so, if we have not surrendered or disclosed, this clause will not apply. However, if we have surrendered and disclosed, we will have to report whether the previously unrecorded income has been properly recorded in the books of accounts during the year. We will have to write what? Whether the previously unrecorded income has been recorded in the books of accounts during the year. So if there is no unrecorded, if there is no surrender or undisclosed income, then this clause will not apply. However, if we have surrendered, all we need to report is whether we have reported the same in our books of accounts during the year, that is the year 21-22. Next is if we have made a default in the repayment of loans and other borrowings. So in clause 3 we were talking about we have given a loans, we have given a guarantee, we have given security. Here we are talking about that we have taken a loans. So if there is a default in the repayment to any lender, we will have to report two things. One is the amount and the period of fraud. One will that is amount and period of fraud. Let us say we have taken 35 lakh rupees and we have not been able to repay it since last 7 months. So we will report since last 7 months we are unable to repay it, and we will also report that 35 lakh is the amount. But you will have to report the same in the prescribed format. So far there was no such format given. Now they have given us a prescribed format in which we will have to report. So firstly we will have to state the nature of borrowings. So which type of borrowing was it? Was it a term loan? What is it, unsecured loan? What type of loan was it? Secondly, we will have to state the name of the lender from whom we had borrowed this. What is the amount? So initially we were stating only amount. Now we have to state the amount that is not paid on the due date. Thirdly, the amount that we have not paid, whether the same is principal or whether it is interest. Then you also have to say the number of days of delay. So for example, let us say you have not paid since last 7 months. So you'll have to state that we have not paid since last 7 months and remarks if any. So here firstly what you have to give is nature of borrowings. Secondly, who was the lender? What is the amount not paid on the due date? The amount was principal or interest. What is the number of days of delays and remarks if any. Secondly, whether the company has been declared as a willful defaulters by bank or financial institution or the lender. Now what do you mean by willful defaulter? If we consider Anil Ambani ji, Anil Ambani was declared as insolvent and hence he could not pay. But while we talk about Malia was not declared insolvent, he ran away, he had money in his pocket and still denied to pay, he will be called as willful defaulter. So we need to check whether the company has been declared as what? Willful defaulters by any bank, financial institution or any other lender. So whether you have been declared as what? Willful defaulter by bank, financial institution or any other lender. Then whether the term loans were applied for which the loans were obtained. So here what you are checking is the end use of the funds. Let us say you have borrowed 90 lakh rupees for purchase of machinery. However, out of this 90 lakh rupees, you ended up investing 20 lakh rupees in the equity shares. So you had obtained the loan for machinery. However, you ended up using it for what? Equity shares. You cannot do that. So here you will have to report, if not, the amount. So for example, 20 lakh rupees is the amount so diverted, and the purpose for which it was diverted, it was diverted in the equity market. So here what you are trying to state is whether the term loans were applied for which the loans were obtained. So what you are checking is the end use, where are the money used for. If not, though, you will have to state two things. One is the amount and the purpose for which the money is used. Now we also need to state here whether the short-term loans have been used for the long-term. For example, we have raised working capital of 25 lakh rupees based on the stock and debtors that we have pledged. This 25 lakh rupees is used to pay the term loan that we have obtained from another bank. Can you do this? No. If it is so, you will again have to state two things. One is the nature. What you have to state in the nature? That working capital has been used to pay off the term loan. And the amount, so how much amount that we have used from the working capital? 25 lakh rupees. So whether the short-term loans have been used for repaying what? Long-term. If yes, you will state two things, amount and the nature. Thirdly, whether the funds are used to meet the obligation of its group companies. Group, what do you mean by group companies? Subsidiaries, associate and joint venture. Whether the funds are used to meet the obligation of its subsidiary, associate and joint ventures? If so, details thereof, again you will have to give two things, nature and the amount. So how much amount has been taken for the you'll say in nature, you'll say whether it is taken for subsidiary, associate or joint venture. And here you will state what is the amount that you have taken for subsidiary, associate and joint venture. Let us say we have applied for a loan of 150 crores. Out of 150 crores, we are using 30 crores for subsidiary, associate, joint venture. So you will have to state that we are using it for subsidiary, and what is the amount that we are using? 30 crores. You will have to state the nature and also the amount. Then we need to report whether the company has raised on a pledge of securities held in its subsidiary, joint venture or associate. So have we pledged the security that we have in subsidiary, joint venture and associate? If so, you will have to give the details thereof and also the report the default if any. Because if there is any default here, what will happen is, if I have pledged the securities of my subsidiary company and if I do not repay on time, that company, the bank or other financial institution, whatever it may be, are going to take my shares and my subsidiary will be their subsidiary henceforth. I will not have that control over the subsidiaries. So if there is any default, you need to report it here. So if so, give the details thereof. Secondly, also if there is a default, report the default. So in case of repayment of loans and other borrowings, again we have 6 points here. How many points? 6 points. Firstly, we said whether there is any default in the repayment to lender, we will have to report the period and the amount in the prescribed format. So you are basically giving 6 things here. Nature of the borrowing, name of the lender, amount not paid on the due date, whether it is principal or interest, what is the number of days of delays and remarks if any. Then whether the company is declared willful defaulter by bank or financial institution, whether the term loans were applied for the loans for which they were obtained. If not, you will have to give what the amount of the loans were diverted and the purpose for which it was used. Next, whether the funds raised on the short-term basis have been utilized for the long-term purpose. Then again you will have to state what is the nature and what is the amount. Whether the funds have been used to meet the obligation of subsidiary, associate, joint venture, again you will have to give the nature and the amount. Whether we have pledged the securities held in the subsidiary, joint venture and associate, you will have to give the details and report the default if any. Moving ahead, whether we have raised money by IPO. What is IPO? Initial public offer. What is FPO? Further public offer. I assume every student knows what is this. So whether the money has been raised by IPO or FPO. So whenever we want to raise money, one option is IPO, FPO, where we raise money from the public, at large. Second option is we can have a preferential allotment. Now preferential allotment is done to the promoters, directors. Private placement of shares or convertible debentures. Private placement will be given to HNIs, mutual fund companies. So we have 3 different ways of raising money. It can be raised via IPO or FPO, which is for public at large. Preferential allotment, which is usually for the promoters, and lastly is private placement, which is given to the high net worth individuals or the mutual fund companies. Now here, what are we supposed to report? Whether the money raised by IPO and FPO, were applied for the purpose of which they were raised. Let us say Zomato raised money. They said we are going to use this money for expansion, promotion and entering the new markets. For example, if you are aware about, they had their business in South Africa, which also they have closed down. So they said we are going to expand in Europe, we are going to expand in Australia. So they took this money for a couple of things. Firstly is expansion, promotion and new markets. However, if they have not used this money for the stated purpose, they ended up using this money to repay the outstanding loan, then we will have to report here. If not, details together with the delays, default and a subsequent rectification if any shall be reported. So if I have not used the money for the stated purpose, which will be highly doubtful, because in case of a listed company, in case of an IPO or an FPO, SEBI will be behind your ass. In case if you are not using the money for the stated purpose, SEBI will make your life very miserable. So somewhere in this case, this is highly doubtful. But in a case if you have not used the money for the stated purpose, or if there has been a delay, or if you have committed a default or subsequent rectification, everything you need to report it here. So this was in case of IPO or FPO. However, if we talk about the preferential allotment, which is for the promoter, or the private placement, which is for HNI and mutual fund, we need to see whether we are complied with section 42 and 62 of the Companies Act. Again, 42 and 62 of the Companies Act is given in your syllabus of law. You have already covered there. All we need to report here whether we have complied with 42 and 62. If not, we will have to give details in respect of the amount involved and the nature of non-compliance. So again, we are giving two things. One is the amount and second is the nature. So again, if you have raised money by IPO and FPO, you need to report whether you have used it for the stated purpose. If not, details together with the delays or default or subsequent rectification, if any, shall be reported. Whether the company has made preferential allotment or private placement of shares or convertible debentures. If so, whether section 42 and 62 of the Companies Act have been complied with. If not, details provide in respect of the amount involved and the nature of the non-compliance. So this was our money raised by IPO, FPO and preferential allotment. Moving ahead with clause 11, which is your favorite clause, that is fraud. Now in CARO 2016, this was clause 10. So if you see the module which is given in May 22, at few places still the clause number quoted by them is clause 10. So make sure you rectify the same. Your clause number is going to be 11. So in case of fraud, what you need to report is whether the fraud is committed on the company or by the company is reported during the year. So whether the fraud is on a company or by the company. So if some party is doing a fraud on the company or it is done by the company itself, you will report two things. Firstly is the nature and the second is the amount of fraud. What is the nature? What are the types of fraud? We have already discussed the same in SA 240. So nature of the fraud will be on SA 240, whereas we will also have to state the amount of fraud involved. So if you see CARO 2016, this was the only point. Now they have made a value addition here. They have said whether 143.12 of the Companies Act has been complied with. Do you recollect 143 of the Companies Act? Let us have a quick revision of 143 of the Companies Act. In case of 143 of the Companies Act, we will ask the auditor, if you have detected any fraud, report it to the audit committee immediately. What do you mean by immediately? Immediately means maximum within 2 days, and we will seek their reply within how many days? 45 days. There may be two scenarios. Either they may reply or they may not reply. If they reply, we will ask Gabbar to go within 15 days to the central government and give three things: report, reply on that report and their own comments. But we will count as 15 days from the date when we receive the reply. However, if reply is not received, we will ask Gabbar to go to central government within 15 days and give report. And also with the report, you will give a fact of non-receipt of reply. But however, the 15 days will be counted from end of 45 days. We will give this to the Secretary, Ministry of Corporate Affairs in a sealed cover by RPAD or speed post, followed up by an email. We will file ADD4. The responsibility is on CA, CS as well as CMA. If you do not comply, the penalty in case of a listed company will be 5 lakh rupees, and in case of another company, it will be 1 lakh rupees. So here when we are discussing CARO, we need to state whether we have complied with 143 of the 143.12 of the Companies Act. This clause was nowhere there. However, now they have added that whether we have complied with 143.12 of the Companies Act. Next, whether the auditor considered the whistleblower complaints, if any, received during the year. So who is a whistleblower? Somewhere an insider or any person who has given us a tip that a fraud exists. So whether we have acted on the complaints received by this whistleblower, we should not ignore the complaints received by the whistleblower. So we need to see whether we have complied with all the three things. Firstly, companies, whether there is a fraud on the company or by the company, is reported during the year. If yes, the nature and the amount of fraud. Whether we have complied with 143(12) of the Companies Act. Whether there were any whistleblower complaints. If yes, whether this we have dealt with the same or not. This was nothing but clause number 11, that is fraud. Moving ahead with related party. In related party, we need to report whether it is as per section 177, whether it is as per 188, and whether it is as per AS18. If you recollect, 177 was nothing but an audit committee, and if you recollect, while we discussed section 177 in our Companies Act chapter, we said what will the audit committee do? Will wear a sari. What was our reviewing the related party transaction? So in case if there is a related party transaction, we need an omnibus approval from the related parties from the audit committee. What do you mean by omnibus approval? For all the related party transaction, we need an approval. Only if we have approval from the audit committee, we can have a transaction with the related party. Also, as per section 188 of the Companies Act, we need a prior approval of the board of directors if we need to get into any arrangement or contract with the related party. If we do not have a prior approval of the board of directors, you cannot get into any agreement or contract with the related party. And lastly, AS18, you are about related party disclosure. So if we are checking related party, we need to report upon three things: whether we have complied with 177, that is omnibus approval from the audit committee; 188 is, that is prior approval of the board of directors; and lastly, disclosure as per AS18. Moving ahead with the non-cash transaction. Did we have any non-cash transaction with the director or the person connected with him? With the director or any person connected with him. So for example, what we can do is, rather than paying him salary, what we can give him is shares. Rather than giving him salary, we can give him a car. So somewhere we are not paying him cash. When we say non-cash transaction, you do not have to take it literally as cash transaction. When we say non-cash, it means cash or bank, either of them. So somewhere here we are paying him in kind. We are paying him in kind. So whether we had any such non-cash transaction with the directors or the person connected with him. If yes, whether section 192 of the Companies Act has been complied with. Again, 192 is a part of your company law syllabus. However, I have given you a small note on the same. In 192, we need to take a prior approval of such arrangement is accorded by the resolution of the company in the general meeting. So shareholders will have to approve in the general meeting if we can pay the director in kind. So this is nothing but a non-cash transaction. So what we need to report is whether we had any non-cash transaction with the directors or the person connected with him. If so, whether it is as per the provision of section 192 of the Companies Act 2013 has been complied with. What is 192? Prior approval of such arrangement is accorded by the resolution of the company in the general meeting. Next, resignation by a statutory auditor. Again, a new point. Mark this also as MBA. This is the second MBA that I have been giving you so far in the whole of CARO 2020. So in case of resignation, we need to see whether there has been any resignation of the statutory auditor during the year. Whether there has been any resignation of the statutory auditor during the year. If so, whether the auditor has taken into consideration the issue, the objection and concerns raised by the outgoing auditor. So for example, let us say Mr. Suresh resigned during the year. Now who is the auditor? Mr. Ramesh. So he will have to consider all the objection and the concern which are raised by the outgoing auditor. Who is the outgoing auditor here? Mr. Suresh. And who is giving this CARO? Mr. Ramesh. So he will have to take into consideration why did Mr. Suresh resign? What were his objections? We will discuss the same when we go to professional ethics. We will discuss the same in clause 8, part 1 of the first schedule. So here, whenever this point is asked, you will also have to quote what? Professional ethics. Also, as a 300 requires us to communicate with the previous auditor. So whenever this point is asked, you will have to quote this clause. You will also quote professional ethics. and you will also quote SA 300 that at planning stage we will have to communicate the previous auditor. So somewhere this is also important. See, we will have to wait for ICI's suggestion in case if they ask such a question, what are they quoting? But we have to be very well equipped and able to understand that we just don't have to specify this clause, we will also have to specify professional ethics and SA 300 because both of them talks about the resignation of an auditor. Also, in this case, Mr. Suresh, who has resigned, he will have to find ADT 3 in the time or else he will be charged with the penalty. These were the clauses of CARO that we have discussed. Moving ahead with what are the problems in the proprietary audit. See, the expression proprietary is a moral term and can be understood with reference of concept of morality accepted by the society. So this is very subjective, right? So something that is moral for me may not be moral for someone else. So it is very subjective and hence this is the biggest problem. The proprietary audit has an inherent element of subjectivity because it is very difficult to establish what are the standards of public interest, what are the commonly accepted customs, what is the standard of conduct. Hence, since it is very difficult to establish those things, it is going to be a subjective assessment. Thirdly, the element of subjectivity has caused proper discharge of duty where delicate and demand discretions, but wisdom of taking commercial decisions under dynamic environment must be evaluated. So what they are trying to say is, see, the environment is very dynamic, so things may keep on changing. So what happens is, we may see in one scenario this is moral, but a lot of times the scenario keeps on changing, the economical, social and political. We need to see, just because the scenario has changed, whatever has been done by the government officer is correct or incorrect. So what we need to do is, we need to keep in mind that things are very dynamic with reference to the circumstances in which it were taken, and therefore the auditor in field must reconstruct such circumstances. The judgment of the auditor must be objective, as otherwise it would dampen the initiative, management and others in taking the commercial decision. Now, to take care of all this problem, CAG has developed norms for proprietary of expenditure of public funds in our country. Now, just because we have such norms laid down by the CAG, by laying down such standards of proprietary government expenditure, CAG has really tried to tackle the problem in a very practical way. So these were the problems involved in the proprietary audit. So the whole of the proprietary audit is very important. Mainly the clauses that we have gone through is important because these clauses were nowhere there in CARO 2016. Also, they were not there in the module of the public sector undertaking. So what I expect is a question based on CARO as well as public sector undertakings where they merge both the things. So somewhere this whole topic of proprietary audit is going to be very, very important. So what are the powers of CAG as per the Companies Act? So under Companies Act, CAG derives its power under three sections: 143.5, 143.6 and 143.7. 143.6 and 7 we have already discussed about, but still let us go through all the three sections. 143.5, who has the power to appoint auditor in case of a government company? So in case of a government company, maybe the first auditor, as per 139.7, the first auditor of a government company shall be appointed by CAG within how many days? 60 days from the date of registration. In case of a subsequent auditor, this was the first auditor, this is the subsequent auditor, as per 139.5, shall be appointed by CAG within 180 days from the commencement of the financial year. Also, the auditor who is appointed under 139.5 and 139.7 shall also submit his report, a copy of his report to CAG. Then 139.6, CAG has a power to conduct supplementary audit within how many days? 60 days from the date of receipt of the report. And as 143.7, the CAG has a power to conduct test audit. Thus, section 143.6 and the 143.7 of the Companies Act empowers CAG to conduct supplementary audit and test audit respectively. In so far as the statutory corporation are concerned, the respective statutes provides for the audit by CAG. The scope includes conducting performance audit of this corporation also, though specifically not stated. So we can also do their performance audit. What is performance audit? The next video is about the discussion of performance audit. Performance audit is systematic and objective examination of evidence The most important point here is, in case of performance audit, we do not audit only the financial statement. It can be the performance of government organization or a program or activity or even a function, in order to provide information to improve public accountability and facilitate decision making by the parties with responsibility to oversee or initiate corrective action. So here we are seeing whether the organization, program, activity or even a function was conducted well. So here it is not an only about the financial statement, we are talking about all such activities. Let us say, for example, on 26th of January, Modi ji conducted a parade at the Red Fort. This is nothing but a program. We want to see whether the funds were well utilized. Let us say India organized a World Cup. Let's say India organized a Olympics. We want to see whether the funds have been properly utilized. This is nothing but what a performance audit. This is nothing but a performance audit. The performance audit in PSU is conducted by CAG, obviously with the help of IAAD, Indian Audit and the Accounts Department. We have discussed all this at the early stage of this chapter. In this particular performance audit, we usually focus on three E's. We usually focus on three E's. First E is the economy. First E is the economy. We want to make sure that we reduce the cost of our productions. We want to reduce the prices. We want the best quality, but however at the best prices. So when we say economical, we do not mean we will buy substandard quality. We are focusing on the best quality with the best prices. So in minimizing cost of resources used for an activity, having regard to the appropriate quantity, quality and at the best prices. Judging economy implies forming an opinion on the resources, that is whether it may be human resources, financial resources or material deployed. This requiring assesses whether given resources have been used economically and acquired in due time in the appropriate quantity and quality at the best price. So all we need to see is all the resources, whether it may be human resource, financial resource, it may be material, are acquired at the best prices and the due time and also at the best quality. So for example, if we are talking about human, we are not hiring people who are referred by some politician, referred by some big businessman. We are hiring people who are qualified, who are competent and who can do the job very efficiently. We are buying the material not just because the seller is our known party, is our related party, or even some MP or MLA has suggested please buy from them. No, we are not going to buy from them. We are going to buy from people who give us the best quality at the best prices. So this is economy. Secondly, efficiency. Efficiency is focusing on the input output ratio. So for the same input, for the same input, for example, let us say to manufacture shirt, to manufacture one shirt we require 2 meters of cloth. For manufacturing we require 2 meters. So input is 2 meter, output is one shirt. So when we put input 20 meter, the output we get is 10 shirts. So what we wish to do is improve this ratio. For the same input, we want to either maximize the output, or for the same output we want to minimize the input. So for example, by 20 meter cloths, we would try, rather than making 10 shirts, we would like to make 11 shirts. So we want to maximize the output. If we want only 10 shirts, we would try to reduce the input. So rather than using 20 meters, we would like to finish the output in 19 meters. This is called as efficiency. So it is the input output ratio. In case of public spending, efficiency is achieved by output is maximized at the minimum of the input, or the input is minimized for a given quantity and the quality of output. Now when we talk about efficiency, auditing efficiency embraces aspects such as whether sound procurement practices are followed. Why are we saying procurement practices? So are we not procuring at a very high prices? We are not procuring the goods which are substandard. If the goods are, the input is substandard, then output is also going to be substandard. Next, whether the resources are properly protected and maintained. So a lot of times they are not very well maintained. They are not very well protected. For example, we bought some food grains. They were not very well maintained. The foodstuffs got rotten. We could not use the same for the production. So somewhere the efficiency is going to reduce because the input is more, the output is going to be less. Next, the human, financial and other resources are efficiently used. There is no waste of resources. Optimum amount of resources, maybe staff, equipment or facilities, are used in delivering the appropriate quantity and quality of goods. So we have not overutilized or underutilized the resources that we have. Next is public sector or programs, entities and activities are efficiently managed, regularized, organized and executed. Efficient operating procedures are used, and lastly the objective of public sector programs are met cost effectively. So the objective with which we had this particular program, whether the objectives have been met or not. The third point focuses on that only. The third point, that is effectiveness, focuses mainly on whether the objectives are achieved or not. Let us say, for example, the financial literacy in India is very low. The number of population and the percentage of the population who invest in the equity market is very negligible. There is hardly 2% to 3% of the population who invest in the equity market. When you go to developed nations like USA, more than 54% of their population directly invest into the equity market. So government is of the opinion that if we want to, enhance our equity market, we do not want to, rely on the FII, that is foreign institutional investors. We would have to, motivate our population to invest into the equity market. So they developed a program where they would be conducting a lot of seminars, they would be conducting a lot of rallies, which would focus on enhancing the financial literacy of the country and motivating them to invest into the equity market. So we started off with this particular project. But when we went to the rally, we could hardly see any posters which were focusing on what? Financial literacy. All we could see is a Netaji standing, with his hand like this. And, they were just promoting their political party. The objective was nowhere met. So when we are doing performance audit, we want to see whether the stated objective is met or not. For this particular purpose, what do we do? What do we need to assess? So in auditing effectiveness, performance audit, for instance, what do we need to check is assess whether the objectives and the means provided for a new or the ongoing project are consistent. So for example, the objective is to educate the whole population, but however the budget allocated for the same is very less. Now they are not consistent. When it is not consistent, the budget that is being provided is not consistent, how are we going to give literacy education to the whole population? Let us say we said we will give free ration to the whole population who are below the poverty line, but again the budget provided is inadequate. Then both the things are not consistent. So we as auditor, we need to see whether the objective and the means are consistent. Determine the extent to which program achieved the desired level of program results. So we had targeted, if 2 to 3% population is investing, we would like to increase this at least to 5% for now. But we conducted a program in such a manner that it was focusing only and only what? Promotion of the political party. So the desired level of the result was obviously not achieved. Assess with evidence whether the observed direct or indirect social or economic impacts of the policy are due to the implementation of the policy or other causes. For example, when you are implementing such a program, somewhere what will happen is it will affect the social and economically. So people will start saving, people would start investing in the equity. So it will have obviously an economic impact. What will be the social impact for this? So people, when they do not have a lot of money in their pockets, usually the lower class people who do not have a lot of money, they end up drinking a lot, they end up smoking, they end up having a tobacco, but they do not have the money in their pockets. When they have invested the money, then in that case they may stop drinking, they may stop consuming alcohol, tobacco. So it will have a social impact as well. So we need to assess whether there are social or economical impacts because of the policy. Identify the factors inhibiting satisfactory performance or goal fulfillment. So you have to identify the factors which can help us understand whether we are satisfactory performing or not. Assess whether the program complements, duplicates, overlaps or counteracts to other related programs. So there is one more program also which is focusing on the same thing. So it may be duplicating, or maybe it is complementing, because both of them will go hand in hand. So we are encouraging them to have savings, and we are encouraging them to invest in equity market. They are complementing each other, but a lot of times it may be overlapping or it may be counteracting. For example, we are advertising not to invest in the equity market. It may be subject to the market risk. We are scaring of people that you invest in the government bonds. Then two programs are counteracting each other. It may not help. We may not achieve the objective that we want to. Assess the effectiveness of the program, of the individual program or the components. We'll have to see whether it is effective, and when do we say it is effective, and it is meeting the stated objective. Determine the management and consider alternatives for carrying out the program that might yield the desired result more effectively at a lower cost. So for example, if we are doing rallies, there could have been a possibility where we could have done a social media campaign, because the population who's going to invest in the equity market might probably already be in the social media platform. So if we are targeting people who are below the poverty line, who does not use social media, who does not access internet, may or may not invest into the equity, right? So our main population was already on the social media. So rather than conducting physical rallies, spending a lot of them, we could have conducted social media. So has the government considered all those things? Assess the adequacy of the management control system for measuring, monitoring and reporting the program's effectiveness. So do we have such control system where we can measure, monitor and report on the same? Also assess the compliance with the laws and regulation applicable to the program. So a lot of times to a lot of program, laws and regulation are applicable. We need to make sure whether we are complying with the same, and identify ways of making programs work more effectively. So this was performance audit. The basically performance audit is focusing on three things. Firstly, the economy, where we want the best quantity quality at the best prices. Efficiency, where we want to maximize the input output ratio. And lastly was the effectiveness, where we want to make sure whether the stated objectives are achieved or not. So next is, how do we plan a performance audit? So firstly, before we start planning, what we need to do is understand the entity and its program. We need to understand the entity and its program, because this is the starting point for planning an individual performance audit. So what will you do while planning? What you will say here is slap Prime Minister's D. What will you say? Slap Prime Minister's D. Firstly, what do you mean by S? Special focus group. So a lot of times audit advisory committee concerns, annual and special report of the World Bank, Reserve Bank of India, reports by the special interest group. So if we have any such special focus group reports, then we will go through those reports. L, we will go through the legislative documents, that is legislation, parliamentary questions and debates, reports of Public Accounts Committee, we have referred to them above, Committee on the Public Undertaking, that is COPU, Estimates Committee, and the letter from the members of parliament. Then we will also go through the academic or the special research. So there has to be an independent evaluation of the entity's academic research and similar work done by the other governments. Then we'll also go through the policy documents of the Planning Commission, Ministry of Finance. Then we will check whether we have done the past audit. If we have done the past audit, probably the past performance will give us something. Then media coverage, whether it is print or electronic media, we'll get some information from there as well. And lastly, D is nothing but documents of the entity. So we'll go through a lot of documents of the entity. So before we start planning of a performance audit, we need to understanding of the entity. Then we will have to define what are the objectives and scope. Why exactly are we doing this performance audit? What is the objective and what is going to be the scope? What all are we going to cover then? Then we'll have to determine a audit criteria. See, audit criteria is nothing but a standard. This is nothing but a benchmark. This is nothing but a benchmark. What we do is we evaluate things against a criteria, against a benchmark, and we see whether we have met the criteria or not. So audit criteria are the standards used to determine whether the program meets or exceeds expectation. It provides context for understanding the results of the audit, against which we can compare the same and whether we can see whether we have achieved or not. Audit criteria are reasonable and attainable standards for performance against which economy, efficiency and effectiveness of the program can be assessed. The audit criteria can be sought to be obtained from the following sources. So from where can we obtain the audit criteria? So we can get it from the procedure manuals of the entity. We can get from the policy, standard, directives and the guidelines. Then the criteria used by the same entity or other entities in similar activities. So criteria that the same entity has used or some other entity has used. We can also obtain independent experts' opinion. We can have a new or established scientific knowledge and other reliable information. And lastly, general management and subject matter literature and research papers. Next, designing audit approach is no uniform audit approach prescribed and can be applicable to all types of subject of performance audit. We will have to decide which approach. So there is no uniform approach. So all various different types of performance audit, various different approach can be used. Selection of approach also determine methods and means used for conducting the audit. Some of the methods which could be used in conducting performance audit are firstly analysis of procedures. So what we will do is we will see the procedures, how they have planned the particular program, how they are conducting it, how they are checking it, how they are monitoring. This would consist examination of documents such as reports, budgets. Then we can also have a case study where there will be a descriptive case study given, and then on the basis of the same we will evaluate whether it is correct or not. We can use the existing data that we can have. We can conduct a survey. We will do analysis of the results that we have obtained, and lastly what we will do is a quantitative analysis. So these are the various methods available for performance audit. Next is we can develop the questions that we can ask based on which we can evaluate whether the performance is going well. So subsequent to designing the audit objectives and determination of audit criteria, the audit team is required to prepare a list of questions to which they would seek answers. The question should be framed in a comprehensive manner involving a detailed hierarchy of questions. Next, assessing the audit team skill and whether the expert is required. So like what we do in the normal audit is we will evaluate whether our audit team is competent enough. They have the adequate skill and competence. If we do not have the adequate skill and competence, what we might require is an outside expert. Next, we will have to prepare an ADM, audit design matrix. Having determined the objective, criteria, approach, data collection, audit team should prepare an audit design matrix. It is structured and a highly focused approach to design a performance of audit study. So ADM highlights the data collection and analysis method. So what we will write is, what is the audit objective? Then we will write the different questions that we have asked. Then what is our standard? What is the evidence and what are the data collection method and the analysis used? So this is nothing but a tabular format of everything that we have done so far. So everything that we have obtained we put in this particular matrix which is called as audit design matrix. Next, we will establish the timetable and the resources. So what resources are required? Financial resources, human resources, and we will prepare a timetable for the same. Then we will intimate this audit program to the audit entities whose performance audit we are going to do, so they could make sure they have everything ready and we could perform this audit. This is performance. How do we plan a performance audit? So the whole answer, if they have asked you, then what you can do is you can cut short a lot of things from here and make sure you can write the relevant points, because if you write all the points given here, you might not probably complete the answer, and if it is asked only for 5 marks, you might probably have to cut it down. So this was our discussion of performance audit. Now there are few elements of a PSU audit. So there are 3 parties which are involved in the public sector undertaking audit. Firstly, obviously the auditor. The role of audit is fulfilled by Supreme Audit Institution, Supreme Audit Institution India, and by personnel delegated with the duty of conducting audit. Who is going to be the responsible party? So basically those charged with governance and management of the entities whose audit is being conducted are going to be the responsible party. Who are going to be the intended users? Usually the basically stakeholders. The intended users are the individuals, organization or classes whereof whom the auditor prepares the audit report. Then the subject matter. We have already covered this. Subject matter is nothing but the actual information. So subject matter is the actual information. Criteria is nothing but your benchmark. When you compare your actual information and benchmark, and what you get is a subject matter information, what in our language we might call this as variance. So this refers to the information, condition or activity that is measured or evaluated against the criteria which is called as the benchmark. So this criteria are the benchmark used to evaluate the subject matter. This refers to the outcome of evaluating the measuring against the subject matter against the criteria. So when we compare the actual information and the benchmark, the result that you get is the subject matter information. Next is types of engagement. So there are two types of engagement. One is attestation, where we give an opinion. We express an opinion whether everything is true and fair. Second is direct reporting engagement, where we are not expressing an opinion as such. So such engagement where the responsible party measures the subject matter against the criteria and represents subject matter information on which the auditor gathers sufficient and appropriate evidence to provide a reasonable basis for expressing a conclusion. Financial audits are always attestation, as they are based on the financial information. So in case of financial audit, we are always giving an opinion, hence this is called as attestation engagement. However, when we go to the direct reporting engagement, here we are not giving an opinion as such. It is the audit who measures and evaluates the subject matter. Performance audit and compliance audit are generally direct reporting engagement. So basic point of difference between this and that is here we do not give an opinion. Then what are the principles of a public sector entity? This is similar to what is the principle of a normal audit. We need to have ethics and independence. We have discussed the same under SA 220. We should have professional skepticism. That is, we should remain alert throughout the audit and also have a professional judgment. Quality control. The audit team should have the adequate skill. We should make sure the audit risk is to an acceptably low level. We should consider materiality, documentation. So all these points, this is under SA 200. Quality control again is SA 220. Audit team, selection of the audit team is again under SA 220. Audit risk is SA 315. Materiality is SA 320. We should have documentation, that is 230. And communication to the management TCWE should be as per SA 260 265. So process related to the audit process, this is quite similar to a normal audit. Firstly, what we will do is plan the audit. So we'll determine the ROMMS. Based on that, we will decide the NTA and we will conduct the audit. And lastly, once when we are done, we will report and do a follow-up. So these are the principles related to the audit process. Moving ahead with the last part, audit report of CAG. So when a report has been given by CAG, what will be CAG including in his report on the PSU? Firstly, what we will have is the introduction, which will contain a general overview of the results of the government companies, deemed government companies and corporations. Then secondly, the results of the comprehensive appraisal of the selected undertakings by the audit board. If you recollect, this is the audit board who does the audit and they will submit their report to CAG and CAG will include their report in his report. We had discussed the same in the above thing as well. Next, summary of the company auditor's report. See, in case of a government company, it is the company auditor who is going to do it. He will submit his report under 140 subsection 5 to the CAG, and CAG has a power to comment on the accounts of the government companies as well. Lastly, significant results of audit of undertakings not taken up for appraisal by the audit board. So here we included what was taken up by the audit board, but there might be undertakings which are not taken up by the audit board on which the CAG will perform the procedures. Those shall also be included in the report of the CAG. So with this, we put an end to our discussion of chapter Audit of Public Sector Undertakings. So moving ahead with our discussion of the question bank. Honestly, there are no new questions here, but still a lot of times you will face problems in interpreting the question on what to write. So let us go to the whole question bank here. What are the principles involved in regarding proprietary audit in case of public sector undertakings? So we have already discussed what are the principles involved. So you can refer the content A above. Next, write a short note on areas of proprietary under 143.1. If you recollect, I had put a video for 143.1, that is LT dice. So the whole answer has been given here, but you can refer your Companies Act. Also the role of CAG, we have discussed the role of CAG 143.5, 143.6 and 143.7. So again you can refer the content that we have discussed above. ABG and Company, a chartered accountant firm, has been appointed by CNG for the performance audit of sugar industry. What factors should be considered by ABG and Company while planning a performance audit of sugar industry? So the question is focusing on planning of performance audit. So we have also discussed the planning of performance audit. You will have to write the same answer here. Next, Sunlight Limited is a public sector undertaking in a production of electricity from solar power. It has commissioned a new project near Goa with a new technology for a cost of 5750 crores. The project had seen a delay in commencement and cost overrun. The state matters that a comprehensive audit by CAG may cover in reporting on the performance and efficiency of this project. So what we are supposed to answer here is comprehensive audit, which also we have covered in the above content. Creta Limited is a company in which 54% of the paid up capital is held by Rajasthan government. The company is engaged in the business of providing consultancy services in relation to the construction projects. The audit of the financial statements of Creta Limited for the financial year 31st March 2020 got completed with a lot of intervention of CAG, wherein CAG was giving directions to the auditors on the manner in which audit should be conducted in respect of certain areas. Further, it also received comments from CAG on the audit report of the auditors. Creta Limited is seeking advice to go against CAG so they can avoid unnecessary interference of CAG. You are required to advise in respect of role of CAG in case of the audit of government company. So you'll have to write 143.5, 143.6 and 147 of the Companies Act. Next, a performance audit is an objective and systematic examination of evidence for the purpose of providing independent assessment of the performance of a government organization, program, activity or function in order to provide information to improve public accountability and facilitate decision making by parties with responsibility to oversee and initiate corrective action. So what they have done is they have written the whole definition of performance audit here. Briefly discuss issues addressed by performance audit in accordance with the guidelines issued by CAG. So here what you are supposed to write is about performance audit. So the good part has been that they have already given the definition. So if you can't recollect, you can copy paste the same. Next, BT Limited, a company wholly owned by central government, was disinvested during previous year, resulting in 40% of the shares being held by the company. The shares were also listed on the BSE. Since the share were listed, all the listing requirements were applicable, including publication of the quarterly results, submission of information to the BSE. Sam, the FM of the company, finance manager of the company, is of the opinion that now the company is subject to stringent control by BSE and the markets. Therefore, audit requirements limited to in a private sector under the Companies Act would be applicable to the company, and CAG will not have any role to play. My friends, here when we call it as a government company, when government, central government or state government owns more than 50%, so that is what they have defined here is, see, government company is a company in which not less than 51% of the paid up share capital is held by central government or any state government or partly by central government and one or more state government, and includes a company which is a subsidiary of such government company. The auditor of this government companies are obviously subject to the provisions of CAG, powers and duties of CAG. So this auditors will be appointed by CAG, who gives the auditor the direction and the manner to which they are supposed to do. So somewhere what the management is trying to say is incorrect. They will be under the purview of CAG. Moving ahead with the last question here. You have been appointed as an auditor of AK Limited. After having that determined the audit objectives, now you have been requested to draft audit criteria. What are the sources that you will be looking at while doing the task? So from which or sources we do get audit criteria? If you recollect audit criteria, this was nothing but a benchmark. This was nothing but a benchmark. So we will have to see from which sources do we get this particular benchmark, which we have already covered above. So with this, we are done with a discussion of the question bank, which was a very simple and easy to go question bank. No different answers that you need to go from here apart from this particular one question. Everything has been covered in part A. So we are beginning with the other chapters. Like you all are aware about, there are different parts. One is standards on auditing, second is professional ethics, third is company audit, and fourth is other chapters. So other chapters, my friends, over a period of time, the weightage has been increasing. If you see the past trend, initially the other chapters were not so important, but now the other chapters are weighted at least more than 50% of your whole syllabus. So today we are starting with a very small chapter, that is liability of auditor. If we talk about the past paper analysis, the number of questions that have been asked from this chapter is very less. If you consider at least the last 2 or 3 attempts, no questions has been asked so far. But even if they end up asking, all they will ask is maximum 1 question of 4 marks or 1 question of 5 marks. So without wasting any time, let us move ahead with a discussion of liability of auditor. So firstly, let us understand what is a professional negligence. So here we are talking about liability of auditor. When is a auditor liable? So if the auditor is professionally negligent, obviously he'll be liable. But let us understand what is professional negligence. It connotes any failure to perform a duty according to the accepted professional standard, which has resulted in some loss, damage or detriment to the party who had engaged a professional. So somewhere what we are trying to say is there will be professional negligence when these 3 things are present. Firstly, there was an existence of duty or responsibility. Let us say you casually, when you met me in the lecture, you asked me, sir, for example, this is my father's return. Can you suggest me what can I do to save some taxes? I gave you some tax planning. However, for example, if when I did not have all the details, the guidance that I gave you was probably incorrect, and because of which you had to pay a lot of taxes. Now, can you say I was professionally negligent? No, because I owed no duty to you. So when one party owed to another party to perform some act with due care, skill and competence. So if there has to be a professional negligence, firstly, there has to be an existence of duty or responsibility. Secondly, there has to be an occurrence of breach. So breach occurs while performing the duty. Breach occurs while we perform the duty. So a breach has occurred. And lastly, because of this breach, you have suffered a loss. So for example, let us say I owed a duty. There was an occurrence of breach, but because of this, there is no loss or damage that you have faced. Can this be called as professional negligence? No. So the loss or detriment being served by the party to whom the duty was owed, and as a result of breach. To establish a liability in respect of third party, it is necessary that such third party should have suffered a loss or damage on account of professional negligence. Now, just because there was a professional negligence, I did not owe duty, does not mean if there was a breach, you cannot say there is professional negligence. All 3 things have to be satisfied. Firstly, there has to be an existence of duty. Secondly, there is an occurrence of breach. And lastly, there is a loss or damage. So this is nothing but what? Professional negligence. What you can expect on this is a MCQ. So moving ahead with our discussion of civil and criminal liabilities under the Companies Act. So we are going to discuss our liability under the Companies Act in this chapter, also our liability under the Income Tax Act. Moving ahead with our liability under the Companies Act. So there can be a civil liability, there can also be a criminal liability. Let us discuss about the criminal liabilities. Criminal liability are as per 2 sections. One is section 34 and second is section 448. Let us firstly discuss section 34. Where any prospectus is issued or circulated or distributed. Where any prospectus is issued, circulated or distributed, which includes any statement which is untrue or misleading. Which includes any statement which is untrue or misleading in form or context in which it is included, where any inclusion or omission of any matter is likely to mislead, every person who authorizes the issue of prospectus is liable under section 447. So what they are trying to say is, the prospectus is issued, circulated or distributed, which contains a statement which is untrue or misleading, or there is some omission which may mislead, then every person who has authorized who has authorized the issue of such prospectus shall be liable under section 447, except two scenarios. Firstly, the statement that was omitted or the statement that was made is immaterial. The statement that was made or the statement which is omitted is immaterial. Secondly, he has reasonable grounds to believe and did believe till the time of issue of the prospectus that the statement was true and the inclusion or omission was necessary. So whenever I issued, I was under the impression that the statement they are giving is true or the inclusion and the omission they are making is necessary. So I did believe till the time of issue of the prospectus. Only in these two scenarios I will be exempted. So in case if the prospectus is issued, circulated or distributed, which includes a statement which is untrue, misleading in form or context in which it is included, or any inclusion or omission of any matter is likely to mislead every person who authorizes the issue of the prospectus shall be liable under section 447. There are two exceptions. One is if the statement or the omission was immaterial and he did believe and had grounds to believe at the time of issue that such prospectus, the statement was true and the inclusion or omission was necessary. Now for other chapters, my friends, the content that we have is huge, humongous. So what we will do is, along with this, we will start making short summary notes. So summary notes may not be very detailed. I have done this job for you in case of Companies Act, Professional Ethics, as well as your standards on auditing. But here at least we will make some notes which will be very helpful for us at the time of revision. So what I would request is everyone have a notebook with you and a red pen and a blue pen. So what you will do is, you will take a new page, you will write Liabilities of Auditor, then we will write Professional Negligence. So in this we will write 3 pointers. What are the 3 essential things? So we studied here what are the 3 essential things. Firstly, you should have existence of duty or responsibility. So firstly you will write existence and duty. Secondly, there has to be an occurrence of breach. And thirdly, there should be a loss or damages. So what we are making is just a quick summary notes, so we can revise the same thing on the last day. My friends, the content is going to be huge and humongous. So right now it may get very boring for you, it may get very, a lot of things that you will have to do, you will have to write it down. But my friends, trust me, you revise it, you make sure you write this here, because if you can see the whole book, whole volume 2, the number of pages are too much, and apart from that you will have to do probably RTP, MTP and a lot of things. On the last day, my friends, even if you just go through from every pages, you may not be able to do it. Secondly, we are talking about the civil and the criminal liability. So second point will be civil and criminal liability as per Companies Act. In that, firstly, we are moving ahead with criminal liability as per section 34. Criminal liability section 34. So here we are talking about issue of prospectus. So we are talking about what? Issue of prospectus. If we have issued something wrong is misleading in the prospectus, then you will be liable. So here in short what we will write is misleading prospectus except one, statement was immaterial, and second, you had reasons to believe and did believe that it is true, right? So this was our section 34. Moving ahead with section 448. If written, report, certificate, financial statement, prospectus, statement or other document. Section 34 was dealing only and only with prospectus. Here we are talking about return, report, certificate, financial statement, prospectus or other document required by, for the purpose of any of the provision of this act or the rules made thereunder, any person makes a statement knowing it to be false in any particular, which is false in any particulars, knowing it to be false, omits any material fact knowing it to be material, shall be liable again under section 447. So if in any return, report, certificate, financial statement, prospectus, statement or other document, if there is a statement which is false, which I knew it was false, if we omit any fact which we knew it was material, then in that case we will be again liable for punishment under section 447. So this is our point number B here. Again we are talking about criminal liability as per section 448. When are you liable under section 448? If you know the any fact which is material, knowing it to be material, false statement, knowing it to be false. Secondly, omits knowing it to be material. Now if you do not comply with this, you will have to pay a liability under section 447. So when does 447 get activated? Without prejudice to any liability, including repayment of any debt under this act or under any law for the time being in force, any person who is found to be guilty of fraud involving amount at least 10 lakh rupees, involving how much amount? 10 lakh rupees, or 1% of the turnover, whichever is lower. So for example, let us say turnover is 100 crores. So 1% is going to be 1 crore. So 10 lakhs or 1 crore, whichever is lower, here it is going to be 10 lakh. So in case if there is any fraud which involves amount of 10 lakh rupees or less, or 1% of the turnover, whichever is less, I will be liable under section 447. Now imprisonment shall be how much? In case of imprisonment, minimum imprisonment shall be 6 months. Minimum shall be 6 months. Maximum it may go up to 10 years. Maximum it may go up to how many years? 10 years. However, if it involves public interest, then the minimum may go up to 3 years. So for example, if you are involved in a fraud, imprisonment will be minimum 6 months, maximum it may extend up to 10 years. However, where the fraud in question is of public interest, the imprisonment shall not be less than 3 years. So minimum will be 3 years, maximum may still remain to be 10 years. What will be the fine that will be involved? Fine shall also be liable to fine shall not be less than the amount involved in the fraud, but which may extend to 3 times the amount involved. So minimum is the amount involved. Minimum is the amount involved. Maximum is 3 times the amount involved. So this is the liability under section 447. Firstly, once again, when will 447 be come into picture? When the fraud is of 10 lakh rupees or 1% of the turnover, whichever is less. Imprisonment minimum will be 6 months, maximum may extend to 10 years. However, this minimum imprisonment of 6 months may be extended to 3 years if the fraud involves public interest. The fine, which will be minimum money involved in the fraud, however, it may extend up to 3 times the money involved. So here again in your summary notes, what you will have to write is, you will have to write about section 447. You will have to write about section 447. So what you will write here is, when is it involved? 10 lakh rupees or 1% of the turnover, whichever is less, then you will write imprisonment minimum 6 months, maximum 10 years. If it is public interest, minimum becomes 3 years. Fine, again you will write minimum amount involved and maximum will be 3 times the amount involved. Moving ahead with the civil liability for misstatement in prospectus under section 35. So we discussed criminal liability under section 34, 448, because of which you will be liable under section 447. This is the fourth section that is coming into picture, which includes only civil. So there will be no imprisonment. All you will have to pay is penalty or a fine. Now what does section 35 say? Where a person has subscribed for securities of a company, acting on a statement included or the inclusion or the omission of any matter in the prospectus which is misleading and has sustained any loss or damage as a consequence, then every person who is. So for example, if there is something that is included or something that is omitted which is misleading, because of which any investor has incurred a loss, then every person who is a director of the company at the time of issue of the prospectus has authorized himself to be named in the prospectus as a director or has agreed to become such a director either immediately or after an interval of time. So either he may be a director of the company or he has authorized that I will become director immediately or after an interval of time, or is a promoter of the company, or has authorized the issue of the prospectus, and lastly is an expert. We as chartered accountants are included here. Is an expert shall be liable to pay compensation to every person who has sustained such loss or damage. So once again, if he is a director of the company at the time of issue of prospectus, he will be liable. If he has authorized himself to be named as a director, or he will become a director either immediately or after an interval of time. He is a promoter of the company, he has authorized the issue of the prospectus, or he is an expert, then he shall be liable to pay compensation to every person who has sustained such a loss or damage. What is the exception given here? In case, let us talk about the director first. Having consented to become a director, he withdrew his consent before the issue of prospectus, and that it was issued without his authority or consent. So he had consented to become a director. However, he withdrew his consent on the prospectus. However, this particular prospectus was issued without his authority. Secondly, the prospectus was issued without his knowledge or consent, and that on becoming aware of this issue, he forthwith gave a reasonable public notice that it was issued without his knowledge or consent. So somewhere the company issued this prospectus without taking a consent from the director or any person. And as soon as that person came to know that this prospectus has been issued and his name has been included, he gave a public notice, he gave a reasonable public notice that this particular prospectus was not issued with my consent. Thirdly, as regards every misleading statement purported to be made by an expert, it was correct and fair presentation of the statement, and he had grounds to believe and did believe up to the time of issue of the prospectus that the person making such a statement was competent to make it, and the said person had given the required consent to issue. So whenever we give such a statement as an expert, we had grounds to believe, and we actually did believe that every statement we are including above in the prospectus is correct. Only in those scenarios you will be excluded. So once again, let us go through the liability of section 35, where a person has subscribed for securities of a company, acting on any statement included or the omission of any matter which is misleading or has sustained any loss or damage as a consequence thereof, then a company and every person who is either a director of the company, has authorized himself to be named as in the director. Thirdly, is a promoter of the company, has authorized the issue of the prospectus, is an expert, shall be liable to pay compensation to every person who has sustained such loss or damage. Who is excluded? Every person who is a director but who had withdrawn his consent, or it was issued without his consent and he has given a reasonable public notice that he had withdrawn his consent. Thirdly, if you are an expert, you had grounds to believe and you did believe at the time of the issue of the prospectus that the above statements are correct, then you will not be liable. So in the Companies Act, we studied 4 sections. Criminal liability under section 34, under 448, penalties under 447, and civil liability under section 35. So this was our civil and criminal liabilities as per the Companies Act. So moving ahead with the liabilities of income under the Income Tax Act. Firstly, section 288. What does section 288 say? A person who has been convicted of any offence connected with any income tax proceeding or who has a penalty that has been imposed under the said act is disqualified for representing an assessee. So if you are yourself convicted under the income tax act, can you represent any other assessee? No. So you cannot represent any other assessee provided you are convicted or you have been charged a penalty. Now for how long you will be disqualified, that is CCIT and CIT will decide. They have the power to determine the period of such disqualification. So this was section 288. What does 278 say? Any person who abates or induces in any manner to another person or makes and deliver income tax authorities a false statement or declaration relating to any income chargeable to tax which he knows to be false or does not believe to be true. So I am inducing him. So I am telling him you can give this false statement to the income tax department, you will not have to pay taxes, your taxes will reduce. So somewhere I am encouraging him. That you can give all such false statements to the income tax department, no problem. In that case, where the amount of tax, penalty or interest which would have been evaded if the declaration, account or the statement has been accepted or true, or which is willfully attempted to be evaded, exceeds 25 lakh rupees. So now here we are talking about that the tax evasion is of 25 lakh rupees, not the income. So for example, the income evaded is 50 lakh rupees. So the tax on the same, let us say when if we are 30% tax bracket, it will be 15 lakh rupees. We are not talking about the same. We are talking that the tax evasion is greater than 25 lakh rupees. Then in that case, minimum imprisonment shall be 6 months and may extend it to 7 years. In any other case, what do you mean by any other case? Where the tax evasion is less than 25 lakh rupees, then in that case, minimum imprisonment is 3 months and maximum may extend to 2 years with a fine. So in both the cases, there will be a fine. But if the tax evasion is greater than 25 lakh rupees, then in that case, minimum imprisonment 6 months, maximum may go to 7 years with a fine. However, if the tax evasion is less than 25 lakh rupees, minimum imprisonment may be 3 months, maximum may be 2 years along with a fine. Now, what does Rule 12A say? Every authorized representative of an assessee who has prepared the return of income furnished by the assessee shall either before making an appearance before the assessing officer having jurisdiction to assess that assessee or immediately after making such appearance furnish to that officer the particulars of the accounts, statement or other documents supplied to him by the assessee for preparation of return. So if I prepared a return on your behalf and if the assessing officer asks me, then in that case I will have to give your accounts, your statement and other documents that you had supplied to me for preparing that return. Where authorized representative has for the purpose of preparation of return of income carried out any examination of such accounts, statement or documents, a report on the scope and results of such examination. So in case on such documents I have carried out an examination. So in that case, what was my scope and what was the result, that is what is my actually report on such examination, I will have to furnish them as well. So in case if I have prepared return on your behalf, I am supposed to furnish to the income tax officer 2 things. Firstly, all the accounts, statements and documents that you have given to me. Secondly, in case if I have carried out an examination of your accounts, firstly I will have to tell him what is the scope of examination and secondly what was the result of the examination. Next, 271J. Where the assessing officer or the commissioner appeals in the course of any proceeding under this act finds that an accountant or a merchant banker or a registered valuer has furnished incorrect information in any report or certificate furnished under any provision of this act or the rules made thereunder, the assessing officer or the commissioner may direct the person to pay a penalty of rupees 10,000 for each such report or certificate. So if I have given 3 wrong certificates, incorrect certificates, my penalty will be 3,000 into 10,000, that is 30,000. So this is the most important point here, is that it is for each report and the certificate. So if I have given any incorrect report or certificate, I will have to pay a penalty of rupees 10,000 per such certificate and report. So under the Income Tax Act, again we did 4 sections. One is section 278, next is 278, then rule 12A and 271J. This was our discussion about liability of an auditor under the Income Tax Act. Let us move ahead with a discussion of the question bank. My friends, do not miss out on the question bank here, because question bank has a lot of questions which may cover a lot of things which are not even part of this particular content. So let us move ahead to a very important discussion of our question bank. In this question bank, my friends, a lot of questions has been asked based on professional ethics. Also, lot of questions have been asked based on your Companies Act. Also, a question has been asked based on SC 240. Let us go through the question bank, we'll understand. Firstly, indicate the precise nature of auditor's liability in the following situation and support your views with authority, if any. A misstatement had occurred in the prospectus issued by the company. Then what is our liability? We have already discussed in the content above, so we are not going through the same once again. Secondly, certain weakness in the internal control procedure in the payment of wages in a large construction company were noticed by the statutory auditor, who in turn brought the same to the knowledge of managing director of the company. In subsequent years, huge defalcation came to the notice of the management. The origin of the same was traced to the earlier year. The management wants to sue the auditor for negligence and also plans to file a complaint against the institute. Okay, let us go through the answer of this, then we'll go back to the third sub question. In the given case, certain weakness in the internal control procedure in the payment of large construction company were noticed by the statutory auditor and brought. So here what they have told is everything is from the question. The management of the company desired to sue. Now, what is the precise nature of auditor's liability in the case can be ascertained on the basis of the under noted consideration. Firstly, whether the defalcations emanated from the weaknesses noticed by the statutory auditor, the information regarding which was passed on to the management. So, firstly we need to check whether the defalcation are because of the same weakness. If it is because of something else, then we are not concerned, but we need to see whether it is because of the same reasons. Whether the statutory auditor properly and adequately extended the audit program of the previous year having regard to the weakness noticed. Also, whenever we have deficiencies in the internal control, we also need to communicate to those charged with governance as per 265. So 265 clearly mentions that auditor shall determine whether on the basis of the work performed, the auditor has identified one or more deficiencies in the internal control. If the auditor has identified one or more deficiencies in the internal control, the auditor shall determine on the basis of the audit work performed whether individually or in combination they constitute significant deficiencies. The auditor shall communicate in writing significant deficiencies in the internal control identified during the audit to those charged with governance. The auditor shall also communicate to the management appropriate level of management on a timely basis. So this is what they have requested as per 265. We have already covered the same answer in 265 as well. The fact, however, remains that the weakness in the design of internal control system and non-compliance with the identified control procedure increase the risk of fraud or error. If circumstances indicate possible existence of fraud and error, the auditor should consider the potential effects of the suspected fraud or error in the financial statement. If the auditor believes that the suspected fraud or the error could have a material effect on the financial statement, he should have performed such modified or additional procedure as he determines appropriate. Thus, normally speaking, as long as the auditor took due care in performing audit, he cannot be held liable. So here, if he has performed his duties, he cannot be held liable. So the whole answer was based on what? S8 265. Third sub question. Based on the legal opinion of a leading advocate, X Limited made a provision of 3 crores towards the income tax liability. The assessing authority has worked out the liability at rupees 5 crores. It is observed that the opinion of the advocate was inconsistent with the legal position with regard to the certain revenue items. Once again, they made a provision of 3 crores in the income tax liability. The assessing officer worked out the liability at 5 crores. It is observed that opinion of advocate was inconsistent with the legal position. So the 3 crore provision that we have made is incorrect. Here, the question is again talking about what? SA 500. So the first question was from this chapter. Second was from SA 265. Third question is talking about SA 500. So what is the third sub question talking about? SA 500 discusses the auditor's responsibility in relation to and the procedures the auditor should consider in using the work of an expert as audit evidence. During the audit, the auditor may seek to obtain in conjunction with the client or independently audit evidence in form of reports, opinion, valuation and statement of an expert. Legal opinion concerning interpretation of agreements, statutes and regulations, notification circular. Before relying on the advocate's opinion, the auditor would have seen that the opinion given by the expert is prima facie dependable. The question states very clearly that the opinion of the advocate was inconsistent with the legal position with regard to the certain items. It is perhaps quite possible that the auditor did not seek reasonable assurance as to the appropriateness of the source data, assumptions and the method used by the expert. So whenever we are evaluating the work of the expert, we need to evaluate firstly source, assumptions and the basis of the method. In fact, SA 500 makes it incumbent upon the part of the auditor to resolve inconsistency by discussion with the management and expert. In case the expert's work does not support the related representation in the financial statement, the inconsistency in the legal opinion could have been detected by the auditor if he had gone through the same. This seems apparent having regard to the wide difference in the liability. Under the circumstances, the auditor should have rejected the opinion and insisted upon making the proper provision. So somewhere they are saying the auditor should have not relied only on the 5 crores penalty, that was 3 crores provision that was requested by the advocate, and should have applied his provisions. Moving ahead to question number 2. Write short note on the auditor's liability in case of unlawful act. My friends, the same question we have covered in the chapter of professional ethics. So we will not be discussing the same question here. Question number 3. Again, this question we have covered in SA 240 as it is where it is. Explain briefly the duties and responsibilities of an auditor in case of material misstatement resulting from fraud. Next. In assessment procedure, Messrs. Cloud Limited income tax officer observed some irregularities. Therefore, he started investigation of books of accounts and audited and signed Mr. Old, a practicing chartered accountant. While going through the books, he found that Messrs. Cloud used to maintain 2 sets of books of account. One is the official set and the other is covering all the transaction. Income tax department filed a complaint to the Institute of Chartered Accountants saying Mr. Old had performed his duties negligently. Again, the same question as it is where it is with the same name we have covered in professional ethics, so we will not be discussing it here. Next, Mr. Fresh, a newly qualified chartered accountant, wants to start a practice and he requires your advice, among other things, on criminal liabilities of an auditor under the Companies Act. So criminal liabilities we have already discussed about, so we will write the same answer here. On the advice of management of Quick Limited, the auditor of a company overlooked and did not report on shifting of certain current year's sales transaction to the next year. The NCLT wants to take action against the auditor. Describe the powers of NCLT under 140 subsection 5. So this is not refer A, this is nothing but our Companies Act. If you recollect 140 subsection 5, so if the tribunal is of the opinion that the auditor is acting in a fraudulent manner, if the application is made suo motu or on an application by central government or by any concerned person, then the auditor will be removed for 5 years from the date of passing of the order. However, if the application has been made by central government and if tribunal is satisfied, the auditor will be removed in 15 days and the new auditor shall be appointed by central government. So you will have to write 140 subsection 5 of the Companies Act here. Next, state the nature of liability as provided in the Companies Act for an auditor for not appropriately dealing with misstatements appearing in the audited financial statement. So we will have a liability under section 447. Again, what is the liability under 447 section? We have already discussed in the above part. The auditor of Mrs. Quick Limited succumbed to the pressure of the management in certifying the financial statement with an overstated figure of turnover. By not adhering to the cut-off principles of the time scale of the transaction for the year. On taking cognizance of this act, the auditor, the tribunal under the Companies Act, initiated proceedings against him. Briefly list the powers of tribunal in respect of including those relating to the making orders. So again we are talking about 140 subsection 5, the same point that we discussed above. CA Prince, a chartered accountant, has appeared before various tax authorities, authorized representative of his client, and delivers to the income tax authorities a false declaration. What are the liabilities? Again, this liability we have discussed about. If we abet or if we induce that person to give false declaration, then we will be liable under section 278. The minimum imprisonment which will be 6 but may extend up to 7 years, but however if it is in public interest it may be extended as well. So this was our discussion question bank of liabilities of auditor. Let us move ahead with our next discussion, that is MCQs of liabilities of auditors. Karan and his friends subscribed to the shares of ABC Limited. ABC Limited had issued a prospectus for issuance of shares against which these persons had subscribed the shares. Later on, it was found that some information as included in the prospectus was misleading. Karan and his friends filed a case against the company covering all parties who were responsible for the prospectus on the ground that information contained in the prospectus was misleading and they suffered losses by relying on that information. So, is this negligence? Let us go ahead and see. The company consulted this matter with a legal consultant in respect of the course of action to be taken and also consulted that if the outcome of the case goes against the company, then which all parties may be held liable and that could be the other consequences. The prospectus included auditor's report, who had also given his clearance. Some of the experts were also involved in respect of the information on which litigation was filed. Subsequently, it was proved that contention of Karan and his friends was correct. It was held that the directors, promoters of the company and the experts involved would be liable to pay compensation to all these persons who had sustained losses or damages. The auditor of the company were also asked to make good the losses, but they refused on an argument that it is limited to the directors, promoters, expert. In this, please suggest which of the following statement is correct. The argument of the auditor is valid. As per the final outcome of litigation, the auditors were not liable. However, on the moral grounds, the auditor should contribute towards the losses. Who does this on the moral ground? So this is invalid. Argument of the auditor is valid. Since the final outcome of the litigation did not hold them liable, they cannot be asked to contribute towards the losses suffered. Argument is not valid. The final outcome of the litigation covers experts and hence auditor also gets covered to contribute toward the losses. My friends, this seems to be the best option. If you recollect, we were covered under expert. So if we have given our consent, we are covered under expert and we are liable as per the above litigation. Still, let us see the point D. The outcome of this litigation seems to be completely wrong. Now we are questioning the litigation itself. The directors and experts were held liable, but along with the statutory auditors, internal, tax auditor, company secretary and tax consultant, legal advisor should also be held liable. My friends, only whose name has been given in the prospectus, who has authorized the issue, only they will be liable, and hence the answer here is going to be C. So this was only one MCQ of this particular chapter. So let us have a quick revision of this particular chapter. In case of liabilities of auditor, we said there will be professional negligence if there are three elements. Firstly, there was a duty which I owed to them. Secondly, there was a breach of that duty. And thirdly, the opposite person incurred or suffered loss because of that breach. Civil and criminal, there are 4 sections that we need to do here. Firstly, we are talking about criminal liability for misstatement in prospectus under section 34. So where the company has issued circulated or distributed. My friends, you will have to recollect this, you will have to memorize this and write as it is where it is, or you will not get marks. So where any prospectus is issued, circulated, distributed, which includes any statement which is untrue, misleading in form or context in which it is included, or where any inclusion or omission of any matter is likely to mislead. Every person who authorizes the issue of such prospectus shall be liable under 447. Exception. This shall not apply to a person if he proves that such statement or omission was immaterial, or he had reasonable grounds to believe and did believe up to the time of issue of prospectus that the statement was true or the inclusion or omission was necessary. Secondly, there will be a criminal liability under section 448. See, 34 was only and only talking about prospectus. But here we said if the return, report, certificate, financial statement, prospectus, statements or other document required by for the purpose of any provision of the act or the rules made thereunder, any person makes a statement which is false in any particular knowing it to be false, so it is a statement which is false and I knew, or omits any material fact and I knew that particular fact was material, then there will be a punishment under section 447. What is the punishment under 447 and when will 447 will be activated? When the fraud involves 10 lakh rupees or 1% of the turnover, whichever is lower. Imprisonment, minimum imprisonment will be 6 months and a maximum may go to 10 years. However, if it is in public interest, minimum imprisonment may go up to 3 years. Maximum may still remain 10. Fine, it shall be not less than minimum will be the amount involved. Maximum it may go up to 3 times the amount involved. So this were the criminal liabilities. Let us go to the civil liability under section 335. Where a person has subscribed for securities of a company acting on any statement included or the inclusion omission of any matter which is misleading and has sustained loss or damage as a consequence, the company and every person. Firstly, who is a director of the company at the time of issue, has authorized himself and is named in the prospectus as a director of the company or has agreed to become such director either immediately or after a period of time, is a promoter of the company, has authorized the issue of the prospectus and is an expert, then they shall be liable to pay compensation to every person who has sustained such loss or damage. Exception here will be if he proves that he had withdrawn his consent. Secondly, it was issued without his consent and as soon as he came to know about it, he gave a reasonable public notice, and if he was an expert, he believed and he had grounds to believe that the above statements were correct. So this was civil and criminal liability as per the Companies Act. When we go to liabilities under the Income Tax Act, if I am myself convicted or there is a penalty imposed by the Income Tax Act, then I cannot represent any assessee for how much period CCIT and CIT will decide. Section 278, if I abet or induce any person to give false statement declaration to the income tax department, then I will be liable. If the tax evasion exceeds 25 lakh rupees, minimum liability will be imprisonment will be 6 months. It may be extended to 7 years and with a fine. However, if it is less than 25 lakhs, then minimum will be 3 months, maximum may be 2 years with a fine. Then rule 12A says, if I have prepared a representation, if I have prepared accounts on the basis of accounts given by me from the assessee, then I need to give the particular statements and other documents supplied to him to the IT officer. Also, if I have done an examination on the same, then I need to report to them the scope and also the results of such examination. And finally, 271J says, if we give any incorrect certificate or a report, then we are supposed to pay penalty of rupees 10,000 rupees for each such report or certificate. So this was our discussion of liabilities of auditor, a very small and a crisp chapter, but not a lot of weightage. But the chapter is such small that it does not make sense that we leave the chapter for option. So I hope you have done the whole chapter and then moving ahead with the next chapter. So moving ahead with our discussion of CARO 2020. So firstly, what exactly is CARO? See, what happens is we give a financial statement. Based on financial statement, give an audit report. After audit report, we have an annexure. In annexure, we give two things. One is IFC, that is internal financial control, which we have already discussed about. And along with internal financial control, what we give is CARO. So there are a lot of points on which financial statement does not give a lot of disclosure. Audit report also does not talk about. So to give users a better understanding, to give a better reporting, what we give is CARO. So is CARO applicable to all the companies? Yes, CARO is applicable to all the companies. CARO is applicable to all the companies including the foreign company. So even if you are a foreign company, will CARO apply to you? Yes. So it will apply to all the company excluding BIPs. So it will not apply to BIPs. What do you mean by BIPs? Bipasha Vasu? No. By BIPs we mean a banking company. To a banking company, CARO will not apply. Why will a CARO not apply? Because here, in case of a banking company, what is applicable is LFAR, that is long form audit report. What is applicable to a banking company? Long form audit report. We will discuss the same in when we go to the chapter of banking company. And since they have LFAR, they are not required to comply with CARO. Likewise, in case of an insurance company also in their act has a lot of reporting, so they need not comply with CARO. If you are a private company, all the private companies know, provided you are a public, provided your paid up share capital plus reserves is less than 1 crore. See, now when we say paid up share capital, we mean both. We mean equity share capital, we also mean preference share capital. When we see reserves, we say all the reserves. So it can be revenue reserves, it can be capital reserves, it can be revaluation reserves. So paid up share capital plus reserves. So a lot of times students, what they think here is only free reserves. We are not calculating dividend, my friends. This is in a general reserves. This is as per the schedule 3. So all the paid up share capital plus reserves, if it is less than 1 crore or even equal to 1 crore, you will be excluded. And loans. So loans is nothing but borrowings from banks or a financial institution. If it is less than 1 crore, then it shall not apply. And if your revenue is less than or equal to 10 crores, it shall not apply. So firstly, revenue, when we talk about, again we will talk about schedule 3, the revenue as per schedule 3. So even the income from discontinued operation, will not be considered here. So this is a cumulative condition. You need to comply with all the 3. So paid up share capital plus reserve should be less than or equal to 1 crore. Your loan should be less than or equal to 1 crore. Your revenue should be less than or equal to 1 crore. So this is a cumulative condition. Even if one of them is satisfied, even if one of them is exceeded, CARO will be applicable. So let us say, for example, if your paid up share capital is 90 lakhs, your loan is, let us say, only 50 lakhs. But however, your revenue is 11 crores, CARO will still be applicable. So all the 3 has to be below the limits to be excluded. Then if you are a section 8 company, 1-person company or a small company, CARO will not be applicable. So once again, CARO is applicable to all the companies including foreign companies. Who are excluded from CARO? If you are a banking company, because LFAR is applicable, insurance company, private company if the paid up share capital plus reserve is less than or equal to 1 crore and your loan is less than or equal to 1 crore and your revenue is less than or equal to 10 crore. If you are a section 8 company, small company, 1-person company, then in that case CARO will not be applicable. Now when we talk about paid up share capital and we talk about revenue, we consider this on the balance sheet date. So we will check the paid up share capital and revenue on 31st of March. But however, when we talk about loans, we will not check it on the financial statement date, not on the 31st March. We will check it any time during the year. So for example, if my loan was 1.3 crores, I have repaid 40 lakh rupees. So loan as of the end of the year is 90 lakh rupees. Is CARO applicable to me? Yes. If any time during the year, if my borrowings has gone over and above 1 crore rupees, it will be applicable irrespective of what the amount is on 31st of March. Even if I have repaid the whole loan of 1.3 crores and if the borrowings is 0 as on 31st of March, this shall not apply. So what we are trying to say is CARO is applicable to all company. Who are excluded? Banking company, insurance company, private company, section 8 company, 1% company. So here what we saw is status shall be checked on the balance sheet date. However, borrowings, when shall we check it? During the year. Now let us say X is a listed company. X, let us say it is a public listed company. Now X has a subsidiary, S Private Limited. The paid up share capital is less than or equal to 1 crore, is less than 1 crore, and their loans is less than or equal to 1 crore, and their finally revenue is less than or equal to 10 crores. So if you consider S Private Limited individually, it satisfied all the condition of a private limited company which is excluded. So if you see it individually, CARO shall not apply to S Private Limited. But however, S Private Limited is a subsidiary of X Limited, and CARO is applicable to X Limited because it is not excluded. So if CARO is applicable to a holding company, it shall definitely apply to a subsidiary. If CARO is applied to a holding company, it shall also apply to a subsidiary company, even if you meet the clauses. So if it is applicable to a holding company, it shall apply to a subsidiary. Now for financial statement, what we usually do is, if there is a holding company's financial statement, there is subsidiary company's financial statement, what we make is consolidated financial statement. Likewise, there is an audit report of holding company. There is an audit report for subsidiary company. What we end up giving is consolidated audit report. Likewise, if there is CARO for holding, there is CARO for subsidiary, there is nothing called as consolidated CARO. There is nothing called as consolidated CARO. Why is there nothing called as consolidated CARO? We will see it at later stage. When you have seen the clauses of reporting, you will get a better understanding. But if there is there anything called as consolidated CARO? No. But however, here they have given a clause. The CARO shall not apply to the consolidated except clause 21. Now what is clause 21? We will see when we go to clause number 21, and we will discuss this whole point when we are in clause 21, because at that stage you will be in a better position to understand this. So this is a new modification. Wherever you see this bulbs, my friends, it is nothing but a new addition in CARO 2020. Such a point was not present in CARO 2016. Now my friends, so far what do we have in our hand is only 1 or 2 material where we have seen questions on CARO 2020. So we'll have to do a lot of critical evaluation on what questions may be asked. What are the additional points which were not there in CARO 16 and have come in only CARO 2020? Because on all such points, Institute will probably ask you a question. So this is just so that you understand which are the new points. So this point was nowhere in CARO 16 but has come in CARO 2020. We will discuss the same point at a length when we go to clause 21. Moving ahead, let us discuss a few questions based on this. As an auditor, how would you deal with the following? L Private Limited, which has an outstanding of more than, outstanding is nothing, loans or borrowings of more than 100 lakhs. See, 100 lakhs is nothing but 1 crore. From financial institution defaulted in repayment to the extent of 50%. The company holds that it being a private limited company, CARO is not applicable. Is CARO applicable? Yes. Because what we said is, if you are a private company and if your paid up share capital is less than 1 crore and your borrowings is less than 1 crore and your revenue is less than or equal to 10 crores, then in that case CARO is not applicable. But however, in this case the borrowing is greater than 100 lakhs, so that is greater than 1 crore. So irrespective of whether you have complied with the other provisions, other limits or not, CARO will be applicable because it was a cumulative condition, it was an AND condition, and hence CARO here is applicable. Okay. Next question number 2. A private limited company reports on the following position on 31st of March. Paid up capital is 60 lakhs. Do we consider paid up capital? Yes. Revaluation reserve, I have already explained, you will also consider revaluation reserve, capital reserve. So will we add revaluation reserve? Yes. Capital reserve 22 lakhs. P&L account debit balance 4 lakhs. So the total comes to how much? 98 lakhs. Is CARO applicable? No. But here a lot of times what mistake students make is they are not sure whether to include revaluation reserve and capital reserve. Secondly, this is a P&L account debit balance. You cannot add it, you have to subtract it. So these are the 3 points that you need to make sure you have not made a mistake. So in this case, CARO is not applicable. Under CARO 2020, how as a statutory auditor would you comment on the following? X Private Limited is a subsidiary of a listed entity. The management of the company believes that since X is a private company and satisfies all the conditions, reporting under CARO is not applicable. My friends, see, X is a private limited company, agree. But it is a subsidiary of a listed entity. If it is applicable to a holding company, it shall also apply to a subsidiary. If it is applicable to the holding company, it shall also apply to its subsidiary, and hence CARO here is applicable. So here, so far what we have discussed is nothing but applicability. What we have discussed is applicability. Now we are moving ahead to the clauses. As everyone is already aware, how many clauses do we have? 21. All these clauses are stated in para 3. All these clauses are stated where in para 3 of CARO 2020. So for example, if your question has been asked on property, plant and equipment of intangible asset, what you will write is, as per clause 1 of para 3 of CARO 2020. So this is how you will quote it. You will quote it as clause 1 of para 3 of CARO 2020. So now here, moving ahead with the first clause. Initially the name of this clause was nothing but fixed asset, but now they have named it as property, plant, equipment and intangible asset, which is actually nothing but what? Fixed asset. So they said, firstly, whether the quantitative details are maintained. We as auditor, we need to verify whether the quantitative details for the same are maintained or not. Of what? Property, plant, equipment and intangible assets. Of what? Property, plant, equipment and intangible assets. My friends, this again is a new point. So far we used to ask, we will need to see whether quantitative details of property, plant and equipment were kept. However, in CARO 2020, they have added the word intangible asset here. My friend, it was the need of the hour. If we see the businesses today, the e-commerce and everything, their intangible assets involved are more. For example, if we talk about Netflix, let us say if Netflix has rights of Suryavanshi, if Netflix has rights of Gangubai, this is nothing but an intangible asset for Netflix. So if we are auditing Netflix, we will have to verify they have a quantitative detail. They whether have a list of intangible asset, the rights that they have. So in this today's scenario, we have all the startup are basically focusing on what? Intangible asset. Whether we consider Netflix, Amazon or we consider Uber, everyone has a lot of intangible asset, and hence it was a need of the hour that we need to see whether quantitative details of intangible assets have been kept. Secondly, whether physical verification is conducted at regular intervals. See, now they have not defined what do you mean by regular intervals. So a lot of people say regular interval means every year. My friends, a lot of times every year might also not be feasible. Let us say we are auditing Indian hotels. Indian hotels is nothing but what? Taj. Indian hotels is nothing but what? Taj. Now Taj has a lot of properties across the globe, not just in India. They have their properties across the globe. Now for example, if we are talking about physical verification of tangible or intangible asset at regular intervals, that is every year, is it humanly possible that we can do physical verification of every property of Taj in one single year itself and again redo the physical verification the next year? I would definitely like to be a part of that particular team. It would be, you know, a blessing in disguise. So is it possible? No. Let us say if Taj has, let us say, 300 properties, for example, what we can do is we can do physical verification of 100 properties in 1 year, 100 properties in second year and 100 properties in the third year, and again after 3 years again we will do the physical verification of this 100 properties, then physical verification of this 100 and then physical verification of this 100. So what we will do is we will do the physical verification when at regular intervals. So we need to verify whether it is done or not. If physical verification is done, whether discrepancies are dealt with. So if we see while doing physical verification, the inventory, I mean the intangible assets in the books of accounts were, let us say, around 292 crores. When we do physical verification, we could identify only 278 crores. So there is a discrepancy here of almost 14 crores. So we need to see whether the discrepancy has been dealt with. So there might be a misstatement in the books of accounts, or there might be a there will be a mistake in our physical verification. So all we need to see whether the discrepancy has been dealt with. But here when we are talking about discrepancy, the amount of discrepancy has not been mentioned. So now we will have to use our own professional judgment. For example, if the inventory is 292 crores and when we did physical verification, the inventory was 291.70 crores. For 30 lakhs, are we going to report it here? So it has been left on our professional judgment. You see discrepancies, whether the discrepancy is material. If it is material, you report it here, whether the same has been dealt with or not. So again, point number 1, whether quantitative details are maintained of property, plant, equipment and intangible asset. So this is nothing but point A of clause 1. This is nothing but point B. Physical verification are done at regular intervals. If yes, discrepancies, if any, are dealt with. Then, are we holding any immovable property in the name of the company? Do we have any immovable property in the name of the company? If not, in the prescribed report in the prescribed format. So we have immovable property. However, it is not purchased on our name. We have purchased the same on someone else's name. So if it is in our name, no worries. We are not supposed to report anything here. If it is not in our name, the property has been purchased in someone else's name, then we need to report in the prescribed format. So this is a new point altogether. Again, there was no such point in CARO 2016. What are we supposed to report here? So firstly, what we'll have to give here is a description of the property. So which property which is not held in our name, it is held in someone else's name. What is the gross carrying value? What is the gross carrying value? Whether the same is held in the name of the promoter, director or relative or their employee. So if we are not holding in the name of the company, a lot of times what will happen is, for example, if there is Reliance Industry, we might buy the property on the name of Mukesh Ambani ji. So we will have to report here that we are holding it in the name of the promoter, that is Ambani ji here. So we will have to say whether we are holding it in the name of promoter, director, relative or their employee. What is the period held in? Since how long are we holding this property on someone else's name? And reasons for not being held in the name of the company. Why are we not holding the same in the name of company? We need to give the reasons for the same. Because if it is a property of the company, it has to be on the name of the company and not on the name of the proprietor, the promoter, the director or their relative. So again, if the deeds of immovable property is in the name of the company, very good. But if it is not, we will have to report in the prescribed format. What are we going to report? Description of the property. What is the gross carrying value? Whether it is held in the name of the promoter, director, relative or employee. What is the period held range? What is the period held range? Since how long are we holding that? What is the reason that we are not holding it in the name of the company? Next, whether there has been a revaluation in the property, plant, equipment and intangible asset. Whether there has been a revaluation in the property, plant or equipment of the intangible asset. If yes, whether the revaluation was based by the valuation done by the registered valuer. So it should not be done by any haphazard, any person. It should, we need to check whether the revaluation was done by a approved registered valuer. If the revaluation is greater than 10%, if the amount change is greater than 10%, it may be upward or it may be downward. This change may be upward or downward, either of the cases. Let us say we had a fixed asset of 40 crores. Now the amount has come down to, let us say, 33 crores. So now we will have to report because the change is greater than 10%. However, the asset was 40 crores. Now it has been shown as 46 crores. Again, we will have to change because the change is greater than 10%. So if the change is greater than 10%, we will have to disclose what is the change of amount as well. So if there has been a revaluation of property, plant, equipment or intangible asset, firstly you need to check whether the revaluation was based on valuation by the registered valuer. If yes, if the amount and change in the amount is 10% or greater than 10%, you need to disclose the amount as well. Proceedings initiated for pending or for holding Benami property. So a lot of times, a lot of people have a Benami property. What is a Benami property? Let us say there is a government official. His official salary for the whole year is hardly 7 lakh rupees, but he gets a lot of things, you are aware about it. So what happens is, if he buys a property worth rupees 2 crores on his name or 3 crores on his name, people are going to raise question on him. People are going to have that suspicion that if you have a salary of only 7 lakh rupees, how could you afford a property of 3 crores? So what he will do is, he will end up buying a property on someone else's name. Maybe his relative, a friend of his, or an XYZ person. But who is a beneficiary of that particular property? That government official. He is using that property, but he is just holding it in someone else's name. This property is called as Benami. That is not our name, it is on someone else's name. So someone would say this is a Hindi word, this is a valid Hindi term that is being used. We will call this always as a Benami property. So whether there are proceedings initiated or pending for holding Benami property. So whether anyone has initiated proceedings against us, that is against the company, for holding a Benami property. If yes, whether the same has been disclosed in the financial statement. So if any litigation is going on against us, we will have to show that as a contingent liability. So we need to disclose whether the same has been disclosed in the financial statement or not. So when we consider property, plant and equipment, overall there are 5 points that we need to report. Firstly, whether quantitative details are maintained. Second, whether there was physical verification conducted at regular intervals. If yes, whether the discrepancies, if any, are dealt with. Whether the deeds of immovable property are in the name of the company. If not, report in the prescribed format. We will report the description of the property. What is the gross carrying value? Whether it is held in the name of the company, promoter, director, relative or employee. What is the period held range? Since when are we holding it? What is the reasons for not being held in the name of the company? Then whether the revaluation of property, plant, equipment and intangible asset. Whether the revaluation is based on the registered valuer. If yes, whether the amount change is greater than 10%, it may be upward or downward. Whether the proceedings are initiated or pending for holding a Benami property and whether the same has been disclosed in the financial statement. So this was a discussion about property, plant, equipment and intangible asset. Moving ahead with our discussion of inventory. Now inventory, there was only one point in CARO 2016. Whether we have conducted physical verification. So similarly to what we did in fixed asset, we have to see whether physical verification was done. But here we need to see whether the discrepancies was 10% or more. While we were doing fixed asset, my friends, discrepancy was not, the materiality level was not defined here. It was left to our professional judgment. If you feel the discrepancy is material, please see whether the same has been dealt. Now they are saying if the discrepancies is 10% or greater than 10%, only then you need to report whether the same has been dealt with or not. So here this materiality level was never there in CARO 16. This materiality level has been defined in CARO 2020. So if the discrepancies is less than 10%, do we need to report it here? Because a lot of times, my friends, when we are doing physical verification of inventory, a lot of times there is always an inherent weakness that we might find some discrepancies. So even if we find some negligible discrepancy, do we need to report it here? No. Only if the discrepancies is 10% or greater than 10%, we need to report it here. Second point, which was never a part of CARO 2020, I mean never a part of CARO 16, a very nice point on which even Institute has asked a question in May 22 RTP. A very nice point. So what we need to see is whether there are sanctioned working capital limits greater than 5 crores in aggregate from banks or financial institution. If you see, I have underlined the word sanctioned here. Why have I underlined the word sanctioned? See, we need to check how much limit is sanctioned. How much limit we have used is irrelevant. For example, if I am sanctioned a limit of 7 crores and I have used a limit of 2 crores, does not matter. This clause will still be applicable to me, because what we are checking is what is the sanctioned limit and not the used limit. So if I sanctioned a working capital limit of 7 crores, is it greater than 5 crores? Yes, it will be applicable to me. So whenever we have a working capital limit, what we usually keep with the bank is a debtors and stock. What we keep with bank is nothing but what? Debtors and stock. So we need to verify whether the quarterly returns or statements are filed. If we have filed the quarterly returns, whether the same are in agreement with the books of accounts. So a lot of time what happens is our stock is, let us say, hardly 5 crores. But in the quarterly return submitted to the bank, we have restated it to be 11 crores because we still want the sanction limit of 7 crores. So far there was no reporting on this. Now the onus has been put on us that we need to check all the quarterly returns that we have filed with the bank, whether the same are correct or incorrect, whether they are in agreement with the books of accounts. Because of this, banks used to incur what? NPA. So if I have only a stock of 5 crores and I have said no, I have 11 crores and I have utilized the limit of 7 crores. Now if I am not in a position to pay, bank will not have enough securities to sell the same and get the money. And hence the onus has been put on auditors that you need to report if the quarterly returns that we have filed with the bank are in agreement with the books of accounts. So in inventory, now there are 2 points. Point A is nothing but whether we have done physical verification and if there are discrepancies. But discrepancy has been defined this time here. If it is greater than 10% or more, you need to report whether the discrepancies has been dealt with. Are we given sanctioned working capital limits greater than 5 crores? Again, my friends, the word sanctioned is important. Does not matter how much you have used. Are you filing quarterly returns? If yes, whether they are in agreement with the books of accounts. So this is inventory. Now the third clause is talking about investment, guarantee, security and loans granted by the company. So firstly, we need to see whether the company has actually granted any loans, has provided loans, guarantees or provided security to any other entity. If the company has not given any loans, it has not done any investment, this clause will not apply. So firstly, we need to see whether the company has provided loans, guarantee or security to any other entity. This is not applicable to the company whose principal business is to give loans. So a lot of students tell me, sir, your banking company is an example. No, banking company is not an example here. Why banking company is not an example? Because to a bank, CARO does not apply at all. We have seen in the exclusion part, does a CARO apply to a banking company? No. So which company's principal business is to give loans? NBFC. So NBFC will not be covered here. So for NBFC, we had a different point altogether. So no reporting for NBFC will be done here. So if your main business is to give loans and take loans, we will not report here. However, if in any other case, if you have provided any loans, guarantee or security to any other entity, we will have to report here. So if you have provided any loans, guarantee or security, we will see how much loans, guarantee and security you have given to the group companies, that is subsidiaries, associate and joint ventures. And how much amount have you given to the other parties? So you need to divide the amount into two. How much has been given to subsidiary, joint venture and associate? How much have been given to the other parties? Then we need to see whether the terms and conditions are prejudicial to the interest. You need to see whether the terms and conditions. Firstly, for example, let us say we gave a loan to someone. We took no security from the opposite person. Is this prejudicial to the interest of the company? Yes, definitely it is prejudicial, because if the opposite person does not ends up paying, then company will incur a loss. Hence, if the opposite person has not given a security, it is prejudicial. Let's take one more example. First example we took, there is no security. Second, the rate of interest in the market is 12%. However, we have charged only 7%. Again, it is prejudicial because company will be losing out on that 5%. So probably that might be a reason that we have given it to the related parties or to the director or to the promoter. But however, the members are at loss. So we need to see whether the terms and conditions are prejudicial to the interest of the company. We also need to see if the opposite party is regular in repayment of the interest as well as principal. So all we are trying to say is whether they are paying their EMIs on time. If not, we will have to report here. So we saw three things so far. whether the company has provided loans, guarantee or security. This is not applicable to a company whose principal business is to give loans. Secondly, we need to see the terms and conditions are not prejudicial to the interest of the company. And thirdly, we need to see whether the repayment of interest and principal is regular. If the opposite person has not paid and it is overdue since 90 days, my friends, if you recollect NPA of audit of banks, if it is overdue for greater than 90 days, it will be treated as NPA. But somewhere we are not talking about banks at all here, because this clause is not applicable to a banking company. CARO is not applicable to a banking company. But however, if it is greater than 90 days, it is a matter of concern. It is a matter of concern. So we need to see whether we have taken any steps for recovery here. So if the opposite person has not paid, we have not even sent him a notice, we have not sent him a legal notice, we have not taken any action, then somewhere it might show us, it might give us an indication that the opposite person again might be a related party. He might be a director or a promoter. So for example, here we need to see whether the opposite person has paid, and if he has not paid for greater than 90 days, when any steps for recovery have been taken or not. Now one more new point has been added here, which was not a part of CARO 16. Loans and advances fallen due during the year has been renewed, extended or fresh loans granted to settle the overdues of the existing loan. So what we are trying to say is, let us say the opposite person was granted a loan of 25 lakhs. He was supposed to pay this over a period of 12 months. However, he could not. So we renewed his loan or extended his loan. We told him that, okay, you do not pay this in 12 months, you pay this in 24 months or 36 months. Or we gave him a fresh loan so that he could settle the old loan. So somewhere all these things are an example of renegotiation. This is nothing but an example of renegotiation, where we are renegotiating all the terms of loans once again. Somewhere it is showing an inherent weakness that all these parties may not be able to pay it on time. So as auditors, we are supposed to show what is the amount and also the percentage of the aggregate of the total loans. Let us say total loans and advances as 100 crores. And loans which are renewed, extended is 5 crores. So here we will end up showing what is the percentage of the total loans, 5%. Again, this is not applicable to whose principal business is to give loans. So like if we are talking about NBFC, this clause is not applicable. Next, if the loans or advances are granted in the nature of loans, either repayable on demand or without specifying the term, to whom will we give the loans on repayable on demand or without specifying the terms? Usually we will give it to the promoters, we'll give to the related parties, we'll give to the directors or employee of the company. So if we have given any loans which are repayable on a demand, so as soon as we ask it, they have to return it back, or without specifying any terms of period, then we need to specify what is the aggregate amount. We also need to specify the percentage of the total loans. Percentage of the total loans to the promoter and the related parties. So again, let us say for example, we have given us 2 crores such loan and a total loans is 100 crores. So here we will end up showing what is the total percentage, 2%. So users can get a clear idea. For example, out of 100%, 5% loans are such on which renegotiations are going on. So somewhere there is inherent weakness. 2% loans are such which are given to the promoters or the related party. So somewhere they will get a better picture which was not available in the financial statement or the audit report. So investment guarantee, security and a loan has been divided into 6 subclauses. Firstly, whether the company has provided loans, guarantee or provided security to any other entity. It will not apply to the entity whose principal business is to give loan, for example NBFC. Then we will see what is the amount given to the subsidiaries, associate or joint ventures. Then we will see what is the aggregate amount given to the other parties. Then we will have to check whether the terms and conditions are prejudicial to the interest of the company. Repayment of interest and principal is regular or not. Next, investment, guarantee, security and loans granted by the company. If it is overdue for greater than 90 days, whether any steps for recovery have been taken. Next, loans and advances has fallen due during the year has been renewed, extended or fresh loan granted to settle the overdues of the existing. Next, percentage of the aggregate to the total loans and advances. not applicable to whose principal business is to give loans. Next, if the loans or advances are granted in nature of loans either repayable on demand or without specifying terms of period, specify the aggregate amount and the percentage of total loans to the promoter and the related party. This was our clause 3, that is investment guarantee, security and loans granted by the company. Moving ahead with the next part, compliance of section 185 and 186. This is part of your company law. Here, all we are again talking about is the provisions related to the loans. If you recollect your company law that you have done in your syllabus, here 185 and 186 is again talking about what? Loans. Here we need not write anything else. So all we need to check is whether there is a compliance with section 185 and 186. Moving ahead, public deposits. What is public deposits? For example, if I keep 1 lakh rupees with Axis Bank, this will be called as fixed deposit. However, if I keep 1 lakh rupees with Future Group, which is a company, and if they are paying me interest, I will not call this as what? Fixed deposit. I will call this as public deposit. If any company other than a banking company is accepting deposit from the public, is called as what? Public deposit. So for every company, there are two ways of getting money. One is from the members and second is from the public. So whenever they raise money from the public, this is called as public deposits. Now, in case of public deposit, the risk associated is always high because it is a form of unsecured loans. It is a form of unsecured loan. So for example, if I have given 1 lakh rupees to Future Group, Axis Bank was paying my rate of interest of only 5.5%. However, Future Group agreed to pay an interest of 7.5%. So though they are giving me 2% over and above what Axis Bank is giving, the risk associated with them is very, very high because they are not giving any security. In case if Future Group does not pay me, I will be at loss. So somewhere here, RBI is very, very much concerned. So a lot of times RBI issues directives for the same. We as auditor are just supposed to report whether the directives of RBI has been complied with. Because a lot of times what happens is such companies do not pay to the public and public incur a loss, which creates a very bad impression. Because of such scenarios, a lot of people stop putting their money into the banking system. They are scared that this bank might go bankrupt and they will not pay. And when they keep the money in their lockers, in their cupboard, it does not come to the economy. And when it does not come to the economy does not grow. So somewhere RBI is not very happy with it. And hence RBI does not want that a company takes public deposit from the public at large and does not end up paying. And hence RBI makes sure that they do not do such things. So they issue directives. So we as auditors, we need to see if we are auditing a company. For example, if we are auditing Future Group, we need to see whether we have complied with the directives of RBI. Also here, Companies Act has a lot of provision in relating to the public deposit. We need to see whether the provision of the Companies Act has been complied with. Thirdly, order of the CLB or the tribunal. So a lot of times tribunal also gives orders for what? Public deposit. So we need to see three things: whether we have complied with the directives of RBI, the provisions of the Companies Act and the orders of the CLB. So clause 4 and 5 are very easy to go. We need to see whether there is compliance of 185 and 186. In case of public deposit, we need to see whether directives of RBI has been complied with, provisions of the Companies Act has been complied with, and order of the CLB or tribunal has been complied with. Then we need to see whether we are maintaining cost records. We need to see whether we are maintaining cost records as per section 148. We just saw a while back in Companies Act itself who is supposed to maintain cost record. If you are dealing in regulated and non-regulated goods and services, and if your overall turnover is 35 crores or more, cost record is applicable to you. Who are excluded? If you are a small enterprise or a micro enterprise, as per the MSMED Act, it is not applicable to you. So if you are supposed to maintain cost records, have you maintained those cost records or no? That is all we are supposed to report here. Next is statutory dues. What do you mean by statutory dues? Every dues that is payable to the government. For example, income tax, GST. So now if you see, they have also included GST, because earlier GST was not included here. So let us say custom duty, GST, income tax, whatever the statutory dues. So in case of statutory dues, there might be two scenarios. It may be disputed or it may be undisputed. Firstly, understand what is undisputed. Income tax department gave us a liability of 50 lakhs that you are supposed to pay a tax of 50 lakhs. As per me also, I am supposed to pay 50 lakh rupees. It is undisputed. It is undisputed. I agree, yes, that 50 lakh rupees is the correct amount. However, I have not paid the same. Then I will have to report if it is outstanding for greater than 6 months. So for example, due date was, let us say, 1st of June. I paid it on 3rd of July. I will not report the same year. Why I will not report? Though I did not pay on the due date, I ended up paying. If it was outstanding for greater than 6 months, only then you will have to report it here. However, if it is disputed, so they send us a penalty of rupees demand of 50 lakhs. But however, as per us, we are supposed to pay only 20 lakhs. So we have a dispute, ongoing dispute for 30 lakhs. In such a case, they said you always report. What do you mean by always report? Need not wait for 6 months. Like we waited here for 6 months, we don't have to wait for 6 months. You will have to report as soon as possible. So for example, in your report, so when you are giving your report, we have not paid this, and only there has been only 7 to 8 days from the due date, still we will have to report. So you will always report here. You will not wait for 6 months. You will report two things. One is the amount. What do you mean by amount? What is the amount that is under dispute? So the amount under dispute is 30 lakh rupees. Which is the authority? For example, it is the income tax authority. So I will write it is in dispute with the income tax authority. So in case of dispute, we'll have to give two things. One is always report two things, amount and the authority. So this was statutory dues. It is, if it is undisputed, report if it is greater than 6 months. If it is disputed, always report two things. One is the amount and second is the authority. So this was statutory dues. Moving ahead with the disclosure of transactions not recorded. Let us say there was an assessment going on in the year of 21-22. Now we disclosed an income which was not recorded in the previous year. So we disclosed an income which was not recorded in the year 2021. So we surrendered on our own, or we disclosed an income while the tax assessment was going on. If that is the case, we need to check whether that unrecorded income has been recorded during the year. So whether any transactions not recorded in the books have been surrendered or disclosed. If so, if we have not surrendered or disclosed, this clause will not apply. However, if we have surrendered and disclosed, we will have to report whether the previously unrecorded income has been properly recorded in the books of accounts during the year. We will have to write what? Whether the previously unrecorded income has been recorded in the books of accounts during the year. So if there is no unrecorded, if there is no surrender or undisclosed income, then this clause will not apply. However, if we have surrendered, all we need to report is whether we have reported the same in our books of accounts during the year, that is the year 21-22. Next is if we have made a default in the repayment of loans and other borrowings. So in clause 3, we were talking about we have given a loans, we have given a guarantee, we have given security. Here we are talking about that we have taken a loans. So if there is a default in the repayment to any lender, we will have to report two things. One is the amount and the period of fraud. That is amount and period of fraud. Let us say we have taken 35 lakh rupees and we have not been able to repay it since last 7 months. So we will report since last 7 months we are unable to repay it, and we will also report that 35 lakh is the amount. But you will have to report the same in the prescribed format. So far there was no such format given. Now they have given us a prescribed format in which we will have to report. So firstly we will have to state the nature of borrowings. So which type of borrowing was it? Was it a term loan? What is it? Unsecured loan? What type of loan was it? Secondly, we will have to state the name of the lender from whom we had borrowed this. What is the amount? So initially we were stating only amount. Now we have to state the amount that is not paid on the due date. Thirdly, the amount that we have not paid, whether the same is principal or whether it is interest. Then you also have to say the number of days of delay. So for example, let us say you have not paid since last 7 months. So you'll have to state that we have not paid since last 7 months and remarks if any. So here, firstly, what you have to give is nature of borrowings. Secondly, who was the lender? What is the amount not paid on the due date? The amount was principal or interest. What is the number of days of delays and remarks if any? Secondly, whether the company has been declared as a willful defaulters by bank or financial institution or the lender. Now, what do you mean by willful defaulter? If we consider Anil Ambani ji, Anil Ambani was declared as insolvent and hence he could not pay. But while we talk about Malia, Malia was not declared insolvent, he ran away, he had money in his pocket and still denied to pay, he will be called as willful defaulter. So we need to check whether the company has been declared as what? Willful defaulters by any bank, financial institution or any other lender. So whether you have been declared as what? Willful defaulter by bank, financial institution or any other lender. Then whether the term loans were applied for which the loans were obtained. So here what you are checking is the end use of the funds. Let us say you have borrowed 90 lakh rupees for purchase of machinery. However, out of this 90 lakh rupees, you ended up investing 20 lakh rupees in the equity shares. So you had obtained the loan for machinery. However, you ended up using it for what? Equity shares. You cannot do that. So here you will have to report, if not, the amount. So for example, 20 lakh rupees is the amount so diverted. And the purpose for which it was diverted, it was diverted in the equity market. So here what you are trying to state is whether the term loans were applied for which the loans were obtained. So what you are checking is the end use, where are the money used for. If not, though, you will have to state two things. One is the amount and the purpose for which the money is used. Now we also need to state here whether the short-term loans have been used for the long-term. For example, we have raised working capital of 25 lakh rupees based on the stock and debtors that we have pledged. This 25 lakh rupees is used to pay the term loan that we have obtained from another bank. Can you do this? No. If it is so, you will again have to state two things. One is the nature. What you have to state in the nature? That working capital has been used to pay off the term loan. And the amount, so how much amount that we have used from the working capital? 25 lakh rupees. So whether the short-term loans have been used for repaying what? Long-term. If yes, you will state two things, amount and the nature. Thirdly, whether the funds are used to meet the obligation of its group companies. Group, what do you mean by group companies? Subsidiaries, associate and joint venture. Whether the funds are used to meet the obligation of its subsidiary, associate and joint ventures. If so, details thereof, again you will have to give two things, nature and the amount. So how much amount has been taken for the you'll say in nature, you will say whether it is taken for subsidiary, associate or joint venture. And here you will state what is the amount that you have taken for subsidiary, associate and joint venture. Let us say we have applied for a loan of 150 crores. Out of 150 crores, we are using 30 crores for subsidiary, associate, joint venture. So you will have to state that we are using it for subsidiary, and what is the amount that you are using? 30 crores. You will have to state the nature and also the amount. Then we need to report whether the company has raised on a pledge of securities held in its subsidiary, joint venture or associate. So have we pledged the security that we have in subsidiary, joint venture and associate? If so, you will have to give the details thereof and also the report the default if any. Because if there is any default here, what will happen is if I have pledged the securities of my subsidiary company and if I do not repay on time, that company, the bank or other financial institution, whatever it may be, are going to take my shares and my subsidiary will be their subsidiary henceforth. I will not have that control over the subsidiaries. So if there is any default, you need to report it here. So if so, give the details thereof. Secondly, also if there is a default, report the default. So in case of repayment of loans and other borrowings, again we have 6 points here. How many points? 6 points. Firstly, we said whether there is any default in the repayment to lender, we will have to report the period and the amount in the prescribed format. So you are basically giving 6 things here: nature of the borrowing, name of the lender, amount not paid on the due date, whether it is principal or interest, what is the number of days of delays, and remarks if any. Then whether the company is declared willful defaulter by bank or financial institution, whether the term loans were applied for the loans which they were obtained. If not, you will have to give what the amount of the loans were diverted and the purpose for which it was used. Next, whether the funds raised on the short-term basis have been utilized for the long-term purpose. Then again you will have to state what is the nature and what is the amount. Whether the funds have been used to meet the obligation of subsidiary, associate, joint venture, again you will have to give the nature and the amount. Whether we have pledged the securities held in the subsidiary, joint venture and associate, you will have to give the details and report the default if any. Moving ahead, whether we have raised money by IPO. What is IPO? Initial public offer. What is FPO? Further public offer. I assume every student knows what is this. So whether the money has been raised by IPO or FPO. So whenever we want to raise money, one option is IPO, FPO, where we raise money from the public, at large. Second option is we can have a preferential allotment. Now preferential allotment is done to the promoters, directors. Private placement of shares or convertible debentures. Private placement will be given to HNIs, mutual fund companies. So we have 3 different ways of raising money. It can be raised via IPO or FPO, which is for public at large. Preferential allotment, which is usually for the promoters. And lastly is private placement, which is given to the high net worth individuals or the mutual fund companies. Now here, what are we supposed to report? Whether the money raised by IPO and FPO, were applied for the purpose of which they were raised. Let us say Zomato raised money. They said we are going to use this money for expansion, promotion and entering the new markets. For example, if you are aware about, they had their business in South Africa, which also they have closed down. So they said we are going to expand in Europe, we are going to expand in Australia. So they took this money for a couple of things. Firstly is expansion, promotion and new markets. However, if they have not used this money for the stated purpose, they ended up using this money to repay the outstanding loan, then we will have to report here. If not, details together with the delays, default and a subsequent rectification if any shall be reported. So if I have not used the money for the stated purpose, which will be highly doubtful, because in case of a listed company, in case of an IPO or an FPO, SEBI will be behind your ass. In case if you are not using the money for the stated purpose, SEBI will make your life very miserable. So somewhere in this case, this is highly doubtful. But in a case if you have not used the money for the stated purpose, or if there has been a delay, or if you have committed a default or subsequent rectification, everything you need to report it here. So this was in case of IPO or FPO. However, if we talk about the preferential allotment, which is for the promoter, or the private placement, which is for HNI and mutual fund, we need to see whether we are complied with section 42 and 62 of the Companies Act. Again, 42 and 62 of the Companies Act is given in your syllabus of law. You have already covered there. All we need to report here whether we have complied with 42 and 62. If not, we will have to give details in respect of the amount involved and the nature of non-compliance. So again, we are giving 2 things. One is the amount and second is the nature. So again, if you have raised money by IPO and FPO, you need to report whether you have used it for the stated purpose. If not, details together with the delays or default or subsequent rectification, if any, shall be reported. Whether the company has made preferential allotment or private placement of shares or convertible debentures. If so, whether section 42 and 62 of the Companies Act have been complied with. If not, details provide in respect of the amount involved and the nature of the non-compliance. So this was our money raised by IPO, FPO and preferential allotment. Now what happens in CARO 2020 or CARO in general is we have to quote the clause as it is, where it is, with the correct number. So those students understand how do we write it, though they recollect, but it is very difficult for them to recollect the clause in a sequence with the numbers. So what I will give you is a trick on how to memorize this 10 clauses so far that we have done in a sequence. What we will say here is fill Priyanka Chopra's DP. So first point F, that was property, plant and equipment, which was nothing but fixed assets. So we call this as F. Second was nothing but inventory. So this is I, inventory. Second L was nothing but loans, guarantee and security. Second L was compliance with 185 and 186. But 185 and 186 any which ways deal with what? Loan. So again this comes L. P was talking about what? Public deposits. C was talking about the cost records. S was talking about the statutory dues. D1 was talking about disclosure of unrecorded income. D2 was talking about default in repayment of loans, and lastly P was talking about preferential allotment, private placement and IPO and FPO. So these are the 10 clauses. Let me take you back, starting with clause number 1. Clause number 1 was nothing but property, plant and equipment. So this is nothing but what? F, fixed asset. Secondly, I was nothing but inventory. Thirdly, investment, guarantee, security, loans granted by the company. Next L, it was compliance with 185 and 186. So this compliance with 185 and 186 was nothing but what? Your loans and advances. Then it was nothing but public deposit. C, it was nothing but cost records. S, it was nothing but statutory dues. D1, disclosure of the transactions not recorded. D2 was default in the repayment of loans and borrowings. And lastly P was private placement, preferential allotment. So these are the 10 clauses. I hope with this particular clause it was easier for you to recollect all the 10 clauses. Okay, so please note this down again. Fill Priyanka Chopra's DP. So these are the first 10 clauses. We will also make a code with which we can remember the other 11 clauses. So this was first 10 clauses. Moving ahead with clause 11, which is your favorite clause, that is fraud. Now in CARO 2016, this was clause 10. So if you see the module which is given in May 22, at few places still the clause number quoted by them is clause 10. So make sure you rectify the same. Your clause number is going to be 11. So in case of fraud, what you need to report is whether the fraud is committed on the company or by the company is reported during the year. So whether the fraud is on a company or by the company. So if some party is doing a fraud on the company or it is done by the company itself, we will report two things. Firstly is the nature and the second is the amount of fraud. What is the nature? What are the types of fraud? We have already discussed the same in essay 240. So nature of the fraud will be on essay 240, whereas we will also have to state the amount of fraud involved. So if you see CARO 2016, this was the only point. Now they have made a value addition here. They have said whether 143.12 of the Companies Act has been complied with. Do you recollect 143 of the Companies Act? Let us have a quick revision of 143 of the Companies Act. In case of 143 of the Companies Act, we will ask the auditor, if you have detected any fraud, report it to the audit committee immediately. What do you mean by immediately? Immediately means maximum within 2 days, and we will seek their reply within how many days? 45 days. There may be two scenarios, either they may reply or they may not reply. If they reply, we will ask Gabbar to go within 15 days to the central government and give three things: report, reply on that report, and their own comments. But we will count as 15 days from the date when we receive the reply. However, if reply is not received, we will ask Gabbar to go to central government within 15 days and give report. And also with the report, you will give a fact of non-receipt of reply. But however, the 15 days will be counted from end of 45 days. We will give this to the Secretary, Ministry of Corporate Affairs in a sealed cover by RPAD or speed post, followed up by an email. We will file ADD4. The responsibility is on CA, CS as well as CMA. If you do not comply, the penalty in case of a listed company will be 5 lakh rupees, and in case of another company it will be 1 lakh rupees. So here when we are discussing CARO, we need to state whether we have complied with 143 of the 143.12 of the Companies Act. This clause was nowhere there. However, now they have added that whether we have complied with 143.12 of the Companies Act. Next, whether the auditor considered the whistleblower complaints, if any, received during the year. So who is a whistleblower? Somewhere an insider or any person who has given us a tip that a fraud exists. So whether we have acted on the complaints received by this whistleblower, we should not ignore the complaints received by the whistleblower. So we need to see whether we have complied with all the three things. Firstly, companies, whether there is a fraud on the company or by the company is reported during the year. If yes, the nature and the amount of fraud. Whether we have complied with 143.12 of the Companies Act. Whether there were any whistleblower complaints. If yes, whether we have dealt with the same or not. This was nothing but clause number 11, that is fraud. Next is Nidhi company. I hope everyone knows what is a Nidhi company. You have done the same in foundation as well as your intern. Nidhi company, we need to see whether the net owned funds is to deposit has a ratio of at least 1:20. In case of a Nidhi company, net owned funds is to deposit is how much? At least 1:20. So somewhere what they are trying to say is, whatever is your net owned funds into 20 is the deposit that you can take. Let us say your net owned fund is 5 lakh rupees into 20. So 1 crore is the amount of deposit is what you can accept. So net owned funds is to deposit has to be 1:20. Out of the funds that we have received, 10% should be in unencumbered deposits. So that is, it should be in a fixed deposit with a scheduled bank. So why are we keeping it in a liquid form? We cannot give this to others people. If for example, if we have lended this amount as well, and if the members do not repay on time, it will be very difficult for us to run this Nidhi company, and hence they said 10% of the total term deposit should be unencumbered. That is, it should be a fixed deposit with a scheduled bank. Then we need to see whether there is a default in the repayment of interest or principal. If yes, whether the same has been dealt with. If yes, we will have to give the details thereof. So again, this is a new point. Earlier in Nidhi company, there were only point 1 and 2. Here now they have said if there is a default in the repayment of interest or deposit, then we need to inform them about the same. So this was our discussion about Nidhi company. Moving ahead with related party. In related party, we need to report whether it is as per section 177, whether it is as per 188, and whether it is as per AS18. If you recollect, 177 was nothing but an audit committee, and if you recollect, while we discussed section 177 in our Companies Act chapter, we said what will the audit committee do? Will wear a sari. What was our reviewing the related party transaction? So in case if there is a related party transaction, we need an omnibus approval from the related parties from the audit committee. What do you mean by omnibus approval? For all the related party transaction, we need an approval. Only if we have approval from the audit committee, we can have a transaction with the related party. Also, as per section 188 of the Companies Act, we need a prior approval of the board of directors if we need to get into any arrangement or contract with the related party. If we do not have a prior approval of the board of directors, you cannot get into any agreement or contract with the related party. And lastly, AS 18, you are about related party disclosure. So if we are checking related party, we need to report upon three things: whether we have complied with 177, that is omnibus approval from the audit committee; 188 is, that is prior approval of the board of directors; and lastly, disclosure as per AS 18. Next, clause 14, again a very simple and a very new clause which was never there in CARO 16. Whether the company has adequate internal control system commensurate with the size and nature of the business. What is ICS? Internal control system. So whether the company has what? Adequate internal control system commensurate with the size and nature of its business. Also, whether the reports of internal auditor were considered by the statutory auditors. What do we need to report here? Whether the reports of internal auditor were considered by whom? Statutory auditor. Now, internal auditor report will be there only when section 138 is applicable. Now, when does our section 138 apply? When there is a listed company. Secondly, there is a public company if deposit is 25 crores or more. Public paid up share capital is 50 crore or more. Turnover is 200 crore or more. Or the borrowings is 100 crores or more. Now, there I'll give you an easy way to recollect this. You will say double profit before tax. What will you say? Double profit before tax. D is nothing but deposit. P is nothing but paid up share capital. B is nothing but borrowing. T is nothing but turnover. Now, deposit, we will consider it as 25 crores or more. Now, what was our code? Double. So, now double everything. So, this 25 ka double will be 50. 50's double will be 100. And 100's double will be 200. So, double profit before tax. So, deposit, paid up share capital, borrowings and investment and your turnover. Okay. When we go to a private company will not have deposits. They will not have so much of paid up share capital. So, there we will consider only B and T, borrowings of 100 crores or more or turnover of 200 crores or more. So, this is section 138 that we will discuss when we go to the chapter of internal audit, management audit and operational audit. Here, wherever you see these two eyes are only for explanation purposes. When you write an examination, all you are supposed to quote is the above clause and not these two eyes. Okay, so this was the internal audit system. Moving ahead with the non-cash transaction. Did we have any non-cash transaction with the director or the person connected with him? With the director or any person connected with him. So, for example, what we can do is, rather than paying him salary, what we can give him is shares. Rather than giving him salary, we can give him a car. So, somewhere we are not paying him cash. When we say non-cash transaction, you do not have to take it literally as cash transaction. When we say non-cash, it means cash or bank, either of them. So, somewhere here we are paying him in kind. We are paying him in kind. So, whether we had any such non-cash transaction with the directors or the person connected with him. If yes, whether section 192 of the Companies Act has been complied with. Again, 192 is a part of your company law syllabus. However, I have given you a small note on the same. In 192, we need to take a prior approval of such arrangement is accorded by the resolution of the company in the general meeting. So, shareholders will have to approve in the general meeting if we can pay the director in kind. So, this is nothing but a non-cash transaction. So, what we need to report is whether we had any non-cash transaction with the directors or the person connected with him. If so, whether it is as per the provision of section 192 of the Companies Act 2013 has been complied with. What is 192? Prior approval of such arrangement is accorded by the resolution of the company in the general meeting. Next is section 45IA. Mark this as MBA. What do you mean by MBA? May be asked. Because this clause, as per me, can be asked only at final CA level. because this deals with NBFC and we have a different chapter altogether, that is audit of NBFC. So what does section 45IA say? Firstly, we need to see whether the company is required to be registered under section 45IA of the RBI Act. Now, who is supposed to get registered and everything? We will study the same in the chapter of NBFC. So, I am not getting into the same. Who is supposed to get a registration, who is excluded? We will take at least 10 to 15 minute discussion when we will go to NBFC chapter. So, I am not getting into that. All we need to see is whether the company is required registration as per 45IA of the RBI Act, and if so, whether the registration has been obtained. So, if you require a registration as per 45IA, whether the registration of the same has been obtained or not. Secondly, whether the company has conducted any non-banking finance or housing finance activities without a valid certificate of registration. So, if a registration certificate was required, without obtaining the registration certificate, you have started with the non-banking finance or housing finance. Initially, my friends, it was only non-banking finance. Now, they have also added the word housing finance here. So, if you have started with the business of non-banking finance or housing finance without obtaining the certificate of registration, you need to report the same. Thirdly, whether the company is a core investment company as defined by RBI. So, before we understand anything more, we need to understand what is a core investment company. So, core investment company is again given where? In the chapter of NBFC. But before we move ahead, let us go through what is a core investment company. A core investment company is obviously a non-banking finance company carrying on the business of acquisition of shares and securities, and which holds not less than 90% of its net assets in the form of investment in equity shares, preference shares, bonds, debentures, debts, loans in group companies. So, for example, if there is a Tata group of companies, there is Reliance group of companies, there is Adani group of companies. So, 90% of my total assets is in one group company. So, let us if I have 1000 crores, out of 1000 crores, 900 crores is in Tata group of companies. So, it can be in any company. It can be in Tata Motors, Tata Steel, Tanishq, Starbucks, Chroma. It can be in any Tata company. It can be in any group of Tata companies. So, out of my net assets of 1000 crores, 90% it can be in equity form, it can be in preference shares, it can be bonds, debentures, debt or loans in group companies. Out of this 90%, 60% should be in the form of equity shares. The investment in the equity shares in the group company constitute not less than 60% of its net asset on the date of the last audited balance sheet. So, now out of this 1000 crore, 60%, that is 600 crores, should be in the form of equity shares only. See, 900 crores was equity, preference, bond, debentures, debt, loans, cumulative. But out of this, at least 600 crores. So, out of this 900 crores, at least 600 crores should be in the equity shares. Rest 300 crores can be preference shares, debentures, bonds or any damn thing. But 60% should be equity share. So, in a way, this is nothing but kind of a holding company, which is investing in a nothing but your group companies. This is called as core investment company. More detailed discussion when we go to the chapter of NBFC. So, what they are asking here is whether the company is a core investment company as defined by RBI. If so, whether it continues to fulfill the criteria and it is exempted, it continues to fulfill such criteria. So, what are we trying to say is, if for example, if we are a core investment company, do we fulfill the criteria? So, that is, do we still have 90% in the group companies? Do we still have 90% in the group companies? Out of the 90%, still 60% is in the equity share. So, do we fulfill the criteria? But however, a lot of times government companies and all are excluded, are exempted from such core investment company. So, in case if I am exempted, do I still fulfill the criteria for exemption? If I am exempted, do I still fulfill the criteria for exempted is what we are supposed to report here. Next, whether the company group has more than one core investment company. Whether the group company has more than one core investment company? If yes, indicate the number of core investment company which are part of the group. So let us say if they have two core investment company, you will have to state here that we have two core investment companies. So these are the 4 points that they are asking us to report under 45 IA of the RBI Act. Firstly, whether the registration is required. If so, whether the registration has been obtained. Secondly, whether the company has conducted non-banking finance or housing finance activities without a valid certificate of registration. Third, whether the company is a core investment company as defined by RBI. If so, whether it continues to fulfill the criteria. If it is exempted, it continues to fulfill such criteria. Next, whether the company has more than one core insurance company. If yes, you will have to indicate the number of core investment companies that are part of the group. Fine. So this core investment company is, again, you are not supposed to quote everything here. All you are supposed to quote under CARO is this 4 points. Moving ahead with clause number 17, cash losses. Whether the company has incurred cash losses in the preceding year or even in this particular financial year. So whether the company has incurred cash losses in the financial year. What do you mean by financial year? The financial year on which I am giving a report, and immediately preceding financial. If yes, I will have to state the amount of cash losses. My friends, I have to teach this to the inter-CA student that if you are given in the P&L amount, net loss, you will have to add a depreciation and you will have to add other non-cash expenses. Only then you will get what cash losses. I hope you understand those things. See, no, so far we don't have a question bank on this CARO 2020 because it is a very new thing that has come up. So somewhere you will have to keep in mind all these points. So if they give you a P&L, you will have to end up adding what? The non-cash expenses. So you get the actual cash loss and you can state the same in your CARO. So this is cash losses in the financial year or the preceding financial year. You will have to state the amount of cash losses. Next, resignation by a statutory auditor. Again, a new point. Mark this also as MBA. This is the second MBA that I have been giving you so far in the whole of CARO 2020. So in case of resignation, we need to see whether there has been any resignation of the statutory auditor during the year. Whether there has been any resignation of the statutory auditor during the year. If so, whether the auditor has taken into consideration the issue, the objection and concerns raised by the outgoing auditor. So for example, let us say Mr. Suresh resigned during the year. Now who is the auditor? Mr. Ramesh. So he will have to consider all the objection and the concern which are raised by the outgoing auditor. Who is the outgoing auditor here? Mr. Suresh. And who is giving this CARO? Mr. Ramesh. So he will have to take into consideration why did Mr. Suresh resign? What were his objections? We will discuss the same when we go to professional ethics. We will discuss the same in clause 8, part 1 of the first schedule. So here, whenever this point is asked, you will also have to quote what? Professional ethics. Also, as a 300 requires us to communicate with the previous auditor. So whenever this point is asked, you will have to quote this clause. You will also quote professional ethics and you will also quote as a 300 that at planning stage we will have to communicate the previous auditor. So somewhere this is also important. See, we will have to wait for ICI suggested in case if they ask such a question, what are they quoting? But we have to be very well equipped and able to understand that we just don't have to specify this clause. We will also have to specify professional ethics and SA 300 because both of them talks about the resignation of an auditor. Also, in this case, Mr. Suresh who has resigned, he will have to find ADT 3 in the time or else he will be charged with the penalty. One more clause that I am marking this as MBA, capability of a company to meet its liability at the existing date. So, more or less the topic is talking about what? The going concern. More or less it is focusing about on what? Going concern. So, on the basis of the financial ratios, aging, I hope everyone understands what is financial ratio. Aging, what do you mean by aging? Dators, for example, how many dators have not paid since last 3 months, since last 6 months, since last 12 months, so aging. and the expected dates of realization of financial assets and payments of liabilities on the basis of financial ratios, aging, expect date of realization of assets. So when we will be in a position to sell off the asset and pay the liabilities. Fourth, other information. What do you mean by other information? Any other information or the annual report, the auditor's knowledge of the BOD and the management's plans. On the basis of these 5 things, whether the auditor is of the opinion that no material uncertainty exists on the date of the auditor report, that the company is capable of meeting its liabilities existing at the balance sheet date. So can I say there is no material uncertainty if and when they fall due within a period of 1 year from the date of the balance sheet? So whether there is any event which is casting significant doubt, whether there is any material uncertainty. If you can recollect anything, my friends, we have discussed this material uncertainty very much in depth in essay 570. So in essay 570 they said, if there is any material uncertainty, management have to disclose the same in the financial statement. However, if the management has not disclosed the same, we will have to qualify the opinion or else give a disclaimer of opinion, or give a disclaimer of opinion or an adverse opinion if we have side. So we might have to give a qualified opinion or an adverse opinion if there is a material uncertainty if the management has not disclosed. So now we have an additional responsibility in context of the same. So on the basis of 5 things, what are the 5 things? Financial ratios, aging, expected date of realization of assets and a payment of the financial liability or other information, the auditor's knowledge of the BOD and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the balance sheet date, the audit report, and the company is capable of meeting its liabilities existing at the balance sheet date, and when they fall due within a period of 1 year from the date of balance sheet. We need to report under clause 19. So this point is more or less focusing about what going concern. Moving ahead to clause 20, transfer amount remaining unspent to section 135(5) to the fund specified under schedule 7. So before I go ahead with the clause, let us have a quick recap of what does 135(5) and schedule 7 talk about. My friends, this was taught to you very much in the detail in your inter-CL law syllabus. I am sure many of you all are also aware about this and recollect the same, but still let us have a quick recap of the same. What does 135(5) say? The board of every company shall ensure that company spends in every financial year at least 2% of the average net profit of the company made during the 3 immediately preceding financial year in pursuance of CSR, that is corporate social responsibility. What does schedule 7 say? Activities which may be included by the company in their corporate social responsibility activities. Activities which may be included where? By the company in their corporate social responsibility. So we can spend the CSR amount only under the schedule 7, the list of activities that have been specified there. Now what are we supposed to report the same under CARO? Whether a company in respect of other than ongoing projects. What do you mean other than ongoing projects? Projects which are over, projects which are rather I would say completed. When we say other than ongoing, it means projects which are completed. The company has transferred the unspent amount to a fund specified under the schedule 7 of the Companies Act within a period of 6 months from the expiry of the financial year. So let us say as per 135(5), considering the 2% of the average net profit, we were supposed to spend, let us say, 30 crores. We ended up spending 28.7 crores. The remaining 1.3 crores we need to deposit under the fund specified under schedule 7 within how much time? Within 6 months from the end of the financial year. If you recollect schedule 7, PM care funds and all such funds were also included in schedule 7. So the unspent amount after the project has been completed, the unspent amount has to be transferred to the fund specified in which schedule? Schedule 7 within how much time? 6 months from the expiry of the financial year. Now this we are talking about the ongoing project. So this was talking about the completed project. Here we are talking about the ongoing project. whether any amount remaining unspent pursuant to any project has been transferred to a special account. If you recollect, we used to make a different escrow account and we used to deposit the money spent in that escrow account. So these are the two things that you need to report under 135.5 specified in the Schedule 7. That is whether in respect of other than ongoing projects, the company has transferred the unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year. B. Whether any amount remaining unspent pursuant to any ongoing project has been transferred to the special mention account. Moving ahead to the last clause of CARO 2020, that is clause 21. If you recollect at the start of CARO 2020, I said in case of holding company, they have their own financial statement. Subsidiary has their own financial statement. So what we end up making is consolidated financial statement. Likewise, holding company has its own audit report. Subsidiary has its own audit report. So we end up making consolidated audit report. Likewise, holding company has its own CARO. Subsidiary has its own CARO. So what we end up making is consolidated CARO? No. There is no thing called as consolidated CARO. Now you are in a position to understand why there can be no consolidated CARO. So, for example, let us say we are talking about the fixed asset, the very first clause. Let us say physical verification of fixed asset was done at the holding. However, no physical verification was done at the subsidiary. No physical verification was done at subsidiary. So now if I have a consolidated CARO, what will I state? Whether it is done or it is not done. Then I will say it is done in holding and subsidiary it is not done. Okay, let us take up the second point, inventory. Physical verification is done. If discrepancy is greater than 10%, report. Okay, in holding there was no discrepancies. However, in subsidiary again there was a discrepancy. So now what will I state? Holding, no discrepancy, subsidiary. Then why to do such a thing? We will issue two different CARO only. For holding a separate CARO, for subsidiary a separate CARO, and we'll ask the users to please report two different CARO. We will not have anything called as consolidated CARO. But however, in this clause 21, they have made an addition. Now what they are trying to say is, for example, if CARO of subsidiary has a qualified or an adverse remark, let us say there was a physical verification of inventory done, the discrepancies were greater than 10%, however the same has not been dealt with and the same was not been dealt with. So subsidiary's CARO has an adverse remark regarding the same. So now holding company's CARO needs to have a reference to the same. So holding company's CARO will give a reference that subsidiary's CARO has an adverse or a qualified remark. Please go to paragraph number 2, that is clause 2, and please refer the same. So we are not giving the whole combined consolidated CARO. In case if the subsidiary, associate or joint venture has any adverse remark in their respective CARO, then we will give a reference to the same in the holding company's CARO. Let us read this point. Whether there has been any qualifications, adverse remark by the respective auditors in CARO's report of the companies included in the consolidated CARO. Which are the companies included in the consolidated CARO? Subsidiary, associate, joint venture. So whether the respective auditors of subsidiary, associate or joint venture has given any qualified or adverse remark in their respective CARO. If yes, indicate the details of the company. So whether it is given in subsidiary, associate or joint venture. And also we will have to state the paragraph number. So for example, it was like, let us say clause 2 of CARO. So we will have to give the paragraph number of the CARO containing qualification or the adverse remark. This was nothing but our clause 21. Once again, if only there is an adverse or a qualified remark in the respective auditor in CARO reports of the companies included in the CFS, if yes, you will have to give the details of the company and the paragraph number. So these are our total clause 21. Here, if you can see, the change in the reporting requirement clearly shows regulators' expectation from the auditors are increasing. Initially, there were only 16 points and now 21 points. In fact, in the 16 points also, the number of reporting has gone very high. More emphasis is done on utilization of funds. Also in the financial stability, we have a point on going concern as well, and regulatory compliances. Auditor has to be very much conscious now, skeptical and accurate while discharging his duties. Now again, what we will do is, before moving ahead, we will memorize this 21 clauses. We will memorize this 21 clauses. Okay? So we have already made a code for the first 10 clauses. Now let us consider the next 11 clauses. Now what we will say is, Fawad, Nawab, Rinse, CR at GSC. Now firstly, what is F? F is nothing but what? Fraud. N is nothing but needy company. R is nothing but related parties. I is nothing but internal audit. N is nothing but non-cash transaction with the director. S is nothing but section 45 IA of the RBI Act. C is nothing but cash losses. R is nothing but resignation of statutory auditor. G is nothing but going concern. S is nothing but schedule 7, and lastly C is nothing but consolidation. So again, F is fraud, N is needy company, R is related party, internal control system, non-cash transaction, section 45 IA of the RBI Act, cash losses, resignation of the statutory auditor, going concern, and schedule 3 and the consolidation. Again, let us mark the same thing here as well. So F is nothing but fraud, then N is nothing but needy company, R is nothing but related party, I is nothing but internal audit system, then N is nothing but non-cash transaction, S is nothing but section 45 IA of the RBI Act, C is nothing but cash losses, R is nothing but resignation of the statutory auditor. This is nothing but going concern. Next, schedule 7, and lastly consolidation. So this was nothing but our next 11 clauses. So the first 10 clauses we said fill Priyanka Chopra's DP, then we said Fawad, Nawab, Rinse, CR at GSC. So let us have a quick revision of all 21. This was nothing but fixed asset. This was nothing but inventory, loans, compliance of 185 and 186, public deposit, cost records, statutory dues, disclosure of unrecorded items, default in repayment of loans, and P was nothing but private and preferential placement. F is nothing but fraud, needy company, then related party, internal control, then non-cash transaction, section 45 IA, cash losses, resignation, going a concern, then schedule 7, and lastly C is consolidation. So I hope with this at least you can recollect all your 21 clauses at one single go. This was our discussion of CARO 2020. So make sure you revise this very well, because CARO 2020 at CA final level is going to be crucial, because there are few clauses which cannot be asked at inter CA level. The rest of the company's audit is as it is where it is at in inter CA level as well. So I'm not expecting a lot of questions based on the same at your level, but CARO 2020 is going to be very important. So we are moving ahead with the question bank of CARO. All those who are very well versed with CARO know all the 21 clauses. I would request you can directly jump onto the questions and see only the question bank. So let us begin with the question bank. As an auditor, how would you deal with the following? L Private Limited, which has an outstanding loan of more than around 100 lakhs from the financial institution, defaulted in the repayment thereof to the extent of 50%. The company holds that it being a private company, CARO is not applicable. See here in this case, it is a private company. If it has a paid up share capital or reserves of less than 1 crore, or if the borrowing is less than 1 crore, or if the revenue is less than 10 crores, they will be excluded. Here the borrowing is greater than 1 crore, greater than 100 lakhs, hence CARO will be applicable. Contention the management is incorrect. A private limited company reports the following position. Paid up capital 60 lakhs, revaluation reserve 20 lakhs, capital reserves 22 lakhs, P&L account debit balance 4 lakhs. Management of the company contends that CARO is not applicable to it. Now, will we take 60 lakhs? Yes. 20 lakh revaluation, all the reserves we are going to consider. Capital reserves of 22 lakhs, yes. P&L account debit balance, we will subtract. So 60 plus 20 is 80 plus 22 102, 102 minus 4 comes to 98. Since it is less than 1 crore, CARO is not applicable. So what I will suggest is, after every question that I read, pause the video, interpret the answer on your own and then see the solution. Next, X Private Limited is a subsidiary of a listed entity. The management of the company believes that since X Private Limited is a private company and satisfies all the conditions under CARO 2020, reporting under CARO is not applicable. Since it is a subsidiary of a listed entity, CARO is applicable even if it satisfies all the conditions of private company. Hence, CARO here is going to be applicable. E-Tech Private Limited, which has an aggregate outstanding loans of around 20 lakhs from banks, 30 lakhs from financial institution, defaulted in the repayment to the extent of 50%. The company holds that it being a private company, CARO is not applicable. Since the borrowing is 20 plus 30, 50, obviously it is less than 1 crore, hence CARO is not applicable. The contention of the company is correct. Next, this was the questions on the applicability. Now moving ahead with the questions related to clauses. This was the question related to applicability. X Limited closed its manufacturing operation and sold all its property, plant, equipment relating to the manufacturing operations during the current financial year. However, it intends to continue its operation as a trading company. In respect of other fixed asset, the company carried out a physical verification at the end of the current financial year and found a material discrepancy to the tune of 1 lakh, which was written off and is disclosed separately in the P&L. Now, in this particular case, there was a discrepancy. We will have to report under clause 1A. So, if case there is a material quantitative details are mentioned, if physical verification is conducted, so we will report it under 1B, we will report it under 1B of the clause 1. Next, under CARO 2020 as statutory auditor, how would you report? NSP Limited has its factory building appearing as property, plant, equipment in the financial statement in name of one of the directors who was overlooking the manufacturing activities. So we should check whether it is on the name of the company. If not, we'll have to give the description. It is to be reported under clause 1C. Next, ABC Limited owns a land of building situated at IP Road, Mumbai, which was purchased before 30 years. The title deed for the same was deposited with the State Bank of India for obtaining credit facilities by the company. As the statutory auditors of the company, what are the audit procedures to be followed? So again, we have to report this under 1C because this, the title deeds is not with the company, it is not on the name of the company. Property, plant, equipment of Amir Limited included 25.75 crores of earth removing machine of outdated technology which had been retired from the active use and had been kept for disposal after the knockdown. These assets appeared at the residual value and had been last inspected 10 years back. As an auditor, what may be your reporting concern in the view of CARO 2020 on the matter specified. So a lot of students end up saying this is this is the change in the change in the value, that is they had revalued. See, just the word residual value does not mean revalue. They have kept it at residual value, that is the book value after charging the depreciation. The point that you need to quote here is that there is no physical verification. You will have to state this under 1B because it was inspected last 10 years back. So it will not be 1D, it will be 1B. Next, moving ahead with inventory. As statutory auditor of B Limited, to whom CARO 2020 is applicable, how would you report in the following situation? Physical verification of only 50% in value of the item of inventory has been conducted by the company. The balance 50% will be conducted in the next year. So can you conduct 50% verification this year, 50% next year? That too in case of inventory? Obviously not. You will have to report under clause 2B. You will have to report under which clause? Clause 2. Why clause 2? Because it is inventory. Under clause 2 we will have to report it under 2A. Reason being there was no physical verification, so we will report it under 2A. Mr. Arjun was appointed as the engagement partner on behalf of Bhishma and Company, a chartered accountant firm, for conducting statutory audit of Sinwar Limited, unlisted public company. Mr. Brijesh, one of the senior engagement team member, was given responsibility to audit matters as per the requirement of CARO 2020. And in that connection, he made the following observation that may be relevant for reporting as under. One of the plant and equipment taken on lease, that is right of use asset by the Sinwar Limited, has been revalued on the valuation by the registered valuer, and the net carrying value of the plant and machinery in aggregate was changed from 4 to 4.5. So this will have to report under clause 1D because there was a revaluation. You state it was done by registered valuer. Amount is to be given if the change in amount is greater than 10%. There is a change of more than 10%. 4 to 4.5 is greater than 10%. Next, during the year under consideration, cash credit limit of 5.5 crores was sanctioned to Sinwar Limited by DMC Bank based on the security of the current asset, which was reduced to 4.5 crores after 6 months. In this connection, quarterly returns have been filed by the company with DMC Bank, which are in agreement with the books of accounts. So here, cash CC facility was greater than 5 crores. Later on it was reduced, does not matter. Clause 2B will be applicable here. We have to state whether the quarterly returns were filed and whether they were in agreement with the books of accounts. So you are required to examine the contention of Mr. Brijesh regarding the reporting about observation in CARO. So we'll have to report first one in 1D and a second we will have to report under 2B. Next, JAM Private Limited was engaged in the business of manufacture of cycles. C.A. Roy was appointed as statutory auditors of the company for the financial year 21-22. During the year under audit, JAM Private Limited obtained working capital facilities from ABC Bank for 10 crores, hypothecating the stock of goods as primary security. On inquiry, C.A. Roy was informed by the management that stock are furnished periodically to ABC Bank Limited and the details of submission of quarterly stock statement are as follows. In the quarter 1, the stock value was 11.5. Stock value statement submitted to ABC was 14. Quarter 2 was 14.75 and there what they had given to bank was 17. Quarter 3 was 11.5, what they stated to bank was 14, and in quarter 4 it was 15.25. The management of JAM Private Limited did not disclose the above variation in the notes to accounts forming part of the financial statements of the company for the year 21-22. Management replied that there are no variations as on the balance sheet date, and further they are of the view that the stock statement furnished to the bank is only a formality and computed arbitrarily only for the purpose of securing higher drawing power, and hence statutory auditors need not be bothered. Is the contention of the management valid? As a statutory auditor, how CA Roy should deal and discuss the disclosure reporting requirement, if any, as per the Companies Act. So what they are trying to say is that it is just we can just give it arbitrary no. We should give quarterly statements whether they are in agreement with the books of accounts. So in this case, the contention of the management is not correct. We will have to report the variations under the CARO. We will report the same under clause 2B. Next. In the course of audit of Y Limited, as the auditor of a company, you observe the following. The company has advanced a loan to a firm in which a director was interested at a rate lower than the prevailing market rate, as well as there was no agreement on the terms of the repayment. How will the auditor report? So it was given to a director at a rate lower than the prevailing market rates. So somewhere it was prejudicial. Also, there was no agreement on the terms of repayment. So here we will have to report two clauses. Under clause 3, we will have to report two things. One, it will be B because it is prejudicial, and also it will be F because it is repayable on demand or without specifying the terms. So basically clause 3, but it will be two sub clauses, B as well as F. Next, H Limited granted unsecured loans of rupees 1 crore at 15% per annum to two of its subsidiaries during the current financial year. Before the year end, both the companies repaid the loan. The management of H Limited is of the opinion that since no balance is outstanding as at the end of the financial year, these loans are not required to be reported in CARO 2020. Please comment. So here they said because they have repaid the loan, we are not supposed to report. We will have to report both the things. The company has granted loan of 1 crore to two of its subsidiaries. The maximum amount involved during the year was 1 crore and balance was nil. Such loans at nil, so we will have to report the same as well. A company auditor noticed that there is an inter-corporate loan granted by the company. State the reporting requirement. We'll have to report under two clauses. One is 3, where we have given loans, and the second is 4. Under 4, we have to say whether 185 and 186 of the Companies Act have been complied with or not. Now, during the course of audit of Messrs CT Limited, it is noticed that 2 lakh employee contribution and 9.5 lakh of employer contribution towards ESIC have been accounted in the books in the respective heads, where it is found that only 4 lakh have been deposited with the ESIC department this year. The finance manager informed that auditor, due to the financial crunch, they have not deposited the amount due, but will deposit the amount overdue with the interest as and when the financial improves. So here what they are saying is this is about statutory dues. They have not paid. This is undisputed because they are saying they have not paid because of the financial crunch. So this has to be reported under clause 7A because this is undisputed. Is the company is regular in depositing? So this is basically a MCQ. They are asking you under which clause you will have to report. So just think of which clause it will be. The company is regular in depositing the undisputed statutory dues, including the provident fund, ESIC, income tax, sales tax, wealth tax, custom duty, excise duty, value added tax, cess, and any other statutory dues with the appropriate authorities, and if not, the extent of arrears of the outstanding statutory dues as the last day of the financial year concerned for a period of more than 6 months from the date they become payable shall be indicated by the auditor. So here, since it is undisputed, we will have to report the same under 7A. Big and Small Limited received a show cause notice from the GST department intending to levy a demand of 25 lakhs in December 22. The company relied to the above notice in January 23, contending that it is not liable for the levy. No further action was initiated by the GST department up to the finalization of the audit for the year ended 31st March. As the auditor of the company, what is your role? See, there was a demand, we have replied, they have not replied anything, does not mean the dispute is settled. So here this is still under dispute, hence we will have to report under 7B. Next, here a lot of knowledge of your custom duty and everything will be required. As an auditor, how will you report under CARO in each of the following situation? Since more than 7 months, payment of electricity bill to the company established under statute is outstanding. Will we report this? No, my friends, we will not report this, because payment to the electricity company is the trade payables that we are paying. It is no statutory dues. See, you do not get, deviated with the word statute. Established under a statute. So, a company is established under a statute. So, this is not to be reported because this is not statutory dues at all. Second, the company had imported goods 5 years back and were placed in a bonded warehouse till the financial year under audit. The company has not paid the import duty as the goods have not been removed from the such warehouse. The company has not paid the rent and interest expenditure as well. See, when you have your goods in a bonded warehouse, till the time you do not remove your goods from the warehouse, there will be no import and hence no duties payable. But however, you need to pay rent and interest for the same. You have not paid, we will have to report this because this is undisputed. The company having the income tax assessment order with the demand notice from the assessing officer. Company has not paid dues payable as the same is not acceptable to the company. Company has neither preferred an appeal against the order nor an application for rectification of mistake has been made. The company has just merely represented to the assessing officer. Just mere representation is not a dispute. So we will have to see whether the due date for filing the dispute has gone by. If it has gone by, we will straight away classify this as what? Undisputed. The company, in the view of voluminous payroll, consistently follows the method of lump sum deposit estimated amount of ESIC collection and adjust the excess of the deficit against the next following month's deposit, and difference of the said amount always remain insignificant. So they pay on monthly basis and lump sum basis, and if few shortfall is there, they will again pay on the lump sum basis. So this is shortfall. In this case, this is a temporary shortfall. We need not report it. So let us go through all the 4 answers. In case of electricity, reporting not required as the dues has arisen on account of contract of supply of goods and services. Second, in case of custom bonded warehouse, reporting for custom duty is not due yet. Interest and rent are required to be incurred under 61 of the Custom Duties Act. Would be under other statutory dues, and auditor would have to examine and comment upon the regularity. Next, in a case of filing the appeal, auditor is to check whether the time limit for filing the appeal or application for rectification is expired or not and report accordingly. And lastly, in case of ESIC, reporting is not required because that was a temporary shortfall. Next, R Limited as on 31st of March defaulted in the repayment of interest and principal due to a financial institution. The due date was 28th of February. However, the default amount was paid on 5th of April. The company's management is of the opinion that since the default is set right before the completion, this need not be reported in CARO. Comment and draft a suitable report. So here, since there is a default, we have not repaid, we will have to state what is the amount and what is the period of default. Under CARO, how as a statutory auditor would you comment on the following? A term loan was obtained from a bank for rupees 75 lakhs for acquiring research and development equipment, out of which 12 lakhs were used to buy a car for use of the concerned director who was overlooking the research and development activities. So here they had taken 75 lakhs for research and development. However, they used it for buying a car. The funds were applied for some other purpose. So we will have to state it here whether the funds were used for the purpose for which they were obtained. If not, we will have to write what is the amount diverted and for which purpose. So we'll report under clause 9C. So we'll report this under 9C. Next, as statutory auditor, how would you deal with the following? LM Limited had obtained a term loan of rupees 300 lakhs from a bank for construction of a factory. Since there was a delay in the construction activities, the funds were temporarily invested in short-term deposits. So since there was a delay in the construction, they invested. See, they have not used. A lot of time people get confused because they said short terms, they said short term money is used for long term. No, short term loans is not used for long term. Here in this case it was invested, so the money is utilized for some other purpose. So it was again be clause 9c. So here it is not going to be that money is short term is used for long term purposes, it is used for some other purpose, and hence it will be 9c. Next, during the financial year ended 31st of March, LM Private Limited had borrowed from a nationalized bank a term loan of 120 lakh, consisting 100 lakhs for the purchase of machinery for the new plant and 20 lakh for the erection expenses. As on the 31st of March, the total capital and free reserves of the company was 50 lakhs. See, this is LM Private Limited, so you need to see whether it will be applicable. The turnover of was 750 lakhs. And bank paid 100 lakhs to the vendor of the company for supplying the machinery. The machinery has reached the yard of the company. The company had drawn the loan of rupees 20 lakhs to the credit of its current account and maintained and utilized the full amount for renovating its office building. So see here, since it is a private company, is CARO applicable? Yes, because they had a loan of more than 100 lakhs, that is more than 1 crore, so it is applicable. Machinery had been kept as capital under stock. Comment. So here they had taken a loan of 120 was to be utilized for machinery and erection expenses. However, they have utilized this 20 lakhs for the maintenance of the office, which is not permitted. You should report it again under 9c, that money is utilized for some other purposes. Next, Gotham Limited had borrowed 1000 crore from XYZ Bank. The principal for which was repayable after 5 years and the interest was repayable at the end of each year. For 4 years, Gotham Limited paid interest on time. Gotham Limited defaulted the 5th installment of interest and principal, which was due on 30th of June. On 30th of December, Gotham Limited approached XY Bank and MNO Bank to restructure existing liability. As a result, existing principal and outstanding and overdue interest was restructured into a new loan amounting to rupees 1100 crores. The management did not provide any disclosure for the default on the loan on the belief that the loan ceased to exist and the new loan maturity was after 5 years. Now, during the statutory audit for the year 22-23, KP and company identified this transaction and obtained relevant documents and understanding. Based on the underlying document, it was identified that said restructuring agreement was approved and signed on 8th of April, that is after the end of the financial year. As a result, on 31st March, restructuring was not approved. Hence, you will have to report the same under clause 9. Now, ABC Limited is a manufacturer of jewelry. A senior employee of the company informed you that the company does not properly disclose the purity of gold used on jewelry. Do you need to report it under clause 11 for fraud? No. This is business malpractices. This is not fraud on the company or company. This is not to be reported under CARO. So from the point of view of reporting on frauds under CARO 2020, there is no implication for misstatement in the financial statement. Hence, no reporting is necessary. Next, what are the reporting requirements in audit report under the Companies Act CARO for the following? Fraud has been committed against the company by an officer. Fraud has been committed against the company by a vendor, or the company has committed a major fraud. See, fraud is on the company or by the company, will always have to report under CARO. Fraud has been reported in the cost audit report but not noticed by the statutory auditor. So this will be reported under 143.12 and also under CARO. Next, in the course of audit of MM Limited, your audit team has identified the following matters. All the amount of 4 lakh per month for marketing services rendered is paid to MG Associate, a partnership firm in which the director of MM Limited is also a managing partner, with a profit sharing ratio of 30%. Based on the independent assessment, the consideration paid is higher than the arm's length price by 1.5 lakh per month. While the transaction was accounted in the financial statement based on amount, no separate disclosure has been made. Since this is a related party transaction, we will have to disclose the same under clause number 30. You are appointed as the auditor of XMP Private Limited for the year 22-23. After the resignation of RSN Company, Chartered Accountant and Statutory Auditor of the company, RSN Company had certain concerns on the accounting matters of the company, leading to the change of auditor. All compliance under 139 and 140 are made by the company with regard to the resignation appointment. During the course of audit, it came to your notice that surveys had been conducted on December 7th by the Income Tax Department, and the department was unearthed record sales of 5 lakhs which had been made in cash on different dates during the year 21-22. XMP Private Limited purchased gold from such collection, and these transactions are not recorded. Company surrendered and disclosed this transaction before the assessing officer and paid taxes. However, the company has not recorded this transaction in the books. So we will have to record the same. We will have to say this, the transaction was disclosed, and we will have to report the same here. So this were our discussion about CARO 2020. This were all the questions of CARO 2020. So I hope, my friends, you have gone through the video lecture of CARO. You have done all the questions, because a lot of questions have been asked on CARO 2020. So with this, we put an end to this particular topic and move ahead with the next discussion. Let us see the questions which are being asked on with this particular section. Praveen, a member of ICI, does not hold a certificate of practice. Is his appointment as an auditor valid? This is a jackpot question, my friends. If they ask you such a question for 5 marks, all the 5 marks should be in your pocket. Now what happens is, even at CA final level, a lot of students do not focus on the section and the subsection. All they end up writing is, as per 141, this is allowed, this is not disallowed. My friends, for such a basic and simple question, they will at least ask you, expect from you that you write the subsection as well. So please, here you will have to write as per 141.1. He is qualified if he holds a certificate of practice, or else he is not. So here, this was question number 1. Mr. A practicing chartered accountant, is holding securities of XYZ Limited having a face value of rupees 900. So Mr. A is holding security of rupees 900. Whether Mr. A is disqualified for appointment as an auditor of XYZ Limited. Now I want you to take your pause and think whether Mr. A is qualified or disqualified. Is he disqualified? Not disqualified because he is holding less than 1 lakh? No. In this case, he will be disqualified. Will he be disqualified? He can hold not even a single penny security. 1 lakh rupees is allowed for my relative. I cannot hold even a single penny security. So in this case, Mr. A will be disqualified. Moving ahead. Would your answer be different if instead of Mr. A, Mr. B, the stepfather of Mr. A, is holding the security? Then in this case, you will be qualified, because a relative can hold security up to rupees 1 lakh of the face value, and here they are holding only 900 rupees. So this will not be an issue here. Moving ahead with question 3. A chartered accountant has been appointed as an auditor of Lakshman Limited. So A is appointed as an auditor of Lakshman Limited. In the AGM held in September 18, which assignment he accepted? Subsequently in January 19, he joined B. So he joined B. Another chartered accountant who is a manager finance of Lakshman Limited. Now he is a manager finance of Lakshman Limited. Now Mr. A is qualified or disqualified? My friends, if you recollect 141.3c, a person who is a partner or who is an employment of an officer or employee of the company. Do you recollect our example Pushpa? If Pushpa is an employee of Gold Mines Limited and Pushpa's partner, who is Pushpa's partner, Konda Reddy, can Konda Reddy be an auditor here? No. So this is the same scenario here. Here he will be disqualified, but the important part is that you will have to quote 141.3c. If you end up writing only 141.3 at the final CA level, probably you will not score marks. So you will have to quote the clause as well. Question 4. An auditor purchased goods worth rupees 5,01,500 on credit from a firm being audited by him. The company allowed him 1 month's credit, which is normally allowed to all the known customers. So this is allowed to all the known customers. Is he qualified or disqualified? My friends, he's definitely what? Disqualified here. But a lot of times students get confused with the term normally allowed. See, it does not matter whether it is an arm's length price, whether it is normally allowed to all the known customers. I am indebted to them for greater than 5 lakh rupees. I am straight away disqualified. Next, Mr. Aditya, a practicing chartered accountant, is appointed as a tax consultant of ABC Limited, in which his father, Mr. Sanghvi, is a managing director. His father is a managing director. Can he be appointed? Yes, he can be appointed, because here we are talking about a tax consultant. Under 141(3) we are talking about disqualification of auditor. We have never mentioned whether a tax auditor is eligible or not eligible. So as per 141(3) we are not concerned with who a tax auditor is. He can be any person. So as per the Companies Act, is he eligible? Yes. But again, we will talk about the same when we go to what professional ethics, whether he is eligible or not. But if I talk about Companies Act, is he eligible? Yes, he is eligible. There is no concern here. My friends, this question was asked for a 2-mark correct or incorrect at inter-CA level, and a lot of students made a mistake in this. In fact, I have asked the same question in final CA level, and again a lot of students ended up making a mistake, and they ended up saying that he is disqualified. My friends, you need to make sure you have your eyes on the word tax consultant here. I hope everyone has understood this. Next, Ram and Hanuman Associate, a CA in practice, have been appointed as statutory auditors of Krishna Limited. For the year 1920, Mr. Hanuman holds 100 equity shares in Shiva Limited, a subsidiary of Krishna Limited. So Krishna Limited has a subsidiary, and Hanumanji holds a shares in Shiva Limited. Now, is he eligible or disqualified? My friends, we said if you have any security in CHAS, company, holding, associate, subsidiary, or subsidiary of such holding, you are disqualified. And we said any security, not even a single penny security you can hold. Your relative can hold, and relative can also hold only in the company. We have not specified anything about CHAS. So here Hanumanji is holding 100 equity shares. A lot of students ask me, sir, they have not given you any amount. We are not concerned with the amount because we cannot hold even one single penny security. So in this case, Hanumanji will be disqualified. So Ram and Hanuman and company will be disqualified. Next, CA Mr. X was indebted to ABC Limited for a sum of rupees 5 lakh on 1st of April. However, Mr. X, having to come to know that he might be appointed as an auditor, he squared the amount on 10th of July. Later on, he was appointed as the auditor of the company for the year ended 31st March at a annual general meeting held on 16th of July. Subsequently, one of the shareholders complains that appointment of Mr. X is invalid because he incurred disqualification under 141(1). Is he disqualified? See, though he had borrowed 5 lakh rupees, he squared the amount. When I say squared the amount, he repaid the whole amount in full on 10th of July. And he was appointed on 16th of July. So the date when he was appointed, he was not indebted. So though I had taken a loan prior to my appointment is irrelevant. The year when I am auditing, that year I cannot be indebted to them, or else there will be what? Threat to independence. But if I had repaid the loan, can I be appointed? Yes, there is no disqualification here. So you can take a loan and repay, and then you can be appointed, no problem here. Next, question number 8. Now I am showing this question, I am reading this question. After reading the question, I will ask you to pause the video and try the question on your own. The question is very simple and easy to go. But there are a lot of small concept involved here, and I want you to try it on your own so you can gain some confidence whether you understand this or no. Mr. Y A practicing chartered accountant has been appointed as the auditor on 12th of June 2018 for the year ended 31st of March. Daughter of Mr. Y purchased securities on 10th of September for face value 45,000, market value 90,000. Daughter of husband of Mr. Y purchased securities on 10th of December, face value 90,000, market value 1,90,000. All the above shares were sold on 10th of March for rupees 3 lakhs. So what I would request is please pause the video for a minute, try the question on your own and then see my solution if you could crack this. So I hope you have paused the video and tried it on your own. Now let us see the solution. Firstly, daughter of Mr. Y. Is daughter of Mr. Y a relative? Yes. So concept number one that you need to know is who was a relative. Is holding securities on a 10th of September. 10th of September 18. Of face value 45, market value 90,000. Do we consider face value or market value? Face value. So I hope everyone could crack this concept as well, that we need to consider face value. Okay. So I can hold up to rupees 1 lakh rupees. So this is the third concept that you need to know. Okay, you need to hold 1 lakh rupees, which is for all the relatives in aggregate. Husband of daughter of Mr. Y. Is he also a relative? Yes, he is also a relative. Purchase securities on 10th of December, amounting to face value 90,000 rupees. So individually, though they are holding less than 1 lakh, but in aggregate, they are holding 1,35,000. So they will be disqualified. The above shares were sold on 10th of March. If you held more than 1 lakh rupees, they have given you a grace period of 60 days to take the corrective action. Your corrective action will start from 10th of December. That is the day on which you exceeded 1 lakh rupees. So if I count as 60 days, in the month of December, you will have 21 days. So 31 minus 10. In the month of January, you will have 31 days. So it is already 52. So in the month of Feb, you are left with only 8 days. So if till the 8th of February 2019, if they sell their shares and if they get their value less than 1 lakh rupees, they will not be disqualified. However, they have sold their shares on 10th of March, which is after 8th of February. For what amount they have sold, we are not concerned. But since it is sold after 8th of February, in this case, we will be disqualified. So I hope a lot of you all could actually crack this. It was not difficult, but all you need to know is this few concept. The fourth concept here is 60 days of grace period. So there are 4 different concepts involved here. I hope you could crack this. PQ and Company is an audit firm with P and Q as partners for the financial year 18-19. The firm has been appointed as the statutory auditors of Mango Orchid Hotel Limited. The audit firm is a regular customer of the hotel and the partners usually stay in the same hotel at the various locations in the course of traveling for their various professional assignment. Normally, the payment of such stay are settled against the quarterly bill raised by the company. So here they have not used the word ALP, nor have they given us any amount here. But when they say are normally settled, here we are supposed to assume that this is an arm's length price transaction and we end up concluding that there is no disqualification here. Now let us say ABC company. Can ABC and company accept the appointment as an auditor in 60 private companies having paid up share capital less than 100 crore? So 60 private companies less than 100 crore. Which has not committed default in filing financial statement under 137 and 92. Because had they failed, I would have not got the exemption of POTS, no? So they have said they have not committed default. 2 small companies and 1 dormant company. So 2 small company, 1 dormant company. Total 63 companies. So there are only 3 partners. So 3 into 20, all we can accept is 60. Am I qualified or disqualified? I am qualified here. Because all these 63 belong to pods and pods I can do unlimited. There is no restriction on the same. Question number 11. KBC, a firm of chartered accountants, are 3 partners K, B and C. K is also in whole-time employment elsewhere. The firm is offered the audit of ABC Limited and is already holding 40 companies. So now K is in whole-time employment elsewhere. Can we consider K at all? So now we'll count only B and C. B and C are two partners. 2 into 20, how much can they accept? 40. They are already holding 40 companies. They are already auditing 40 companies. Can they accept the audit of ABC? If they do accept, it will go to 41 and they will be disqualified. So they cannot accept. Next. Now this is again a frequently asked question. So again what I would insist is, you pause the video. It is very easy. Every student will be able to crack this. But somewhere ICAI, they are very keen on asking this question again and again. So what I want is, you pause the video once. You crack this on your own and then you see my solution if you could crack this or not. Okay, so I'm assuming you have paused the video and tried it on your own. Now I'm discussing the solution. Mr. A signs the balance sheet of 10 small companies. Do we consider small companies? No. 10 private companies having paid up share capital less than 100 crore. Do we consider them also? No. So as such, A has not audited any company. Next, Mr. B signs the balance sheet of 10 private companies having paid up share capital less than 100 crores. We do not count them. And 5 private companies having paid up share capital of more than 100 crores. Yes, we will have to count them. So B as such have audited 5 companies. Mr. C signs the balance sheet of 10 private companies having paid up share capital more than 100 crores. We'll have to count them. And 5 public companies. Public companies, we don't have to bother for the paid up share capital. We are going to count them. So C as such have audited 15 companies. What is the maximum number of audit the firm as a whole can accept? What is the maximum number of audit each individual partner can accept? So now see, A can accept 20 more audit, B can accept 15 more audit, and a C can accept 5 more audit. So as such, total number of audit, how much they can accept? 40. Now let us see the answer here. The firm can accept 40 more audit, A can accept 20, B can accept 15, and C can accept 5. I hope you could crack this. This was a very basic question, but this was just a frequently asked question, and hence I asked you to do the same. Messrs. Duster and Company, Chartered Accountant, appointed as an auditor of R Limited for the financial year 1920. The company is also in need of some of the actual services. Consequently, the board of directors of the company offered the same to Messrs. Srivastava and Company, an associate to Messrs. Duster and Company, which has been duly accepted by the same. See, Mr. Duster and Company is the statutory auditor. He cannot provide actual services because these are mentioned under 144. Now they offered the same to Srivastava, but Srivastava is an associate to Mr. Duster. So I cannot provide, but even my associate cannot provide. So here again I will be disqualified. Before we move ahead, my friends, let us go through the past questions that has been asked on section 139. KM Private Limited, engaged in manufacturing of silk shirt, is a newly incorporated company dated 1st of September. On 28th September, the new members of KM Private Limited themselves appointed C.A. Raj, a renowned practitioner, as the first auditor of the company, opposing that the board is not authorized to appoint the auditor. You are required to comment on the actions of the members. So here this is the first auditor being appointed in case of a non-government company. Why? This is a private limited company, so this is a non-government company. In case of a non-government company, the first auditor is appointed by BOD within how many days? 30 days. However, within 28 days, it is the members who have appointed. So this appointment is invalid. It should be the board of directors who should have appointed the first auditor. In case if board had failed, after 30 days, member could have appointed. But here this is an invalid appointment. The first auditor of Messrs. Healthy Wealthy Limited, a government company, was appointed by board of directors. My friends, in case of a government company, the first auditor is appointed by Comptroller and Auditor General of India and not by board. So here again this is an invalid appointment. Moving ahead with question 16. At the AGM of ICI Limited, Mr. X was appointed as statutory auditor. He, however, resigned after 3 months since he wanted to give up the practice. So this is the case of casual vacancy. State how the new auditor will be appointed and the conditions to be complied for. So this is the casual vacancy. So in case of a non-government company, if it is due to resignation or due to any other reason, now this is the case of resignation, then a board of directors shall appoint the auditor within 30 days. However, they should take approval of the members within the next 3 months. So we write the whole procedure here. So moving ahead with question number 17. Messrs. Young and Company, Chartered Accountant Firm, a statutory auditor of Old Limited, is dissolved on 1st of April due to differences of opinion among the partners. The Board of Directors of Old Limited in its meeting on 6th of April appointed another firm, Messrs. Sharp and Company, as their new auditors for 1 year. Here, see, they are being dissolved, so in a way they are resigning. So this is again a case of what? Casual vacancy, and the board shall appoint within 30 days. So board have appointed within 30 days, that is on 6th of April, that is within hardly 6 days. But here they appointed the new auditors for 1 year. My friends, in case of casual vacancy, I had written a note down there that in that case they can be appointed only up to the next AGM. Their tenure is only up to the next AGM and not for 1 whole year. So I hope you understand 1 year is not equal to the next AGM. So here everything else was correct, but however they could not be appointed for the 1 year. They should have been appointed only up to the next AGM. Now, X Limited is an unlisted public company. Its balance sheet shows a paid up share capital of 7.5 crores and a public deposits of 70 crore. The company appointed Messrs. ABC and Company, a CA firm, as the statutory auditors in its annual general meeting held at the end of September for 11 years. Now, is this correct or incorrect? My friends, see here, this is about 139(2). 139(2), it is applicable if your paid up share capital in case of a public company is 10 crores or above, or your borrowings is 50 crores or above. Here the borrowings is 70 crores, my friends. Public deposit is also a borrowing. So external rotation is applicable, and if the external rotation is applicable, if you are an individual firm, then in that case you can be appointed for 1 term of 5 years, and in case you are a partnership firm, then 2 consecutive 10 years of 5 years each. But here they are being appointed for 11 years, which is definitely invalid. Moving ahead with question number 19. C. Ashwin was appointed as auditor of Bristol Limited for the year 1920. Since he declined to accept the appointment, the board of directors appointed C.A. John as the auditors in place of C.A. Ashwin, and the appointment was accepted by C.A. John. Is this okay? No, my friends, this is definitely not okay. Why? Because here Mr. Ashwin declined, and now if Mr. Ashwin declined, this is not casual vacancy. This is somewhere the auditor was not appointed at all. When will the casual vacancy arise? Do you remember my opening sentence on casual vacancy? I said the auditor was appointed and then his office becomes empty. Here, Mr. Ashwin is not at all appointed because he declined to accept the appointment. And when there is no appointment, will this lead to a casual vacancy? And can board fill this casual vacancy? No. We will again have to call the members, and members shall appoint the auditor. Here, what board has done is incorrect. So please mark this a very important question. This was an important discussion. A lot of students fail to answer this particular question. Moving ahead to question number 20. CAX is a partner in AB and Associates and Messrs. MN and Associates simultaneously. Messrs. AB and Associates has completed its tenure of 10 years as an auditor in XYZ Limited, immediately preceding the current financial year. It may be noted that the provisions for applicability of rotation of auditors are applicable to XYZ Limited. Now the company wants to appoint MN and Associates as the auditor for the next 5 years. Whether MN and Associates is allowed to accept the appointment as an auditor? Secondly, would your answer be different from above if CAX, being in charge of AB and Associates and certifying authority of the financial statement of XYZ Limited, retires from the partnership firm in Messrs. AB and Associates and joins MN and Associates? Now my friends, here Mr. X is a common partner, so definitely here he cannot be appointed because they will become ineligible because they belong to the network firm. In the second case, Mr. X is retiring from one firm and going to the other firm. Now friend, tell me, can he say we were on a break when Rachel did not listen to Ross? Do you think so Companies Act is going to listen to us? No, so we cannot say we were on a break in this case. So in both the cases it is not allowed. In both the cases this is not allowed. Moving ahead to the last question, question number 21. ABC Private Limited, a new company incorporated on 1st of July, is engaged in manufacturing business on 30th of July. The managing director of ABC Private Limited himself appointed C.A. Mohan, his daughter's husband, as the first auditor of the company. You are required to state the provision of the Companies Act relating to the appointment of the first auditor. Okay, so here what has happened is it is a new company formed on 1st of July. On 30th of July, the managing director himself, he himself cannot appoint, my friends. The whole of board of directors are required. Only one managing director cannot do this, and hence this is also an invalid appointment. A lot of students, end up giving a wrong answer. he is the relative and XYZ things. My friends, here we are talking about the managing director. He himself could not appointed. PQR Limited removed their first auditor by passing a resolution in the meeting of the board of directors for his removal without obtaining prior approval from the central government. Offer your comments in this regard. My friends, here they did not obtain a prior approval of the central government, which is required under section 140 subsection 1. Therefore, this is going to be invalid. Here you should have obtained an approval from the central government. So very basic question here. Director of T Limited draws an advance of US $200 per day in connection with the foreign trip undertaken on behalf of the company. On his return, he files a declaration stating that the entire advance was expended without any supporting or evidence. T Limited books the entire expense on the basis of such declaration. As the auditor of T Limited, how would you deal with this? So here, my friends, they have taken US dollar of $200 per day. Now there can be a case that this is spent for the personal expenses, then it should not be charged to the revenue expenses, and hence we need to see whether we have any supporting or evidence. So the auditor is required to inquire whether the payment was done by the company for the foreign trip is personal expense or not, and collect the necessary supporting evidence. If it appears to be personal expense, auditor is required to ascertain whether such expense is properly authorized or not. If not authorized, the auditor should state the matter in his report. Moving ahead with question number 24. This is a very important point, though the minute point, but very important point. The auditor of X Limited did not report on the matter specified under section 143(1) of the Companies Act 2013, on which he inquired into, because of the reason that he was satisfied. But the management of the company wanted the auditor to report on those matters so that the members can also be aware of the true position of the company. Comment as to whether the auditor is required to report upon the matters specified under the Act he inquired into, and whether the contention of the management is sustainable. My friends, under LT-DICE, that is under 143(1), we are just supposed to do inquiry. We are not supposed to report on all those matters. Only if we are not satisfied, we will report on all those matters. Here the management is requesting us to comment on all the matters even if we are satisfied. So no, the contention of the management is incorrect here. The auditor of XYZ Limited is correct in non-reporting the matter specified under 143(1). X Limited has a branch in Malaysia. The company has appointed Mr. X, who is qualified to audit accounts as per Malaysia laws. Mr. Z, the statutory auditors, objects to the same, contending that he alone can audit the branch office accounts. Discuss. Now here, whoever is qualified to be an auditor in Malaysia can be appointed as an auditor. Yes. So here the contention of Mr. Z, the statutory auditor, that he only himself can be appointed is invalid. No problem here. The person who is qualified in Malaysia can also be a branch auditor. Next. Question number 26. Mr. Seema and the company had been the company auditor for Amudan Company Limited for the year 1890. The company had 3 branches located at Chennai, Delhi and Mumbai. The audit of branches Chennai, Delhi were looked after by the company auditor themselves. The audit of Mumbai branch had been done by another auditor, Messrs. Vasan and Company, a local auditor situated at Mumbai. The branch auditor had completed the audit and had given his report too. After this, but before finalization, the company auditor wanted to visit the Mumbai branch and have access to the inventory records maintained at the branch. The management objects to this on the grounds of the company auditor is trespassing the scope of the audit areas. Now my friends, if you remember our rights of an auditor under 143(1), we already discussed we can access the books of accounts not only of the company but also of the subsidiary at the branch at all the times. So here the main auditor cannot, the branch auditor cannot restrict us. The main auditor can go to the branch and have an access to the books of accounts and the records. So this was our discussion on 143(8), that is branch audit, and 145, that is who can assign the audit report. But here it was a very basic discussion. But before we move ahead, we'll have to go through the few questions of section 148 because these are very critical. We will have to evaluate this. Let us say Sugar Limited is a top sugar manufacturer, an exporter in India operating from Noida specific economic zone. Its revenue from sale export for the preceding year is given below. Sale within India is 1157 lakhs. Let's convert it into crores. So it will go to 11.57 crores. Sale outside India is 13.53 crores. Total revenue is 25.10 crore. Mr. X, the statutory auditor, is of the view that the company is mandatorily required to include the cost records in their books of accounts and consequently conduct cost audit. He also suggested a name of his friend who is a cost accountant in practice for the purpose of such cost audit. However, the management is of the view that company is neither required including cost records in their books of accounts nor conduct cost audit. Comment on the same. So now see, cost records will be applicable if my overall turnover is 35 crores or more. In this case, is my overall turnover 35 crores or more? No, my overall turnover is only 25 crores. So is cost record applicable? No. When we come to cost audit, we need not discuss because the company is belonging to a specific economic zone and we have already understood if you belong to what C, that is specific economic zone, electricity, or if your export is greater than 75%, audit is not applicable. So cost audit is also not applicable here. So in this case, neither the cost record is required nor the cost audit. Moving ahead, XYZ, having a place of business in Delhi, is engaged in the production of trading, import and export of orthopedic implants and pacemaker. The company's revenue from export is usually in foreign currency. Its total revenue classification for the immediately preceding year is as follows. Intrastate sale is 1400 lakh, which comes to 14 crore. Interstate sales is 15.5. Export to US is 49 crores. Export to UK is 69 crores. Total comes to 147.5 crores. The management of the company is of the opinion that company is not required to maintain cost records in their books of accounts. Consequently, there is no requirement to do cost audit. Again, let's consider. In case of cost records, if our turnover is 35 crores or more from regulated and non-regulated, we'll have to do cost records. So in this example, it is 147.5 crores. So definitely cost records are required. Now, when we talk about cost audit, if you are from SEZ, if you are in electricity, or if your export is 75% or more of the total revenue, it shall not apply. Here, if you consider the export to US is 49 crores, UK is 69 crores, total comes down to 118 crore. So when we consider it against the total revenue of 147.5 crores, the export comes to 80%, which is definitely greater than 75%. Then as per that, cost audit shall not apply. So in this company, though cost record is applicable, is cost audit applicable? No, because the export is greater than the 75% of its total revenue. Next, X Limited is engaged in the production of iron and steel. A CA firm, Messrs. M and Company, was appointed as the statutory auditors of X Limited for the current financial year. During the year, the management of the company realized that company is required to maintain cost records in their books of accounts and get it audited. Therefore, in general meeting, the members of the company appointed M and Company as the cost auditor of the company. You are required to examine the validity of appointment M and Company as the cost auditor. So, my friends, can the same person, M and Company, who is already a statutory auditor, be appointed as a cost auditor? No. We already studied if the same person cannot be appointed as a cost auditor as well as a statutory auditor. So, this was our discussion about the cost records and the cost audit, that is section 148 of the Companies Act.
Okay, let us go through question number 1. CA Sant, a newly qualified professional with certificate of practice, approached CA Pant, the auditor of his father's company, Messrs. Max Limited, to allow him to have some practical and professional knowledge and experience in his firm. He can set up his own professional practice. CA Pant allowed him to sit in his office for 6 months and allotted a small chamber with other office infrastructure facility. In the course of his association with CA Pant's office, he used to provide tax consultancy independently to the client of the firm and also filed few IT and GST returns and represented himself before various tax authorities on behalf of the firm, although no documents were signed by him. During this association, CA Pant's office, he did not get any salary or any share of profits or commission, but only reimbursement of usual expenses like conveyance, telephone, etc. was made to him. After the end of the agreed period, he was given a lump sum amount of rupees 3 lakhs by CA Pant for his association out of gratitude. So here what is happening is, CA Sant qualified, he has a certificate of practice. He approached CA Pant that he wants to practice, before he sets up his own firm, let him have some practice. So CA Pant allowed. Now here what happened, CA Pant was representing CA Pant, CA Sant was representing CA Pant. But however, CA Sant was neither his employee, neither his partner. See, I said there should be two preconditions. First, he should be a CA in practice. Okay, satisfied. Second should be, he should either be his employee or either he should be his partner. But in this particular line, they have made it very clear. He did not get any salary, so he is not an employee, or any share of profit or commission, so he is not even a partner. So CA Sant cannot represent CA Pant. Here CA Pant will be guilty of professional misconduct. So let me take you to the answer. Mr. Pant will be guilty of professional misconduct by virtue of clause 1 of the part 1 of the first schedule, as he allows any other person to practice in his firm name, whereas other person Sant is neither a partner nor an employee. Okay, so here CA Pant will be guilty of misconduct under clause 1 of the part 1 of the first schedule. So I hope you all understood it. Let us move ahead with the question bank of the clause 2. So question number 2. A CA obtained loan of a finance company for the purchase of building, agreeing to pay interest at the rate of 6%. Okay, this was valid. And 10% of his gross professional receipts till the loan is repaid. No, my friends, I cannot do that. I cannot pay him. The opposite person is not a member, he is not a partner, he is not a retired partner, not a legal representative of a retired partner, deceased partner, nor is he a member of the professional body, nor is he a person having prescribed qualifications. So I cannot share with him. Here he is, why he is guilty of professional misconduct under clause 2 of the part 1 of the first schedule. Okay, moving ahead with the third question. K, a practicing chartered accountant, gave 50% of the audit fees received by him to L, who was not a chartered accountant, under the nomenclature of office allowance, and such an arrangement continued for a number of years. My friends, I told you we cannot pay them directly or indirectly any share, commission or brokerage under any nomenclature. I cannot use the nomenclature office allowance. At the end, this is nothing but a commission. So I cannot share like this. So Mr. K will be deemed to be guilty of professional misconduct. Whatever the nomenclature you use does not really matter. Question 4. This is also one of a frequently asked questions, so please pay attention. Mr. X, who passed his examination on 18th of July, started his practice on 15th of August. On 16th August, one female candidate approached him for articleship. In addition to monthly stipend, Mr. X also offered her 1% of his CA firm. Can we share this profits? No, we cannot share. Okay, let us read ahead. She agreed to take both 1% of the profits of the CA firm and stipend as per the prescribed rate by the ICAI. The Institute of Chartered Accountants sent a letter to Mr. X objecting the payment of 1% profits. Mr. X replies that ICAI stating that he is paying 1% of the profits of his firm over and above the stipend to help the article clerk, as the financial position of the article clerk is very weak. Is Mr. X liable for professional misconduct? Yes, definitely he is liable. You cannot say the financial condition is weak. You cannot pay any profits out of the fees that you have received. You cannot share. Okay, so in this case, Mr. X will be guilty. Okay, this is not tenable. Okay, moving ahead with the next question, question number 5. A chartered accountant who was in practice since last 20 years died in a road accident. His widow sold a practice to another chartered accountant in practice for 30 lakhs. The price also included the right to use the firm. Is it true? Yes, we can do so. Only thing what we need to add in the answer is that they should obtain a permission of the ICAI. The widow of the deceased can sell the goodwill provided it is completed within 1 year from the date of the death, which we already read, and also the permission of the ICAI is obtained. So yes, it is possible, but just keeping in mind that it should be completed within 1 year and the permission of the same has been obtained or not.
Let us go to the past questions of clause 3. Mr. X is a practicing chartered accountant. Mr. Y is a practicing advocate representing matters in the court of law. X and Y decided to help each other in the matters involving their professional expertise. Accordingly, Mr. X recommends Mr. Y in all litigation matters in the court of law, and Y consults X in all matters relating to finance and other related matters which comes to him in arguing various cases. Consequently, they started sharing profits of their professional work. Is Mr. X liable for professional misconduct? So what has happened here? X is a chartered accountant and Y is a lawyer. X is a CA and Y is a lawyer. So they started referring each other and eventually they started sharing profits as well. Now can they do so? Yes, definitely can do this. But as per clause 2, we said we cannot pay or allow, but we had an exception list and lawyer was covered there. Likewise, in clause 3, we said we cannot accept or agree to accept, but there was an exception list and a lawyer was part of that exception list. So here we can pay, also we can accept, but the most important part that you will have to take care is you will have to mention both the clauses, clause 2 as well as clause 3. So let us go through the answer. Mr. X will not be deemed to be guilty of professional misconduct as clause 2 and 3 permits a CA in practice for profit sharing with members of any other professional body or with other persons having prescribed qualification and advocates are prescribed under what? Regulation 53A. So I can share with a lawyer and I can also accept from a lawyer. Let us move ahead with the past questions of clause number 4. Mr. P, a chartered accountant in practice, entered into partnership with Mr. L, an advocate for sharing of fees for the work sent by one to other. However, due to some disputes, the partnership was dissolved after 1 month without any fees having received. So what happened here? Mr. P entered into partnership with Mr. L. Mr. P is a practicing chartered accountant and Mr. L is an advocate. Can they enter into such a partnership? Yes, we said persons having prescribed qualification, my friend, advocate is covered there, and also members of professional bodies also includes what? Bar Council of India. So we can enter into a partnership with an advocate. There is no misconduct in this particular thing, and hence our answer will be Mr. P will not be deemed to be guilty of professional misconduct as clause 4 permits a CA in practice into partnership with entering into partnership with members of other professional bodies or with such other persons having prescribed qualification and a member of Bar Council of India and persons having Bachelor of Law are prescribed under 53A, which we have already done while we were doing our clause 2. So here we can enter into a partnership with an advocate. There is no misconduct at all. Mr. P will not be deemed to be guilty of professional misconduct. Mr. Z, a chartered accountant, wrote several letters to the government department pointing out seniority of his firm, sending his life sketch and stating that he had a glorious record of service to the country as well as to the organization of accountancy professional with a view to get the audit work. My friends, can he claim superiority? He could have asked from the work from another chartered accountant, but however, he could not claim superiority here. So here he will be guilty of clause 6 of the part 1 to the first schedule. Mr. S, a chartered accountant, published a book and gave his personal details as the author. This detail also mentioned professional experience and his present association with the partner as a partner with Messrs. RST, a firm. So now my friends, after the recent amendment that we have seen, if we publish an article, then in that case we can mention the firm name as well as the name of the CA. So there is no misconduct here. Next, Messrs. LMN, a firm of chartered accountants, responded to a tender from a state government for computerization of the land revenue records. For this purpose, the firm also paid rupees 50,000 as earnest deposit. So they paid how much? 50,000 for what? Earnest deposit. Is this valid? So once again, he responded to a tender from state government. So we have to see whether in case of tender, whether it is exclusively for chartered accountants or other professionals are also invited. If it is exclusively for chartered accountants, then in that case it has to have a minimum limit, minimum fees. And also if we are asked for earnest deposit, can we give this earnest deposit? Yes, there is no problem. So in the present case, since the computerization of property record does not fall within the exclusive areas of CA, Messrs. LMN can respond to the tenders as well as deposit of rupees 50,000 as earnest deposit and shall not have committed any professional misconduct. Moving ahead, question number 11. CAS and CAM are two partners of a CA firm SMN company. Being very pious, CAS organized a religious ceremony at his home for which he instructed his printing agent to add his designation chartered accountant. With his name in the invitation card, later on the invitations were distributed to only the relatives, close friends and clients of both the partners. My friends, they could have given this They could have given this only to the partner, close friends and relative of the partner at whose place the ceremony is being conducted. However, they gave it to relatives, close friends and clients of both the partners. It can have been given to only to the relatives, close friends and clients of CAS and not both the partners, and hence you will be guilty of misconduct. So this is an important question, because if you do not identify this word both, probably your answer will be wrong. Question 12. A special notice has been issued for a resolution at AGM of F Limited, providing expressly that CAS shall not be reappointed as an auditor of the company. Consequently, CAS submitted a representation in writing to the company as provided under Section 140 subsection of the Companies Act. In the representation, CAS incorporated his independent working as professional throughout the term of office, and also indicated his willingness to continue as an auditor if appointed by the shareholders. So all he is showing is his willingness. He is not doing anything unethical. He is not soliciting for his continuance. Then my friends, this is to allowed, right? If you can't even come to the representation and say that I am willing to be reappointed, then what representation are you going to give? So at least this should be allowed, right? If he is soliciting, if he is asking for his basic continuance, then no problem. But if he is soliciting only, then he will be disqualified. Next, CAN in practice started the project consultancy work as a part of his practice and advanced the same. Send an email to all the chartered accountants in the country informing them of his service and for securing professional work. So can we ask for work from chartered accountants? Yes, and hence there is no misconduct. But however, if you see minutely here, what they have written is it is sent to all the chartered accountants. So here we will have to take an assumption that all the chartered accountants are practicing chartered accountant, because we can send this only and only to the practicing chartered accountant. This cannot be sent to the others. This cannot be sent to other chartered accountants. If you recollect your clause 6, let me take you back to your clause 6. Any CA from applying or requesting for or inviting securing professional work from another chartered accountant in practice. So here what we have mentioned in practice. So if you are in practice, so if here we have sent an email to all the chartered accountants, so here we are assuming that when we have sent this, it is sent to all the chartered accountants who are in practice. It is sent to all the chartered accountants who are in practice. So here we will have to take an assumption that it is sent to all the CFs who are in practice, and hence there is no misconduct. Next, LMN and Associates, a firm of chartered accountants, responded to a tender exclusively for chartered accountants by an organization in area of tax audit. However, no minimum fees was prescribed in the tender. If you recollect, in case of a tender, if there is no invitation, we cannot fill the tender. If there is an invitation, we need to see whether it is exclusively for chartered accountants or whether it is for others as well. If it is exclusively for chartered accountants, then in that case, there has to be minimum fees. If there is no minimum fees, then we cannot accept such a tender. We cannot fill such a tender. So here there will be a misconduct because they have submitted a tender where no minimum fees was prescribed. Next, an advertisement was published in a newspaper containing a photograph of Mr. X, a member of the institute, wherein he was congratulated on the occasion of opening of the ceremony. My friends, in case of a newspaper, if there is an opening ceremony, if there is a new office, all we can have is a bare fact that there is a change in our address and nothing more. Can we have our photograph there? Obviously, this will amount towards soliciting or advertising, so we cannot have such an amount there. Next, Mr. X, a chartered accountant and the proprietor of X and Company, wrote several letters to Assistant Registrar of the Cooperative Society stating that though his firm was on the panel of auditors, no audit work was allotted to the firm, and further requested him to look into the matter. My friends, we can have ourselves on the panel, but however, we cannot make roving inquiries. Once you are registered on a panel, if there is work, they will definitely give you. You cannot ask them again and again why the work has not been allotted. This will again amount to what? Soliciting. So Mr. X would be held guilty under clause 6 of part 1, as roving inquiries for solicitation is not allowed. Next, Mr. Sodi, a chartered accountant in practice who is proposed to be removed as the auditor of a company, makes unsubstantiated and derogatory remarks against the management of the company in his representation under 140. My friends, he can ask for his continuance, but if he is making unsubstantiated or derogatory remarks, he is misusing his power under 140, that is right of being heard. This will not be allowed. He will be considered guilty of misconduct, that is under clause 6. Next, a letter is sent by a chartered accountant in practice to Ministry of Finance, inquiring whether a panel of auditor is being maintained by the ministry, and if so, to include his name in the panel. So again, my friends, here we cannot make roving inquiries. So if there is a panel, we can apply for the same. However, can we make roving inquiries here? No, roving inquiries are not permitted. Next, M, a practicing chartered accountant, sent a letter to another firm of chartered accountants claiming himself to be pioneer in liaising with the central government ministries and its allied departments for getting various government clearances, various for which he had claimed to have expertise, and had given a list of his existing clients and details of his staff letter. My friends, we can ask for work from another chartered accountant provided we comply with two things. Firstly, we do not claim superiority. Secondly, we do not give the client names. Here, he has done both of them because he said, I am a pioneer. So somewhere he is claiming superiority. Secondly, also gave a list of all the existing clients and details, and hence he has not complied with both the conditions, and hence he will be guilty of professional misconduct. Next, Mr. Honest, a chartered accountant in practice, wrote two letters to Messrs. XY Chartered Accountants, a firm of CA, requesting him to allot some professional work. As he did not have significant practice or clients, he also wrote a letter to Messrs. ABC, a firm of chartered accountants, for securing professional work. Mr. Clever, another chartered accountant, informed ICAI regarding Mr. Honest's approach to secure the professional work. Is Mr. Honest wrong in soliciting professional work? My friends, he is not wrong. He can definitely ask from another chartered accountant, provided he does not claim superiority or does not give the list of his clients. Here he has not done either of them, and there is no disqualification here. There is no misconduct here. Next, during the opening ceremony of a new branch office of a CA Young, his friend CA Old introduced to CA Young his friend and client Mr. Rich, the owner of an export house whose accounts had been audited by CA Old for more than 15 years. After a few days, Mr. Rich approached CA Young and offered a certification work, which hitherto had been done by CA Old. CA Young undertook the work for a fee which was not less than the fee charged by CA Old in the earlier. If you recollect our example, if the work is emanating from another friend, so for example, one of my friend introduced me to a client, and if that client comes to me and asks me to do the work, I will say, please you come by that particular friend, I cannot accept your work. So can I accept the work? Can I claim I have not charged fees less than the fees that that professional was charging? No. The acceptance of work emanating from a client introduced by another member is not permitted. Mr. Young will be deemed guilty of professional misconduct under clause 6 part 1 of the first schedule. So this were our question bank of the clause 6. Let us go through the few questions based on website. Messrs. XYZ, a firm of chartered accountants, created a website xyzindia.com. The website, besides containing details of the firm and biodata of the partners, also contains photograph of all the partners. So we can have photographs, but however we can only have passport style photograph and nothing else. So here we are saying they have complied with all the guidelines and does not appear. All we will write is we are assuming that these photographs are a passport style photograph. See, they have not said that this is not a passport style photograph, and hence we say there is no violation here. Next, XY and Associates, a firm with 5 partners, developed a website xyzassociates.com. The website also contained a link to All India Chartered Accountants Association, a voluntary association where X, a partner of the firm, is currently a vice president. My friends, we discussed which other website links can we give. We can give link to ICAI website, its regional council, government or government departments, then AICPA, CICA, but here they have given a link to All India Chartered Accountants Association, which is prohibited. You cannot give the same. So as per the guidelines issued by ICI for development and contents of the website, a website may provide a link to a website, its regional council branches. Okay, so here we cannot provide this particular link. A CA in practice created his own website in an attractive format and colors and circulated information in the website through email. So he created the website, very good, but he should have not circulated the information in the website through an email. This will amount to what? Soliciting, and hence he will be guilty of professional misconduct. Mr. X, a CA in practice, provides a part-time tutorship under coaching organization of the institute. On 30th June, he was awarded the best faculty of the year as gratitude from the institute. Later on, he posted his frame photograph on his website when he was receiving the said award from the institute. My friends, even if you are receiving an award from the institute, such photographs are not allowed, because all you can have is a passport style photograph, and hence you will be again guilty of professional misconduct. Mrs. XYZ, a firm in practice, develops a website xyz.com. The color chosen for the website was very bright green, and the website was to run on a push technology, wherein the name of the partners for the firm and the major clients were to be displayed on the website without any disclosure obligation. You can create a green website, that is color is definitely okay, but you cannot have on push technology. You can also not have the major client's name mentioned here. Again, you will be guilty of professional misconduct under clause 6. Next, PQR and associate chartered accountants have their websites. On the letterhead of the firm, it mentions visit our website pqr.com. In the website, the nature of the assignments handled, name of the prominent clients and fees charged is displayed. My friends, we cannot do this. We could have printed the same on our professional stationery, that is okay, but however we cannot disclose the name of the client and the fees that have been charged, and hence again you are guilty of misconduct. Let us move ahead with the final discussion of the questions based on our clause 7. Mr. Adnan, a chartered accountant in practice, is a partner of 4 firms. While printing his personal letterhead, Mr. Adnan gave names of all the firms in which he is a partner. Can he give the names of all the firms? Yes, definitely, there is no problem as such, yes. So here it is completely allowed. There is no such restriction. Next, Mr. B, a practicing chartered accountant as well as a qualified lawyer, was permitted by the Bar Council to practice as a lawyer. He printed his visiting card where he mentioned his designated as chartered accountant and advocate. See, he can have his name as chartered accountant. However, he cannot use any other designation along with chartered accountant. So if he had printed 2 different visiting cards, one for the purpose of chartered accountancy where he had stated chartered accountant, one for the purpose of advocacy where he had stated the designation advocate, it would have been okay. But on the same visiting card, you cannot have a designation chartered accountant as well as advocate. You will be guilty of clause 7. So Mr. B is guilty here. Mr. Nigel, a chartered accountant in practice, delivered a speech in the national conference organized by the Ministry of Textile. While delivering the speech, he told the audience that he was a management expert and his firm provides service of taxation and audit at reasonable rates. He also requested the auditor to approach his firm chartered accountants for these services at the request of the audience. He also distributed his business cards and telephone number. This is definitely what this will lead to, what soliciting advertisement, and hence he will be guilty not only under clause 7 but also under clause 6. Always remember, my friends, whenever under clause 7 you feel it is amounting to advertisement, it is amounting to what? Advertisement, you will also have to quote clause 6. So here clause 6 as well as clause 7 will be quoted. Next, Mr. SP, a chartered accountant, obtains registration as a category 4 merchant banker under SEBI's rules and regulation and act as an advisor to the capital issue of MB Company Limited. He designated himself under the caption merchant banker in client offer document and advisor to issue in his own letterhead, visiting cards and letterheads. So what he wrote is merchant banker. My friends, if he is a chartered accountant in practice, the only designation that he can use is chartered accountant. He cannot use the designation merchant banker, and hence he will be guilty under clause 7. Mr. M, a chartered accountant in practice, has printed visiting cards. Besides other details, also carries a quick response code. The visiting card as well as the QR code contains his name, office and a residential address, contact details, email ID and a name of the website. So can you have a QR code? Yes. Provided QR code also consists only those information that have been permitted by ICAI. So apart from that you cannot have anything else, but here the things that he has on the QR code is permitted by ICAI and hence there is no misconduct here. Mr. R, a practicing chartered accountant, is a director in X Limited, a public company. The prospectus of X Limited mentions the name of Mr. R as a director along with his various professional attainment. His areas of specialization and expertise in the field of international taxation. So he can have his name, but however can he give his professional attainments? No, here he will be guilty because he cannot give his professional attainments. So let us go through a question bank of clause number 8. Mr. X, a chartered accountant, accepted his appointment as a tax auditor under Section 44AB of the Income Tax Act and he commenced the tax audit within 2 days of his appointment since the client was in a hurry to file return of income tax before due date. After commencing, Mr. X realized his mistake of accepting this tax audit without sending any communication to the previous tax auditor. In order to rectify the mistake, before signing the tax audit report, he sent a registered post to the previous auditor and obtained postal acknowledgement. Will Mr. X be guilty? Yes, definitely he will be guilty. We said we should do this before accepting. It does not matter whether you have done it before signing the report, you should do this before accepting and hence he will be guilty under clause 8 of the part 1 of the first schedule. Next, can a CA, a chartered accountant, be held guilty of professional misconduct under the following circumstance? W, a chartered accountant, sent a letter under certificate of posting to the previous auditor informing him about his appointment as an auditor before the commencement of the audit. Though this time they did it before the commencement, however they did it under certificate of posting, which is not permitted. You should do by RPAD or by hand, but here what they have done is under a certificate of posting and hence again they will be guilty of misconduct. Next, CD and company, a firm of chartered accountants, accepted an assignment for audit of state level VAT. Okay, so this is a old question, so still you have VAT, but let's consider this, and communicated the same over a phone to the previous auditor. Can you communicate it over a phone? No, you need RPAD, you need a speed post, but however you cannot do it over a phone call. Next, CAT in practice was appointed to carry out the internal audit of a stockbroker listed with BSE. However, he failed to intimate his appointment to the statutory auditor of the company. Statutory auditor feels that this is violation. This is not a violation. I said you should be filling his shoes. If you are appointed as internal auditor, communicate with internal auditor. No need to communicate with the statutory auditor. So in this particular case, there is no violation of the clause 8. P, a chartered accountant, had accepted appointment as the auditor of QRS Company Limited without ascertaining from the company whether the requirements of 139 and 140 has been complied with. However, he realized this only after the acceptance. Here, he will definitely be guilty of clause 9 of the part 1 of the first schedule because we accepted the appointment without ascertaining whether section 139 and 140 has been complied with. One more question, a very basic question once again. CAX was appointed as the auditor of ABC Limited for the year 1819. Since he declined to accept the appointment, the board of directors appointed CAY as the statutory auditor in place of CAX, which was also accepted by CAY. So here what happened is CAX was appointed. CAX declined This is similar to our example of Ashwin and CA John, which we did in the previous video and also in case of Companies Act. He declined. Because he declined, CAX declined here. This is not a case of casual vacancy. Here they said board of directors appointed. Board of directors cannot appoint, my friends, because this is not a casual vacancy. We will again have to call an EGM and members will appoint a new auditor. However, this is not the case and hence they have violated section 139 of the Companies Act. So for this particular clause, you need to have a very good knowledge of section 139 as well. If you don't know what is section 139, if you yourself don't know whether it is complied or not complied, you cannot answer in this particular clause. So this was our very small discussion about clause 9 of the part 1 of the first schedule. Let us go through the question bank of clause 10. CAD, a chartered accountant, prepared a project report for one of his clients to obtain a bank finance of rupees 50 lakhs from commercial bank. Consequent to the sanction of the bank loan, CAD raised a bill of 2% of the loan sanction. Can you? Yes, this belongs to what? LCM4. This is nothing but fundraising activity and hence you will not be guilty. Next, question number 41. An auditor of cooperative society has agreed to charge fees 5% of the profits of the society. In case of Cooperative Society Act, they allow, so it is again completely okay. He will be not guilty. Here you will have to mention clause as well as regulation 192. PQR Private Limited approached CAY, a chartered accountant in practice, for debt recovery service. CAY accepted the work and insisted for fees to be based on 2% of the debt recovered. Again, we can charge on this particular case, no worries at all. Next, Mr. P, a practicing chartered accountant acting as liquidator of AB and Company, charged his professional fee on a percentage of the realization of asset. So he was acting as a liquidator. So again belongs to LCM 4. So again there will be no misconduct. So if you are very well versed with the list of LCM 4, the questions will be this easy. But if you do not recollect LCM 4, the questions may get difficult for you. Efficient Limited is running into losses and in order to optimize resource utilization and cost reduction, approaches you to carry out the assignment and offers fee of 5% of the benefit derived from the suggestions made by you. So can you again do this? Yes, because this is dealing with the cost optimization, cost reduction, which is again belongs to LCM 4 and which you can accept. So this was a discussion of clause number 10. Mr. J, a practicing chartered accountant in 2013, during 19, he got an offer from the post of chief accountant of a software development company as a full-time employee for a salary of 60,000 per month. On accepting the appointment, Mr. J converted his practice into a partnership firm by taking a fresh chartered accountant as his partner. Mr. J neither intimated the institute nor obtained permission from the institute about his employment. Will Mr. J be held guilty? So here he took a became a full-time employee for a salary of 60,000. So if you are into full-time employment or part-time employment, you need to obtain a permission from the institute. Here he has not obtained and hence he will be guilty under clause 11. Next, M, a chartered accountant in practice, is the statutory auditor of S Limited for the year 31st of March. In January 19, he was appointed as director in H Limited with the holding company of S Limited. So you are the auditor of subsidiary and appointed as a director of the holding. There will be a conflict of interest. Hence this is not valid and you will be guilty of misconduct. Mr. A, a practicing chartered accountant in practice, has been appointed as the editor of a monthly journal which analyzes the performance of the stock market and the mutual fund scheme. The editor of a monthly journal which analyzes stock market and mutual fund. This is not a professional journal, my friend. This does not relate to our profession. If it relates to income tax, standards on auditing, accounting standard, it would be a professional journal. But stock market and mutual fund is not a professional journal and hence in this particular case he will be guilty of misconduct. CA Preeti is a leading income tax practitioner in Delhi. She is very much fond of cooking. Due to this passion of her, she also wrote a cookery book, Delight Your Tummy, during the year. but she didn't take any permission from the council of the institute for engaging in the authorship of the book. So again, if you had written a professional book, there was no misconduct. There was no misconduct. But when we talk about professional, professional was related to the editorship. For books, they have never mentioned only professional books. For books, they said I can be into an authorship of the books. It is not prohibited. So clause 11 permits of any books, and hence there is no misconduct on the part of CA Preeti. CAZ is a leading income tax practitioner and consultant for derivative products. He resides in Mumbai near to the ABC Commodity Stock Exchange and does the trading in commodity derivatives. Every day he invests nearly 50% of his time to settle the commodity transaction. Is CAZ liable for the professional misconduct? So he is investing nearly 50% and he has not obtained any permission from the council, and hence he will be guilty of misconduct. If Mr. Z has obtained a specific permission, then no misconduct. But if he has not obtained a permission, then he will be guilty of misconduct. A chartered accountant having a certificate of practice entered into partnership with persons who are not members of the institute for the purpose of carrying on business. The share of the chartered accountant in the profit and losses was 25%. He was to take part in the business and was entitled to represent the firm before the government authorities. He was operating the bank account of the firm, was receiving monies from the customer, and was looking after the affairs of the partnership. So he shares 25% here. So can he be a partner here? He will be guilty of misconduct under both clause 4 as well as clause 11, because clause 4 tells us with whom can we enter into a partnership. Apart from those people, we cannot enter into a partnership, and hence there will be a misconduct of clause 4 as well as clause 11. CA Raghu is in practice in the field of income tax over a period of 12 years. He has gained experience in the domain over other years. Sam, a student of Chartered Accountancy course, is very much impressed with the knowledge of CA Raghu. He approached CA Raghu to take guidance on some topics of income tax related to his course. CA Raghu on request decided to spare time and started providing private tutorship to Sam and some of his friends along with. However, he forgot to take specific permission from ICAI for such private tutorship. So, is private tutorship allowed? Yes, private tutorship is allowed. There is no problem because we have been given a general permission that no specific permission is required for private tutorship. So, this was our discussion of clause 11. As a practicing chartered accountant gives power of attorney to an employee chartered accountant to sign reports on the financial statement on this behalf. So he gave power of attorney to employee. Can you give it to an employee? So we said he has to be CA plus COP plus the partner. Here he will be guilty of clause 12. Next. Mr. A practicing chartered accountant working as proprietor of Messrs. A&E Company, went to abroad for 3 months. He delegated the authority to Mr. Y, a chartered accountant, his employee, for taking care of routine matters of his office. During his absence, Mr. Y has conducted the under-mentioned job in the name of A&E Company. He issued audit queries to client which were raised during the year. Now tell me, audit query, do we give any opinion here? Are we giving any opinion here? No. We are just raising the audit queries. It is completely okay. So if there is no opinion, we will consider this as routine, which is allowed. Second, he issued a production certificate to a client under GST laws. See, production certificate, we are giving a certificate, right? Hence, this is going to be an opinion. If this is an opinion, this cannot be considered as routine. Last, he attended income tax proceedings for client as authorized. So he just attended. He has not given any opinion. So here there is no opinion. Hence this can be considered as routine. Let us check the answers here. Issuing audit queries during the course of audit falls under the routine, which can be delegated. So I said if there is no opinion, it can be considered as routine. Next, issuance of production certificate is not routine. So I said if there is an opinion, it is not routine. Hence this is not allowed. Attending income tax proceeding, here they said falls under routine. See, there is no opinion and hence it is a routine. So it is a very simple thumb rule. If there is an opinion, then in that case it is not routine. If there is no opinion, then it will be considered as routine. If you remember this thumb rule, there will be no confusion. Though in the book I have given the whole list what can come under routine transaction, but no need to memorize it. You can just use this particular thumb rule and go with it. So this was our discussion of clause 12. Mr. C, a chartered accountant, holds a certificate of practice while in employment, also recommends a particular lawyer to his employer in respect of a case. The lawyer, out of the professional fees received from the employer, paid a particular sum as a referral fee. So can I do that? No, I will be guilty of misconduct. My friend, had I be in practice, I can share with a lawyer. But here the important point is, here I am in employment. If I am in practice, if I have recommended a lawyer, then I can ask him for a referral fees. If he has recommended me, I can give him referral fees. If you recollect clause 2 and clause 3 of the part 1 of the first schedule. But if I am a member who is in employment, who is in service, and if I am recommending him and if I charge him a percentage, this is not allowed. So this was question 54. This is clause 1 and the clause 2 of the part 2 of the first schedule. So let us go through the question bank of the first and the second clause. Mr. X, a chartered accountant, employed as a paid assistant with chartered accountant firm on a 31st of December 2018. He leaves the services of the firm. Despite many reminders from ICEI, he fails to reply regarding the date of leaving services of the firm. So here the chartered accountant did not reply to ICEI. Does ICI form part of ICD BDQA? Definitely it forms part of ICD BDQA. So here we will be guilty of clause 2 of the part 3 of the first schedule. So X is held guilty because he did not supply the information asked for. Next, Mr. G, while applying for a certificate of practice, did not fill in the columns which solicit information about his engagement in other occupation or business while he was indeed engaged in a business. So if you are engaged in some other business, you have to inform ICI. So they had asked for this information. However, Mr. G did not supply the information. Again, he will be guilty under clause 2, part 3 of the first schedule. Next, XY Associates, a chartered accountant firm, is having a relationship with multinational accounting firm in India. ICEI require that all the firms having networking relationship with any other entity need to furnish the information online within a stipulated time. XYZ failed to respond. So now who required for the information? ICI. Again, we have not complied with the requirements. We have not supplied information. Hence, again, we will be guilty under clause 2, part 3 of the first schedule. CAD, a chartered accountant in practice, availed a loan against his personal investment from bank. He issued 2 checks towards the repayment of the said loan as per the installments due. However, both the checks were returned by the bank with the remarks insufficiency of fund. Now, if there is insufficiency of fund, my friends, this will bring disrepute to the institute and hence you will be guilty under clause 2, part 4 of the first schedule. Mr. P, a chartered accountant in practice, approached manager of a nationalized bank for a loan of 25 lakhs. He also informed the manager that if the loan is sanctioned, income tax return of the manager and the staff will be filed without charging any fees as a quid pro quo for the loan sanction. So I cannot do this just because I want loan. I cannot give them such incentives. This will bring again disrepute to the institute and hence you will be guilty. Mr. A, a practicing chartered accountant, failed to return the books of accounts and other documents of the client despite many reminders from the client. The client had settled his entry fees dues also. So there was no reasonable cause for me to retain his books of accounts. This was mere out of negligence, again which brings disrepute to the institute and hence you will be guilty under clause 2 of part 4 of the first schedule. C. Kumar, who is contesting Central Council election of institute, engages his article assistant for his election campaign, promising him that he will come in contact with influential people, which will help him enhance his career after completion of the training period. My friends, you cannot use article for any other purpose apart from the professional practice. What he is doing is not correct. So with this, we are done with a discussion of all the four parts of the first schedule. So this is part 4, clause 1 and 2 of the first schedule. A CA in practice was engaged by a businessman to present him before the tax authorities on current matters. And in the course of such employment, he came across certain documents pointing of tax frauds in the preceding years, for the client was not represented by him. Is the member liable to disclose the existence and contents of the documents to the tax authorities? No, my friends, I will not disclose that. It will amount to breach of confidentiality. Next, question 63. XYZ Limited company has applied to a bank for a loan facilities. The bank, on studying the financial statement of the company, notices that you are the auditor and request you to call at the bank for a discussion. In the course of discussion, the bank asks for your opinion regarding the company and also asks for the detailed information regarding the few items in the financial statement. The information is available in your working paper file. What would be your response? Can you give this? No, my friends, it will again amount to breach of confidentiality, and hence we cannot give this working paper to any outside authority. Mr. C, a practicing chartered accountant, in the course of audit of a listed company, discovered serious violation of the provisions of the Companies Act, informed the registrar of the companies out of public interest. So you cannot do this, my friend. You cannot go and inform registrar out of public interest. You will be guilty under this particular clause. Next, Mr. Z, a chartered accountant, was invited by Chamber of Commerce to present a paper in Synopsim on the issues facing by the Indian leather industry. During the course of his presentation, he shared some of the vital information of his client's business under the impression that it will help the nation to compete with other countries at international level. So still, I cannot disclose the client's information. My friends, even while I teach you, I give you n number of examples. While teaching ROMMS, I told you that there were only 6 workers. There were 9 workers, but when we found out there were only 6 workers. N number of examples that I have given you are real life examples. But I have never gave you an indication of which company it was. I have never even given you a hint by which you can, make out which company it will be. Even as a teacher, I cannot use the real life examples about the client's confidential information that can help you understand. So what Mr. Z did here was incorrect. So this is an important question. Because this is a frequently asked question. ICAI is asked the same question at least 3 to 4 times. So here he will be guilty of misconduct. So this was our discussion of clause 1 of the part 1, the second schedule. So let us go to the question of clause 2. Mr. L, a chartered accountant, issued a certificate of consumption which did not reflect the factual position. Certificate was given on the basis of minutes of the board meeting. So here we have not checked at all. There is no examination. Forget about us. No one else also has done the examination. Then I will be guilty of clause 2, part 1 of the first schedule. Let us go through the questions of clause 3. CAQ certifies financial forecast of a client, and same was forwarded to a bank by client. Based on the certification, a loan was sanctioned. Based on the certificate, loan was sanctioned. So here what we are trying to say is that I certified the financial forecast. It is completely okay. We just read that we can participate in the financial forecast. So we have just participated, and hence we will not be guilty. We will write in the answer provided in our report we have given sub TV. That's it. So we can definitely participate. There is no worry at all. We should not vouch for the accuracy is the problem here. Mr. N, a practicing chartered accountant, requested by client to prepare projections and a report for the next 5 years. He stated in his report source of the information, basis of forecast, major assumptions made to arrive at the forecast, and does not vouch for the accuracy. So in his report, he has already included sub TV. So can I participate in this forecast? Yes, definitely he will not be guilty of professional misconduct. Had he not given sub TV, he would have been guilty. D. A practicing chartered accountant examined and reported on the prospective financial statement for one of his clients to obtain a cash credit facility of 75 lakhs from private bank. The bank has sanctioned the credit facility of rupees 60 lakhs to his client. Consequent to the sanction of the loan by bank, he charged a fee of rupees 60,000 based on 1% of the credit facility received. So what here he has done is he has examined and reported on the prospective financial statement. Can we do so? Yes, we can do so, but we cannot vouch for the accuracy. So Mr. D is allowed to examine the prospective financial information of the clients provided condition as stated in SAE are fulfilled. What does SAE condition say? That in our report we need to give sub TV. Also, here what they have said is we have charged 1%. So can we charge on the percentage basis? We can definitely charge on percentage basis because here it is for fundraising. And if you recollect a regulation 192, they said we can charge on percentage basis when there is fundraising. So here, however, charging of fees on percentage basis to misconduct under clause 10 of the part 1 of the first schedule except as permitted under regulation 192. Charging percentage of fees of fund raised under regulation 192, hence there is no misconduct on part of Mr. T. So here there is no misconduct, but here you have to be very vigilant and make sure you quote clause number 3 of the part 1 of the second schedule. But with this, you do not forget clause 10 of the part 1 of the first schedule, which was talking about charging of percentage. So yes, you can do so. So this was our discussion of clause 2 and 3 of the part 1 of the second schedule. AP and Company, a firm of chartered accountants, was appointed by D Limited to evaluate the cost of a new product manufactured by it for their information system and fixation of the fair market price. Partner P of the firm is a non-executive director of the company. Comment with reference to the Chartered Accountants Act. So what has happened is he was appointed by D Limited to evaluate cost of a new product by it for their information system and fixation of fair market price. Mr. P of CA firm is a non-executive director of the company. See my friends, I cannot be appointed when I am being appointed as an auditor. Here I am being appointed as a cost of a new product. So there is no professional misconduct. Had I been appointed as an auditor, there would have been a misconduct. But for reducing the cost of a new product is completely okay. There is no problem as such. Mr. W is appointed as the statutory auditor of private limited company in which spouse's sister's husband holds 75%. So who is holding? Spouse, sister's husband. So if you for this you have to recollect the definition of AS 18 that you have done in your inter. My friends, spouse's sister husband is nowhere a relative as per AS 18. So here there is no professional misconduct. So somewhere they are not testing your knowledge of professional ethics. What they are testing here is your knowledge of AS 18. So this was a discussion of clause 4. Mr. A was appointed by H Limited to audit the PF trust maintained by the company. While conducting the audit, he noticed that large number of loans have been given out of the trust to the employer in contravention of the rules of the PF trust. He disclosed the irregularities to the trust and to the company, but not to the individual subscribers of the PF. When queried on his omission to disclose, he explained that he owed no duty to the individual members. So here they had not disclosed this particular fact, and the fact is definitely material, and hence he will be guilty under this particular clause. So guilty by clause 5 of part 1 to the second schedule, as he was required to disclose the fact to the beneficiaries of the fund, like he gives a report to the shareholders of the company. Next, question 73. Mr. J, a chartered accountant, identified that ABC Limited has taken a loan of rupees 15 lakhs from Provident Fund account. During the course of audit, the said loan was not reflected in the books of accounts and the statement were prepared ignoring the same. So, they had taken a loan from the provident fund account. This is a material fact which has to be disclosed, but the same has not been disclosed. Hence, you will be guilty under clause 5, part 1 of the second schedule. Question 74. The superannuation cum pension fund for the employees of a company was under a separate trust. Both the company and the trust were under the same management. The auditor who was auditing the accounts of the company as well as the trust noted some irregularities in the operation of the trust and commented upon these irregularities in the confidential report given to the trustee, but did not mention about these irregularities in his report on the annual accounts of the trust. Again, a material fact which has not been disclosed, and hence again he will be guilty under clause 5, part 1 to the second schedule. So this was clause 5 where we were talking about the material fact. Mr. X, partner of X and Company Chartered Accountant, has compiled and signed the balance sheet of Falls Limited for submission to the bankers of the said company. Mr. X also compiled and signed at the request of the company another balance sheet inflating the value of the asset by 20% for submission to a term lending institution. Both the balance sheet were not in conformity with the books of accounts maintained. So they had made two different balance sheet, one where they had inflated the value by 20%. So they are saying both the balance sheet were not in conformation with the books of accounts. Here what they are asking is comment on the liability of Mr. X. There is definitely a material misstatement, and hence the misstatement will also be a fact. So we will have to quote both clause 5 as well as 6. So Mr. X would be held guilty under clause 5 and 6 of part 1 of the second schedule, as Mr. X has compiled two different balance sheet for the same date without reference to the actual books of accounts but on instruction of the client. As per clause 5, he failed to disclose a material fact known to him. As per clause 6, he has also failed to report a material misstatement known to him. So this is a material fact as well as material misstatement. Hence, we have quoted both the clauses, that is clause 5 as well as clause 6. Let's go one more question. A practicing chartered accountant was appointed to represent a company before tax authorities. He submitted on behalf of his client certain information and explanation which were found false and misleading. So again here there is going to be a misstatement. My friends, now is the point to understand the third important point that we had marked, where he is concerned in his professional capacity. So when I say in his professional capacity, he is giving an opinion on the same. If he is giving opinion on the same and if they report a material misstatement, only then he will be guilty. If I am not giving any opinion on this, will I be guilty under this clause? Let us come back to this particular question. Practicing chartered accountant was appointed to represent a company before tax authorities. He just submitted on behalf of his client certain information and explanation. He is not concerned in his professional capacity, that is, he is not giving an opinion. Is there any opinion by the chartered accountant here? No, and hence he will not be guilty. The CA would not be liable as he is not engaged for examination of any information and he had only submitted the information acting on the instruction of the client as authorized representative. So here he is not at all guilty, and hence all the three words were important. In clause 5, material fact, clause 6, material misstatement. Second point was financial statement, which includes the report as well as certificate, and the third and the important point on which we saw the last question was in his professional capacity. So this was a discussion of clause 5 and 6 of the part 1 of the second schedule. Mr. Fair, a practicing chartered accountant, was appointed to carry out a balance sheet of a non-profit organization. The internal auditor detected certain irregularities at one of the branches of the organization which Mr. Fair had failed to detect. So that is okay, right? The internal auditor detected. We referred to this in the note number 1. So as a statutory auditor, we may not do such in-depth checking which an internal auditor may do. So if he has detected, there is no problem. We are not going to be guilty under this particular clause. A search under section 132 of the Income Tax Act in the premises of a leading merchant led to the discovery of two sets of books of accounts. One is set to record all the income correctly and second, record only the limited income. A CA has issued audit report on the basis of second set of books. What would be your answer if the first set of books carried evidence of checking by the CA? So there are two sets of books. So obviously one set of book includes only the income on which we are paying taxes. Second set of books includes everything. So CA had checked both the books and there is an evidence that you have checked both the books of accounts. Then definitely you will be guilty. You will be guilty under clause 7 of the part 1 to the second schedule. Mr. X, a CA in practice and statutory auditor of True Limited, advised managing director of a company to include order under negotiation to reflect a better financial position. Mr. X thereafter gave a clean report on the balance sheet. So they have included order under negotiation, which we have already covered in our examples, that which you cannot do that. Also what here they have said is not just this, he will also be deemed to be guilty under clause 2 because he has not checked, he has signed the report without examination. So this is an important point, not just clause 7, even clause 2, because he did not examine and he just gave the report without examining the financial statement. The cashier of a company committed fraud and absconded with the proceeds thereof. The company, during the course of the accounting year, the chief accountant of the company also did not know about the fraud. In the course of the audit at the end of the financial year, auditor failed to discover the fraud. After the audit was completed, the fraud was discovered by chief accountant. Investigation made at that time indicate that auditor did not exercise proper skill and care and perform his work in a desultory and a haphazard manner. With this background, the director of the company intended to file the proceedings against the auditor. Definitely they have said he did not exercise proper skill and care and hence he will definitely be guilty here. Fine. Next, Mr. B, a practicing CA, expressed opinion on the financial statement of ABC for the year ended 18. It was later found that the closing stock was valued arbitrarily by the management, which was accepted by him without any further verification, and large amount of revenue expenditure was capitalized. So we cannot arbitrarily value the same. We need to apply our audit procedures. We cannot rely only and only on the return representations given by the management. Hence we will be guilty under this particular clause. Mr. D, a practicing chartered accountant, did not complete his work relating to the audit of the accounts of a company and had not submitted his reports in a due time to enable the company to comply with the statutory requirement. My friends, as an auditor, if we did not submit our report on time, this is mere gross negligence and hence definitely you will be guilty under this particular clause. So this was a discussion about if you do not perform your duties with due diligence and if you are grossly negligent. CAZ, who conducted audit of Marathi Daily New Era, certified the circulation figure based on the Management Information System report without examining the books of accounts. So all he did was took the MIS report and relied on the same and he did not perform any procedures. So you will have to quote clause 2. Why clause 2? I certified where I have not done any examination, 7 because I was grossly negligent, and 8 because I did not obtain sufficient information. So the important point here is quoting all the 3 clauses together. You will get marks only if you quote all the 3 clauses, or my friends, or else you will not be allotted any marks. Next, Mr. A CA, was the auditor of A Limited during the financial year 18-19. The investment appeared in the balance sheet of the company at rupees 10 lakhs and it was the same amount as in the last year. Later on, it was found that the company's investment were only rupees 25,000, but the value of the investment was inflated for the purpose of obtaining higher amount. So the amount was inflated. So initially it was 10 lakhs. It has remained the same. When we saw, it was actually how much? 25,000. So somewhere again here we will have to close 2, 7 and 8 because we did not apply any procedures. We certified without applying any procedures. We were grossly negligent and also we did not obtain sufficient information. So it is very simple, but all you need to make sure is you quote all 2, 7 and 8. This was a discussion of clause 8. A charitable institution entrusted 10 lakh with the auditor Messrs. Ram and Company, a chartered accountant firm. to invest in specified securities. The auditor pending investment of the money deposited in their saving bank account, and no investment was made in the next 3 months. My friends, it was in his personal account and no investment was made. He will be guilty. So Mr. Ram and company will be guilty of professional misconduct as he did not put the amount in a separate banking account. Mr. Ram, a CA in a practice, received rupees 15 lakh rupees on 15th of December 18 on behalf of one of his client who has gone to USA. Mr. Ram deposited the said amount in his saving bank account as per the instruction of the client. The said amount is to be returned to the client on 31st of March when he will return to India. On occasion of the birthday of his wife, Sita, Mr. Ram withdrew 5 lakh rupees and spent on the birthday party. He redeposited rupees 5 lakhs in the cash in the said saving bank account on 25th of March 2019 and returned the entire amount of 15 lakhs to the client. My friends, this will not work. This is nothing like what Harshad Mehta did, right? He was using people's money. So here you cannot use this 5 lakh rupees for your wife's birthday party. And even if you have returned the same, does not mean you are doing what you're doing is ethical. So Mr. Ram will definitely be guilty of misconduct here. You cannot use this particular amount for personal use. Next, Mr. Z, a practicing chartered accountant, received a sum of rupees 1 lakh on 1st of September from a client who intended to live abroad for a period of year, with a request that his advances tax liabilities to be paid with a period over a period of year, with a request that his advance tax liabilities to be paid over 3 installments, 15th of September, 15th of December, 15th of March. After remitting the first installment of advance tax on 15th of September, Z did not keep the money in a separate banking account and he is of the opinion that money will be spent within a reasonable time. This is not a reasonable time, right? So for the first quarter, we understand. See, you received the money on 1st September. 15 September, you made a payment. Okay, we understand. Chalo, within 15 days, it would have been difficult to open a separate bank account and it would not make any sense. But however, for 15th of December and 15th of March, you have still a lot of time at your disposal. Here, this is not a reasonable time, my friend. You should have opened a separate banking account and here you have not, and hence you will be guilty under clause 10, part 1 of the first. So with this, we are done with the whole part 1 of the second schedule. So what does question 88 tell us? Mr. S, a practicing chartered accountant, agreed to provide portfolio management services to his client. Mr. D, comment with reference to the Chartered Accountants Act 1949. My friends, if you recollect our management consultancy services, all we can provide is Salter. Apart from Salter, if we provide any other services, then we will be guilty. So here, is portfolio management services included here? No, portfolio management is not included and hence we will be guilty of misconduct. Next, C. Nataraj in practice accepted an assignment as advisor and consultant to the public issue of shares by his client, Messrs. Super Limited. Besides helping the company as an advisor, he also underwrote the public issue of the company to extend 25% at a commission of 1%. Remaining shares were underwritten by banks and other financial institutions at the same rate of commission. He contends that the above assignment are part of the management consultancy work permitted by the Council of the Institute. Do you agree with the view of C. Nataraj? Decide in the light of the applicable code of conduct. So again, does underwriting fall part of Salter? No. Underwriting does not form part of Salter and hence this would not be allowed. You will be again guilty of misconduct. Next, Mr. A chartered accountant in practice, has been suspended from practice for a period of 6 months and he had surrendered his certificate of practice for the said period. During the said period of suspension, though he did not undertake any audit assignment, he undertook representation assignment for income tax, whereby he would appear before the tax authorities in his capacity as a CA. So everything would have been okay, but they said he is representing in his capacity as a CA. If you are suspended, how can you represent in your capacity as a CA? So definitely here you will be guilty because you are suspended and you cannot represent in your capacity as a CA. Mr. Dice, a practicing chartered accountant, was ordered to surrender his certificate of practice and he was suspended for 1 year on certain professional misconducts against him. During the period of suspension, Mr. Dice, designating himself a GST consultant, did the work of filing GST returns and made appearance as consultant before various related authorities. He contended that there is nothing wrong in it, as like any other GST consultant could take the work, and his engagement as such in no way violate the order of suspension inflicted on him. Is he right in his contention? So here this time he is representing as a GST consultant. So he is not representing himself in his capacity as a chartered accountant, and anyone else who is not even a chartered accountant could have represented as a GST consultant. So here there is no problem, and hence Mr. Dice is correct and he is not guilty of misconduct. Next, question number 92. Mr. G, a chartered accountant in practice, as a sole proprietor, had office in Mumbai near Churchgate. Due to increase in the professional work, he opens another office in suburbs of Mumbai, which is approximately 80 kilometers away from the municipal limits of the city. For the running of the new office, he employs 3 retired income tax officers. So my friends, see, everyone viewing this lecture is not from Mumbai. Okay? A lot of you all are from Bangalore. So in this particular case, if you consider the city limits, see, Churchgate and suburbs are in the same city. But we are not supposed to consider that. We will consider that it is approximately 80 kilometers away from the municipal limit. So even if they give you some example from Bangalore, Chennai, and if you are aware that it is in the same city, does not matter. What we will consider here is how many kilometers they have given, because this is a pan-India level. So students from Mumbai might be aware about the geography of Mumbai. Students from Bangalore might be aware about the geography of Bangalore. But this is a pan-India level examination. Not everyone is aware about the cities. So what you will have to focus is on those kilometers. On what? Those kilometers. So it is approximately 80, which is more than 50 kilometers. And hence that particular branch requires a special in charge who is a CA. You cannot appoint 3 retired income tax officer, and hence here again they will be guilty of professional misconduct. Next, question 93. XY and Company, a firm of chartered accountants having 2 partners, X and Y, one in charge of the head office and another in charge of the branch at a distance of 80 kilometers, puts up a name of the name board of a firm in both premises and also in their respective residences. So here, see, they had a branch at 80 kilometers. That is not a problem here because they have in charge, right? One in charge of head office and another in charge of the branch. So at both the branches, there is one chartered accountant who is in charge. That is not the problem at all. They put the board at the premises but also at their respective residences. My friend, you cannot put a board at your residence. Only you can have your board at the branch or your own head office. This is not permitted. So a lot of students might get deviated, they might get distracted with the information given. The question was focusing on the board put in at the residence. Next, Mr. Dheeraj, an aspiring student of ICEI, approached Mr. Murli, a practicing CA, for the purpose of articleship. Mr. Murli, the principal, offered him a stipend at the rate of 2000 per month to be paid every 6th month, along with the interest of 10% per annum compounded monthly to compensate such late payment on the plea that the cycle of the professional receipt from client is 6 months. Mr. Dheeraj agreed for such late payment in the hope that he will get some extra stipend in the form of interest. Mr. Mulli used to disburse salary to all his employees on time. Is this allowed, my friends? If you recollect, we should receive the stipend monthly basis beyond all doubts. So you cannot pay for 6 months even though if you are paying interest. This is incorrect because we need to pay it on time. So here he has violated regulation 48 of the CA regulations 1988, and hence he will be guilty of clause 1 part 2 of the second schedule. Next, the manager of ABC Private Limited approached CAX in the need of a certificate in respect of consumption statement of raw material without having a certificate of practice. CAX issued to the manager of the company acting as a CA in practice and applied for the COP to the on the very next day to avoid any dispute. So if you start with the work of a practicing chartered accountant without having a COP, again you will be guilty. So this could have not be done. So again he has violated section 6 and hence he will be guilty under clause 1 part 2 of the second schedule. PQ and a company, a firm of chartered accountants, included the name of R as a partner while filing application for appointment as auditor for public sector branches. It was subsequently noticed on the date of application that R was not a partner of PQ and company. My friends, he will be guilty under clause 3 part 2 of the second schedule because he is submitting information knowing it to be false. So if we supply any information, statement or returns to ICD BDQA knowing it to be false, you will be guilty under clause 3 part 2 of the second schedule. Next, Mr. Brilliant, a chartered accountant, received a major professional assignment. To complete the said assignment, he was required to buy 4 computers. Due to his inability to provide funds for acquiring the same, he borrowed money from a firm where one of his article clerk and his father was interested. What will be the chartered accountant's liability? See, my friends, in this case, what has happened is he was already appointed and later on we are borrowing money. So if you recollect while we were discussing this particular thing, I had mentioned that in this particular question, institute has taken a stand that it is not for the consideration of articleship. Had it we borrowed money before appointing an article assistant, it would amount to misconduct. But here we have borrowed money after the article assistant has been appointed. So accepting loan from article clerk in case of engagement of an article clerk is prohibited under regulation. But in the present case, it appears from the fact that article clerk is already been engaged and serving under him. And thus Mr. Brilliant will not be held guilty under clause 1 part 2 of the second schedule. Next, X, a practicing chartered accountant, in an application for permission to study submitted by his article to the council had confirmed that the normal working hours of his office were 11 am to 6 pm and the hours for which the article assistant was required to attend class was 7 am to 9:30 am. According to the information from the college, the article assistant attended college from 10 am to 1:55 pm on all weekdays. About the article assistant attending classes even during office hours, X pleaded ignorance. Again, you are submitting incorrect information. You are submitting what? Incorrect information, and hence you will be guilty. So Mr. X will be deemed guilty under professional misconduct under clause 1 part 2 of the second schedule for contravention of the regulation of the institute, and under clause 3 part 2 of the second schedule for submission of information knowing it to be false. So you will have to quote both the clauses, that is clause 1 of the part 2 as well as clause 3 of the part. Now this particular question is a repetitive question. We have already discussed the same, but since it has been reprinted, let me again read it out for you. Mr. Brilliant, a practicing chartered accountant, received a major professional assignment. To complete the said assignment, he was required to buy 4 computers. Due to his inability to provide the funds for acquiring the same, he borrowed money from a firm where one of the article clerk and his father were interested. What will be the chartered accountant's liability? So again, he will not be liable because here we are saying in this case it was taken after he was appointed, so no worries at all. Also, question number 100 is a repetitive question, but still again let me read it out for you. X, a practicing chartered accountant, in an application for permission to study submitted his article assistant to the council had confirmed that normal working hours of his office were 11 am to 6 pm and the hours during which the article assistant was required to attend were 7 am to 9:30. According to the information from college, the article assistant attended the college from 10 am to 1:55 pm on all weekdays. About the article assistant attending the classes even during the office hours, X pleaded ignorance. So again he will be guilty under both clause 1 part 2 and also the clause 3 part 2. So a repetitive question. Next, P, a chartered accountant, did not maintain any books of accounts. on the ground that his income did not exceed prescribed under 44AA of the Income Tax Act. See, whatever you follow under the Income Tax Act is irrelevant. If you are a member in practice, you have to prepare a cash book and your ledger accounts, that is your books of accounts. So here he will be guilty of misconduct. So Mr. P will be guilty of professional misconduct under clause 1 part 1 to the second schedule due to the contravention of chapter 5 of the Council General Guidelines for non-maintenance of books of accounts. So whatever taxation laws you are following does not matter, you will have to prepare your books of accounts. Next, Mr. Gaurav is a partner in XYZ and Company, a firm of chartered accountants with 6 partners. During the year 1920, Mr. Gaurav had signed 290 reports consisting both corporate and non-corporate. See, there are 6 partners. Under tax audit, they can sign 60 per person. So total overall they can sign 360. This particular partner has said 290. Does not matter. In Companies Act, per partner can sign only 20, but there is no such prohibition in case of a tax audit. One partner could have also signed all 360, and hence there is no misconduct here. It is perfectly alright. Next, A is the auditor of Z Limited, which has a turnover of rupees 200 crores. The audit fee for the year is fixed at rupees 50 lakhs. So his audit fees, statutory audit fees is 50 lakhs. During the year, the company offers an assignment of management consultancy within the meaning of section 2 for a remuneration of rupees 1 crore. So he's been offered management consultancy for 1 crore. Seeks your advice. So firstly, we need to see whether we can provide management consultancy. So it has been provided as per section 2. So there are few management consultancies such as Salter which we can provide. But however, this management consultancy will be other services, and your remuneration for other services cannot exceed your remuneration for statutory audit if you are a listed company, if you are a public sector undertaking, if you are a public company whose turnover is 50 crores or more. Your turnover is how much? 200 crores or more. So will this apply? Yes, this will definitely apply. So your other services cannot be greater than your statutory audit. So here again you will be guilty because you are prohibiting chapter 9 of the Council General Guidelines 2008 as he accepts the management consultancy assignment at a fees higher than the audit fees. If your fees were less than the audit fees, then we would have seen whether you are permitted or not permitted. But if it is greater, then irrespective of whether it is Salter or any other services, you will be guilty of misconduct. So with this, we finally put an end to our discussion of the part 3 and all the whole of the second scale. So let us begin with our discussion of SA 700. What does SA 700 mention about? Forming an opinion and reporting on the financial statement. So what is our objective under SA 700? Our objective is that we want to form an opinion. So based on the audit evidence that we have obtained so far, we want to conclude and form an opinion. And not just that, once we have formed an opinion, we want to express that opinion through a written report. So our objective here is to form an opinion on the financial statement based on the evaluation of conclusions drawn from the audit evidence obtained and express clearly through a written report that describes the basis for the opinion. So we will also give on what basis we have formed our opinion. Let us directly move ahead with the main part of this particular standard, that is elements of the report. So what are the basic elements of a report? So firstly, what you have is a title. Usually what is the title that we write? The Independent Auditor's Report. What we write here is the Independent Auditor's Report. Then we will write the addressee to whom the report is addressed. Usually it is addressed to the shareholders. So what we will write here is to the addressee. So firstly what we will write is title, then addressee, then what we will write is auditor's opinion. So in auditor's opinion, obviously we will write our opinion that everything is true and fair. We will obviously write our opinion that everything is true and fair. But along with that, what we will write here is date, notes. What we will write here is date notes. Firstly, specify the date or the period covered by each financial statement. So people should at least know for which particular year you are giving this report. For example, it is for 23-24, whether it is for 24-25. So specify the date or the period covered by each financial statement. State that the financial statements have been audited. It is very essential that you write the word that it has been audited. Because my friends, if we are giving a disclaimer of opinion, earlier also we have gone through SS 705 to an extent where we give qualified, adverse or disclaimer. My friends, when we are giving a disclaimer, we do not have sign. And when we do not have sign, we cannot use the word that financial statement have been audited. We will have to use a sentence that we were engaged to audit. We cannot write it that we have audited because we could not obtain sign. And hence, when you are saying everything is true and fair, it is very essential that you write the word that the financial statements have been audited. So you specify the date and the period covered by each financial statement comprising the financial statement. Then you write that the financial statement have been audited. Then identify the title of each statement comprising the financial statement. What do you mean by title? You will have to write balance sheet, P&L, cash flow statement. So you identify the title of each statement comprising the financial statement. So then a lot of students will ask, sir, then why have they not directly written balance sheet, P&L? Because in case if you are preparing for an NPO, then in case of an NPO, you might not have a P&L. What you might have is an income and expenditure account. In case of insurance companies, again the title may change. In case of banking company, again the title may change. So initially what you wrote is you specify the date or the period covered by each financial statement. Then you write that the financial statements have been audited. Then you identify the title of each statement comprising the financial statement. You also identify the entity whose financial statements have been audited. So you will have to write somewhere the name of the company. How will people come to know which company's audit report this is? So you also identify the entity. My friends, our opinion is not only on the financial statement, it is also on the notes. So after identifying the title, you will also refer to the notes, including the summary of significant accounting policies, because our opinion is not only on the financial statement but also on notes to accounts. So whenever we are writing auditor's opinion, we will always write that it is true and fair, and along with that we will write date notes. What do you mean by date? You will specify the date. You will write that it has been audited. You will identify the title of each financial statement. You will identify the entity whose financial statements have been audited, and you will also refer to the notes to accounts. So this was our auditor's opinion. So what we wrote initially was title, then we wrote addressee, then we wrote auditor's opinion. In auditor's opinion, what we wrote is date notes. Now, after the auditor's opinion, what we will write is basis for opinion. What do you mean by basis for opinion? On what basis we have given the above opinion that everything is true and fair? So in that, what we will write here is SIA. What do you mean by SIA? Firstly, S1 is we will state that we have conducted our audit in accordance with standards on auditing. So we need to at least inform them that we have conducted our audit in accordance with the professional standards, that is standards on auditing. So there was no flaw in applying my audit procedures. Secondly, from S, I would say that we have sufficient and appropriate audit evidence. My friends, if we do not have sufficient and appropriate audit evidence, can we end up concluding that everything is true and fair? No. So state whether the auditor believes that the audit evidence the auditor has obtained is sufficient and appropriate to provide a basis for our opinion. So I need to state that the audit evidence that I have is sufficient as well as appropriate on which I can conclude that everything is true and fair. Then I will include a statement that auditor is independent, and where relevant, I will also say that I comply with the ethical requirements. My friends, what are the ethical requirements? We have discussed the whole thing in professional ethics. We have the whole chapter of professional ethics there. So we will also say that we have complied with the ethical requirements. So firstly, what did we say? That audit was conducted in accordance with standards on auditing. Secondly, we have sufficient and appropriate audit evidence. We are independent and comply with the ethical requirements. And also, what we will say here is we will give a reference to the section of the auditor's report that describes the auditor's responsibility under the SA. So we'll give a reference to the auditor's responsibility as per the standards on auditing. Fine. So this was our basis for opinion. Once again, let us go through. Firstly, what we will write is the title, that is independent auditor's report. Then we will write the addressee, usually it is to the shareholders. Then we will write auditor's opinion, where we will state it is true and fair. Along with that, we will say date notes, that is that specify the date. Then it has been audited, title of the each statement, then entity whose financial statement have been audited, and refer to the notes including the summary of significant accounting policies. Along with that, we will give a basis for opinion. In basis for opinion, what we will say is CR. Firstly, that we have conducted our audit in accordance with standards on auditing. We have sufficient and appropriate audit evidence. Include a statement that auditor is independent and complies with the ethical requirement. We will also give a reference to the auditor's responsibility section under this particular report itself. Once we have given the basis for opinion para, we will give a going concern para. My friends, going concern we have already discussed under SA 570. If going concern is inappropriate, we will mention the same under the going concern para. Next is key audit matter. Next is key audit matter para. Now my friends, key audit matter we are going to discuss at length when we go to SA 701. But what I am doing is I am just putting an extract of the definition of key audit matter here, so you understand key audit matter, so we can move ahead with this particular topic. SA 701, that is communicating key audit matter. Now what are key audit matter? Key audit matters are those matters that in the auditor's professional judgment are most significant in the audit of financial statement of the current period. So if as per the auditor's professional judgment, they were most significant while doing the audit of the current period financial statement, and if the matters are communicated to those charged with governance. So we need to have a tick mark on two things. Firstly, it has to be most significant. Secondly, it has to be communicated to TCWG. Then the matter qualifies to be key audit matter. Now what do you mean by most significant? Let me give you an example. During March 20, auditors of Super Avenue Limited, that is DMart, the auditors said verifying inventory was a key audit matter. Why verifying inventory was a key audit matter? Because it was most significant for them. Because during March 2020, there was a nationwide lockdown going on, and hence what they had planned for physical verification of inventory was not possible. So somewhere in the month of April, they had to do it an alternative date. They could not do it during the month of March because of the nationwide lockdown. Not just that, even evaluating what is the amount of shrinkages. So they said somewhere we had inventory of 1940 crores. Now evaluating shrinkages was also difficult. What do you mean by shrinkages? Now DMart deals with FMCG products. For example, dairy products. For example, breads. All these products come with an expiry date. So breads usually don't last for more than 5 days. Dairy products likewise, they have their own expiry date. Now we went for inventory verification not in the month of March but later on, and due to nationwide lockdown a lot of goods could not be sold. Now since a lot of goods could not be sold and they have exceeded that expiry date, the NRV will become 0 and this could not be part of the inventory. So they said somewhere around 17 crores were shrinkages. But then identifying what is the shrinkages across all the branches, across all the centers was a matter of most significance. We had to apply a lot of audit procedure. So this matter can be called of most significance, and if this matter is communicated to those charged with governance, the matter will become a key audit matter. Is communicating key audit matter applicable to all the entities? No, it is applicable to listed entities. So if I am an auditor of listed entity, I must give a key audit matter. However, in other than listed companies, if I as an auditor want to voluntarily give, then I can voluntarily give a key audit matter. But if it is an audit report of a listed company, it is mandatory. We need to give a key audit matter. So this was a gist about what is a key audit matter. I hope you have understood. We are going to discuss very much further in detail in 701, but you just got a brief idea of what a key audit matter is. So here we will include the key audit matter. So I've just shown you a small extract of 701. When we go to the standard, we will discuss very much at length. So we will include once again the title. After the title, we will write the addressee. Then we will write auditor's opinion. In auditor's opinion, we will write date notes, date it has been audited, title, entity, and notes to accounts. In basis for opinion, we will write SIA. Firstly, standards on auditing. Then we have sufficient and appropriate audit evidence. We are independent and comply with the relevant ethical requirement and reference to the auditor's responsibility. Going concern para and key audit matter para. Now comes management responsibility. So management responsibility, we will say that they are supposed to prepare financial statement as per AFRF. This is their responsibility for preparing financial statement. My friends, we had already mentioned this while we were discussing precondition that financial statements are to be prepared by management. Not just that, internal control is also to be designed by management, just so that financial statements are free from material misstatement, whether due to fraud or error. So financial statements are to be prepared by management. Plus, the internal control is also to be designed, implemented, and maintained by management. Also, to assess whether the going concern is appropriate or inappropriate is the primary responsibility of the management. My friends, though we as auditors apply audit procedures for going concern, who is primarily responsible? Management, because they are supposed to make financial statement. If going concern is inappropriate, then accounting will not be done on book value, it will be done on realizable value. And hence, management is the one who makes a preliminary assessment. So, who will assess the going concern? Management. So, what we are saying is preparation of financial statement is management's responsibility. Assessing internal control, determining internal control, implementing and maintaining is responsibility of management. Assessing whether the going concern is correct or incorrect is the responsibility of the management. Where those charged with governance and management is not the same. So in a lot of scenarios, in a lot of companies, management and TCWG may be the same. I'm not talking about those companies. I'm talking about companies where there is those charged with governance. In that case, we will write a note here that those charged with governance are responsible for oversight of the financial reporting process. So that is, they will oversee the financial reporting process. If anything goes wrong with the financial reporting process, it is not just the management who will be responsible, it will also be those charged with governance who will be responsible. So this section of the auditor's report shall identify those responsible for the oversight of financial reporting process when those responsible for such oversight are different from the management. In this case, heading of this section shall also refer to those charged with governance. So this was a management responsibility. So preparing financial statement in accordance with AFRF and internal control as the management determines necessary. Then assessing the entity's ability to continue as a going concern and whether the use of going concern basis of accounting is appropriate, as well as disclosing, if applicable, matters relating to going concern. If those charged with governance is different from management, a note that those charged with governance are responsible for oversight of the financial reporting framework. Next comes auditor's responsibility. So as soon as we give management responsibility, obviously we will also have to write auditor's responsibility. So in this section, we will state that our primary objective is to obtain a reasonable assurance whether the financial statement as a whole are free from material misstatement due to fraud or error. So that is our basic objective, that we want a reasonable assurance. Once we obtain an assurance, we want to issue the auditor's report that includes the auditor's opinion. So if you go back to the objective of this particular standard was this only. We want to form an opinion and we want to express it through a written report. So we are again saying the same thing, that what we want is a reasonable assurance and we want to issue a report on the same. But here we are clarifying that reasonable assurance is a high level of assurance, but it is not an absolute assurance. It is not a guarantee. My friends, it is not a guarantee because there are inherent limitations. So can we as an auditor give absolute assurance? No. So in the auditor's responsibility para, we are just clarifying that what we have given is a reasonable assurance, is not a absolute assurance, that it is not a guarantee that audit conducted in accordance with SA will always detect a material misstatement when it exists. So there are chances that even though we have conducted our audit in accordance with standards on auditing, there may exist some error and fraud which the auditor may not be able to detect. So firstly, what we said is our objective is to obtain a reasonable assurance and express it through a return report. Then reasonable assurance is a high level of assurance and it is not a guarantee. Thirdly, we will state that misstatements can arise from fraud or error and can be considered material if individually or in aggregate they could reasonably expected to influence the economic decision of the users taken on basis of this financial state. So what we are trying to say is things may get material. Things may get material. They may be material individually or in aggregate. If they could influence the economic decision of the users. So if they can affect the influence the economic decision, then that is considered as material. Now we will discuss at length what is materiality when we go to essay 320. You already have the index list with you. We will discuss this when we are done with in 320. Also, we will have to provide a definition or description of materiality in accordance with AFRF. So, a lot of times AFRF defines what is material and what is not material. For example, as per the Schedule 3 of the Companies Act, any item which is 1% of the revenue or 10 lakhs, whichever is lower, we will have to disclose the same separately. So if the item, for example, let us say our whole turnover is 100 crores. What do you mean by 1%? Let us say 1 crore. If an item is greater than 1 crore, you will have to disclose it separately. So likewise, if any such definition or description of materiality has been given by the AFRF, you will have to define or give the description of materiality here as well. So far what we said in case of responsibility of auditor, we want to obtain a reasonable assurance that the financial statement are free from material misstatement due to fraud or error. Then issue an auditor report that includes auditor's opinion. Then we will say reasonable assurance is high level of assurance. It is not a guarantee. Thirdly, we will say misstatements can arise from fraud or error. Describe that they are considered material whether in individual or in aggregate. They could be reasonably expected to influence the economic decision of the users. Provide a definition or description of materiality in accordance with AFRF. Next, we will say what is the responsibility of the auditor. The responsibility of the auditor state that the auditor exercises professional judgment and maintains professional skepticism. Now, what is professional skepticism? That is, we will be alert throughout the audit. So, what we are trying to say here is that we will have our own judgment and also have maintained professional skepticism. This is the duty of an auditor, responsibility of an auditor. Also, what are his further duties? His further duties are nothing but RIA Go. What is RIA Go? Firstly, to identify and assess the risk of material misstatement. So that is our to identify and assess ROMMS is my responsibility and not someone else's responsibility. To evaluate and obtain the understanding of internal control system. See, until unless I do not obtain an understanding of internal control, how will I understand control risk? And if I do not understand control risk, how can I ascertain ROMMS? If I cannot ascertain ROMMS, how can I decide my NTE, that is nature, timing and extent of audit procedure? So firstly, to identify and assess ROMMS. To obtain an understanding of the internal control system. Next, to evaluate the appropriateness of the accounting policies. The accounting policies that we have used in the circumstances, whether they are appropriate or inappropriate. To conclude the appropriateness of the management's use of going concern. So see, management is responsible to assess whether the going concern is correct or incorrect. But we also have to apply our audit procedures as per SA 570 just to evaluate whether going concern is appropriate or inappropriate. Next, to evaluate the overall presentation and structure and content of the financial statements. Firstly, what we said is to identify ROMMS, then to obtain an understanding of the internal control system, to evaluate the appropriateness of the accounting policies, to conclude that the appropriateness of the management's use of going concern, and to evaluate the overall presentation and structure of the financial statements. So what we will write here is RIAGO. Also, in case of group audit, we need to describe what is the auditor's responsibility in group audit. So for example, there is a holding company, there are subsidiary, joint ventures, associate. So in case of group audit, what is the responsibility of the auditor? We need to state that as well. So this was the second point that we understood in case of responsibility of auditor. What was the first point? We want to obtain a reasonable assurance and issue a audit report. Reasonable assurance has high level of assurance, but it is not a guarantee. A statement that misstatement can arise from fraud or error and either describe that they are considered material individually or in aggregate if they could influence the economic decision, and provide the definition or description of materiality in the AFRF. Then auditor's responsibility, what is their further responsibility? State that the auditor exercises professional judgment and professional skepticism. Describe the audit by stating the auditor's responsibility are RIAGO. Firstly, what is R? To identify and assess ROMMS, to obtain an understanding of the internal control system, to evaluate the appropriateness of accounting policies, to conclude the appropriateness of the management's use of going concern, to evaluate the overall presentation and structure of the financial statement. Next, describe the auditor's responsibility in group audit. So this was auditor's responsibility. Third point, auditor's responsibility for the audit of the financial statement shall also discuss what? So in this part, we are discussing what all we need to communicate to those charged with governance. So firstly, the auditor will have to communicate with those charged with governance the plan, scope and timing of audit. Also, the significant findings of the audit and significant deficiencies in the internal control that the auditor identifies. So we will communicate with those charged with governance three things. Firstly, the plan, scope and timing of audit, significant findings of the audit and significant deficiencies in the internal control. Also, if we are talking about a listed company, we need to communicate with those charged with governance that we comply with the ethical requirements regarding the independence. So ethical requirements we have again discussed in our professional ethics. So for audit of financial statement of listed entity, state that the auditor provides those charged with governance a statement that auditor has complied with the relevant ethical requirements regarding independence and communicate with them all relationship and other matters that may reasonably be thought to bear on the auditor's independence and where applicable related safeguards. Thirdly, for audit of financial statement again of listed entity, we will also have to give a key audit matter. What is key audit matter? We have already understood in CARO, but in detail we will discuss when we go to key audit matter. So for a financial statement of listed entity, any other entities for which the key audit matters are communicated in accordance with 701, state that the matters communicated with those charged with governance, the auditor determines those matters were of most significance in the audit of financial statement of the current period and therefore the key audit matter. The auditor describes these matters in the auditor's report unless law and regulation precludes public disclosure. So we'll discuss this at length when we go to 701. With this, we are done with the auditor's responsibility. So once again, initially what we will give is title, then we will give addressee, then auditor's opinion, we will state it is true and fair, then we will write date, notes. What is D? Date. A is audited, T is title, E is entity and N is notes. Basis for opinion, we will write CR, that we have done our audit as per standards on auditing. We have sufficient and appropriate audit evidence. We are independent and complying with the ethical requirements and auditor's responsibility reference. Then we will give a going concern para, then we will give a key audit matter. Management responsibility will say financial statement plus internal control is the responsibility of management. Whether going concern is appropriate, assessing that is also the responsibility of management, and where those charged with governance is different, they will keep an oversight over the financial reporting process. In case of auditor's responsibility, we said we want to give a reasonable assurance through a written report. Then we said reasonable assurance is a high level of assurance, but it is not a guarantee. Then we gave a description about materiality and things like that. Second point, We said we will keep professional judgment and professional skepticism. Then we will do RIA Go. R is nothing but ROMMS, I is internal controls, A is accounting policies, going concern and oral presentation and structure, and group audit. In case of those shared with governance, we'll communicate with them the plan, scope and timing, significant findings of audit, significant deficiencies in internal control. If we are listed entity, we will communicate them now we are independent and comply with the ethical requirement. If we are listed, we will also communicate with them the key audit matter. So these are the things that we have discussed so far. Moving ahead with our report, we will give other reporting responsibilities. So if the auditor addresses other reporting responsibilities in the auditor's report on the financial statement that are in addition to the auditor's responsibility under the SA, these are the other reporting responsibility shall be addressed in a separate section in the auditor's report with the heading report on other legal and regulatory requirement. So my friends, if any law's requirement is greater than SA 700 requirement, we will fulfill that requirement by reporting under the paragraph report on other legal and regulatory requirement. My friends, the best example for you here is 143.3. So we have discussed a few matters to be reported under 143.3 of the Companies Act. There are a lot of matters under 143.3 which are not mentioned here under SA 700. So we will report upon those matters under this particular header. So only for the reference of the students who have not bought the full course, I am attaching 143.3 here once again. So all those students who have bought the full course, please do not see this here. We will cover this at length again when we go to Companies Act. So please do not view this. I am attaching this only because a lot of students buys only standards and auditing, only a few chapters. So if they have bought standards and not bought company audit, then in that case it will be helpful for them. So all the students who have already bought the whole course, please view this in the company audit. So I am just attaching 143.3 where I'll discuss which are the reporting requirement as per 143.3 which are in addition to SA 700. So moving ahead with 143.3, duty to report upon a certain matters. My friends, here we are talking about report upon certain matters. My friends, here previous section 143.1, I was highlighting inquire upon a certain matters. Here I am saying report. So here whether you are satisfied or you are not satisfied, you are going to report upon these matters. Do you understand the difference between the two? If you have still not understood the difference between the two, please go back to the video recording of the previous video and see it, because a question has been asked on this. I'm not just highlighting for my sake. The question has been asked on this minute point. On that 143.1, we are just supposed to inquire. If the auditor is satisfied, he is not supposed to report. But 143.3, whether he is satisfied or not satisfied, he is supposed to report upon this matters. On which matters he is supposed to report? He is supposed to report on A, B, C, D, E, F, O. A, B, C, D, E, F, O. Public will say this professor is teaching us as English, but he does not know A, B, C, D as well. But yes, in this answer, we are going to say A, B, C, D, E, F, O. Firstly, from A, all the information and explanation which to the best of his knowledge and belief were necessary. So whatever he thinks that is necessary, on all of those information he will have to report. B, whether the proper books of accounts as required by law have been kept. So whether the books of accounts are appropriate or not. C, whether the balance sheet and the P&L, are in conformation with the books of accounts kept above. So the balance sheet and P&L should match with the books of accounts. If they are not matching, obviously this will be a misstatement. So firstly, we need to see all the information which are necessary as per his knowledge. B, proper books of accounts have been kept. C, the balance sheet and the P&L are in conformation with those books of accounts. D, whether the accounting has been done, financial statement has been done as per the accounting standard. So whether it has been done as per AS or not. Then E, eligibility, whether any director has been disqualified from being appointed as a director under section 164.2. So we need to see whether you are qualified or disqualified. So when we were talking about auditors, we were talking about eligibility, disqualification under section 141.1, 2 and 3. Here we are supposed to see whether the director is qualified or disqualified, and that we will see under section 164.2. So here as an auditor, we are just supposed to see whether the director appointed is eligible, that is whether he is qualified or not. Then we need to see whether the adequate internal financial controls with reference to the financial statement have been kept or not. So here all we need to see is whether the internal controls, whichever are required internal controls, have been kept or not. However, reporting of internal financial control, however, the reporting of internal financial control is not applicable if you are a private company. If you are a private company, and being a private company, you are a one-person company or a small company. So if you are a one-person company and small company, then in that case, auditor need not report upon the internal financial controls. Or else if you are a private company and if your turnover is less than 50 crores and your borrowings is less than 25 crores. Once again, your turnover is less than 50 crores and your borrowing is less than 25 crores. This is a and condition, my friends. This is a and condition. Both has to be satisfied. So if your turnover, let us say, is 45 crores, however your borrowing is a 30 crores, still this shall apply. So if there is a company, private company, which has a turnover of less than 50 crores, as per the latest audited financial statement, which has aggregate borrowings from banks or financial institution or any body corporate at any point of time. At any point of time. So when we talk about turnover, we see on the balance sheet date. However, when we check borrowings, we check at any point of time. So for example, during the year, my borrowings was 35 crores. However, out of 35 crores, I ended up repaying 11 crores. So as on the balance sheet date, my borrowings is only 24 crores. Still, this clause will apply to me because during the year, my borrowings was over and above 25 crores. So for borrowings, we need to check at any point of time during the year, not only on the balance sheet date. Moving ahead to the other matters to be included. Please mark this as important because there are a lot of small amendments here. Other matters. What are the other matters to be included? Now let us say, for example, if we have a shipping company and now the shipping company is spilling a lot of oil. The shipping company is spilling a lot of oil in the ocean and we have a liability against the same. Someone has filed a lawsuit against us claiming that we are spilling oil and we need to pay environmental liabilities. We need to pay the site cleanup cost. Now, whether the company has disclosed the impact, if any, of the pending litigations on the financial position. So if we have any pending litigation, whether the company has shown the same as a contingent liability. So whenever we have a litigation going on, we need to disclose what is going to be the probable financial impact or in a contingent liability as a disclosure. Now if, for example, let us say we had a penalty of 10 crores. We are also aware that we had spilled the oil and we are aware that we will have to probably pay a penalty of 7 crores. But however, we are not sure if we will have to pay a penalty of 10 crores. Then in that case, AS4 and AS29, as you have already learned in your inter, asks us to make a provision of 7 crore in the books of accounts because it is quite probable than not that there will be an outflow of 7 crore rupees. Then in that case, we need to see whether a provision has been made. Whether the company has made a provision as required under any law or AS for material foreseeable losses. So whether we have made any such provision for the material foreseeable losses or not. So firstly we said if there is any pending litigation, we need to show it as a disclosure, as a contingent liability. Then in point number B, we are supposed to report whether the provision is required by any AS or law. So when we say AS, it is nothing but 29 and AS4. Any provision has been made or not. Thirdly, whether there is any delay in transferring the amounts required to be transferred to the Investor Education Protection Fund. For example, we declare dividend. However, a lot of shareholders, we could not trace them because they changed their location, they changed their address, somewhere we do not have their bank account, so we could not pay them their dividend. So in Companies Act, in your inter, you have already learned if we could not pay the dividend, we will transfer that to a separate account. For how many years? 7 years. If no shareholder, if no investor comes ahead to take their money in this 7 years, we need to put this amount in a fund. The fund is called as Investor Education Protection Fund. Here all we are supposed to report is whether there was any delay in transferring the amounts required to be transferred to the Investor Education Protection Fund. So these are the other matters. Firstly, whether a contingent liability, that is pending litigation, has been disclosed. If any provision was to be made, whether the provision has been made. Whether there is any delay in transferring the amount to the Investor Education Protection Fund. Now we have a new point altogether here. So do not get scared by the length and breadth of this particular point. Let us read it. Whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no fund has been advanced, loaned or invested either from borrowed fund or a share premium or any other sources. So what they are trying to say is, apart from the loans advances that we have already disclosed, apart from the loans and advances that we have already disclosed, we have not made any loans, we have not advanced any money, we have not invested any money. Whatever be the source of money, whether that is from borrowed funds, whether it is from share premium, whatever may be the source of money, but all the loans, advances and investment have been appropriately disclosed by the company to a person or any other person or entities, including foreign entities, with the understanding, whether recorded in writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in any other person or entities identified in any manner whatsoever by on behalf of the company ultimate beneficiary, or provide any guarantee, security or like to on behalf of ultimate beneficiary. So what they are trying to say is, for example, I have given a loan to Mr. X. However, I did not want to show Mr. X in my books of accounts, probably he is my related party, or I did not want to show it to people that I have given to X. So what I did was, I gave the money to Mr. Y. And I told Mr. Y to give the same amount to Mr. X. So in this case, who is the ultimate beneficiary? Mr. X. Then in my books of accounts, I should not only disclose Y's name, I shall also disclose Mr. X's name. Because directly or indirectly, who is benefiting from this transaction? Mr. X. Mr. X is nothing but the ultimate beneficiary. So in this case, I will also have to disclose Mr. X's name in my books of accounts. When we go to the other point, it is exactly opposite. See, in point number 1, we said all the loans, advances and investment that we have disclosed, those are the only loans and advances. Apart from that, there are no other loans, advances and disclosure investments. Here what we are saying is, all the money that we have received, we have disclosed. Apart from that, the money that we have received, apart from what we have disclosed, there is no other money that we have received. So whether the management has represented to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no fund had been received by the company from person or entities, including foreign entities. So likewise, this time what happened is, Mr. X, I took a money from Mr. X as a loan. But however, I did not want to show that I took money from Mr. X. So I told Mr. X to give it to Mr. Y. And then I took the money from Mr. Y. So again, ultimate beneficiary will be Mr. X. So I will have to show that I have borrowed the money from Mr. X here. Sub point 3 is saying that I will perform my audit procedures. And based on my audit procedures, I give a reasonable assurance that everything that is stated in clause 1 above and clause 2. Clause 1 was what? That all the loans, advances and investment have been disclosed, and all the loans that we have taken has also been disclosed. So after applying my audit procedures, I am giving a reasonable assurance that everything in clause 1 and clause 2 is correct. There are no misstatement. There are no material misstatement in clause 1 and clause 2. Moving ahead with the next point. Whether the dividend declared or paid during the year by the company is in compliance with section 123. Section 123, my friends, is nothing but in your company law syllabus. So here we are not supposed to do anything else. All we are supposed to do is, we are just supposed to write there whether they have complied with section 123 or not, when they have declared or whether they have paid dividend. Next, this point is little interesting. Whether the company in respect of financial years commencing on 1/4/2022. So somewhere this point has not yet started. It is starting from 1st of April 22. So this financial year, this is going to be applicable. whether the company has used a accounting software. So what they are trying to say is whether do we have an accounting software for maintaining our books of accounts, which is a feature of audit trail. So do they have a feature of audit trail? Now what do you mean by audit trail? In audit trail, what you get is edit log facility. So who has changed an entry? On what date it was changed? Who had the power to change that? So we get the whole of logs. So what happens is in continuous audit or concurrent audit, for example, when I go in the month of January, I will check the transactions of December. When I go in the month of February, I'll check the transactions of January. When I go in the month of February, again January, then March, I will check February. April, I'll check March. So what happens is when I'm going in the month of April, I'm checking the transactions of March. I will not recheck the transaction of January, which I already done. Now there is a chance that entity management may commit a backdated fraud. They might go again in the books of accounts of January and change an entry there which I have already audited. So somewhere a lot of times company come up with a software which has an audit trail. So if someone has changed an entry in the month of January, you will get a log. For example, who from whose access, which person has changed it, which entry has been changed, which date it has been changed, what has been the change in the amount. So for us as auditor, it gets very easy to know whether any backdated fraud has been done. So here we need to see do we have an accounting software which has a feature of audit trail. If it has a feature of audit trail, whether the same was operating throughout the period. We need to check whether it was operating throughout the period. So we had that software, we had that feature, but we had never used that feature. So we need to check whether it has been operating throughout the period. Secondly, we need to check there has been no tampering with the audit trail. Secondly, we need to check whether there is no tampering. Why tampering? Or else what would happen is someone would change the entry and they would delete the whole of audit logs. So somewhere if there is a tampering done, then we would have no evidence at a later stage. And whether the audit trail has been preserved, whether the audit trail has been preserved, whether we are retaining it for the record retention. So as long as you keep your books of accounts for the same period of time, you also need to retain this audit trail, because if at times if after 2 years we come to know about a fraud in the previous year, this audit trail may again help us. So what we are supposed to see is, firstly, do we have an accounting software which has a feature of audit trail, whether it was operating throughout the period, whether there is any tampering done with the same, and are we still retaining the records for the same. So this was a discussion about 143.3. Now if you minutely observe, we started in other matters from point A, B, C. After C, I started discussing E. So a lot of students might think, sir, D has been skipped or your numbering is incorrect. No, my friends. Point number D has been omitted. What was point number D? Whether the company had provided any requisite disclosure in the financial statement as to the holdings as well as dealings in the specified banknotes during the period 8th November to 30th of December. So whether we have given any such specified banknotes. What was this specified banknote? What was 8th November to 30th December 2016? While my friend Pradhan Mantri ji Modi ji came on a TV on 8th of November at 8 p.m. and he said you cannot use your 500 and 1000 rupees note. It will be worthless. All you can do is play Monopoly with it. So at that point of time, we were supposed to report how many old notes have we deposited and how many new currency notes we have obtained. But now those disclosures, those reporting is not at all required, and hence a D is omitted, and hence we go to clause E. So this was a discussion about 143.3, that is duty to report upon certain matters. So this was 143.3. So requirement of 143.3, where they are in addition to SC 700, we can write it here. 143.3 was just an example. There can be any law and regulation which requires additional reporting. We'll report the same under this para. Let's take signature. So whenever you do a signature, signature is always in his personal name. Even if there is a partnership firm, you will sign in the personal name and name the partnership firm there beneath. You will also have to write the membership number of the institute. Not just then, you will also have to write the UDIN number. So these days there is also a requirement of UDIN number. Whenever you upload a report, you will have to apply the UDIN number as well. So once again, it will be in the person name. It will sign in the person name and in the name of the audit firm, membership number, and what else we have to give is a UDIN number. Next is place of the auditor's report. For example, let us say client's head office is in Delhi, auditor's head office is in Mumbai. The report is signed in Gujarat. My friends, what will be their place specified in the report? We will specify Gujarat. So we need to see where the report is signed. It does not concern us where the client's head office is, where the auditor's head office is. We will write the name where this report is signed. And lastly, the date. The date shall not be earlier than the date on which sufficient and appropriate evidence has been obtained. So once we have obtained all the sufficient and appropriate evidence, only then we can issue a report. Before that, we cannot issue the report. With this, we are finally done with our format of SA 700. Finally, the format of SA 700 goes something like this. I hope everyone remembers this now. Firstly, what we will write is title, that is independent auditor's report. Then we will write addressee. Then we will write auditor's opinion. In auditor's opinion, we will write true and fair. Then we will write date notes, that the date it has been audited, title, entity, and refer to the notes to accounts. Then we will write basis for opinion. Then we will write SIA. Firstly, we have conducted an audit in accordance with standards on auditing. We have sufficient and appropriate audit evidence. We are independent and comply with the ethical requirement, and also refer to the auditor's responsibility that prescribes auditor's responsibility. Then we will write about the going concern. Then we will write about key audit matter. Management responsibility, we will state that preparing financial statement is responsibility of the auditor. Also, the internal control is responsibility of the auditor. Then assess the entity's ability to continue as a going concern. Lastly, those charged with governance. This section of the auditor's report shall identify those responsible for oversight of the financial reporting process. So if there is those charged with governance, we will give this note as well. In auditor's responsibility, say we want to obtain a reasonable assurance and issue a written report. Reasonable assurance is a high level of assurance, but it is not a guarantee. Next, we will say things may be material individually or in aggregate if they could influence the economic decision of the users. If there is a definition or description of materiality given, we will provide the same as well. Then auditor's responsibility section should state that we will have professional judgment and professional skepticism. Then RIAGO, that identify ROMMS, internal control, accounting policies, conclude the use of going concern, overall presentation and structure. Describe the responsibility in case of group audit. Fine. Then in case of those charged with governance, we will communicate with them the plan, scope and timing, significant findings, significant deficiency in the internal control. If it is a listed entity, we will say we comply with the ethical requirements and also we are independent. In case of listed entity, we will also give a key audit matter. Then report on other legal and regulatory requirement. If the requirement of law is in addition to SA 700, we will report the same under this particular para. Then we will give a signature. Signature will bring the personal name. There is a partnership form, then the personal name along with the name of the audit firm. We also have to give the membership number and the UDIN number. Then place of the report will be where the report is signed, and date should not be earlier than the date on which SI has been obtained. So this was the format of SA 700. Now there is one more important point here is a lot of times there are international standards on auditing. So an auditor may be required to conduct an audit in addition to SA issued by ICI, that is International Standards on Auditing or Standards on Auditing by any other jurisdiction. If this is the case, the auditor's report may refer to the standards on auditing in addition to international standards on auditing, but the auditor shall do so only if there is no conflict between ISA or such standard on auditing of the other jurisdiction and those essay that would lead the auditor to form different opinion. So can I use international standards on auditing? Yes. But if I use international standards on auditing and if I use Indian standards on auditing, if the opinion is going to be different, I cannot use it. Not to include, if international standard on auditing does not let me include emphasis of matter paragraph or other matter paragraph, still I cannot use the same. So in two circumstances, I cannot use international standards on auditing. If the opinion is going to be different, let us say opinion is not going to be different, but international standard precludes me from giving an emphasis of matter or other matter. Both these points we are going to discuss in SE 706, what is emphasis and what is other matter paragraph. Next, the report includes at a minimum each element above when the auditor issues layout or wording specified by standards on auditing. So even if I use international standards on auditing, all the elements that I have discussed in SS 700, that is title, addressee, auditor's opinion, basis for opinion, going concern para, key audit matter para, management responsibility, auditor's responsibility, report on other legal and regulatory requirements, signature, place and date. So these are the basic element, minimum element which should be part of my report. So even if I follow international standards on auditing, it is completely okay, but none of the elements here should be omitted. So this is what if I use international standards on auditing. With this, we are finally done with our discussion of SA 700, that is the report of everything is true and fair. Once we go through SA 705, 706, what I will do is I will make you go through the reports of HDFC, demand, and so you can observe how the reports are written and you can understand everything that they have written in the report. So we'll go through the actual real life companies as well and gain some more knowledge out of it. With this, I finally put an end to my discussion of SA 700. So let us understand SA 705, that is modifications to the opinion in the independent auditor's report. The standard is important not because they will ask independent questions based on 705, but 705 will be used in conjunction with a lot of standards. For example, when you go to SA 500, we obtain an evidence or you cannot obtain an evidence, we will have to report as per SA 705. So 705 will be seen in a lot of other standards as well. So what is 705? So before we understand 705, let us understand there are two types of report. One is unmodified report and second is modified report. Unmodified report is where we say everything is true and fair. This format is governed under SA 700. For unmodified report, the format has been given under SA 700. When we talk about modified, there are two types. Modified without modifying the opinion or modified by modifying the opinion. So here the opinion still remains everything is true and fair. Then what do you mean by modified without modifying the opinion? My opinion is true and fair, but however the format that I have used above changes. I will not use the format as given under SA 700. My format will change. Hence we say modified without modifying the opinion. So we have two options. We can either give an emphasis of matter paragraph or we can give an other matter paragraph. So this particular point will be covered in next standard, that is SA 706. So 706 talks about emphasis of matter paragraph as well as other matter paragraph. Modified by modifying the opinion. So here we are modifying the opinion. Here we are not saying everything is true and fair. SA 705 deals only with this situation. If we give an unmodified opinion, we will go to SA 700. If we modify without modifying the opinion, we will go to SA 706. But if we are modifying by modifying the opinion, we will come to SA 705. So modified by modifying the opinion. Here, there are two scenarios. Either the auditor has sufficient and appropriate evidence that a material misstatement exists, or the auditor is unable to obtain sufficient and appropriate evidence that financial statements are free from material misstatement. That is, either we have evidence or either we do not have evidence. If we have evidence, matter may be material and pervasive or matter may be material but not pervasive. What is material? We will discuss what is materiality when we go to SA 320. But in simple words, what is material? Anything which affects the user's decision. Anything affects user's financial decision will be considered as material. But what do you mean by pervasive? So there are three scenarios where it can be considered as pervasive. See, if we understand the English meaning, the dictionary meaning of pervasive, pervasive means present everywhere. For example, the air is pervasive. So in auditing, in three different scenarios, it will be called as pervasive. One, when it does not affect one single account, but it affects multiple accounts. The effect is not confined to one single element or component of the financial statement. It affects multiple accounts, multiple components and elements of the financial statement. For example, we have sufficient and appropriate audit evidence that going concern is inappropriate. My friends, going concern is one of the fundamental assumption. If going concern is inappropriate, then accounting will be done on realizable value and not on book value. I hope everyone is aware of this basic concept. We will use realizable value and not book value. Now let us say the company has not amended their financial statement. The company is still making their books of accounts on the basis of book value. So we have sufficient and appropriate evidence that a material misstatement exists. Yes, the matter is material. It is also pervasive because it is not affecting one single account, not one single element. It is affecting n number of components, n number of elements and n number of accounts. So matter is material and pervasive. So when we have sufficient and appropriate audit evidence that a material misstatement exists and the matter is material and pervasive, we will give an adverse opinion. Which opinion will we give? Adverse opinion. However, if the matter may be material but not pervasive. Let's take one more example. Let us say we were auditing Vivo. Vivo spent very heavily during the year of 21 in advertisements. Let us say they spend up almost 400 crores in the name of advertisement. They gave IPL sponsorship and then they realized we could not afford and a lot many other advertisements. So this 400 crores that they spent into the advertisement, they debited the whole advertisement of 400 crores in one single year. My friends, this should not be treated as an expenditure of one single year. It should have been treated as a deferred revenue expenditure. Let us say if we are deferring over for a period of 5 years, 80 crores should have been debited to the PNL, 320 crores should have gone to deferred revenue expenditure. But what they did was they debited the whole of 400 crores in one single year itself. Is the matter material? Definitely this will affect the user's financial decision. Is the matter pervasive? This time the matter is not pervasive because it is not affecting multiple accounts, elements and component. It is affecting only and only advertisement. So in this case, what we will say is, except for the effect of 320 crores, except for the effect of 320 crores in advertisement, everything else is true and fair. So this 320 crores is misstated. However, everything else is true and fair. So this type of opinion is called as qualified opinion. So when the auditor has sufficient and appropriate evidence, but the matter is material but not pervasive, we will give a qualified. So if we have psi, matter is material and pervasive, we will say adverse opinion, everything is not true and fair. Here we are, so in case of adverse, we would say everything is not true and fair. But when the matter is material but not pervasive, we would say except for the effects of everything else is true and fair, which is called as qualified opinion. Now let us say if the auditor is unable to obtain psi. If the auditor is unable to obtain psi, then there are two scenarios. The matter is material but not pervasive, or the matter is material and pervasive. So now everyone knows what is material. Let us again understand what is pervasive. So I said pervasive could be in three scenarios. One example I already gave you, where it does not affect one single element, it affects multiple accounts and elements. Second, it affects one single component, but the effect is so substantial, the proportion of the effect is so substantial that it will be considered pervasive. Let me give you an example. Let us say we have a stock in Afghanistan. The total assets of the company is 100 crores. The stock in Afghanistan is itself 90 crores. Now, there is a war situation going on in Afghanistan. Can we travel from India to Afghanistan just to evaluate that 90 crore ka inventory? My friends, this is Rohit Shroff. Am I Tiger Shroff? Can I go to Afghanistan to evaluate the inventory? No, we will not be able to obtain psi. The auditor is unable to obtain psi. So here it is affecting one single account, that is stock, but the proportion is very substantial. It is almost 90% of my total assets. So though it affects only one single element, since the proportion is very substantial, again I would say it is material. So if the auditor is unable to obtain psi and the matter is material and pervasive, I will give a disclaimer of opinion. What do you mean by disclaimer of opinion? I am not giving any opinion, nor am I saying everything is true and fair, nor am I saying everything is not true and fair. I would not say, I am being a Gandhiji's third monkey. I would not say everything is true and fair. I would not say everything is not true and fair. I am disclaiming my opinion, that is, I am keeping my opinion with myself. I would not give anything. So if the auditor is unable to obtain psi, matter is material and pervasive, I will give a disclaimer. But what if the matter is material but not pervasive? Let's take the fourth and the final example. Let us say we are auditing HDFC. If you all are aware, HDFC has almost 5,608 branches. Let us say out of 5,608 branches, we did not have records of 8 branches. Let us say we had this 8 branches somewhere in Kerala. We faced flush scenarios and all the records, all the hard disk and everything got corrupted. We could not retain any documents. Matter is material, my friends. But this cannot be called as pervasive, because out of 5,608 branches, 8 branches data I do not have. So I do not have psi. I cannot say whether the financial statements of that 8 branches are true and fair, nor can I say financial statements of those 8 branches are not true and fair. So in that case, what I will say is, except for the effects of those 8 branches, everything else is true and fair. This time I would not say those 8 branches are also wrong. I would say for those 8 branches, I do not express an opinion. See, if those 8 branches would have been very substantial, if out of those 8 branches, one was the head office, if the proportion was very much substantial, then it would have been pervasive. But if it is not very substantial, if the proportion is not very high, then the matter is material but it is not pervasive. In that case, we will again give a qualified opinion, where we will say that we cannot express our opinion on those 8 branches since we do not have psi, but for the other 5,600 branches, everything else is true and fair. So to conclude, if the auditor has psi, if the matter is material and pervasive, we will give an adverse opinion. If the matter is material but not pervasive, we will give a qualified opinion. Again, if the auditor does not have psi, if the matter is material and pervasive, we will give a disclaimer. If the matter is material but not pervasive, we will give a qualified opinion. So I told you the matter will be considered pervasive in 3 cases. I have already explained you 2 cases. What was the first one? Not confined to specific elements, accounts or items of financial statement, that is, affects multiple elements, accounts and items. Second, if so confined that it is affecting one single element, account or item, but represents or could represent substantial proportion of the financial statement. So it may affect only one single element, but the proportion is very, very high. Lastly, third point, in relation to the disclosures, are fundamental to the user's understanding of financial statement. So if a disclosure which requires to be disclosed in the financial statement is not disclosed, and it is very fundamental to the user's understanding. For example, going concern is inappropriate. Okay, we will restate everything from book value to realizable value, but we also need to give a disclosure for the same. Or else how will the user understand whether this is a realizable value or book value? And hence a disclosure is must here. But the management did not provide this disclosure. Now this is very fundamental to the user's understanding. User might end up investing money in that company which is not going to continue for foreseeable future. So if there is a disclosure which is again very fundamental to the user's understanding, and if that disclosure has been omitted, this will also be called as pervasive. So matters can be material and pervasive in 3 scenarios: when it does not affect one single element, affects multiple elements, it is confined to one element but it is very substantial proportion, or if there is an omission of a disclosure which is fundamental to the user's understanding. I hope everyone understood what are the different types of opinion. Now there is one important note which we will be able to understand when we go to essay 701. What they are trying to say is, if I disclaim my opinion, then I cannot give a key audit matter. Now why not? Obviously we'll understand when we are done with 701. So I've written this note. Once when you are done with 701, we will again revisit the note and discuss about the same. So now what we are doing is, I will just ask you the questions, though you are sitting at comfort of your home and we are not live. I would request if you could write your answers in some notebook and see whether you have given me the correct answers. Super Duper Limited is a company engaged in manufacture of office furniture. Messrs. Young, Old and Associate are the statutory auditors of the company for the financial year 2021. During the year under audit, the engagement company has not bifurcated its loan into long-term and a short-term. CA Young understands that such misstatement is not pervasive, though the same is material. Explain the type of opinion. My friends, in this case, do we have psi? Yes, we do have psi. The matter is material but not pervasive. They have very clearly stated. Then what is the type of opinion that we can give here? Qualified opinion. I hope everyone could give me the correct answer. Next, Messrs. Taj, Raj and Associate are the statutory auditors of Polex Limited, engaged in the manufacturing of premium watches for the financial year 2021. During the course of audit, CA Taj, the engagement partner, found that stocks and debtors of the company, constituting about 80% of the total assets of the company, are not realizable. Further, the cashier of the company has committed fraud during the year under audit. Both the facts are not reflected in the financial statement during 31st March 21. Accordingly, CA Taj is of the view that impact of both the situation on the financial statement is material and pervasive, and thus the financial statement present a distorted view of the state of affairs. Explain which type of report. Again, my friends, do we have psi? Yes, we have. Matter is material and they are saying it is also pervasive. Then without any thought, we know what the answer is going to be: adverse opinion. Lastly, Delightful Limited is a company engaged in the production of smiley balls. During the financial year 2021, the company transferred its account to the computerized system SAP from manual system of accounts. Since the employees of the company were not well versed with the SAP system, there were many errors in the accounting during the transition period. As such, the statutory auditors were not able to extract correct data and reports from the system. Such data was not available now manually also. Further, the employees and the management were not supportive in providing the requisite information to the audit team. Explain the kind of report the auditor of the company should issue. My friends, this is the case where we do not have psi, because electronic records we are not able to extract, manually also not available, and they were not supportive in providing the requisite information. So here there is no psi. My friends, matter is material and pervasive because it is not affecting one single element, it is affecting all the elements, because I have no sufficient and appropriate evidence even on a single element or account. Hence, in this case, we will end up giving a disclaimer of opinion. So here they will not ask you short notes, they will give you such case studies and they will ask you 2-mark MCQ. The main important part about this particular standard is that this will be used in conjunction with a lot of standards. For example, SA 500 series, 505, a lot of cases we will be discussing that we will have to modify the opinion SA 705, and hence you should be aware of this particular concept. So this was a discussion about SA 505, that is modifications to the auditor's opinion. So moving ahead with SA 706, that is emphasis of matter para and other matter para in the independent auditor's report. So a lot of places we have already understood what is emphasis of matter and other matter paragraph. So this is nothing objective and meaning. So you cannot call this as only objective, this is objective as well as meaning. So what is the objective here? The objective of the auditor having formed an opinion is to draw users' attention when in the auditor's judgment it is necessary to do so by way of clear communication, by way of a clear additional communication in the auditor's report. So we want to just draw users' attention here. There are two different cases. One is a matter, although appropriately presented or disclosed in the financial statement, is of such importance that it is fundamental to the user's understanding of financial statement. This is nothing but emphasis of matter paragraph. So matter appropriately presented, a matter appropriately disclosed in the financial statement. So it has been appropriately presented, it has been appropriately disclosed. is of such importance that it is fundamental to the user's understanding of the financial statement. For example, let us say there is some problem about the going concern. Management has accounted everything from book value to realizable value. So they have appropriately presented. They have also disclosed that the going concern is inappropriate. But the matter is of so high importance that it is fundamental to the user's understanding. So it is correctly presented, it is correctly disclosed, but I just want to draw users' attention to this particular matter, and hence I again write this in the emphasis of matter paragraph. Secondly, as appropriate, any other matter that is relevant to the auditor's understanding of audit, auditor's responsibility and auditor's report. So whenever it concerns ARR, that is audit, auditor's responsibility and auditor's report, we will mention the same under other matter paragraph. So this is basically nothing but a definition of emphasis of matter and other matter para. Now moving ahead to a discussion of emphasis of matter. So what we will do say here is, where are we going to include this? We are going to include this after the basis for opinion para. So firstly what we will write is title, then we write addressee, then we write auditor's opinion, then we write basis for opinion. So here we are going to include emphasis of matter paragraph before we include a going concern para. What will be the header of this particular para? Obviously emphasis of matter para or other appropriate heading. So here though we write other appropriate heading, but we will always stick to emphasis of matter paragraph. We will also give a clear reference to the matter being emphasized. For example, in a note number 3, they have mentioned that going concern is inappropriate. I want to highlight note number 3. I want to highlight a note number 3. In that case, I will give a clear reference in emphasis of matter paragraph that I am talking about note 3. So, users will be in a good position to go and read out what exactly I am trying to say. If I leave it on to them that I am highlighting a matter, but which matter they do not know, they will have to play scout and guide in the whole financial statement and audit report, and hence I am giving a clear reference to the matter being emphasized. So, where will I include this paragraph? After the opinion para. What will be the header? Emphasis of matter paragraph or other appropriate heading. Include in the para a clear reference to the matter being emphasized. Also indicate that the auditor's opinion is not modified in respect of the matter being emphasized. So I will give a clear indication that though I am giving an emphasis of matter paragraph, my opinion is not modified here. My opinion still stands to be true and fair. I just want to highlight this, I just want to draw users' attention to this, and hence I am giving an emphasis of matter para. See, as a chartered accountant, me as a CA final students, you are aware that in case of emphasis of matter para, we are not modifying the opinion. But when user reads an emphasis of matter paragraph, probably he may misunderstand it, and hence just to avoid, mitigate that particular misunderstanding, we are clearly indicating that our opinion is not modified in respect of the matter being emphasized. So we mentioned 4 points here. Firstly, we will include it after the basis for opinion para. We will use the heading emphasis of matter or any other appropriate heading. We will give a clear reference to the matter being emphasized. Indicate that the auditor's opinion is not modified in respect of the matters emphasized. Which are the few examples where we can include emphasis of matter paragraph? So this is just an illustrative list. This is not an exhaustive list. These are not the only examples where we can use emphasis. You can use at n number of places. So this is just an illustrative list. So where can you use? Where there is a substantial doubt about the entity's ability to continue as a going concern. So when there is a substantial doubt, we can mention the same in the emphasis of matter paragraph, provided the management has also disclosed. See, if management has not disclosed that there is a substantial doubt, then we may have to modify the opinion. I am not saying that we are going to modify the opinion. I am saying they have already disclosed the fact. I just want to highlight it, then I will mention the same under the going concern para and also under the emphasis of matter para. Then there is an early adoption of an accounting standard that has a pervasive effect on the financial statement. For example, let us say, for instance, let us say in India, in accounting standard, we still do the book value. We follow book value. But in IFRS, we usually follow fair value. So let us say India came up with an accounting standard which is applicable for 1/4/23. I'm giving you an hypothetical example. So from 1/4/23 we came up with a standard. Now here the accounting is going to be done on fair value. The accounting is to be done on fair value and not on book value. But however, our company started applying that particular standard this year itself. That is for 1/4/2022. We started applying that particular standard. So there is an early application of the new accounting standard. Now this new accounting standard has a pervasive effect. This new accounting standard has a pervasive effect because we are not going to follow book value, we are going to follow fair value. Now our financial statement may not be comparable with the financial statement of other companies because they are not going to use this particular accounting standard this year. They are going to apply this accounting standard in the next year. Now I just want to draw users' attention here. There is nothing wrong here. See, we were allowed to have an early application and we applied it. So I just want to draw users' attention that we have changed our accounting from book value to fair value because there is a new accounting standard which requires the same, and there is a pervasive effect, and you cannot compare our accounts with some other company's account. I can mention the same in the emphasis of matter paragraph. Next, there has been a material change and a change between the accounting principles or in the methods of their application. So for example, let us say there were two companies where there was a merger. Let us say Future Group and Reliance Retail were having a merger. Now Future Group follows WDV and Reliance Retail follows SLN. Now in case of Future Group, they will have to change their accounting policies from WDV to SLM just so that merger with Reliance Retail is easier. Future Group was following FIFO basis, whereas Reliance Retail was following weighted average. The Future Group will have to come down to weighted average just so that merger gets easier. So in this particular year, the Future Group has changed a lot of accounting principles and policies. There is nothing wrong here, but we just want to highlight it to the users that there has been a material change. So when there has been a material change in between the periods in accounting principles or in methods of their application, we can highlight the same here. Next, there is an uncertainty relating to the future outcomes of exceptional litigation or regulatory action. So let us say there is a litigation going against us. If we fail, if we do not win that particular litigation, the penalty will be so substantial that probably the company may not continue. So this is quite in connection with this itself. So this were a few examples. Again, like I said, these are illustrative examples. Firstly, G, there is a substantial doubt about the entity's ability to continue as a going concern. Early adoption of a new accounting standard that has a pervasive effect on the financial statement. There has been a material change between the period in the accounting principle and in the methods of their application, and uncertainty relating to the future outcomes of exceptional litigation and regulatory action. So this is nothing but GAL. Once again, so this what we did was emphasis of matter. Whenever we are asked emphasis, firstly we will write this particular definition, that a matter, although appropriately presented or disclosed in the financial statement, is of such importance that it is fundamental to the user's understanding. Then we will write that we will include it after the basis for opinion. We will use the heading emphasis of matter paragraph. You include a clear reference to the matter being emphasized. Indicate that the auditor's opinion is not modified in the matter being emphasized. Then there is a substantial doubt about the entity's ability to continue as a going concern. Early adoption or application of a new accounting standard that has a pervasive effect on financial statement. There has been a material change between the periods in accounting principles or in methods of their application. Uncertainty relating to the future outcomes of exceptional litigation regulatory action. Fine. Let me give you a small example on this. Lomax Limited is a company engaged in the business of manufacture of candles. CA Kamal Nath is the statutory auditor of the company for the financial year 2021. During the year under audit, there was a fire in the company's factory, as a result of which some of the company's plant and machinery destroyed. The same was disclosed by the company in the notes to accounts annexed in the financial year 31st March 2021. CA Kamalnath decided to communicate this matter in the auditor's report, as he is of the view that matter is of such importance that it is fundamental to the user's understanding of financial statement. Help CA Kamalnath to deal with this situation in the auditor's report. So now what we will give here is emphasis of matter paragraph. What we'll give here is emphasis of matter paragraph. So in the present case, there is a need to add emphasis of matter paragraph in the auditor's report. How will we draft the same? What we will say here is the effects of fire in the company. We draw attention to note Y. So we can write any note, note X, Y, Z of the financial statement which describes the effect of fire in the company's factory. Our opinion is not modified in respect of this matter. So usually what we do is we give the heading emphasis of matter paragraph. Did we give it here? Yes. Secondly, what we do is emphasis of matter para. Secondly, where we will give after the basis for opinion para. Third, we will always draw attention to the note we have given it. And lastly, we will mention that our opinion is not modified. So all the four things have been given here. So this was our emphasis of matter paragraph. I hope everyone has understood this. Moving ahead with our discussion of other matter paragraph in the auditor's report. So whenever things affect ARR, that is audit, auditor's responsibility and auditor's report, we will have to give other matter paragraph. Once again, whenever things affect audit, auditor's responsibility and auditor's report, what we will give is other matter paragraph unless it is prohibited by law and regulation. So if law and regulation prohibits, we cannot give other matter paragraph, or we will always give other matter paragraph when it affects audit, auditor's responsibility, auditor's report with the heading other matter or other appropriate heading. Where will we include this particular paragraph? We will include it immediately after the opinion para. We will include it immediately after the opinion para and emphasis of matter paragraph if any. So what we will do is there will be title, then addressing auditor's opinion, basis for opinion. If there is emphasis of matter paragraph, first we will write emphasis and then after we will write other matter paragraph. But not necessarily there always has to be emphasis. So if there is no emphasis after basis for opinion, you can straight away write other matter paragraph. So this was how do we write that particular para. So firstly, whenever it affects audit, auditor's responsibility or auditor's report, we will write in the other matter para or other appropriate heading immediately after the opinion para and in the emphasis of matter paragraph if any. Now let us understand which are the examples where we can use other matter paragraph. This is nothing but rally. The examples here are very important and very crucial. So just pay a little more attention to these examples, because if you read plainly, you may not understand these examples. So firstly, R is reason why the auditor is unable to resign even though there is a limitation on scope. So we have studied under SA 210. If there is a ROSA, that is restriction on scope of audit, or there is a limitation on scope of audit, then the auditor shall withdraw from the engagement. But a lot of times the law and regulation may not permit. Let us consider one such law. In case of listed entities, SEBI told us if you have done review of quarter 1, review of quarter 2 and review of quarter 3, and after quarter 3, even if there is ROSA, you will not withdraw, you will do the review of quarter 4 and do the audit of the full year. What is the logic behind this particular thing? What they are trying to say here is, see, if you resign after quarter 3 and some another auditor is being appointed, he will not have sufficient time to apply his audit procedures. So he would say, I am disclaiming the opinion because there was time constraint. So better you only do the audit and you give a disclaimer, but this time you will not say it was due to time constraint, you will say it was a ROSA imposed by the management. This reason will be more better for the user's understanding. So if you have done review of 3 quarters, you will have to do the review of 4th quarter even if there is a restriction on scope of audit. So if there are reasons why the auditor is unable to resign from the engagement even though there is a limitation on scope, we will mention the same in the other matter paragraph. Next, another set of financial statements are prepared in accordance with another general purpose framework, and that the auditor has issued a report on those financial statements. Let us say there is a Deutsche Bank. Deutsche Bank is a German-based bank. They have a subsidiary in India. The subsidiary in India are supposed to make the financial statement as per Ind AS. But for the purpose of consolidation with the holding company in Germany, they will also have to focus on German GAAP. So they will prepare their accounts financial statement on two framework, that is German generally accepted accounting principles and Ind AS. So there are two financial statements prepared, one on German GAAP and one on Ind AS. And I as an auditor have given my report on both the general purpose financial reporting framework. So I just want to highlight it to the users, bring to their attention that there are two financial statements, one prepared as per German GAAP, one prepared as per Ind AS, and I have issued my report on both the financial statements. So I just want to draw users attention to this because I have two different reports here. I don't want them to be confused. Third, a lot of time law and regulation may require you to elaborate on the matters and provide further explanation. So if a law requires you to do so, we will do so. And lastly, if the auditor's report is intended solely for the intended users. So there are two types of framework, general purpose framework and specific purpose framework. Specific purpose framework is only and only for the intended users. For example, if I am making my financial statement only for the bank, only for my investor, then this is called specific purpose framework. This may not be useful for the public at large. So if I have a general purpose framework, then it is okay, but if it is specific purpose framework, this report may not be useful for everyone, and hence I will state that auditor's report is intended solely for the intended users. So firstly, R, reason why the auditor is unable to resign from the engagement even there is a limitation on scope. Another set of financial statements are prepared by the same entity in accordance with another general purpose framework. Then law and regulation or generally accepted practice that may require or permit the auditor to elaborate on the matters. And lastly, the auditor's report is intended solely for the intended user. Now there is one important note that we need to understand here, but this note will be able to understand when we go through SA 701. So when we go to SA 701, we will go through two notes. One note that we have written here in 706. Also, if you recollect in 705, also we mentioned one note based on 701. So once we are done with 701, we will discuss both the notes once again. With this, we are also done with our discussion of 706, that is emphasis of matter paragraph and other matter paragraph. S is 701, that is communicating key audit matter. Now what are key audit matter? Key audit matters are those matters that in the auditor's professional judgment are most significant in the audit of financial statement of the current period. So if as per the auditor's professional judgment, they were most significant while doing the audit of the current period financial statement, and if the matters are communicated to those charged with governance. So we need to have a tick mark on two things. Firstly, it has to be most significant. Secondly, it has to be communicated to TCWG. Then the matter qualifies to be key audit matter. Now, what do you mean by most significant? Let me give you an example. During March 20, auditors of Super Avenue Limited, that is DMart, the auditors said verifying inventory was a key audit matter. Why verifying inventory was a key audit matter? Because it was most significant for them. Because during March 2020, there was a nationwide lockdown going on, and hence what they had planned for physical verification of inventory was not possible. So somewhere in the month of April, they had to do it an alternative date. They could not do it during the month of March because of the nationwide lockdown. Not just that, even evaluating what is the amount of shrinkages. So they said somewhere we had inventory of 1940 crores. Now, evaluating shrinkages was also difficult. What do you mean by shrinkages? Now, DMart deals with FMCG products. For example, dairy products. For example, breads. All these products come with an expiry date. So, breads usually don't last for more than 5 days. Dairy products, likewise, they have their own expiry date. Now, we went for inventory verification not in the month of March but later on, and due to nationwide lockdown, a lot of goods could not be sold. Now, since a lot of goods could not be sold and they have exceeded their expiry date, the NRV will become zero, and this could not be part of the inventory. So they said somewhere around 17 crores were shrinkages. But then identifying what is the shrinkages across all the branches, across all the centers, was a matter of most significance. We had to apply a lot of audit procedure. So this matter can be called of most significance, and if this matter is communicated to those charged with governance, the matter will become a key audit matter. Is communicating key audit matter applicable to all the entities? No, it is applicable to listed entities. So if I'm an auditor of listed entity, I must give a key audit matter. However, in other than listed companies, if I as an auditor want to voluntarily give, then I can voluntarily give a key audit matter. But if it is an audit report of a listed company, it is mandatory. We need to give a key audit matter. So this was a gist about what is a key audit matter. I hope you have understood. We are going to discuss very much further in detail in 701, but you just got a brief idea of what a key audit matter is. But now, though we have understood what is a key audit matter, but we need to see communicating a key audit matter is not a substitute for disclosures in the financial statement. Now let us say we have changed a lot of accounting policies. Let us say there was a merger between Future Group and Reliance Retail. We are the auditors of Future Group. So Future Group has changed a lot of accounting policies. So they need to disclose the same in the financial statement. However, they did not disclose the same in the financial statement and we ended up reporting the same as a key audit matter. Will this be okay? No, my friends. It is key audit matter is not a substitute for disclosure in the financial statement that the AFRF requires the management to make or that are otherwise necessary to achieve fair presentation. So, if there is a disclosure to be made as per the AFRF or to at least achieve fair presentation, we need to give that disclosure. We cannot substitute that disclosure with a key audit matter. In fact, if that disclosure is not given, we may have to modify the opinion. Second point, it is not a substitute for expressing a modified opinion when required by the circumstances of a specific audit engagement in accordance with 705. So for example, if they have not given the disclosure, then I need to modify my opinion. But however, I did not modify the opinion. All I did was I ended up giving a key audit matter. Will this do? No, you need to give a modified opinion. Thirdly, it is not a substitute for reporting under SA 570. So if there is a doubt about the going concern, if going concern is inappropriate, we need to state the same under the going concern para. If you recollect the format of SA 700, we write title, we write addressee, we write auditor's opinion, we write basis of opinion, then we write a going concern para. So in case if anything is wrong, we will have to mention the same in going concern para as well. We will have to apply our audit procedures as per SA 570. But however, if we failed to do so, then in that case we cannot just give a key audit matter. So key audit matter is not a substitute for reporting in accordance with 570 when material uncertainty exists relating to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. And lastly, it is not a separate opinion on individual matters. So, for example, if we have highlighted something in a key audit matter, we are not giving a separate opinion. Our opinion is already contained in the opinion, auditor's opinion para. So, when we give a key audit matter, we are not giving separate opinion on the matters described under key audit matter. These are just the matters which were most significant and hence we are again writing the same. So, what we are trying to say is key audit matter is not a substitute for disclosure in the financial statement. It is not a substitute for expressing a modified opinion. It is not a substitute for SA 570 where we have to report material uncertainty, and it is not a separate opinion on individual matters. Next, what is the purpose of communicating key audit matter? So what will we say is budget. What we'll write here is budget. Firstly, it provides a basis to further engage with management and those charged with governance about certain matters relating to the entity audited financial statement. So somewhere it provides a basis on which we can again communicate with management, those charged with governance, because a key audit matter is a matter which is the most significant as per the auditor's judgment, and also the same is communicated to those charged with governance. So somewhere while we are addressing a key audit matter, it is providing a basis to further engage with management and those charged with governance. Secondly, it provides additional information to the intended users. If you recollect my example, we had inventory of around 1940 crores in DMart, out of which shrinkages were 17 crores. We had a lot of difficulty in evaluating whether this particular inventory is correct or incorrect and whether even the shrinkages are correct or incorrect. So in that case, we could give users additional information, or else about the shrinkages, and we face difficulties in physical verification of inventory. All this was never mentioned in the financial statement or the audit report. So when we give a key audit matter, it provides additional information to the intended user. So the second purpose is to provide additional information to intended users of financial statement to assist them in understanding those matters that in the auditor's professional judgment were of most significant. So we can give some more light to the matters which were of most significant to the auditor. Also, there are a lot of areas where management takes significant judgment. So when we give key audit matter, we can help the intended users understand on what basis they have taken those judgment to assist the intended users of the entity and areas with significant managed judgment in the audited financial statement. And lastly, because of the key audit matter, we can enhance the communicative value of the auditor's report. In fact, we can improve the transparency of the audit that was performed. So we give more additional information. So it enhances the communicative value, or else the user would have never come to know about the shrinkages and the inventory calculation that we face, physical verification problems that we face. So it provides more transparency on how the audit was performed. So these are the purpose of key audit matter. Firstly, it provides a basis to further engage with the management. It provides additional information to the intended users. Then it provides to assist the intended users in understanding the entity and areas of significant management judgment. Lastly, to enhance the communicative value of the auditor's report by providing greater transparency about the audit that was performed. तो ये हमारा क्या हो गया? बचे. क्या ये हो गया हमारा? This is budget. What is the purpose of communicating a key audit matter? Next, what are the factors that we need to consider while we are determining a key audit matter? So we'll classify everything in three different lists. First list is nothing but areas where the ROMMS is high. So my friends, wherever ROMMS is high, the assessed risk of material misstatement is high, obviously all those matters are going to be significant matters for the auditor. So areas where the risk of material misstatement is high is the first point. So we'll classify into three lists. The first list is areas where ROMMS is high. Then wherever the management has taken an accounting estimate. See, whenever they have an estimate, let's take a few examples of estimate. While we are talking about depreciation, we are talking about estimated useful life. RDD is again nothing but a estimate. Warranty is nothing but an estimate. So a lot of circumstances management makes an estimate. Whenever they are making an estimate, auditor will also have to take a judgment whether the management estimate is correct or incorrect. So wherever we have to take a judgment, somewhere this matter becomes most significant to us, because we also had to take a lot of judgments here. So significant auditor's judgment relating to areas in the financial statement that involve significant management judgment, including the accounting estimates that have been identified. So first what we said is area of higher ROMMS, then where accounting estimates have been made by the management. So management may have taken a judgment there. Then auditor will also take a judgment whether the management judgment is correct or incorrect, or somewhere this will become a significant matter. Lastly, effect of the significant events or transaction that have occurred during the period. Best example might be COVID-19. So COVID-19 had a significant effect. It can be any catastrophe. For example, there was flood, there was earthquake, there was a fire in the premises. So whether there was any significant event or transaction that has occurred during the period which may have a significant effect. So even this will become a key audit matter. So we classified into three lists. Areas where ROMMS is high, where management has taken an estimate. So management may have taken a judgment, and to evaluate whether their judgments are correct, auditor will take significant judgments. Then any significant event or transaction that has occurred during the period which may have a significant effect. Out of this three list, we will identify which events were of most significance, and all those events will become key audit matter. The auditor shall determine which of the matters determined above were of most significance in the audit of financial statement, the current period, and therefore are the key audit matters. So these are the factors to be considered for determining key audit matter. Firstly, where ROMMS is high. Second, where there have been accounting estimates. where there are significant judgments taken by the auditor, the effect of the audit of the significant events, and lastly where the matter were of most significance. So these are the factors to be considered while determining a key audit matter. Now, how do we communicate a key audit matter? So whenever we want to communicate a key audit matter, so if you recollect our format, firstly we had title, then we had addressee, then we had auditor's opinion, we had basis for opinion, going concern, and then we had a key audit matter. So whenever we are giving a key audit matter, we will have a separate section with the header, a key audit matter. What will be the introductory language of that particular matter? I mean, what do we write in that particular para? So what we will write there is key audit matters are those matters that in the auditor's professional judgment were of most significance. Once again, the key audit matter are those matters that in the auditor's professional judgment were of most significance in the audit of financial statement. Secondly, these matters were addressed in the context of audit. So we will not scare off the particular investor. We will just tell him this was the most significant event. He will probably, be scared of whether to invest or not to invest. So we will tell him that these matters were addressed in the context of audit of the financial statement as a whole, and in informing the auditor's opinion thereon, the auditor does not provide a separate opinion on these matters. So what we will try to tell them is that with these matters were addressed, we do not modify our opinion in respect of this matter. We still say everything is true and fair. So firstly, what we will write is key audit matters are those matters that in the auditor's professional judgment were of most significant. Then we will write how the matter was addressed in the context of the financial statement as a whole. So this is how we communicate the introductory para. Then we will give a description of each key audit matter of the auditor's report shall include a reference to the related disclosure, if any. So if we already have some notes to accounts, we will give a reference to notes to accounts. For example, if we are highlighting something which is given in note 3, we will give a clear reference to the matter that we are talking about. So they understand. Also, we will have to state two things here. Why the matter was of most significant. Why the matter was considered to be one of the most significant, we will have to write the reason. Why is this determined as a key audit matter? And then we will write how the matter was addressed. Because like I said, we do not want to scare off that particular investor. We just do not want to scare the users by just giving the most significant matter. We also need to show them how that particular matter was addressed. The auditor shall describe each key audit matter in the report unless law and regulation prohibits public disclosure. So if law and regulation prohibits that you cannot give a key audit matter, then we cannot give a key audit matter. Or in extremely rare circumstances, the auditor determines that matter should not be communicated in the auditor's report because the adverse consequences of doing so would reasonably expected to outweigh the public interest benefits of such communication. So if we believe that if we communicate a key audit matter, it may not benefit. In fact, it might have adverse effect and it might outweigh the public interest. So let me give you a hypothetical example. There is some problem about going concern. Management has disclosed the same, disclosed the material uncertainty. In that case, we have also mentioned the same in the going concern para. But again, we are talking about the same matter in the key audit matter. So we are saying why it was most significant. And then we are saying we could not mitigate whether we are not sure whether this may arise or may not arise. So there is still an uncertainty. So what will happen is, users might not understand this. In a key audit matter, you write this, why is it most significant. You also write how you have addressed the same. But here you have not addressed the same. So what you will do is, if you have not addressed the same, you will have to inform. You will have to at least inform the users what exactly has happened. But somewhere, if you are not able to give a clear picture, you are putting the users still into dark. You are creating a misleading information. You are creating some confusion in their head. Then in that case, it is better that you do not give a key audit matter. So in extremely rare circumstances, like I gave you a hypothetical example, that if you are writing something about going concern, the users are not understanding, they are misinterpreting. In that case, they would feel that going concern is definitely incorrect and they might end up selling the shares. And if they end up selling the shares, the share prices will go down because the supply is high and the demand is low. Then the share prices might go down and it will outweigh the public interest benefit. The public will lose out and will not gain anything out of this. Only in these two circumstances. Which two circumstances? Where the law and regulation precludes, or if you think it may outweigh the public interest, only in that scenario you will not give a key audit matter, or else every key audit matter has to be given. So this was our SA 701, that is key audit matter. Once again, let's go through what we studied here. Is we understood what is the meaning of a key audit matter, the matter of most significance, and the matter communicated to TCWG. It is applicable to listed entities and voluntary you can apply in any other case. Communicating key audit matter is not a substitute for disclosures. It is not a substitute for a modified opinion, for going concern, as well as it is not a separate opinion on individual matters. What is the purpose? It provides a basis to further communicate, further engage with management and TCWG. It provides additional information. We can understand the significant areas where management has taken a judgment, and it enhances the communicative value and the transparency of the audit report. What are the factors we'll consider? We'll divide into three lists where ROMMS is high, where accounting estimates are involved, where management has taken a judgment, and to evaluate that judgment, auditor has taken a judgment. Any significant events or transaction that has occurred during the period, out of this, whichever are the most significant, we'll classify them as what. How do we communicated a key audit matter? Under the heading key audit matter, what will be the introductory language? That these are the matter of most significance. This matter were addressed, so we are not giving a separate opinion on this matters. If possible, we'll give a reference to the related disclosure. Then we need to specify why the matter was considered of most significant and how the matter was addressed. Then we will give a key audit matter unless law and regulation precludes, or in extremely rare circumstances if we think it may outweigh the public interest, we will not provide the key audit matter. So with this, we are done with 700. We are done with 705, 706, 701. Now, before we move ahead with 710 and 720, what we will do is we will understand how to write a qualified opinion, a adverse opinion, a disclaimer of opinion. So we are going to understand what are the various ways of writing a different reports, because if you go to the module, if you go to the pronouncement, they have huge formats which will get very difficult for you. So I have devised a small trick with which you can very easily understand the types of opinion. So we'll go through the three different types of opinion. You'll also see few reports such as of HDFC Bank, DMart Limited. So at least you are in a better position to understand, you are in a better position to see the reports of actual companies. So let us go through the report writing before we move ahead with 710. So now there are four types of report. One is unqualified, second is qualified, then adverse and disclaimer. My friends, unqualified is nothing that you have studied under SA 700. What you write under SA 700, first is title, that is independent auditor's report. Then you write addressee, that is to the shareholders. You will write auditor's opinion, in which you will write firstly true and fair, and then you will write a date notes, that is date it has been audited, title, entity, and the notes. Then you will write basis for opinion. Under basis for opinion, you will write CA, that is we have done it as per the standards on auditing. We have sufficient and appropriate audit evidence. Then independent, complying with the ethical requirement and auditor's responsibility. Then we will give a going concern para, we will give a key audit matter para, we will give a management responsibility para, where you will say the financial statement as well as internal control are to be prepared by the management. They need to assess whether the going concern is appropriate. They are supposed to write a note if those shared with governance are different. Then we will give the auditor's responsibility. Under auditor's responsibility, firstly we are trying to say we want a reasonable assurance and want to express via written report. Then reasonable assurance is a high level of assurance, it is not a guarantee. Thirdly, we talked about materiality, that things individual in aggregate may be material. Then we said we are going to keep professional skepticism and professional judgment. Then we mentioned about RIAGO. What is RIAGO? Firstly ROMMS, then internal control, then accounting policies, going concern, overall structure and presentation, and group audit. Thirdly, we mentioned about We will communicate with those shared with governance the plan, scope and timing, significant findings of audit, significant deficiencies. Then we will also communicate to them that we are independent and complying ethical requirement, and in case of listed entity we will also communicate a key audit matter. After the auditor's responsibility, what we write here usually is report on other legal and regulatory requirement. Then we will give a signature, then we will give a place, and then we will give a date. So now my friends, irrespective of the type of opinion, that is whether it is unqualified, qualified, adverse or disclaimer, your title is going to be the same, your address is going to be the same. We'll see the difference between auditor's opinion and basis for opinion. Your going concern is going to be the same, key audit matter will be the same, management responsibility will be the same, auditor's responsibility will be the same, your report on other and legal regulatory requirement will be same, signature, place and date, everything will be same. So only difference that you will see will be under auditor's opinion and basis for opinion. Even the whole of auditor's opinion and basis for opinion will not change. So let us just do little smart work. The rest of the format will remain the same. Now when we are writing the auditor's opinion, in case of auditor's opinion, we firstly write that it is true and fair, and secondly we mention date, notes. Now here in case of opinion para, the first line, in case of unqualified we say that we have audited. In case of unqualified, again we will say we have audited. In case of adverse, again we will say we have audited. But in case of disclaimer, we will say we were engaged to audit. Now we cannot say we have audited because we could not obtain SI. So only this particular point. So A point is changing. In date notes, which point is changing? A. Fine. So what we are changing here is A. Then which comprises the balance sheet at March 31st. So whatever is the date, so D point is remaining the same. P&L, cash flow statement for the year ended. So somewhere title is also remaining the same. So what they are changing is A point, D remains the same, T remains the same. Entity we already might have written, when we start the audit report, we might write the entity name. So entity name will also remain the same. Then we have given a reference to the notes to the financial statement, including summary of significant accounting policy. So notes will also remain the same. Now comes the opinion, that is true and fair. So in last line, in case of opinion, third line we will write in our opinion and best to our information and according to the explanation given to us. In case of qualified, we will write gives true and fair view of the financial position. What we will write is gives true and fair view of the financial position. In case of qualified, what we will write is except for the effect or the possible effects of the matter described in the basis for qualified opinion para, financial statements are true and fair. So in case of unqualified, we said gives true and fair view. Here also we are saying it gives true and fair view. But what did we write in the initial part? Except for the effects. Now let us say, in case of advertisement, let us say we were auditing Vivo, there was 400 crores of advertisement. They debited the whole 400 crores in one single year. They should have debited 80 crores in the first year and 320 crores should have been treated as a deferred revenue expenditure. But they treated the whole 400 crores in one single year itself. So here we will write except for the effect of 320 crores in advertisement, everything else is true and fair. So here we will just quantify what is the effect. But also we have written the word possible effects. Why have we written the word possible effects? Because a lot of times we give a qualified opinion when we do not have SI. So if we have SI and we can quantify that 320 crores is a misstatement, good. But in case if we do not have SI, we might have to project what will be the amount of misstatement, and hence we have written the word possible. But then again a lot of students might ask, sir, we have written true and fair. Yes. See, whether we have SI or whether we don't have SI, except for that particular matter, everything else is true and fair, right? So what we will write is except for the effect or the possible effects of the matter described in the basis for opinion, the financial statements are true and fair. Coming to adverse opinion. Because of the significance of the matter described. Why are we writing significant? Because the matter is material and pervasive. In the basis of adverse opinion para, financial statements are not true and fair. So here we are saying that the financial statements are not true and fair. Here this time we are not saying that they are true and fair. What we are saying is they are not true and fair. Lastly, because of the significance of the matter, again we have written the word significant because it is material and pervasive, described in the basis of disclaimer of opinion, para, the auditor does not express an opinion on the financial statement. So this time we are not expressing an opinion. So in case of qualified, we said true and fair. In case of qualified, we said except for the effect or possible effects, again true and fair. In case of adverse, we are saying not true and fair. And in case of disclaimer, we are saying we cannot express an opinion. We cannot say whether everything is correct or incorrect. So my friends, when we are writing the auditor's opinion para, what basically will change is the first line and the fourth line. Second line, third line, everything will remain constant. So your title remains constant, addressee remains constant. In auditor's opinion also only the first line and the last line changes. Coming to basis for opinion. In basis for opinion, my friends, what do we write usually? SIA. So we have conducted our audit in accordance with standards on auditing. Then we have sufficient and appropriate evidence. Then we are independent and complying with the ethical requirements and give a reference to the auditor's responsibility. So everything will remain the same except for the last line. So this is the last line, which is basically nothing but S2 for us, So only S2 will change. So we believe that the evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. So in case of unqualified, we'll write the same line. We believe that the evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Now qualified and adverse, everything will remain same, just the last word will change. So we believe that the evidence we have obtained is sufficient and appropriate to provide a basis for our qualified opinion. So here it was opinion, here we wrote qualified opinion. Third, we believe that the evidence we have obtained is sufficient and appropriate to provide a basis for our adverse opinion. So the only word that has changed is qualified and adverse. But disclaimer, we will have to write it differently. Because of the matter described in the basis of disclaimer of opinion, we were not able to obtain a psi to provide a basis for our opinion. So here we are saying we have obtained a psi. Here we are saying we were not able to obtain psi to provide a basis for our opinion. So again, in case of basis for opinion, only one last line is changing. Everything else remains constant. So again, title same, addressee remains same, auditor's opinion, first line and fourth line changes, basis for opinion, third line changes, everything else remains the same. So whatever question is asked, you will not face any problem. I hope you have understood. You can write here the whole thing as it is, where it is. Just make sure you recollect these 3 lines perfectly. If you can identify these 3 lines perfectly, your whole report will go correct. So now before we move ahead with the next thing, like I promised, let us go through the report of HDFC. Let us go through the report of Super Avenue, that is DMart Limited. So you'll understand which are the ways in which they write the report. So firstly, let us see the report of HDFC Bank. So this is the annual report for 2021. So if you see, they have given so many things here. I am directly taking you to the independent auditor's report. So let us directly go through the independent auditor's report. Now, the independent auditor's report. So firstly, what they will write here is the independent auditor's report. This is nothing but our title. After title, what we will write is addressee to the members of HDFC Bank Limited. Then what we will write is auditor's opinion. So in auditor's opinion, what we write is true and fair, and what we write is date, notes. So firstly, if we talk about D, so here they have given us the date, then it has been audited, then title. So title is going to be balance sheet, P&L, cash flow statement. So they are given the title. Entity name they will again not write because they have already mentioned here HDFC and here in the annual report of HDFC, so not required. You will also give a reference to the notes. Then you will give a true and fair view. So here you will end up saying that in our opinion and based to the information given to us, the financial statements gives a true and fair view. So this is our opinion para. So I hope everyone could see this was nothing but our opinion para. Then in our basis for opinion para, what we write is, in basis for opinion we will end up writing CR. So firstly we will say we have done our audit in accordance with standards on auditing. Then we will say we have sufficient and appropriate audit evidence, we are independent and comply with the ethical requirement, and also we give a reference to the auditor's responsibility. So this is nothing but our basis for opinion. After basis for opinion we write going concern if there is some problem in going concern. If there is no going concern, then in that case what we will write is directly emphasis of matter and other matter paragraph. So here they have not given any other matter, what they have given is emphasis. So what they are trying to say is, we draw attention to note 24 of schedule 18 to consolidated financial statement, which describes the extent to which COVID-19 pandemic will continue to impact the bank's consolidated financial statement will depend on the ongoing and the future developments which are highly uncertain. Is not modified in this respect. So if you recollect emphasis, we give the heading emphasis of matter. Have we given the heading? Then we give a clear reference to the matter being emphasized. Then in that case we also write that our opinion is not modified. We have given all the things. So this is going to be an emphasis of matter. There is no other matter paragraph in this particular report. We'll see in the audit report of DMAT. Then we will also write about the key audit matters. So key audit matters were of those matters that they were of most significant, that in our professional judgment were of most significant introductory language. Then we will also write how these matters were addressed, and we do not provide a separate opinion on this matter. So if you recollect key audit matter, the introductory language was this. Then we will explain what are the key audit matter and how the key audit matter were addressed. So if you wish to, you can go on this particular website and can read through this, because a lot of things are based on your accounts. So first we will write what are the key audit matters and how they were addressed. So every key audit matter has been given here. Once we are done with key audit matter, then we will give management responsibility para. So in management responsibility para, if you recollect, we will write that preparation of financial statement is your responsibility. Preparation of this financial statement is your responsibility. Also internal control is also your responsibility. So we'll also mention about the internal control. Then we'll tell them even going concern is your responsibility. And then if those shared with governance is different, we'll give a note about the same. Then auditor's responsibility will say that we want to obtain a reasonable assurance. Then we will say reasonable assurance is nothing but a high level of assurance, but it is not a guarantee. Then we will talk about misstatements can be individual or in aggregate can be material. So we are talking about materiality. Then we will say that we will keep professional judgment and professional skepticism. Then we will mention about RIA go. So R is nothing but ROMMS, risk of material misstatement. I is nothing but internal control. A is nothing but accounting policy. G is nothing but going concern. Then overall presentation and structure of the company. So here we are going to talk about the overall presentation and structure of the company. Also we will say that we will communicate with those charged with governance. What we will communicate the plan, scope and timing of audit. We will communicate the significant findings. We will also communicate significant deficiencies in the internal control. Then we will tell them we are the ethical requirements and we comply with independent, and we will also communicate with them the key audit matter which we have already communicated above. Then other matter paragraph. So they have said we did not audit the financial statement of two subsidiaries whose financial statement reflect total assets of this many lakhs and total revenue. If you recollect, if you have not done chapter of banking, in chapter of banking we said if there are unaudited subsidiaries, then we did not just give the quantum, we just did not give the number of branches, but we also need to quantify that how many advances, how many income from those particular thing. So we have given the same here in the other matter. Then report on the other legal and regulatory requirements. So as per 143.3 there are a lot of reporting requirements which are not covered under SA 700. So we'll give the same under this particular para. Then after this what we will give is a signature. Signature is always in the personal name, though we will write partnership firm name, but it will be in the personal name. We'll give the membership number, you will also give the UDIN number, then comes the place, and then comes the date. So this was our audit report of HDFC Bank. I hope you have got some gist about how do we usually write the report. Also, let us go through the report of DMart. So let us go through the report of DMart as well. So again, they have given the whole annual report. I am directly taking you to the independent auditor's report. So again, if you see, the title is the independent auditor's report. Then addressee is going to be the shareholders. Then we'll write about the opinion. We will write date notes. Again, we have said it has been audited, we have written the date, then we have written the title, that is balance sheet, P&L. We have also said that we give a true and fair view. So it is going to be the same as it is where it is, that like what we saw in case of HDFC. After the opinion paragraph, what we write is basis for opinion. So again, we will say CR, that is it is as per the standards on auditing. We are independent and comply with ethical requirements, auditor's responsibility. Then again, there is no problem about going concern. We will write key audit matter. Key audit matter, again in the introduction, what we will write is key audit matter are those matters that in the auditor's professional judgment of most significant, and then how we have addressed those matters, and we are not giving a separate opinion on these matters. So this is the introductory part. Then we have why the matter was a key audit matter and how the auditor has addressed. This was the example while I was giving you while we started key audit matter. So what they have given here is, as at 31st of March, the carrying amount of inventory amounted to 1947.4 crores after considering allowances for inventory shrinkages of 17.3 crores. This inventory is held at the stores and distribution centers of the holding company. Allowance for shrinkages was an audit focus area because of the assessment of the inventory cycle counts were carried out at periodical intervals during the year, and further significant judgment is involved by the holding company in identifying the amount of provision. So how have we addressed the same? We obtained an understanding of and evaluated the design and tested the operating effectiveness of the controls of the holding company in relation to the allowance of inventory shrinkage. We performed the holding company's controls over the inventory cycle counting. In testing this control, we observed that the inventory cycle counting process at the selected store and distribution centers on a sample basis. Then we assessed the inventory shrinking provision by assessing the level of inventory shrinkage write-downs. Then on account of the COVID-19 lockdown imposed, the holding company was unable to carry its physical verification in the last 2 weeks of March as planned. However, the location schedule for physical verification in last 2 weeks had been verified during the year as planned, and accordingly shrinkages days have been used for the location. So here we have addressed how we have managed all those matters. After key audit matter, we'll write management responsibility. Then again we'll write auditor's responsibility. We want to give a reasonable assurance, which is high level of assurance but not a guarantee. Then about materiality, we'll keep professional skepticism, professional judgment. Then RIA go. Then we'll talk about what are we going to discuss with those charged with governance. All those things we are supposed to write here. Then report on legal and other regulatory requirement, which is again as per 143 of the Companies Act. Then we will again write the signature. Then it will be again in the personal name. You will write the partnership firm, you will write the membership number, you will write the UDIN number, you will write the place as well as the date. So this is how usually a report is given. I hope you have understood how do we write a report. So before we move ahead, let us go through the question bank. So in question bank, we are going to discuss for now SA 700, 701, 705 and 706. So this 4 standards on auditing, I am discussing the whole question bank together. 710 and 720 will take up independently when we do those essays. So question number 1. Under the applicable standards on auditing, in what circumstances does the report of statutory auditor require modification? What are the types of modification possible to the said report? So we will have to discuss here the whole of SA 705. But my friends, do not draw the whole chart of 705. You will have to write it in paragraph form. That is, the auditor may have SI, auditor do not have SI. If the auditor has SI, material but not pervasive qualified. material and pervasive adverse. If they do not have sign, material but not pervasive qualified, material and pervasive disclaimer. Now question number 2 is an interesting question here. What are the features? They are asking what are the features of a qualified report. So what are the features of qualified report? Firstly, there should be a clarity. So if we are modifying the opinion, if we are expressing a qualified opinion, it should be in an unambiguous manner. We should clearly state why are we modifying the opinion. It should not leave the users to an ambiguity. Secondly, we also need to give their explanation why we have modified the opinion. So where the auditor answers of any statutory affirmation in the negative or with qualification, his report shall state the reasons for such answers. So what we are trying to say is we should give exact reason, explanation why we are modifying the opinion. So firstly we need to have clarity, then we'll give explanation. Thirdly, placement. So all the qualifications contained in the report, when there are notes which are subject matter of qualification, the same should be preferably annexed to the auditor's report. So we should contain all the qualifications together, they should not be scattered. However, a reference to the notes in the auditor's report does not automatically become a qualification. Next, we need to write the word except for. We cannot use any other phrase subject to or with the foregoing explanation. We will have to exactly write except for. So a quantified opinion should be expressed as except for the effects of the matter to which qualifications relate. It would not be appropriate to use the phrase such as with foregoing explanation or subject to in the opinion paragraph, as these are not sufficiently clear and forceful. So we need to write without the foregoing explanation or subject to in the opinion paragraph. Next, we also need to give the quantification here. So it is also necessary that we should quantify. Wherever possible, we need to write the effect, and if we do not have psi, we need to write the possible effects. That is, we need to take an estimate, but we always have to quantify or else user will not understand. So it is necessary that the auditor should quantify wherever possible the effect of individual as well as total effect of all qualifications on the statement of profit and loss or state of affairs of these qualification on the financial statement in a clear and unambiguous manner. In circumstances where it is not possible to quantify the effect of the qualifications accurately, the auditor may do so on the estimates made by the management after carrying out such audit test as possible and clearly indicate that the figures given based on the estimates of the management. So where we do not have psi, we might have to ask the management, we might have to take their estimates, and based on those estimates we will have to quantify the opinion. We also have to give the nature of qualification. We cannot give any vague statements because it will again lead to an ambiguity. So vague statements, the effect which on accounts cannot be ascertained, like trade receivables, are subject to confirmation. No provision for tax has been made in the view of loss, etc. should be avoided. We should give exact quantification, how much amount of data have not given confirmation, how much provision is to be made. So then in that case users will be able to take a decision. Where a company has committed irregularity resulting in the breach of law, the auditor should bring the same to the notice of shareholders by properly qualifying his report. So these were the various features. Also what they are saying is notes report relationship. Where notes of qualificatory nature appear in the accounts, the auditor should state all qualification independently of their report so that user can assess the significance of this qualification. So this was a very vague answer. They had asked what are the features, and we will have to write this answer because Institute has given the same in the suggested answer as well. Next, write a short note on certificate for special purpose versus audit report. So basically they are asking what is the difference between certificate versus the audit report. So when we talk about certificate, it is a written confirmation on the accuracy of the facts therein and does not involve any estimate or opinion. For example, if someone is asking, give us a certificate about the stock. I mean, what is the inventory in this particular godown? Just give us a certificate. So we are just giving a written confirmation about the accuracy, what is the quantity of the stock. We are not expressing any opinion. We are not involving any estimate here. The term certificate therefore used where we verify the accuracy of the fact. So whenever we are verifying the accuracy, we will use the word certificate. An auditor may thus certify circulation figures of a newspaper or the value of imports or exports of a company. So for example, in case of circulation, how many newspapers are being circulated, we can give a certificate here. Next, an auditor certificate represents that he has verified certain figures and is in a position to vouch their accuracy as per his examination of documents and books of accounts. So what we are trying to say here is that we have verified it and we vouch for the accuracy of what we have written there in the certificate. So this was up till here we explained what is certificate. So we said it is a written confirmation certifying the accuracy of the facts. Secondly, the term certificate therefore used where the auditor verifies accuracy. Thirdly, we have given an example here. And fourthly, what we are trying to say is here we are in a position to vouch for their accuracy. Now comes a report. A report, on the other hand, is a formal statement usually made after an inquiry, examination or review of specified matters under the report and includes reporting auditor's opinion thereon. So it is a formal statement where we'll conduct all our audit procedures, inquiry, inspection, and then we'll give an opinion thereon. When an auditor issues a report, when a reporting auditor issues a certificate, he is responsible for factual accuracy. But on the other hand, when we are talking about the report, he is responsible only for a reasonable assurance. He is not responsible for the factual accuracy. So on the other hand, when a reporting auditor gives a report, he is responsible for ensuring that report is based on factual data, that his opinion is due in accordance with the facts, and that is arrived by application of due care and skill. The report involves expression of opinion which may differ from one professional to another. In case of certificate, whether it is me or any other chartered accountant, our certificate will always be the same because we are verifying the factual accuracy. But report involves a lot of professional judgment and hence may differ from person to person. There is no question of exactitude in case of report since the information is contained is based on estimates. Hence we can never give an absolute assurance because estimates are involved here. That is inherent limitation. Next, question number 4. Give examples of emphasis of matter paragraph which may have an adverse effect on the functioning of the company as well as those which may not affect the functioning. So basically all you need to give the examples of emphasis of matter paragraph. So the answer you will write here is GAL. But do not just give the examples, you also define what is emphasis of matter paragraph. You also state how the emphasis of matter paragraph will be displayed and then you write the examples. Only and only examples may not work. CA Amar has come across certain key matters while auditing the accounts of PR Limited for the financial year 17-18. He, being associate of your firm, seeks your advice on communicating key audit matter in the auditor's report. So my friends, we have already discussed how do we communicate a key audit matter, what will be the introductory line, how will we disclose the same. So we'll have to write the same, how do we disclose a key audit matter here. Next, there are certain circumstances in which emphasis of matter paragraph is mandated to be included. Explain this statement in the light of mandatory requirements that are to be emphasized in the auditor's report when audit report is on financial statement prepared in accordance with the special purpose framework. So here, this particular answer is not relevant to your anymore because they have answered this as per special purpose framework. SA 800 is nowhere part of your syllabus. So the only reason to mention this question is that this particular part will not be asked. They may ask you to write about the examples, but will they ask you to write about the special purpose framework? No, because that is not part of your syllabus anymore. So when such a question is asked, you will just straight away write the examples. That is nothing but GAL because you do not have special purpose framework in your syllabus anymore. So I'm not discussing this question here. Next, question number 7. Write a short note on purpose of communicating key audit matter. So my friend, what is the purpose? The purpose is nothing but budget. B was what? Provides a basis. A is additional information. J is judgment. And lastly, E is enhances the communicative value. Next, Mr. A was appointed as statutory auditor of X Limited. While doing audit, Mr. A is required to determine key audit matter which are required to be mentioned in the auditor's report. You are required to advise Mr. A about the consideration which Mr. A shall take into account while determining the key audit matter. So what are the factors that you will consider? You will classify into three lists where ROMMS is high, where estimates are involved, where a significant event has occurred, and whichever are the most significant, we will select those as a key audit matter. Alternatively, they have asked similar question in different ways. The auditor shall determine from the matters communicated to those charged with governance, those matters that require significant auditor attention in performing the audit. In making this determination, the auditor shall take into account the key factors. You are required to define the key audit matters and briefly discuss the factors determining key audit matter. So again, same answer you will write. Next, question number 8. As an auditor of a listed company for the year 31st March, how would you determine a key audit matter? So again, the answer is going to be the same. That is, you classify them into the three list. Next, CA Amar has come across certain key matters while auditing the accounts of PR Limited for the financial year 1920. He, being the associate of your firm, seeks your advice on communicating key audit matter. So how you communicate with the header key audit matter, then the introductory language that this is the matter of most significant, how we have addressed and we are not giving a separate opinion. You will have to write the same para here. Next, state the circumstances in which a matter determined to be a key audit matter is not required to be communicated. My friends, there are only two circumstances where we will not communicate, where law and regulation precludes us and we think it might outweigh the public interest. If we think so it will outweigh the public interest, in that case we will not give the key audit matter, or else every time we will give a key audit matter. So this also we have covered in our notes. Next, property, plant and equipment of ABC Limited included 25.75 crores of earth removing machines of outdated technology which had been retired from the active use and had been kept for disposal after knockdown. These assets appeared at residual value and had been last inspected 10 years back. As an auditor, what would be your reporting concern? So somewhere this was 10 years old. Once again, let me read it. Included 25.75 crores worth machinery, outdated technology, and we had kept for disposal. It was appearing at the residual value and was inspected 10 years back. My friends, here let us go through the answer. Auditor is required to report under various requirement of SAs, legal and regulatory provision. In the present situation, the major reporting requirements will be: as per SA 260, communication with those charged with governance. Auditor should communicate significant matters arising during the audit that were discussed, correspondences with the management. So though we have not done SA 260, whatever the significant matters that we identify, we need to communicate with the management. Secondly, the situation as given in present appears a key audit matter and hence the auditor is required to report the situation under the key audit matter. So we'll give this under key audit matter as well. We will also give the same under CARO. So again we will disclose the same under CARO, but now we will write CARO 2020. So we'll give the same matter under CARO 2020. We have discussed CARO 2020 already in our company audit. Whether the company is maintaining proper records showing full particulars including the quantitative details and the situation of the fixed asset. So whether they are showing all the proper records, quantitative details of the fixed asset are maintained or not maintained. Whether the fixed assets have been physically verified by the management at regular intervals. So similar things we have already reported under CARO 2020 also. Conclusion: in the present case, the auditor's reporting concern will be as per 260-701 and as per CARO 2020. So all these points were as per CARO 2020. So we'll have to write what are we going to report under SA 260. We are going to report under SA 701, that is key audit matter, and we shall also report the same under CARO 2020. Right? So I have not changed the answer here because this was an old question. I am just changing it here. So because we cannot quote CARO 2016 anymore. Next. When should an auditor make a disclaimer of opinion in the auditor's report? When we will give a disclaimer of opinion, when the matter is material and pervasive, and when we do not have psi, so we'll have to write as per 705. Next, ADKS and Company LLP are newly appointed statutory auditors of PKK Limited. During the course of audit, the statutory auditor have come across certain significant observations which they believe could lead to material misstatements of financial statement. Management has different view and does not concur with the view of the statutory auditor. Considering this, the statutory auditors are determining as to how to address the observation in terms of their reporting requirement. So circumstances in which opinion may be modified. So as per SA 705, when can you modify the opinion? The auditor concludes. What do you mean by auditor concludes? That we have sufficient and appropriate evidence based on the audit evidence obtained that the financial statement as a whole are not free from material misstatement due to fraud or error. So for what reasons we can modify? For example, if there are inappropriate methods of selection of accounting policy, or the accounting policies are inconsistent with the AFRF. So either we have incorrectly selected the accounting policies in the circumstances, or they are not at par with the AFRF. The disclosures as required by the AFRF are not given. Next, the auditor is unable to obtain psi. So this is the case when we do not have sufficient and appropriate audit evidence. To obtain sufficient and appropriate audit evidence to conclude that the financial statement as a whole are free from material misstatement may be due to following reason. There may be a limitation which is imposed by the management, which is called as LOSA or ROSA in our language. Circumstances beyond the control of the entity. Do you recollect an example? For example, if the stock is in Ukraine, can you go to Ukraine? No. And lastly, circumstances due to the nature and the timing of the audit work. That is a time constraint. So this was SA 705. Types of modified that we can give is qualified, adverse or disclaimer. Next, after accepting the statutory audit of Messrs All-in-One Limited, a department store, you become aware of the fact that the management of the company imposed certain limitation on scope of your assurance function, which may adversely affect and result in your inability to obtain sufficient and appropriate audit evidence. Indicate the consequences and your response to limitation on scope. So my friends, this we have already done in our SA 210. So we'll have to write the answer as given under SA 210 and not of SA 700 series. Next, compare and explain audit qualification and emphasis of matter. So what is the difference between qualification and emphasis? So as per 705 deals with the provision relating the qualification. The qualification are given when the auditors are having reservation on some items of the financial statement. It is issued on the following circumstances: when the financial statement are a materially misstatement but which may not be pervasive. So we give qualified when the matter is material but not pervasive. Secondly, the auditor is unable to obtain psi, but again the matter is material but not pervasive. So we may have psi if the matter is material and but not pervasive, qualified. If we do not have psi, matter is material but not pervasive, again qualified. As per 706, now they have explained what is an emphasis of matter paragraph. So emphasis of matter is a paragraph which is included in the auditor's report to draw users' attention to important matters which are already disclosed in the financial statement and are fundamental to the user's understanding. EOM is used when there is uncertainty relating to the future outcome, for example litigation. We have already covered all these examples under GAL. So they have given the examples where we can use emphasis of matter para. Next, D Limited, a Delhi-based company, is having a turnover of 25 crores and has a branch at USA having a turnover of rupees 10 lakhs. As converted from US dollars, the area where the branch office is situated was severely affected by storms and the office along with the accounting records completely destroyed. Due to the unavailability of records in 1920 did not include the figures pertaining to the said branch. As the statutory auditor of financial statements of D Limited, for the financial statement of D Limited, how would you report on the same? So they have not included at all the reports of that particular branch. So reporting on the financial statement, as per SA 200, the overall objective of the independent auditor is to perform the audit procedures and to obtain a reasonable assurance whether the financial statement as a whole are free from material misstatement and to express an opinion on the same. In all cases, when reasonable assurance cannot be obtained and a qualified opinion is insufficient, SAs require the auditor to disclaim the opinion or withdraw from the engagement. So if we do not have sign and we cannot give a qualified opinion, then either we may give a disclaimer of opinion or withdraw from the engagement. Now in this particular scenario, D Limited, a Delhi-based company having a turnover of 25 crore, has a branch at USA having a turnover of 10 lakhs. The area where the branch office is situated in USA was severely affected by storms, and the office along with all the accounting records was completely destroyed. Due to the unavailability of records, the financial statement of D Limited for the financial year did not include the figures pertaining to the said branch. So they given everything that was given in the case. Now in the present case situation, company is required to make appropriate disclosure in the notes to accounts. Based on the disclosure made in the financial statement, auditor is required to include emphasis of matter paragraph, that is we just want to highlight the same. However, if no disclosure is made, then we might have to qualify the opinion and we cannot give only emphasis of matter paragraph. So conclusion, if appropriate disclosure are given, we will give emphasis of matter. If appropriate disclosure are not given, we will qualify the opinion as per 705. Next, enumerate important matters which can be included in emphasis of matter. So we already know what are the matters that can be included in emphasis of matter. We will write GAL. With this, finally we are done with our question bank of SA 700, SA 701, 705 and 706. Finally, we put an end to our discussion of this particular video. See you ahead in the next video, my friends, where we will move ahead with our discussion of SA 710. So let us begin with our next standard on auditing, that is SA 710, comparative information and corresponding figure. Now what are our objectives as per 710? It is nothing but to obtain a sufficient and appropriate evidence whether the comparative information included in the financial statement have been presented in all material respect in accordance with the comparative information in the AFRF. So whether the comparative information is as per AFRF, and finally second is to report in accordance with the reporting requirement. So we just want to obtain a sign that sufficient and appropriate evidence that the comparative financial statement are made as per AFRF. But to understand this, we will have to understand a lot of things. So before we move ahead, we need to understand two first definitions. The first definition is what is a corresponding figure. Second definition is going to be what are the comparative financial statement. So what is a corresponding figure? Corresponding figure is nothing but a comparative information where amounts and disclosure of the preceding period are included as a part of the current period financial statement and are intended to be read in relation to the amounts and other disclosure relating to the current period. These corresponding figures are complete financial statement capable of standing alone, but are integral part of the current period financial statement intended to be read only in relation to the current period figures. Now what do you mean by this? Let us say if we are preparing financial statement for 2023, we also give figures of 2022. This is called as corresponding figure. This is called as corresponding figure. Now let us read through. A comparative information. So obviously this is comparative information, right? Because we are comparing the previous year, where amounts and other disclosures of the preceding period. So this is amounts and also the disclosure of the preceding period are included as a part of the current period financial statement and are intended to be read in relation to amounts and other disclosures relating to the current period. So you are going to read the figures of the previous year only in connection, only in relation to the amounts of this year, just because we want to compare both the years. These corresponding figures are not presented as complete financial statement capable of standing alone, but these are integral part of the current period financial statement intended to be read only in relation to the current period figures. This is called as a corresponding figure. Once again, what is a corresponding figure? Comparative information where amounts and other disclosure for the preceding period are included as a part of the current period financial statement and are intended to be read only in relation to the amounts and other disclosures relating to the current period. These corresponding figures are not presented as complete financial statement capable of standing alone, but are integral part of the current period financial statement intended to be read only in relation to the current period figures. This is called as corresponding figure. Next is what are comparative financial statement. See, comparative information where again amounts and other disclosures for the prior period are included for comparison with the financial statements of the current period, but if audited are referred to in the auditor's opinion. So, the basic difference between comparative financial statement and corresponding figure was what? So, if we are just giving previous year figures, this will be called as corresponding figures. But when we give our opinion on 2022 as well as 2023, this will be called as comparative financial statement. So, when my opinion is only and only on this year, then this will be called as corresponding figure. But if my opinion is on this year as well as the previous years, this will be called as comparative financial statement. Next, the level of information included in those comparative financial statement is comparable with that of the financial statement of current period. That is okay. But the main point of difference between both was in comparative financial statement, my opinion is on both the years. In corresponding figure, my opinion is only and only on this year's. Now, what is the auditor's responsibility under this particular standard? So, the auditor shall determine whether the financial statements include comparative information as required by AFRF and whether such information is appropriately classified. So, I just want to make sure, I just want evidence as an auditor that the corresponding figures or the comparative financial statement are as per the AFRF. For this, what will I do? Firstly, I will compare the information with the previous year. I will have to check whether the comparative information agrees with the amounts and disclosures presented in the prior period. So, what I will do is I will obtain audited financial statement of the previous year. See, there may be two circumstances. I may myself be the auditor in the previous year, or I was not the auditor. If I am myself the auditor, then no worries. But if I am not the auditor in the previous year, I will perform these procedures in accordance with 510. If you recollect SA 510, under 510 we said there was an answer called as PAM also. There was an answer called as PAM also. So, here this is nothing but P of PAM also, that I will obtain a financial statement of the preceding period and compare with that whether the opening balances are correct. So, here we are not talking only about opening balances, we are talking about all the comparative information. See, what is the difference between 510 and 710? 510 was a narrow standard. It used to focus only and only on the opening balances. So, for example, a few personal account may have opening balance, a few real account may have opening balance, but nominal accounts will never have a opening balance. But when we talk about comparative information, all the personal account, real account as well as nominal accounts will have comparative information. Hence, 710 is broader in concept. So, coming back to this particular point, I will obtain the audited financial statement of the previous year and compare whether the information agrees with the previous year or not. Also, I need to check whether the accounting policies are consistently applied. Whether the accounting policies reflected in the comparative information are consistently applied with those in the current period. If there have been changes, so firstly see whether they have been consistently applied, because a consistency is one of the fundamental assumptions of accounting. If you recollect, going concern, accrual and consistency. So, we need to check whether the accounting policies in the previous year and this year have been consistently applied. Only then you can compare this year's figures with the previous year figure. But does not mean you cannot change. There are certain circumstances where you can change your accounting policies. So, if there is a change in the accounting policy, whether those changes have been properly accounted, adequately presented and disclosed in the financial statement. So, we need to check whether they have been properly accounted, adequately presented and disclosed in the financial statement. So, once again, The auditor shall determine whether the financial statement include comparative information required by AFRF and whether such information is appropriately classified. For this purpose, the auditor shall evaluate the comparative information agrees with the amounts and other disclosures presented in the prior period. Secondly, the accounting policies reflected in the comparative information are consistent with those applied in the current period, or if there have been changes, whether the changes have been appropriately accounted, adequately presented and disclosed. Next, if the auditor becomes aware of possible material misstatement in comparative information while performing the audit of the current period figures. See, we are saying he becomes aware of possible material misstatement. What are we saying? If becomes aware of the possible material misstatement. So let us say I was performing my audit procedures. I was verifying the datas, the balances of datas are correct or incorrect. I asked Tokyo, are you supposed to pay 40 lakh rupees? Tokyo said no, I am supposed to pay 36 lakh rupees. I asked Nairobi, are you supposed to pay 60 lakh rupees? Nairobi told me no, 54 lakh rupees. I asked Helsinki, are you supposed to pay 80 lakhs? He said no, 72 lakhs. I asked Oslo, are you supposed to pay 1 crore? He said only 90 lakhs. So somewhere I realized that all the data in the previous year have been inflated by 10%. All the data in the previous year have been inflated by 10%. So I became aware of the possible material misstatement. I am still not sure. Then in this case, I will have to perform additional audit procedures. The auditor shall perform additional audit procedures as necessary in the circumstances to obtain a SI to determine whether such a material misstatement exists. So I will perform my procedures, additional procedures as necessary. In circumstance to circumstances, my procedure may vary. Now I want to evaluate. For example, in the example that I gave you, what I can do is I can obtain external confirmation. I can obtain ledger accounts from those party and compare with our. I can also obtain a GST returns to evaluate whether the sales and everything that they have recorded is correct or incorrect. So circumstances to circumstances, my procedure may vary, but I perform my additional procedures to obtain SI whether a material misstatement exists. See, here I said there is a possibility, there is a doubt that a material misstatement may exist. Now I need to perform procedures to obtain evidence that whether a material misstatement exists. But now let us say if I was the auditor in the previous year, let us say 2021-22 I was the auditor. Now I am auditing right now 22-23. Now while performing audit procedures of 22-23, I became aware of a possible misstatement in the previous year, that is 21-22. So for 21-22, this will be nothing but a subsequent event. If you recollect, what is a subsequent event? There were two things, that events occurring between the date of financial statement and date of audit report. What is the second thing? The second thing was events, the facts which have become known to the auditor after the date of auditor's report. So now this is the fact which become known to the auditor after the auditor's report, and hence this will be a subsequent event. So if I was the auditor in the previous year, I will also have to comply with the procedures of SA 560. So if the auditor had audited the prior period financial statement, the auditor shall also follow the relevant requirement of SA 560. Next, what I will do is I will obtain a written representation from the management for all the periods referred to in the auditor's opinion. So for example, if I have given opinion on 2022 and as well as 23, then I will obtain written representation not only for 23, I will obtain written representation for 22 as well. So for example, if we have 2019, 20, 21, 22 and 23. If I am giving my opinion on all these 5 years, I will obtain a written representation for all these 5 years. Not just this, if there is any prior period item, I hope everyone understands what is a prior period item. For that, I will ask a specific written representation from the management. So auditor shall obtain a specific written representation regarding prior period item that is separately disclosed in the current year statement of P&L. So once again, let us go through what are the auditor's responsibility. So auditor shall determine whether the financial statement include comparative information required by the AFRF and whether such information is appropriately classified for this purpose. Auditor shall evaluate whether comparative information agrees with the amounts and other disclosure presented in the prior period. I will have to check whether the accounting policies have been consistently applied. If there is a change in the accounting policy, whether those change has been appropriately accounted, presented and disclosed. If the auditor becomes aware of the possible material misstatement, then he will have to perform additional procedures as necessary in the circumstance to obtain a SI to determine whether a material misstatement exists. If the auditor had audited the prior period financial statement, the auditor shall follow the requirements of SA 560 as well. As required by SA 580, the auditor shall request written representation for all period referred to in the auditor's opinion. The auditor shall also obtain a specific written representation regarding the prior period item. So this was the auditor's procedure in case of comparative financial statement or comparative figures. Okay. So now moving ahead with the next discussion, that a previous year report may contain a qualification. What can a previous year report contain? A qualification. What do you mean by that? Let us say I was not the auditor in the previous year. The person who is the auditor in the previous year, let us say our Pushpa was the auditor in the previous year. Now, Pushpa gave a qualified opinion. What did Pushpa give? A qualified opinion in the previous year. So when the auditor reports on the prior period as previously issued included a modified opinion, and the matter giving rise to the modification is resolved, properly accounted for and disclosed in the financial statement according to AFRF. So firstly, the previous year auditor, that is Pushpa, gave a qualified opinion, that is a modified opinion. Secondly, they are saying the matter because of which, it was modified, has been resolved, properly accounted and disclosed. Let us take an example. We were the auditors of Vivo. In Vivo, they had a lot of advertisement. Let us say they spended almost 400 crores. So all 400 crores they expended, and for 400 crores of advertisement was debited to one single year. My friends, it should be treated as a deferred revenue expenditure. You cannot debit all 400 crores to one single year. You need to apportion in the next 5 years. So let us say 80 crores will be debited to this year. 320 crores should be treated as a deferred revenue expenditure. However, everything was debited to the P&L. So Pushpa qualified the opinion and said everything is not true and fair. Now later on, company also realized and they rectified the matter, that is they resolved the matter. So that particular matter has been appropriately resolved. It has been properly accounted and disclosed in the books of accounts. Then I, as an auditor of this year, I do not have to refer to that particular matter. So auditor's opinion on the current period need not refer to the modification. Do I need to refer to the modifications? No, not at all. Now, when the auditor report on a prior period as previously issued, again included a modified opinion. What did he include? A modified opinion. But this time a matter giving rise to the modification is unresolved. See, here we said it is resolved. Here we are saying it is unresolved. So again Pushpa said everything is not true and fair. 400 crores has been debited to the P&L account, whereas only 80 crores should be debited, 320 crores should have been treated as a deferred revenue expenditure. So he modified the opinion. The company has still not resolved the matter. Everything is still was debited in that year only. Company has not rectified the same. Then in this year, my friend, I will have to modify my opinion. So the misstatement does not relate to this year. The misstatement relates to the previous year. But my opinion is on the comparative financial statement. So I am giving opinion on 23. I am giving opinion on 22. So though the mistake is in 2022, but my opinion is on 23 as well as 22. So in that case, I will have to modify my opinion on this year as well. I will have to modify my opinion on this year as well. So had they resolved the matter, I would have not mentioned it. But if they have not resolved the matter, I will have to modify my opinion on this year as well. So once again, just briskly read through both the points. First point, what they said is when the auditor's report on the prior period as previously issued included a modified opinion, and the matter giving rise to the modification is resolved, properly accounted and disclosed in the financial statement to AFRF, the auditor's opinion on the current period need not refer to the modification. When the auditor's report on the prior period as previously issued included a modified opinion and a matter giving rise to the modification is unresolved, then in that case the auditor shall modify the auditor's opinion on the current period financial statement. This is where a previous report contains a qualification. Next, few important points of reporting. Now this particular point we have already discussed. When comparative financial statements are presented, the auditor shall refer to the each period for which the financial statement are presented and on which an auditor opinion is expressed. So for example, let us say when I am giving comparative financial statement, my opinion is not only on 2023, it is also on 22. So in short, we are trying to say that our opinion is on each period in which the financial statement has been presented. So we have already discussed this. Second, if the auditor obtains audit evidence. So when we say auditor obtains audit evidence, can I say that this is the case where the auditor has signed that a material misstatement exists in the prior period financial statement on which unmodified opinion has been previously issued. Once again, if the auditor obtains audit evidence that material misstatement exists in the prior period financial statement on which unmodified opinion has been previously issued, then in that case the auditor shall verify. In that case the auditor shall verify whether the misstatement has been dealt with as required under the AFRF. So all we need to do is we need to verify whether the misstatement has been dealt with. Once again, if the auditor obtains audit evidence that material misstatement exists in the prior period financial statement on which unmodified opinion was previously issued. So the previous year's auditor was again Pushpa. He gave an unmodified opinion. So he said everything is true and fair. But while performing the audit procedures of this year, I came across certain misstatements in the prior period. So what I will do is I will go to the management and I will ask the management to deal with the same. I will ask them to rectify this mistake. If the management has rectified their mistake, very good. If it has been appropriately dealt as per the AFRF, no problem. If that is not the case, so that is if the management has not given the effect, they have not rectified, then in that case the auditor may have to give a qualified opinion or adverse opinion. See, this is the case where the auditor has say, because what we said, the auditor obtains audit evidence. So this is a case where auditor has say. If the matter is material but not pervasive, we will give a qualified opinion. If the matter is material and pervasive, we will give an adverse opinion. So if the auditor obtains audit evidence that material misstatement exists in the prior period financial statement on which unmodified opinion has been previously issued, the auditor shall verify whether such misstatement has been dealt with as required under the AFRF. And if that is not the case, the auditor shall express a qualified opinion or an adverse opinion in the auditor's report on the current period financial statement. So this is if we obtain a SI when unmodified opinion was given in the previous year. Now, if the financial statement for the prior period were audited by the predecessor auditor, so we were not audited in the prior year. So if we had not audited in the prior period, then in that case, if it is permitted by law and regulation, we can mention the same in other matter paragraph. My friends, if you recollect your other matter paragraph, we can give as per SA 706 other matter paragraph in 3 cases: whenever it affects audit, whenever it affects auditor's responsibility, or whenever it affects auditor's report. Now, this is affecting my auditor's responsibility. This is affecting my auditor's responsibility. Why? Because I was not the auditor in the previous year, someone else was the auditor. So whenever it is audited by a predecessor auditor, what I can do is, I can state in the other matter paragraph that the financial statement for the prior period were audited by a predecessor auditor. That is, I was not the auditor in the previous year. I will also give what is the type of opinion given by that particular auditor. So type of opinion expressed by the predecessor auditor. If the opinion was modified, the reasons therefore. So why the previous year report was modified? For example, if the previous year auditor said everything is true and fair, then we need not give any reasons. Just because we have say everything is true and fair, why do we need a reason for that? We will have to give the reasons only if we think everything is not true and fair. Also, I will give the date of that particular report. So once again, if the financial statement for the prior period were audited by a predecessor auditor, that is, I was not the auditor, then I can state the same in other matter paragraph, because whenever it relates to the audit, auditor's responsibility or audit report, then in that case the financial statement for the prior period were audited. I can state in the other matter para that the financial statement for the prior period were audited by the predecessor, the type of opinion expressed by the predecessor, and if the opinion was modified, the reasons therefore. Also, I will have to give the date of that particular report. Next, if the prior period financial statements were not audited, if the prior period financial statements were not audited, then in that case the auditor shall state in other matter paragraph. So if again, see here point number 3 we said it was audited by a predecessor auditor, but there is a chance that they were not audited. If you recollect SA 510, there are two circumstances: if they were audited by a predecessor auditor or not audited at all. So if the prior period financial statements were not audited, the auditor shall state in the other matter paragraph. So auditor shall state in which matter paragraph? Other matter paragraph in the auditor's report that the corresponding figures are unaudited. See again other matter paragraph, because whenever it affects my audit, auditor's responsibility or my report, I can give in other matter paragraph. Again this is affecting my auditor's responsibility because prior period financial statements were not audited. So I can state that same in the other matter paragraph. But it does not mean that I am relieved of all of my responsibilities. So even if I state in the other matter paragraph that they were not audited, I will still have to apply my procedures of SA 510. So what they are saying is such a statement does not relieve the auditor of the requirement to obtain SI that opening balance do not contain misstatement. So just to give a clarity, I mean just to inform the users, I can say that I was not the auditor of the previous year does not mean by that one single disclosure I am done with. I will have to perform audit procedures and obtain audit evidence regarding the opening balances as per SA 510. So these are the 4 points of reporting. Once again, let us go through the 4 points. When comparative financial statements are presented, the auditor's opinion shall refer to each period for which financial statements are presented on in which auditor's opinion is expressed. So it will be for each period. Second, if I have obtained audit evidence that a material misstatement exists in the prior period on which unmodified opinion has been previously issued, the auditor shall verify the misstatement has been dealt with as required under the AFRF. Second, if this is not the case, the auditor shall express a qualified opinion or an adverse opinion in the auditor's report on the current period financial statement. If the financial statement for the prior period were audited by the predecessor auditor, the auditor is permitted by law and regulation, then I can state the same in other matter paragraph, and I will state that it was audited by the predecessor. Type of opinion, if he has given everything is true and fair, nothing else is to be given, but if he has given a modified report, I will also have to give the reasons why and the date of that particular report. If the prior period financial statements were not audited at all, again I can state the same in another matter paragraph, but this does not mean that I am relieved of my responsibility to obtain SI regarding the opening balances. So this was a very small standard. With this we are done with SA 710. But before we move ahead any further, let us go through the question bank of 710 and then move ahead to SA 720. So very basic question. Auditor's responsibility in respect of corresponding figures. So we will have to write the whole responsibility here. Second, the audit report of P Limited for the year 18-19 contained a qualification regarding non-provision of doubtful debts. As the statutory provision of the company for the year 19-20, how would you report if the company does not make provision of the doubtful debts or the company makes adequate provision? So see, previous year's report contained a qualification. So that is previous year report was modified. So let us say Pushpa gave a modified report in the previous year. Now the company does not make the provision When we say company does not make the provision, in short the matter is not resolved yet, or the company makes the provision, that is the matter is resolved. So if the matter is resolved, I need not refer to the previous year's previous year's report. I need not modify my report on this year. But if the matter is still not resolved, I will have to modify my opinion on this year as well, and I need to refer the previous year figures. So this was question number 2. Let us go through the last question. It was observed from modified audit report of the financial statement of AS Limited for the year 31st of March that depreciation of 2.5 crores for the year 18-19 had been charged off to the P&L instead of in the carrying value. State in relation to the audit report for the year 2020 whether such modification in the previous year would have any implication on the current year. If yes, how would you deal? So now again the answer will be the same that we discussed in question 2. Now we will have to see whether the matter is resolved or whether the matter is not resolved. If the matter is resolved, we need not refer to the previous year modification. But however, if the matter is still not resolved, then I will have to modify my opinion on current period financial statement as well, because the corresponding figure contains a misstatement which is still not resolved. With this, we are done with our essay 710. So let us see you in the next video where we move ahead with our discussion of 720. So moving ahead with essay 720, the auditor's responsibility relating to other information. So last standard of the essay 700 series. Now what is this standard talking about? What are the objectives? To consider whether there is a material inconsistency between the other information and the financial statement and other information and the auditor's knowledge obtained in the audit. So firstly, obviously you will have to understand what exactly is other information. So let us understand what is other information, and only then you will be able to understand the objective. But let us read through this. So first objective is to check whether there are any material inconsistency between other information and financial statement, other information and auditor's knowledge obtained in the audit. Second, to respond appropriately when the auditor identifies such material inconsistency to appear, or otherwise auditor becomes aware of the other information to be materially misstatement, to report in accordance with this essay. So obviously, like I said, you will not understand what exactly I am trying to say in this till the time you understand what is other information. So financial or non-financial information other than the financial statement and auditor's report included in the annual report. So let us do one thing. Firstly, let me take you through the annual report and explain you what exactly is other information, and only then let us move ahead with this. Okay. So let us see the annual report of HDFC. This is the older annual report of 2021 of HDFC Bank. Now, everything that is included in the annual report apart from the financial statement and audit report is nothing but other information. So for example, they have given you the balance sheet size. Let us say 17,46,871 crores is the balance sheet size. What is the total number of gross profit? Total deposit. What is the gross non-performing assets? What are the total banking outlets? What is their CSR? Then here they have given us what is the growth in advances, what are the CSR benefits, employee strength is 1,20,000, net margin is how much, return on capital is how much, their net profit is 31,116.5 crores. So what they have given here is the total, lot of other information as compared to the financial statement and audit report. So all the information here apart from financial statement and audit report will be considered as other information. Now this standard focuses on what if this information is incorrect. For example, a lot of users may go through this figures only because financial statement and audit report would get very monotonous. So such colorful pictures, bar diagrams, charts and things like that, a lot of people may go through this only. They may not open the financial statement. Now what if financial statement does not have a misstatement, but it is the other information, that is this information in the annual report is incorrect? Because a lot of people may just see this. They must see this is the net profit, and based on this net profit they'll take a decision. What if this net profit is incorrectly stated? Because our opinion is on the financial statement. Our opinion is never on the other information. and hence ICAI came up with a standard SS 720 where we apply procedures on this as well, and if there is something wrong in this other information, if there is some misstatement in the other information, we take action based on the same. So this is other information. Let us go back to the standard that we are discussing. So now I hope everyone has understood what is other information. So let us again understand the objective. To consider whether there is any material inconsistency between other information and a financial statement. Secondly, there is a material inconsistency between the other information and the auditor's knowledge. So if, let us say, as per the financial statement, the profit, let us say, has been shown as 45,000 crores, but whereas the profit was not 45,000 crores. So this is other information and financial statement has inconsistency. Let us say number of branches which they showed was different. Let us say the number of branches that other information annual report shows is different, and as per the auditor's knowledge the number of branches is different. So this does not relate to the financial statement. See, when I talk about net profit, it is financial statement. When I talk about the total amount of deposit, it is financial statement. But when I talk about number of branches, it is not included in the financial statement. Hence, that is nothing but auditor's knowledge obtained in the audit. So if there is any material inconsistency between the other information and financial statement and other information and the auditor's knowledge. So for the first time we are going to discuss about other information. So far my opinion is concerned only and only on the financial statement and not on the annual report or other information. But this essay deals with what is our responsibility in regards to that particular other information. Now what is a misstatement? So you basically know what is a misstatement. We have been doing that since our basic concepts, that is the first lecture of standards in auditing. But still, misstatement here you will have to just reconsider it once. A misstatement of the other information exists when the other information is incorrectly stated or otherwise misleading, including because it omits or obscures information necessary for a proper understanding of a matter disclosed in the information. So either it is incorrectly stated or otherwise it is misleading, that is the information that we have put in the annual report is not correct, is called as a misstatement. So this is important concepts, that is other information and misstatement. Before we move ahead with the standard, let us go through the examples of amounts or other items that may be included in the other information. And for your information, my friends, ICI has asked this question in the examination. They have not asked any question based on the audit procedure. They have just asked you the examples of the other information. So examples of amounts or other items that may be included in the other information. So what can be included? Let us consider the amounts and then we will consider other items or information. Firstly, items of summary, in a summary of key financial results. Now this is other information, this is not financial statement. Selected operating data. Special items such as asset disposition, litigation, provision, assets impairment, liquidity, capital, just resource information, capital expenditure by segment division, amount involved in guarantees, contractual obligation, legal or environmental claims and other contingencies, financial measures or ratios. So these are nothing but the amounts. Next, there are few other items. Explanation of critical accounting estimates and related assumptions, identification of related parties and description of the transaction with them. Next, articulation of the entity's policies or approach to manage commodity foreign exchange or interest rate risk. Description of the nature of a balance sheet arrangement. My friends, these are not part of the financial statement. Next, description of the guarantees, indemnification, contractual obligation, litigations or environment liability cases and other contingencies. Description of changes in the legal or the regulatory requirement. Management's qualitative assessment of the impact of new financial reporting standards, descriptions of the business environment and outlook, overview of the strategy. Next is description of trends in market prices of key commodity or raw material, contracts of supply, demand and regulatory circumstances between the geographic regions, explanation of the specific factors influencing the entity's profitability in the specific segment. So these are the various other items. Now what they have given is on which they have asked a question as well. Other information does not comprise of what? See, other information does not comprise of PIC's hold. Now, what is PIC's hold? Other information does not comprise the product responsibility report. It does not include separate industry or the regulatory reports. It does not include the CSR report, the sustainability report. So, this is about the separate industry and the regulatory reports. Then it does not include the diversity and the equal opportunity report, labor and working conditions report, human rights reports and other legal regulatory framework. So, P is product responsibility, I is separate industry or regulatory report, C is CSR, S is sustainability report, H is human rights report, O is other regulatory filings with the government agencies, L is labor practices and working conditions, and lastly D is diversity and equal opportunities report. So, these are the information which does not comprise of the other information. Now, finally moving ahead with our heart of this particular standard, what are the audit procedures? What exactly are we supposed to do? So far Institute has not asked question based on this. Somewhere I am expecting that Institute may sometime soon frame a question based on this. So, firstly, the auditor shall determine through discussion with the management which document comprises the audit annual report and entity's planned manner and timing of issuance of such documents. So, all I got an understanding is which documents are going to be part of that annual report and when are we going to issue those documents. So, this was our point number 1. Point number 2. The auditor shall make appropriate arrangements with the management to obtain in a timely manner and if possible prior to the date of the auditor's report the final versions of the document comprising the annual report. So, firstly I discuss with the management, I obtain an understanding which documents are going to be the part of the annual report and when are you going to issue those documents. Then I will try to ask the management to provide with me all those documents before the final annual report has been issued. So, before the audit report I give, you please give me all the above documents. Secondly, so this was point number 2. Firstly, I understood which are the documents included in the annual report. Then I will request the management that if possible prior to the date of the audit reports, please give me the final version of those documents. But honestly, this may not be possible because the day when you give your audit report, all such documents may not be available. So, what you will ask is, when some or all of the documents determined in A above will not be available until after the date of auditor's report. So, what they are trying to say is till the day when you sign your audit report, if above documents are available, very good. But if the above documents are not available, I will request the management to provide a written representation that the final version of the documents will be provided to the auditor when available. So, firstly I will get it and prior to its issuance by the entity such that the auditor can complete the procedures required by this essay. So, see, in the above point we told them that if it is possible you please give all these documents prior to the date of auditor's report. But we understand that this may not be possible, so we are giving our audit report, but you give a written representation that you give it to us in writing that you will provide the final version of this document before you issue these documents to the others, so that I can apply my procedures as contained in SA 720. So, this was point number 3. Point number 4, to consider whether there is a material inconsistency between other information and financial statement, other information and the auditor's knowledge obtained in the audit. So, we have understood this in the definition of misstatement. For example, let us say the net profit given by the other information is something different, net profit given by the financial statement is something different. So, here there is a material inconsistency or material misstatement. The number of branches as the auditor knows, I mean as per the auditor's knowledge is different. The number of branches mentioned in that particular other information is different. So, then there is going to be a material inconsistency. If the auditor identifies a material inconsistency, see if everything is good, if there is no material inconsistency, then I need not perform any other procedures as per SA 720. My procedures will move ahead only when I find a material inconsistency. So, if the auditor becomes aware of the material inconsistency to exist or becomes aware of the other information appear to be materially misstated, the auditor shall discuss the matter with the management and if necessary perform other procedures to conclude. A material misstatement of the other information exists. So, I will have to perform my audit procedures and conclude whether the misstatement is in other information or whether the misstatement is in the financial statement or whether the auditor needs to update his understanding of the entity and its environment. So, for example, let us say the net profit as per the financial statement was 31,000 crores. They reflected it as 42,000 crores. So, there is a misstatement in the other information, there is no misstatement in the financial statement. Other way around, other information reflected as 42,000, financial statement reflected as 31,000. Now, this time the misstatement is in the financial statement, for example. So, the material misstatement may be in other information or financial statement. Let us say number of branches as per the other information was 5,608. But however, as per the auditor's knowledge, we were only aware about 5,500 branches. So, then in that case, there is two possibility, either the other information is incorrect or auditor was not aware of all the branches. So, either the other information is incorrect or auditor needs to update the his understanding of the entity and its environment. So, 5 points we saw so far. Firstly, I will discuss with the management and understand what are the documents that comprise the annual report and when are they going to issue those documents. I will request the management that if possible you issue those documents prior to the date of the auditor's report. Third, when some or all of the documents determined will not be available until after the date of auditor's report. So, if they are not going to be available, then I will ask them to give us to us in writing that you will provide to us the final version before you issue it to the others from the entity. Then we need to consider whether there is any material inconsistency between the other information and financial statement, other information and the auditor's knowledge obtained in the audit. If I conclude that yes, there is a material inconsistency, then we will have to perform procedures to conclude whether material inconsistency is in other information, whether it is in financial statement or we need to understanding of the entity in its environment. Next, if the auditor concludes that material misstatement of other information exists, the auditor shall request the management to correct other information. So, see, if there is a material misstatement in the financial statement, we will talk of, then we will have to modify the opinion. This SS 720 is dealing only with what? If there is a misstatement in other information. So, point number 6, what are they saying? If the auditor concludes that a material misstatement of other information exists, the auditor will request the management to correct the other information. Now, if the management agrees to make the correction, the auditor shall determine whether the correction has been made. So, we requested them, see, as per you the number of branches are something else and actual number of branches are something else. You please rectify that particular data. So, if the management agrees, I will not blindly trust them. I will have to evaluate whether they have actually made those corrections. Secondly, if they refuse to make the correction, then auditor will obviously go to those charged with governance and request them that please make the correction, because whenever the management does not listen to us, we will go to those charged with governance. Point number 7. If the auditor concludes that material misstatement exists in the other information obtained prior to the date of auditor's report, the other information is not corrected after communicating with those charged with governance, the auditor shall take appropriate action. So, what they are saying is, if the material misstatement exists, if the auditor concludes, see, when we say concludes, that we have evidence that a material misstatement exists in other information obtained prior to the date of auditor's report. Let me take you back to the first point. So, here we said, if possible, you give us prior to the date of auditor's report. So, we have not issued the audit report and we became aware that there is some material misstatement in the other information. Then in that case, consider the following. Consider the implication of the auditor's report and communicating those charged with governance about the auditor's plan to address material misstatement in the auditor's report. So, I may have to consider what will be my impact on the auditor's report and I will also communicate the same to the those charged with governance. Also, wherever possible, wherever the law and regulation does not prohibit, I may also consider whether withdrawing is the correct opinion, the correct thing, because what they are doing is basically nothing but fraud. So, I may have to withdraw also from here. So, this was point number 7. Point number 8. If the auditor concludes, see, there were two situations we saw. We may get this before we give the auditor's report. So, in that case, we still had option to consider the implication on the report. But now there is also a chance that we may receive that after the auditor's report. Then in that case, what will we do? If the other information is corrected, perform procedures necessary in the circumstances. Very good. If it is corrected, very good. However, if it is not corrected, after communicating with those charged governance, take appropriate action considering the legal rights and obligation to have seek the uncorrected misstatements appropriately brought to the attention of the users from whom the auditor's report is prepared. So, if the auditor concludes that material misstatement exists in other information obtained after the date of auditor's report, if it is corrected, very good. If it is not corrected, I will inform those charged with governance and I will take appropriate action. That is, I will have to understand what are my legal rights and obligation. I may have to seek a legal opinion on the matter and understand what are my legal rights and obligation. Point number 9. The auditor shall include a separate section with the heading other information or other appropriate heading when the date of the auditor's report for an audit of financial statement of a listed entity, the entity has obtained or expects to obtain the other information. So, whenever we are auditor of listed entity, we will always have to mention a paragraph on the other information. Or for an entity of financial statement of an unlisted corporate entity, the auditor has some or all of the other information. So, wherever the company is preparing an annual report, to have a basic conclusion on this, whenever a company is preparing an annual report, whether you are a listed company or whether you are not a listed company, you will mention all this in the other information paragraph in your auditor's report. Last, when the auditor's report is required to include other information, what will this section include? First, a statement that management is responsible for other information. So, whenever I am giving other information, I will firstly state that it is not the auditor, it is management who is responsible for this other information. Secondly, identification of other information if obtained prior to the date of the auditor's report, and for an audit of financial statement of entity of other information, if any, expected to be obtained after the date of auditor's report. So, I am just having an identification of which are the documents that are going to be included in the other information, whether it is prior to the audit report or after the audit report. Third, a statement that the opinion does not cover other information and accordingly the auditor does not express or will not express an opinion on any form on the assurance conclusions thereon. So, our opinion is only and only on the financial statement. Auditor is not giving and he cannot give any opinion on the other information. So, firstly we said management is responsible. Second, we are identifying other information if any obtained prior to the date of auditor's report or other information that we have obtained after the date of auditor's report. Next, a statement that the auditor's opinion does not cover the other information and accordingly the auditor does not express or will not express an opinion or any form of assurance conclusions thereon. Next, a description of the auditor's responsibility relating to the reading, considering, reporting on other information as required by this essay. So, in the first point we say management is responsible, but we will also say what is auditor's responsibility in accordance with essay 720. And lastly, we will state that when other information has been obtained prior to the date of auditor's report, a statement that auditor has nothing to report. So, if we have received it prior to the audit report, if everything is correct, then we need to mention it that auditor has nothing to report, or if the auditor has concluded that there is an uncorrected material misstatement of the other information, a statement describes the uncorrected material misstatement. So, if I believe everything is correct, I need to specify there is nothing to report, but however there is an uncorrected misstatement, I will also have to specify there that there is an uncorrected misstatement in the other information. So these are the 10 different procedures. Let me take you to all the different 10 points together. Firstly, what we did in step number 1 is we will discuss with the management what comprises the annual report and what is the plan, manner and timing of issuance of such documents. Also, I will ask them, if possible, give me all those documents prior to the date of auditor's report. But that may not always be possible. So if it is after the auditor's report, I will ask them to give me a written representation. That final version will be given to me before it is issued to the others. Then I need to see whether there is a material inconsistency between other information and financial statement and other information and the auditor's knowledge obtained in the audit. Next, if the auditor identifies that a material inconsistency appeared to exist, the auditor shall discuss the matter with the management and if necessary perform procedures to conclude whether other misstatement is in other information, misstatement is in financial statement, or the auditor understands of the entity and its environment needs to be updated. If the auditor concludes that a material misstatement of the other information exists, the auditor shall request the management to correct the information. If the management agrees to correct the information, determine whether the correction has been made. But however, if they refuse, then I may have to go and inform the matter to those charged with governance to make it corrected. Point number 7, they said, if the auditor concludes that a material misstatement exists prior to the obtaining the giving the report, then I will have to consider the implication on the auditor's report, and wherever possible I may also consider whether withdrawing is an appropriate option. Now when it is after the date of the auditor's report and if it is corrected, then nothing is to be done, but if it is not corrected and I have also communicated with those charged with governance, I will take appropriate action. I will also consider what are my legal rights and obligation in this particular matter. Next, if the auditor's report includes a separate section, that is other information, when do I have to include it? Whenever they have met the annual report, whether you are listed or whether you are unlisted. If you are preparing annual report, you will include a separate para other information. What will you include in the other information section? That management is responsible for this. Then if it is obtained prior to the auditor's report and whether it is going to be obtained after the auditor's report. Next, a statement that we are not expressing any opinion on this particular matter. Next, a description of the auditor's responsibility. And lastly, when the other information has been obtained prior to the date of auditor's report, a statement that the auditor has nothing to report, or let us say if there is an uncorrected misstatement, then we will have to report that there is an uncorrected misstatement in the other information. With this, we are done with essay 720 as well. Let us go through the question of this 720. LMP and Associate, Chartered Accountant. The auditor of PQR is a listed company for the year 31st of March 19. Is concerned with the auditor's responsibility relating to the other information, both financial and non-financial, included in the company's annual report. While considering other information, LMP considers whether there is material inconsistency between the other information and financial statement. As a basis for the consideration, the auditor shall evaluate the consistency, compare selected amounts or the other items in the information and such amount or other amounts in the financial statement. Guide LMP and Associates with the examples of amounts and other items that may be included. This is the first question, my friends. They are not asking you any procedures, they are just asking you examples of the amounts or other items that may be included in other information as per 720. With this, we are done with our discussion of essay 720 as well. And not just that, my friends, we are done with the whole discussion of SA 700 series. So we have done SA 700 with a format of everything is true and fair. We did key audit matter, we did modifications to the auditor's opinion, we did 706 emphasis of matter, other matter paragraph, we talked about corresponding figure and comparative financial statement, and lastly what we covered here is SA 720. With this, we are done with 700 series as well.